Good morning, everybody. Good morning, Rachel.
Good morning. How's it going?
Good. It's a little bit of a pollen-y mess in South Carolina. It's allergy season here. So I apologize in advance if I start sneezing during this show. it, if you've never lived in the southeastern United States, you might not know, but the pollening is a little bit worse than everywhere else in the country. It almost looks like it's snowing yellow snow outside some of these days.
Oh,
Your car,
wow.
your car has a layer of pollen that you have to scrape off before you can even see out your window. It's something I never dealt with growing up in New Jersey, and it was definitely some culture shock when I moved down here.
Wow.
But so that's going on right now. So imagine clumps of pollen in the air and how it might affect your allergy.
Just floating through the air as you
Yeah.
walk around. Yeah.
Yeah, today looks like it's going to be that hazy day. We always get one day where it's like you can barely see. So it looks like that's today. But yeah, if anyone listening lives in the Southeast, they definitely know what I'm talking about, and it's going on right now. But today it is the pre-morning show. It is Tuesday. We're going to talk about today's market news, and really, we kind of mean yesterday's market news because the day just started. So these are some of the headlines. I'm going to put my slide up on the screen real quick, and there we go. You should see it any second. So there are a few stories we're following. And I was really, really glad Rachel brought this first one to my attention. Like I saw the thing and just kind of like waved it off because it's one of those investments I wish I could forget. But 23andMe
We all have those.
Right. 23andMe filed for bankruptcy. So they were one of, and I'll just kind of give you some background just because I know from investing in them. They were one of the products of the SPAC boom I believe 2021 is when they went public. They were taken public by a SPAC that was sponsored by Richard Branson, the Virgin Group, and it went public at initially a $3.5 billion valuation. It was worth up to a $6 billion company at one point, and for good reason. During COVID, the stimulus checks really helped out the genetic testing business. People had you were sitting at home, wanted to see what their genetics were. But I learned some lessons from this. But before we get in, Rachel, what are your thoughts on this bankruptcy and kind of what it means?
Yeah, this has been an interesting one to follow. I never owned shares of this business, but it's one that I've been following the last few years through kind of the ups and downs, if you will. And they've been having a difficult time up until this point. One of the biggest issues they've dealt with the last few years is the fallout from the data breach that happened in 2023. They had a situation where hackers accessed personal information from about 7 million customer accounts. And shortly thereafter, there was more pressure on the stock. Obviously, they quickly worked to address those issues from the breach. But that caused major consumer as well as investor drops in confidence. There was also the resignation of the entire board of directors, and the CEO at the time. And she had proposed to take the company private, and her lack of real clear plan for the future and the company led to a really major rift in the board, which had ultimately led to that resignation. And that data breach, as well as their ongoing financial struggles, had really raised concerns about the security and privacy of customers' data. And they had been working to, try to turn some of their financial woes around, but without much success. And the company was founded almost 20 years ago. They became popular for quite a while of time with millions of users. And they were, of course, dealing as well with the financial fallout from the class action settlement from the data breach, which, of course, was not a surprising subsequent development from that kind of a massive breach. But I think there's also been concerns. I've been seeing news stories about what's going to happen to some of the information stored by 23andMe once they go through their bankruptcy filing. They've said that they are going to maintain the consumer protection of their data that they had been enacting all of this time. But there's obviously concerns that if there was a bankruptcy or sale, depending on the structure of that type of a transaction, that their data could go to a new company, be sold off in bankruptcy. There's under their current privacy rules, they wait for a valid subpoena, search warrant, or court order before sharing data with law enforcement. So it would be interesting to see what that looks like in terms of if their policies were to change, if they're actually sold off, if they're transferred over to a new company as part of bankruptcy proceedings. What does that look like? In terms of the actual filing, they did file for, Chapter 11 bankruptcy protection. And I believe that was just on, what would that have been? Yeah, Sunday night. Yeah, it was Sunday night. They filed in a Missouri federal court. Now, Chapter 11 bankruptcy is a reorganization bankruptcy. So it's designed to give struggling businesses a chance to reorganize their finances and debts rather than liquidating assets. And the idea is that the debtor proposes a plan to creditors how debts will be repaid over time. This plan must be approved by the court and by creditors. And during the Chapter 11 process, the company remains in control of its assets and operations, but under the oversight of the bankruptcy court. And also in filing for Chapter 11, that triggers an automatic stay, which means that creditors are temporarily prevented from taking action to collect debts. So I mentioned the structure of the bankruptcy because I've been seeing a lot of news stories about concerns over how the data would transition. And I think it's worth noting, this is a restructuring bankruptcy at this point. This is, not a liquidation bankruptcy. Washseki has resigned from her role as a CEO effective immediately, although she will remain a member of the board. She had written on X shortly after they filed, "We've had many successes. I equally take accountability for the challenges we have today. There's no doubt that the challenges faced by 23andMe through an evolving business model have been real, but my belief in the company and its future is unwavering." And as Matt had mentioned a little bit with the history, so that was founded back in 2006. They really rocketed into the mainstream with their DNA testing kits, went public in 2021 via merger by SPAC, and were valued around $3.5 billion at the time. They have a market cap now of less than 20 million. Last March, 23andMe's independent directors, they had formed a special committee to really evaluate how the company might move going forward. Anne had submitted multiple proposals, Washseki, to take the company private. Those were all rejected. And then they had unanimously determined to reject whatever proposal she had entered earlier this month. So if, they decide to sell assets through a Chapter 11 plan, and that's approved by the court, they will actively solicit qualified bids over a 45-day process. She said that Washseki said she plans to pursue the company as an independent bidder. In her post on Monday, 23andMe has between 100 million and 500 million in estimated assets, as well as 100 million or up to 500 million in estimated liabilities, according to their bankruptcy filing. There have been, consumer alerts that we've seen issued. For example, the California Attorney General issued a consumer alert urging residents to consider deleting their genetic data from 23andMe's website. So there's a lot going on here with this company. The things are still very fluid. As I mentioned, they're going under Chapter 11 at this point. Understanding what the trajectory of that will look like for this particular business is going to take time. Traditionally speaking, Chapter 11 provides, again, for reorganization to keep the business alive and pay creditors over time. It does not discharge all debts. This is the route they're taking now. We'll see in terms of what this type of bidding process that's been alluded to on some of their, assets looks like. As mentioned, former CEO Anne Washseki says she plans to pursue the company as an independent bidder. So who knows what this is going to evolve into? But it is certainly quite a interesting and somewhat sad end for a business that I think had tremendous potential that a lot of people used as, in consumers. Plenty of people in my family have used their services over the years, but also looking at it as an investor, it's been quite a turbulent few years, and I don't think I would have anticipated that it would come to this. But I have a feeling there will be more updates about the business in the coming weeks and months.
Yeah, I mean, and it's also worth pointing out that Anne Wojcicki is the co-founder, so this is like her baby, so that's why she's so intent on taking it private and keeping it.
Right.
So a couple of thoughts. The real reason I wanted this to be like kind of our headline thing is because of the investing lessons I learned from it, and kind of what it taught me and what went wrong. So, I mean, one of the things that attracted me to the business was that they have more genetic information than pretty much every other company out there. At the time they went public, they had genetic information on roughly 12 million people. That's increased since then. The nearest competitor had 1 million. So it was a big, big lead with genetic material. And the real problem, and the reason they were kind of hemorrhaging money, just kind of for context, this business was doing about 300 million in revenue per year and was losing about $200 million. So really terrible numbers there. You can't really stay in business for long when you started with about $500 million on your balance sheet. You're losing about 200 million a year. Do the math. I'm surprised they made it this long. The problem wasn't the genetic kits. They weren't making a ton of money on those, but the problem was they wanted to leverage that genetic material to develop drugs, and were spending hundreds of millions of dollars a year to develop genetic therapies that weren't making them any money. So the big lesson I learned from this, and it's one that I've said several times on these shows, is that a good product does not always make a great business. There are a few other examples of this I could point out, but this is a great example of, I mean, I think we can all agree that 23andMe's genetic testing kits were a revolutionary product. It's a fantastic product. But to make it work as a business, they were going to need to take it to the next level and develop pharmaceuticals, because, selling a few million genetic tests a year and making a very slim margin on them isn't going to justify the $3.5 billion valuation they went public with. So it was trying to get to that next level that was really the end for them. Like I said, I'm surprised they made it this long. They were losing money kind of hand over fist and never really, a lot of other SPACs jumped into the market and were losing hundreds of millions of dollars a year by design, that were growing revenue at like 50, 60% a year and are now breaking even. Like SoFi is a good example of that. That's now profitable. They were willing to lose money at first. But this one never really kind of gained any traction profitability wise, never showed a clear path to profitability, which is why, I mean, even before the bankruptcy, this was down to a $50 million valuation. They had already done a 20-for-1 reverse split to keep their stock price over $1, which they initially went public at $10. So this was, if you split on a split adjusted basis, this was down about over 99%. From its initial share price. So, all right, we'll move on from 23andMe. And I know, Rachel, you follow this one. I am not that familiar with all the weight loss drugs going around. Pharmaceuticals are generally, obviously, from 23andMe, are an area I'm not very good at investing in.
Well, no, there's a difference there, Matt. I wouldn't hold that against you.
Big difference.
I won't hold that against you. We've all had those.
And Novo Nordisk, Novo Nordisk, Eli Lilly, they're totally different animals than 23andMe, right?
Yeah, very much so.
So what just happened with Wegovy?
So Novo Nordisk, this has been kind of interesting. We've seen this from them as well as from Eli Lilly, sort of working to get ahead of the lower cost competition in the GLP-1 drug space, which I think is kind of ingenious, actually. So Novo Nordisk, there was an article I found on Fierce Pharma talking about how they are working to expand what was already launched, their discounted Wegovy program. They had launched a cheaper option earlier this month through their own NovoCare pharmacy, and they've said that they had wanted to expand to more traditional retail channels in the near future. And then they just launched a new offering where all eligible cash-paying customers can access Wegovy at $499 per month. And now all cash-paying patients can purchase any Wegovy injection doses, which could be anywhere from 0.25 milligrams to 2.4 milligrams, at their local pharmacies for $499 and access a 28-day supply. That is a further cut from Novo's previous policy that allowed self-pay Wegovy patients to access the drug at a cost of $650 per month. Now, it's worth noting that patients that are enrolled in government-funded healthcare programs are not eligible for this offer, and many patients with insurance that cover Wegovy may pay as little as $0 to $25 a month out of pocket for the drug, according to Novo Nordisk. But obviously, there are patients that fall into gap areas of coverage there, right? There are some insurance companies that still do not cover these drugs, or do maybe not cover them adequately to serve patient needs. This is an interesting evolution we're seeing from some of these pharmaceutical companies. Eli Lilly also had launched their own, direct-to-consumer platform not so long ago called Lilly Direct, and it's designed to simplify the patient experience, offering online pharmacy solutions and virtual care for conditions like obesity, migraines, diabetes, allowing patients to order specific medications directly through the platform at a lower cost. As is true with Novo Nordisk, Eli Lilly's direct-to-consumer platform also allows access to its GLP-1 drugs like Zepbound. And that's something that is a really newer phenomenon that we're seeing. A month ago or so, Eli Lilly had unveiled it was the cost of about $499 to access its GLP-1 Zepbound through its Lilly Direct self-pay pharmacy solutions. So Novo Nordisk has come in at the same cost. And then since then, Eli Lilly has also been offering Zepbound 2.5 milligram doses at $349 per month, or $499 per month for the 5 milligram, 7.5 milligram, and 10 milligram doses for self-pay patients. So now that we're seeing this expansion from Novo, it's sort of these two major players in this space battling it out. There also is the reality that these companies have been dealing with an environment where there have been very small enterprises and larger ones selling copycat versions of their GLP-1 meds. We saw a reality up until, I think, about a month ago when the FDA issued its update that because there was a global shortage of GLP-1, the main active ingredient, semaglutide, which is the main active ingredient in Novo Nordisk's GLP-1 drugs, that allowed compounding pharmacies to make essentially duplicates of their drugs. Now that shortage is no longer in place, companies are no longer allowed to make drugs that way. However, there are legal exceptions, which companies like Hims & Hers Health are taking advantage of. For example, there's something called the 503A exception. And that's where small operations can legally keep mixing compounded GLP-1s outside of a shortage if they have adjusted that version in a way that makes a, quote, significant difference for the patient. So maybe switching a dose, adding or removing an ingredient for medical reasons. It's essentially an exception that allows for compounding when a significant medical need for a specific patient necessitates a customized formulation that's not commercially available, and not as a way to, it's not designed to be a way to produce essentially a copy of an approved drug, but it does provide some areas and wiggle room for some of these companies to run, which is why we've seen comments from management at companies like Hims & Hers Health talking about how they are going to, continue to produce within the legal bounds that they are allowed, even though they're no longer going to be compounding in the way that they were under the provisions of the shortage. So it's a really interesting dynamic we're in, looking at how Novo Nordisk and Eli Lilly are responding in this time. I think it's fascinating to me. I think it's very smart that they're both offering their own discounted versions of their GLP-1 drugs. I mean, obviously there are companies making very safe, compounded versions like we saw Hims & Hers Health doing in these recent months. But there are also scammers that have arisen in the age of GLP-1 that are selling sometimes safety dubious versions of GLP-1. And one of the things that's interesting about these moves by Novo Nordisk and Eli Lilly is they're, I think, working to get ahead of the curve a bit, so to speak. They understand that this is a highly competitive environment. While they are sort of the biggest and most dominant players in this space right now, smaller players are continuing to work on, disruptive GLP-1 medications. Now, again, there are room for multiple successful players to eat up market share. but it's something that's worth noting, and creating their own platforms where these are these massive pharmaceutical companies, and they're creating their own platforms where individual consumers can go and access much more cost-effective versions, not still, not cheap maybe for some consumers, but still much more cost-effective than some of these would be if they were to be paid directly out of pocket, and to give them the opportunity to access those formulations at a per month cost, I think is something that's really notable, and shows them also working to get ahead of not just smaller GLP-1 players, but some of these other telehealth-centric businesses that might be threatening their market share in the future. Eli Lilly's Lilly Direct platform, for example, they're selling a range of drugs direct to consumers, not just GLP-1s on there. So it's interesting to consider. It's certainly an evolution that you're seeing in this space. I mean, the idea of these big pharma companies having their own direct-to-consumer platforms where they're selling their versions of their own blockbuster drugs is really kind of fascinating to see. And we've also seen statements from the FDA. For example, they released a statement last week laying out concerns over unapproved versions of Wegovy and Zepbound because of the lack of oversight for safety, effectiveness, and quality. There was a note subsequently from Citi analysts saying that really further closes the door on compounders. A lot going on here, very much a reality that while there are other players in the space and there are new entrants to the space and a lot of promising drugs in clinical trials in the GLP-1 market, Eli Lilly and Novo Nordisk sort of reign supreme right now. And I think the expansion of sort of their own retail pharmacies in the case of Novo Nordisk, and then Eli Lilly's direct-to-consumer platform is sort of the next iteration of how these pharma companies are recognizing what the competitive landscape is going to look like.
I was muted.
You're good.
It seems like kind of a really interesting environment right now, especially with all the unapproved alternatives, like you said. I don't know about you. I wouldn't inject an unapproved medication into my body. So I feel like the price cuts. At one, I don't think this is going to be the last one. I like you used the word evolution, which is a perfect word to use there, because I do think this is going to continue to evolve. And the cheaper it gets, the fewer people will go for those unapproved alternatives. This is still a pretty expensive medication. It's $4.99. It's per month, correct?
Yeah, it would be $4.99 per month for a certain dosage. Yes.
Yeah, so that's $6,000 a year. It's not like going to Walgreens to buy a bottle of Tylenol.
No.
But
No.
but it's definitely more affordable. Mike, our behind the glass, just pointed out that the list price of Wegovy without insurance is approximately $1,350 a month.
Yeah.
Which is in the ballpark of 17,000 a year, just off the top of my head. So it's a significant cut.
Sure.
So let me see. I wanted to get to the Google News, and then we'll take some questions because I see them coming in. Get your questions in, by the way. Slido.com event code is Fool24. I see some questions building up. I see some good questions on bank stocks. I see a question on a 3D printed house that looks really interesting. We'll get to those in just a second. So I am not that familiar with Wiz, the company being acquired by Google for $32 billion. And you can talk about that in just a second. But why that is really interesting to me is the deal itself is that, one, it shows that these big tech companies are spending money on something other than AI infrastructure and like building out data centers and things like that, because CapEx is a big concern among investors in the big tech companies. So they're finding ways to kind of bolt on acquisitions to their business instead of just buying data centers and chips and things like that. So that's one thing that's encouraging. And two, I think this is a lot of not just this news, but what we've been seeing lately has a lot of implications for M&A and IPOs and things like that. Another news item that didn't make the list was that one of my favorite companies, StubHub, just announced that it is going public. StubHub's only been in a private company for a couple of years. They've been around for a while, but they were part of eBay until 2020. They were valued at, let me see, $4 billion. in 2020. A company called Viagogo bought. They were a rival ticket reseller. They bought StubHub from eBay in 2020 for $4 billion. eBay bought StubHub in 2007 for $310 million. So that was a solid investment for eBay. But StubHub is targeting a $16.5 billion valuation in its IPO filing. So that's roughly a 4x in 4 years, 5 years, which is impressive because in 2020 valuations were kind of elevated for these kind of companies. So it's showing that good businesses are getting good, big, high valuations again. I mean, StubHub's bigger than it was in 2020, but not by that much. So it's very promising for the IPO market in general. I have my wish list of companies that I would love to see go public. We can go down that rabbit hole all you want, but there are a lot of. I'm sure you have some too that you would love to see go public. But StubHub is the biggest one I've heard announced in quite a while. It's not just in terms of dollar amount, but in terms of the anticipation that people wanted it to go public. I put this. It's kind of like on par with like a DraftKings when they went public on how much attention it's getting. So, I mean, do you agree with that, or what do you think of the Wiz acquisition?
I think it's interesting. We're seeing maybe like this very gradual turn in both, I think, the IPO and M&A markets that we have been sort of looking at. Is this going to shift for a while? Because it's been a very sluggish time there. But yeah, Google's $32 billion acquisition of Wiz, that could be a very different environment that we're starting to see. Now, this is the thing, they have tried to acquire them before. There was conversation of them acquiring Wiz. Let me try to remember exactly when that was. I think was it last year? And then that did not go through. I'm trying to remember exactly.
It was last year for a $23 billion offer.
Yeah, that was it. And now we're at a $32 billion offer. So this would be the biggest deal in the company's history. Wiz is a cloud security platform, right? So it scans and analyzes cloud environments to identify and prioritize risks. It enables organizations to secure their cloud infrastructure and applications before deployment and during runtime. It provides a really comprehensive view of a customer's cloud environment, including things like code and cloud resources and services. It has also what's known as a cloud native runtime defense, which helps detect and block ongoing attacks in the cloud. There's obviously been, with the proliferation of artificial intelligence, the transition to the cloud. This has really amplified the need for cybersecurity solutions. So this acquisition does make sense. This is also, again, after that initial $23 billion offer fell through last year. And at the time, the CEO of Wiz had then talked about the company maybe actually going public. And so now we're back to a dynamic where Google or Alphabet is talking about acquiring Wiz, and for a roughly $9 billion premium above what we had been discussing last year. So it's interesting. I mean, if this deal goes through, could this be the beginning of more M&A activity in the coming months and the next couple years? That would be interesting. I think that they are paying, potentially a very, very steep valuation for this company if indeed the deal goes through. I mean, we've seen different estimations of Wiz's valuation through the years. It still seems like a bit of a premium, even though this is a really interesting business. And I do think it would have a very valuable role to play within the broader, Alphabet ecosystem. But it is the largest acquisition in Alphabet's, 26-year history. They have made numerous acquisitions through the years, including that $12.5 billion takeover of Motorola Mobility in 2012. So that would be a very, very expensive purchase, hopefully one that would also pay off in a much more meaningful way than that other one that I alluded to. I do think that there are a lot of ways in which this would, make sense for their business, and especially the pivot that they've made towards AI. But you also think about okay, Alphabet has been facing numerous issues from a regulatory standpoint related to antitrust and concerns about having a monopoly. Would this deal in any way be caught up in some of that? Is something that I think some people are wondering and watching. The Wiz deal is certainly going to get a look from antitrust regulators. So that's one element to consider in terms of whether this is actually going to go through. But I think it's an interesting deal. I think we've seen also that there have been more and more kind of adept hacking schemes since the rise and sort of proliferation of AI. And that's something that has created a dynamic where companies do really need to beef up their cybersecurity. And so in that way, I think this acquisition of Wiz makes a lot of sense if it gets past, regulatory muster. And I think there's still a bit of a question mark about that. But you also wonder, how is that going to impact potentially the IPO market? Because again, after that first deal with Wiz fell through, Wiz was talking about going public. If they are indeed bought out by Alphabet, is that going to potentially, dampen some of the spirits in the IPO market? So there's a lot to look at here. I think it's interesting. It's what I'm watching. The StubHub IPO you mentioned, that's interesting because we saw Klarna that filed their IPO prospectus. I've had some questions about CoreWeave, which has planning its very shortcoming IPO. That'll be happening quite soon. StubHub now is filed. I am surprised by the number of companies that are looking to go public right now. I will say that. I think it's a little bit of an interesting time to enter the public markets. Obviously, these things are planned quite a long ways in advance. But it is fascinating. And I will say it is exciting to talk about some of these companies that'll be entering the public markets. One of the biggest ones that has happened in the last couple of years is Reddit. So I'd be very curious to see how some of these businesses perform. Obviously IPO stocks can be quite volatile, at least in those early periods of time. And there's a lot in terms of the business, that I need to look into further as it relates to StubHub. But kind of fascinating time to be in the market right now. There's a lot going on there.
Yeah, so I want to go ahead and hit some questions. Thank you for that. That was a really good, that was better than my discussion. So I'll go ahead and take the first question. Matt asked about Wells Fargo, which is really a fascinating case. It says, Wells Fargo stock been in purgatory for years. I remember you sold it the past fall. So I would push back against the case that the stock has been in purgatory for years. But let's rewind. I don't know. I'm sure, Rachel, you're familiar with the Wells Fargo fake account scandal that happened. Can you believe it's been almost 10 years since that happened?
Wow.
That happened in 2016. So it's almost 10 years. It happened before that, but it was revealed in 2016. And for those not familiar, because not everyone listening was an investor 9 years ago, Wells Fargo until 2016 was thought of as the best of the big four banks. They were like what JP Morgan Chase is today in terms of like the public's opinion on them. They were considered, extremely trustworthy. They had great asset quality. And one thing they used to brag about in their investor materials is their ability to cross-sell products to their customers. At the time, the average banking customer had roughly 4 products with their same bank, like a checking account, a savings account, a mortgage, a credit card, what have you. The average Wells Fargo customer had about 6, and no one could figure out how they were doing it. Everyone thought that they were just really, really good at creating products people wanted and selling them to other people. It turns out that wasn't the case. Their employees were being incentivized essentially to not only pressure customers into opening accounts they didn't need, but to open accounts on customers' behalf without telling them. The thought was in some cases it was relatively harmless and like, let me open a savings account with 2 cents in it for this customer. They don't have to know about it. It's just going to be sitting there. But there were like, credit cards being opened illegally. There were other things they were creating auto insurance accounts where people didn't need it. I got one of the letters at the time. My auto loan was with Wells Fargo. I got a note saying I didn't have insurance and they were going to automatically start charging me for insurance. And they gave me some like ridiculous time frame, like 5 days to get my insurance information uploaded into their system, which thankfully I did because I watched my mail very closely. and they ended up paying some stiff penalties in the billions of dollars for this when it was revealed. Their CEO left. They had to completely overhaul their culture. So because of that, the biggest fallout from that wasn't just that they had to pay, I think it was a $3 billion fine for the main scandal. There were a bunch of mini scandals that were revealed. Warren Buffett had a great quote about it. There's never just one cockroach in the kitchen. That that once something comes to light, people start taking a closer look.
Oh,
Um,
that's good.
so it turned out that their culture was really, really flawed, to put it nicely. And there was the insurance scandal that I mentioned. There were a few other ones. You can look at, if you Google Wells Fargo scandal timeline, it takes up more than a page with all the things that were revealed after the fact. So they had to pay a lot of monetary penalties, but banks were used to paying monetary penalties. After the financial crisis, banks paid billions of dollars in monetary penalties. That wasn't the big issue. The big issue is that the Federal Reserve slapped an unprecedented penalty on Wells Fargo and said that they were not allowed to grow. This went into effect in, I want to say 2019, somewhere around that time, but it was during what was argued, it was the first Trump administration. And it was arguably during the best growth environment for banks that there had been in decades. And that penalty is still in place today. Wells Fargo is not allowed to grow beyond where it was at the end of 2018 or 2019. And it's kind of been stuck. Other banks have have been growing their loan portfolio, growing their business. Wells Fargo hasn't been allowed to. So the company, in a way, has been stuck in purgatory. Is kind of the long way of or the short way of saying all that. But the stock has actually performed kind of well because it turns out just to kind of give you the number, I'm looking at a 5-year chart of Wells Fargo. So back to 2020, the Wells Fargo stock is up by 157% since that time. That's about 25 percentage points greater than the S&P 500. So they've actually beaten the market. So it's not fair to say that the stock has been stuck in purgatory, but the business definitely has. The stock has done well for a few reasons. Number one, management's done a great job of overhauling the culture, the new management team. And it turns out not as many people left Wells Fargo as over these scandals as you would think. Switching a bank's a pain, especially in cases like in Wells Fargo when the average customer had 6 different products with the bank. And, I don't want to move my checking account, savings account, my mortgage, my auto, refinance my mortgage, move my auto loan. Even right now, it would be a real pain. Wells Fargo is not my main bank, but it would be a really real pain to discontinue my relationship with them. My auto loan, I just paid it off, but it was with Wells Fargo. My mortgage is with Wells Fargo and has probably 22 years left on it. And I don't want to refinance my 3% mortgage right now. I just don't want to do it. It would really be a big, it would negatively affect my financial life to switch from Wells Fargo right now. And that was the case for a lot of people. So we didn't see a ton of switching, not to the extent that you might expect. So not only have they done a great job of restoring trust, but it seems that customers have largely moved on from the scandals, and the stock has done really well. Most bank stocks haven't done that great recently. Or in the 2022-2023 timeframe, there was of course all the banking crisis that we saw in mid 2023. Interest rates rose, and it increased deposit costs on banks. There's a lot of consumer spending uncertainty right now. That's been weighing on banks. People think default rates are going to rise and things like that. But you're correct. I did sell the stock. The question did say that. I did get rid of the stock, but I do like the company. For me, it was more that I just had too much banking exposure after that 150-something% rally that I mentioned. So that was a long-winded way of saying that Wells Fargo stock's doing well, but the business, that FDIC penalty or the Federal Reserve penalty is still in place. Hopefully it will be lifted soon. They keep saying that they anticipate it being lifted. The latest is they anticipate it by the end of this year. I'm not holding my breath, but that's my thoughts on Wells Fargo. Rachel, you see one?
Yes. T-Stock was saying thoughts on 23andMe being acquired by a big pharma. Lots of genetic data there. I can share my thoughts on that. So I think it's also worth talking a little bit more on kind of what their plan is. So like I mentioned, they voluntarily filed for Chapter 11 in the state of Missouri. That is a form of reorganization. It allows a company to continue operating while it develops a plan to restructure its debts and potentially become profitable. But a company in Chapter 11 bankruptcy can be acquired through something that's known as a Section 363 sale. And that means that a company in Chapter 11 may sell its assets or the entire company through that process. Section 363 sale, it's a bankruptcy auction process that requires court approval. That is the route that they are seeking. They noted in their announcement of the bankruptcy the other day that they are, quote, seeking authorization from the court to commence a process to sell substantially all of their assets through a Chapter 11 plan or pursuant to Section 363 of the U.S. Bankruptcy Code. If approved by the court, the company, with the assistance of an independent investment banker, would actively solicit qualified bids over a 45-day process. If multiple qualified bids are submitted during the court-supervised sale process, the company plans to conduct an auction to maximize the value of its assets. And that is, again, what we were mentioning earlier, where Am Washiki, is planning to be an independent bidder, as she also was a integral founder in the company. I could absolutely see a pharmaceutical company or some other major healthcare enterprise having interest in this. I mean, this is a company that is highly in distress right now, but their fundamental underlying product and the data that they have could be something that would be really valuable to a potential buyer. Now, in their bankruptcy announcement, 23andMe had said that any buyer of its assets would be required to observe applicable privacy laws for customer data. And again, if you're a user of 23andMe, you have to explicitly affirm that the company can share your data, although obviously people's data could be included as part of a sale of the company. And then some states have passed privacy laws that require a person's consent before their genetic data is transferred from one entity to another. 23andMe does allow customers to delete their accounts. There's a lot going on here. I think it's interesting to entertain how Washiki could be a potential buyer of the business. She resigned as CEO, saying on X so that she could be in the best position to pursue the company as an independent bidder. So that's going to be interesting to watch. But you could see how the platform of 23andMe could be incorporated into a much larger enterprise and be sort of a valuable asset to a business over the long run. I think we're going to have to really wait and see. Are some of its assets going to be sold to different buyers, to one buyer? There's a lot of questions, right now. And I think that there has been a lot of different scenarios that consumers as well as investors are entertaining, trying to understand exactly what would happen to some of that data and how that would work. And obviously, there are a lot of, privacy concerns involved that I think some consumers are worried about. And it says, at the front end, when you create an account and you submit your data to 23andMe, they ask you for your consent to use your data for research purposes. There's been data that's shown that about 80% of consumers give consent when asked to check that box with 23andMe. And those consumer agreements also have privacy statements that say that U.S. customers have certain rights. So the right to opt out of, for example, storage of their saliva samples, the right to request deletion of their account. The company does have the right to share personal information once receiving the consent of the customer with service providers and contractors for sample analysis, marketing, and analytics. Also, under the privacy statement terms, the company has the right to transfer customers' personal information in the event of a sale or bankruptcy. And customers can't protect their data from being accessed, sold, or transferred as part of that transaction. All goes back to the fine print of what we sign with some of these things. But the reality of that also means that in the event of a sale, there is a wealth of data that could be transferred over to a potential new owner. It doesn't mean that they would, that it would be a free-for-all, that data would no longer be safe, but it does mean that it could be transferred over in the event of a sale. So does that mean the new owner is, Ann Washiki? That remains to be seen. I can't imagine that there aren't a few different major healthcare enterprises that are interested in this business right now. But we'll have to see what that looks like in the coming weeks.
Yeah, there might be some interest, but if you think, you mentioned there are some transfer concerns, but even if, let's say, half of the people who are in 23andMe's database opt out of having their stuff transferred or delete their accounts, that's still like 6 or 7 million people. That's a great genetic library.
Right.
But on the other hand, 23andMe did partner with a major pharmaceutical, GlaxoSmithKline. It was a 50-50 partnership for drug development, and
Yes.
it wasn't a terribly successful one. So I question how much value is in, I mentioned their closest competitor had about 1 million people's genetic material. Is it really a big value difference between having 1 million and 7 million people's genetic material? I don't know. Um, but at the other hand, you can essentially get it for free right now. They estimate that 23andMe's assets and liabilities are almost equal at this point. So if you make a reasonable offer for the company, I mean, you could get this for nothing. So
Yeah.
I wouldn't be shocked.
Yeah. I
But
wouldn't
yeah.
be shocked either. I'll be curious to see. Maybe we'll have an update on some show in the near future.
So another one from Q Room. I apologize if I said your handle incorrectly. Can I have your thoughts on Bank of America? I've had it for years, but I'm thinking of switching over to Goldman Sachs. You're bringing up some old stuff for me. First we had the Wells Fargo scandal, which is one of the first things I covered at the Fool. And now Bank of America is the longest running stock that's in my portfolio. It is. I bought it in 2012 in the wake of the financial crisis, and I still own it today. It's the one that's been in my portfolio continuously for over 13 years now, and it's done well. Yeah, obviously I bought it when it was very very down in the beginning of the financial crisis. It's done very well since then, but I the question also I mentioned, would you switch to Goldman Sachs right now? I like Bank of America and I like Goldman Sachs, which I don't own anymore, but I have in the past. I like them for different reasons. Bank of America generally, I think, is going to be the biggest beneficiary of a rising rate environment, or I'm sorry, a falling rate environment. Right now, Bank of America and all the big banks, they're well known for, you'll hear your friends say, "I'm not opening a savings account with Bank of America because they pay 0.01% or something to that effect," or same with Wells Fargo and all the other big ones. But what you don't realize is their deposit cost on corporate deposits and government deposits and things like that is actually substantial. So as rates rose, the cost they had on deposits increased significantly on an overall basis because personal deposits are only like half of their deposit base. And meanwhile, the interest rates they were getting from their loan portfolio, which is things like mortgages, didn't really rise accordingly, at least on an aggregate basis. So interest rate margins have compressed over the past couple of years. The short version is that I think when rates start to fall or continue to fall, I should say, we're going to see deposit costs come down further and interest margins tick upward in the big banks. Goldman Sachs killed their consumer business a couple of years ago, which is why I got out of the stock, honestly, which in retrospect was a mistake, but I just thought it was a big failure on their part. They don't have the same falling rate tailwind, I guess I would say, as the other big banks. But on the other hand, Goldman Sachs is set up to do much better when things are going poorly in the markets. I mean, the 2008 2009 period was one of Goldman's most profitable times ever. As the market got really really volatile in the financial crisis, when every other bank in the world was losing money, Goldman Sachs was profitable. The same in the pandemic days when the market got volatile. There was that initial COVID crash. People were worried about all these companies going bankrupt. Goldman Sachs was making money hand over fist. I want to say 2021 broke that record they set during the financial crisis as their most profitable year ever. So very, very profitable business, especially in bad times. There are certain aspects of their business that do terribly in bad environments, like M&A and IPO advisory, like we were talking about. The whole reason that Google is spending money on Wiz and StubHub wants to go public is that the market's generally doing well, the economy is doing well, there's appetite for risk. But when that's not the case and the market gets volatile, like we saw in 2020 or 2008, Goldman's trading revenue goes through the roof. Trading volumes go up on both the fixed income and the equity side. There's different kinds of advisory business like bankruptcy advisory and restructuring advisory that do better during those times. So my short version is Goldman is a business that figures out how to make money no matter what. They always figure out how to make money. Whereas Bank of America, it's much more of a cyclical bank, in my opinion, in terms of being vulnerable to recessions. You can see, default rates rise and being vulnerable to interest rate headwinds. But out of the two, I love Bank of America right now. I think they're going to be a big winner over the falling rate cycle. I think their CEO has done a great job of leading the business into the technological era. Bank of America was very proactive at things like closing drive-throughs that weren't being used very often and consolidating branches. None of the Bank of America branches near me have an active drive-through. You walk into the branch and there's a lot of like AI assistants and things like that. A lot of people don't realize Bank of America actually won best mobile banking app for the past few years. Because their function out, they've invested a lot in technology, and I think they're going to be kind of a sneaky fintech play in a way. So I am a big Bank of America fan, especially if you can get the stock on weakness because of tariff concerns or anything like that. But Bank of America is still my biggest bank investment. It's the longest running stock in my portfolio, and to me, it's one of my best examples of you buy your stock and you don't do anything as long as the company continues on it to do, and they're doing what I want them to do. So I'm gonna keep that one, but nothing against Goldman.
There was an interesting question that had come in actually yesterday about a company that I wasn't as familiar with, but wanted to look up. And this is fun sometimes on these shows. I'll learn about a company a little bit in real time. But Besties was asking, does anyone know or can comment on Bluebird, the school bus maker, ticker BLBD? What are your expectations for the next 5 years? Is it a good value now? So I'll offer some thoughts on it with the caveat that this is one I'm just digging into. This is not a business I am super familiar with, nor an industry that I have historically invested in. But it is a company that I took some time to read about and get to know a bit. This is a business that goes back to the 1920s. They've been around for a very long time. The company has evolved significantly through the years. At one point just being under the control of the family that founded it, and then being under the control of institutional investors, and eventually going public, I think about 10 years ago, actually only, even though the company's been around for about 100 years. Back in the day when they were first founded, they were known for the wooden frame school buses. But nowadays, what Bluebird Core does is they focus on low and zero emission buses, like electric and propane buses. And that's what they're in the business of designing, engineering, and manufacturing. They are known for type C and D models of school buses, and they also manufacture specialty buses. But they're a leader in low and zero emission school buses. But a significant portion of their sales still come from propane, natural gas, electric powered buses as well. They're seeing significant growth in their EV buses, which is kind of interesting. A notable increase in orders and deliveries there. And they have been continuing to report really record revenue growth as well as profits. It's still a relatively small enterprise. However, their primary customers are school districts, school bus operators, and their core business is really on designing, engineering, manufacturing, and selling these vehicles. They're known for their all-American bus model, which is the longest running bus model line, and then other models that share design elements with that. They primarily sell their vehicles through their US and Canadian dealer network to school districts. They've partnered with a company called Generate Capital to offer fleet electrification as a service, including financing, charging, infrastructure, and maintenance services. It's kind of fascinating to see. I have not encountered many businesses like this in my, stock investigation journey. The business itself, they have a market cap of about 1.1 billion, trade for a price to earnings multiple of about 11 at this point. The stock itself is just about $35 a share. Shares are down a bit over the last year, although the stock is up about more than 200% over the trailing 5-year period, which I thought was very interesting. Looking at their recent results, again, just to kind of give an idea of sales, they had revenue of about $314 million. That was down slightly from a year ago, but they did significantly increase their net income from $2.6 million a year ago to about $28.7 million in this most recent fiscal period. And this was their first quarter of their fiscal 2025. The CEO at the time of the results said market demand remains strong. We have 4,400 units in our order backlog as of the end of the first quarter. Unit sales were about the same as last year. Revenue was down again slightly. That was partly driven by their product mix. They said 94% of our first quarter unit sales mix comprised of internal combustion engine buses. And this demonstrates the strong earnings power of our base business. They said we also saw strong growth in EV orders from both the EPA's Clean School Bus program as well as state and local level programs. And as of today, we have approximately 1,000 EV buses either sold or in our firm order backlog. They reaffirmed their full year financial guidance for adjusted EBITDA of about $200 million this year with a 14% margin. That would be a full year record for Bluebird. They are also targeting adjusted free cash flow, 40 to 60 million, net revenue between 1.4 and 1.5 billion. So kind of an interesting business. They, I think based on what I was looking through, have struggled with profitability through the years, just given the fundamentals of operating this type of a business. I believe they are still, reporting, negative free cash flow under GAAP. And that's something that they are working to improve. So there's some fundamentals there that make me a bit hesitant with this particular company. I do think the valuation is not bad, even considering the fact that they are, kind of struggling with consistent profitability. They are improving a lot on those metrics. It's one I'd have to take a much closer look at before I could determine whether I would want to take a position. But those are just some thoughts on the business itself.
Yeah, I know Bluebird fairly well. I'm a big EV believer. They're kind of a sneaky EV play, I would call it.
Yeah,
It's really rare to find a successful, long established, like they've been around for a long time, long
right.
established automaker with a net cash position.
Yeah.
On their balance sheet, they have 128 million in cash, only about 90 million in debt, so they have positive net cash. Revenue, the last quarter or whatever aside, they've actually grown pretty significantly over the past few years. And there's a lot of room to modernize the bus fleet in this country. I did
Right.
a search while you were talking. There are 490,000 school buses in the United States. Only 5,000 of them are electric.
Oh, there you
Um,
go.
yeah, my kids, right before we got on this call, my kids got picked up by a big old clunky diesel bus. That's what the majority of them are. So before we get out of here, I want to get this question from David here because I promised I'd address this on a previous show. Short on time, Matt, but what are your thoughts on rocket companies after the Redfin buyout? The short answer is I kind of would have preferred Redfin to stay as a standalone business, but I get it. And I liked Rocket before this deal. Rocket is the number one mortgage lender in the United States by a significant margin. And right now, and not Rocket's one of their big specialties is refinancing. No one's refinancing right now. Even with the depressed market environment, with 7% mortgage rates, fewer people are buying houses. There's very little existing home inventory. There's no one's refinancing, as I mentioned. They still did about $100 billion of mortgage volume last year. That could multiply several times over if interest rates start to fall and people actually start to tap into their home equity. Right now, the U.S. homeowners are sitting on about $35 trillion of home equity. That's the highest amount ever. And no one's really using it right now. People are, Home Depot, we covered on a show recently, Rachel, and they said that a lot of people are delaying big projects specifically because of high interest rates and they don't want to tap into their home equity. So I think Rocket has a lot of tailwinds. I kind of like that this takes care of some of my least favorite parts of Redfin's business, specifically their debt load, their profitability concerns, their stock-based compensation as a percent of their market cap. There's a lot of positives to this deal. companies, especially Zillow, have been trying to create an all-in-one real estate platform for years and haven't been able to do it organically. So this is a good way to kind of jumpstart that and really, I mean, Zillow and Redfin have both been trying to break into the mortgage market in a significant way for a long time and haven't been able to do it yet. So this really kind of creates a big mortgage lender, a big brokerage all in one that should have a lot of synergies going forward. I haven't sold any of my Redfin shares yet. I don't plan on doing it. I do need to dig into Rocket just a little bit more before I make that call, but it's an all stock transaction and there's still a bunch of hoops to jump through before it will actually go through. So I'm keeping an eye on the situation and doing some digging, and I will have a more thorough report on Rocket when it gets closer. All right.
We're at the end of our hour.
It's 9 o'clock. I felt like it went really quick.
I know. It flew by. Super fun.
Yeah, and we have the actual morning show. This was the morning pre-show. We have the actual morning show getting ready to start. I see Sanmeet, I see Tim, I see Thomas just going clockwise on my screen. So good morning, everybody, and we will turn it over to you. Thanks, Rachel. It's been a great time.
Hey, good morning. Thanks, Matt and Rachel. Good morning, fools. Welcome to the morning show. It is Tuesday, March 25th, and I'm here with Tim Beyers and Thomas King. Hope you all are doing well. And how are you guys?
Very good.
Good, man.
You. Good.
Getting some coffee. Very early. Dark 30 for Tom out on the West Coast.
Yeah, very early for both of you, huh?
Well, earlier
7 o'clock,
for him.
6 o'clock?
So
7 for you, Tim, and 6 for you, Tom?
Yes.
Yeah, 6 for me.
Yeah,
Yep.
Wow. Well, we have a lot of stuff to cover. We were chit-chatting to figure out what we want to talk about, and it turns out we have quite a bit we could talk about. So I guess we'll start off right away with all this tariff confusion. Yesterday the markets did pretty well because there was some talk that some of the tariffs were going to be kind of dialed back a little bit or delayed, and now there's some reports of tariffs on auto imports and pharmaceutical products in the coming days. I haven't checked. Last I checked, the futures were up a little bit this morning. I think they were down earlier and they're up. They're probably bouncing all over the place. But what's happening? What do we make of all this? What do we? How do long-term investors kind of keep steady in this tariff storm?
I mean, you had posted something about how retailers are responding, Sanmeet, and I think we'll get to that. I'll tell you what I think is most worrying from this perspective. So from a macro perspective, I'm a fundamental investor. I don't like to do a lot of macro predicting, but the thing that is worrying me that I think can cause real damage potentially, I'm not going to forecast that it will or it won't, but because it's new, is this idea of a punitive tariff that's sort of a second order tariff. For example, something that is apparently being considered. I saw this reported on Bloomberg. I don't know if this is going to happen or not, but this would worry me. The United States inflicting a tariff if, let's say, a trading partner of ours buys oil from Venezuela. That's new. That is tariff as weapon. And I have some concerns about that, because if we're going to start doing that to sort of implement foreign policy, instead of like using the tariff to try to stabilize a market, using it as a foreign policy weapon, that's different. And it creates a level of potential economic impact. Yeah, I just I don't particularly love that, because I think it just creates a new level of risk that we haven't seen. So that's what I'm on the lookout for here. I hope that is a lot of arm waving and doesn't actually end up being something. But when I see it on Bloomberg, I start to get nervous.
Yeah, I mean, using the tariffs as a weapon, or weaponizing tariffs, I guess, could cause, a lot of issues. I mean, I was pulling up the Wall Street Journal this morning like I usually do, and one of the big headlines was trade war explodes across the world at pace not seen in decades. So proliferating tariffs engulfing U.S., China.
That's not a great headline.
Yeah, and their partners draw parallels to 1930s protectionist spiral. That subheadline was even worse because I'm like thinking, all right, 1930s. What happened in the 1930s exactly? Was something happened? Something happened, right? I mean,
Yeah,
it wasn't good. That's what I know. But I mean, yeah, I mean, it makes sense, right? Like I've always thought, I don't think about economics too much, broadly speaking, but I've always thought free trade, global trade amongst friendly countries, allies, partners can help the global economy. It helps your individual economy, but it helps the global economy. But now starting to put up tariffs starts putting up these barriers and restrictions, and one country will tariff the other, and they'll retaliate, and they'll just keep going back and forth, where basically everyone's like, well, what are we going to do? Are we all just going to produce our own goods and manufacture everything on our own and not rely on anybody for anything? I don't know how possible that is, because, I mean, the United States has plenty of resources of its own. Other countries do not. It probably strangles a lot of the really small countries with a lack of resources. But then again, inflation has always been, like, for a long time, has been a worry, and it's just starting to come down. You start imposing, if we have to do everything in-house at home, it's going to cost more.
Yeah.
Tom, what do you got? What do you think?
I mean, I was just thinking about the future. I think that, and I think this is fairly well established by now, that the Trump administration thrives on that uncertainty and shock factor. That sort of, they use that pretty effectively to get what they want. And I would suspect that for the time being, I don't know how long, this is probably unlikely to change. This threat of tariffs, now we remove the tariffs. If we get what we want, now we bring the tariffs back, and that sort of thing. So, I won't, I've got no predictions for the future, except that I suspect it'll continue to be uncertain and choppy and, sort of all over the place. So we'll see. Yeah.
I would just super quickly here, Sanmeet, the thing that I'm watching is how far does, like, the reason I'm being very specific about the secondary tariffs, where you use, it's new to use a tariff as a weapon. So, like, Mike was asking us here in the private chat, like, is it fair to compare the tariffs to, like, sanctions, for example? I would have said up until today, Mike, those things are not even remotely related. They're not the same thing. Sanctions and tariffs are not even remotely related, and we shouldn't conflate them. Except if secondary tariffs come into play, then they are still different, but they have a somewhat related effect of, like, hey, if you don't get in line and meet our, foreign policy objective or an agreement that we have between our two countries, we're going to slap this on you. And so it's just, that makes it different. I didn't expect tariffs to become part of the foreign policy conversation. That's what's new and changes the dynamics here a bit. But so that's for me. There's a great comment here, because I do believe in market resilience, and what was it here? It was Husker Sooner. And glad you're watching for the first time. I feel the market will get past the tariff tantrum in time. The market has seen worse. That is true. And so I do think you are right to have a sense of at least long-term optimism. I do think that's right. And so I feel like I have not lost my sense of long-term market optimism, but I am watching to see how much ground we push here, Sanmeet, in terms of going new, where we take tariffs from an economic tool to a foreign policy tool. That's just something that I'm gonna watch, because I think it's when you get into new territory like that, the opportunity for unintended consequences goes up.
Yeah. Yeah. And again, just a reminder, fools, we make no political statements or commentary
Right,
here.
yeah.
It's all economic, really, because these are economic consequences. These are economic situations. And that's really what we're commenting on, whether, what, like, the reality is tariffs. The reality is confusion over tariffs, the unpredictability of when and what tariffs are coming or going and being reduced or not. It's going to cause the market to be in a little bit of a haywire. A market does not like certain uncertainty, and there's a lot of uncertainty when it comes to that. And that, on a bigger macroeconomic picture, kind of filters down to all these other things and companies, which kind of relates to the article I saw today that I sent to you guys that I'll share here too with in the Slido. But the headline in the Wall Street Journal: retailers bulk up inventories to blunt tariff impact. So a real consequence of these tariffs is that many retailers, Costco, Williams Sonoma, a whole handful of other ones that they listed in here, are basically kind of pulling forward inventory purchases in anticipation of tariffs. And a lot of these inventory levels that some of these retailers in the most recent quarter have risen higher than their sales. So that tends to be a concern when retailers have faster inventory growth versus sales growth, because that means they're not selling the inventory as fast as maybe they should. The inventory turnover isn't fast. So what happens is, all right, great, they're gonna maybe buy a bunch of this stuff right now, save on tariffs in the future, not knowing exactly what tariffs they may even have to pay, which is great. But if consumer demand slows down, people don't buy these things, which is slowly, sentiment is starting to weaken. What do they do with all this stuff? Well, they either sit on it, or they discount it to try to get rid of it so they can get new stuff to sell, or they sell it off to, like, you might have like your discounters like TJ Maxx and or others, dollar stores or whatever, to kind of get rid of that inventory. But the problem is they paid a certain amount for these goods. If they have to discount them, then they're losing money on this stuff. So it becomes a real problem, and it can become a real problem for these companies that I don't know exactly the magnitude of how much stuff and how big this is for the retail industry, but it's a concern nonetheless.
All right, I asked both of you to make a reckless prediction here then. So, because I can understand why a retail operation would want to be a bit more opportunistic and aggressive in building out your backlog, because you want to reduce supply chain risk amidst the tariffs, right? You want to at least get ahead and keep your input costs down on a unit basis as much as you can, while you can get ahead of the tariffs, to be a little bit more aggressive in your supply chain planning. Does this, given the unpredictability of what we've seen, does this make you more or less convinced that we will see 1 year from now odds of there being in the retail sector significant inventory write-downs because you got too far ahead? What do you think? Give me a percentage, Tom.
I mean, I think I just want to break down my thinking here. Like, there are two factors that are playing in my mind. The first is that it looks like inflation's going up again, and if these tariffs come into play, that'll push it up higher. That's the first factor. Second factor is there's the well-known risk that Sanmeet pointed out, that higher inventories lead to higher write-offs. So you combine those two factors and you get a situation where people aren't buying things because they're feeling poorer because of inflation, and these companies were sitting on a lot of inventory. And I think that is a recipe for large write-downs, yes. So that's my prediction. If you want a percentage, man, I mean, I don't know, 1 in 5,
30%, 25%.
25%, 20%.
Sanmeet, what do you
sorry.
think? 20%. What do you think, Sanmeet?
So here's my thinking too. I think retailers are being cautious right now, and maybe you know they're not. I don't think they're going to push too hard on this until they start feeling more like even more significant threats. Because right now, I think, without getting political again, but like the tariffs, I think right now, outside of what you said, Tim, about the weaponizing, that's different, I think. But right now, I think these tariffs are being used as like a negotiation tactic and to really strong arm other countries into kind of getting what we want. Ultimately, I think full-blown tariffs are not going to happen, and I think that they'll subside, and I think that there could be some write-downs for retailers for sure, but as some of this stuff subsides, then the retailers won't bulk up on inventory. So I'm going to put my percentage lower, maybe like 5%, because I think these tariffs aren't going to stick still. Because ultimately, if inflation starts creeping up, the administration is going to start doing something. The markets will start tanking really bad, and inflation ticks up. Something's going to, like, they're going to do something about it because perception is not good then.
Yeah. I'm going to split the difference between you and say 10%. And the reason for that is I do think you're right, Sammy, that this, I don't think the tariffs will be applied persistently. And I think that because of the volatility of those tariffs, it'll make predictability really hard. So I think that you're probably going to have some retailers that get caught, but I don't think it's going to be so big that you're going to have retail apocalypse. I don't believe that. But I do think, the nature and the volatility of this is such that you're probably going to see a few retailers get caught. So that does lead to some how I would respond to that. For me, as an investor, I'm going to be watching for the high quality retailers, the ones that do really well with their inventory turns, the ones that are, persistently very smart and very conservative about this.
Yeah.
It's going to make things, I think if you're an investor and this starts making you frustrated because things get topsy-turvy, I want to give you some reassurance that the long term is still, there's still reasons to be long-term optimistic, but I do understand that the volatility could be a bit maddening. Buckle up if you have some extra cash. And I would say if you are like me and you have some anxiety, and in particular, if you have anxiety dealing with your portfolio, it's never a bad thing to have some built-in, sort of buffers that allow you to just be like, you know what, everything out there is absolutely nuts. I need a little extra cash so that this doesn't make me feel insane. Like, you got to take care of yourself in the midst of all of the madness. So, but I do think in a weird way, this may give some real opportunities to the best run of the retailers. But boy, do we need to be doing that? I mean, I guess this is where we are, so we'll just have to, ride it out.
Yeah, I agree,
kind of
Tim.
like the early days of COVID. Remember all the inventory stockpiling then as well.
Right.
Yeah,
That's a good point. Yeah.
I agree with Tim too. Like the companies like Costco, Walmart, Target, I'm not as worried about. They can handle unabsorbed losses. Companies
100%.
like Williams Sonoma, Zumiez, this were listed in this article, and then like apparel retailers, Those I would have more concerns about because they don't
might be
turn
a little
inventory
harder.
as quickly, and it's also not repeat purchases of stuff. So yeah, those I would feel more worried about. And the other point that you made, Tim, I totally agree with. It's going to be a rocky road. And it's going to be bumpy. It's going to cause a lot of anxiety and nerves, but see it as an opportunity because for so long the markets have been just ripping up higher. You know, when we get some of these like downdrafts, if you have some cash to work that you can use comfortably, that you're not worried about needing for the near short-term future, put some of that to work. And if you're a long-term investor, it's going to pay off over the long term. Maybe even just like the S&P index, or something like a more stable, Costco type company. Take advantage of some of these market drops if you have the cash to put to work.
Yeah. It's important. All right.
So another thing that shifting away from tariffs, but in the tech world, there seems to always be lots of news going on, and there's a few things going on with AI, as if there isn't always a few things going on with AI. But
no, you don't say.
there's always we can always find some news related to AI every single day. So our jobs have become a little bit easier with AI around. But I don't know what we did without AI. But so yeah, Tim, you had a couple stories on AI that I think were interesting to chat about.
Well, let's talk about the one. I think it came up last hour as well. So the I believe he's the CEO. No, I'm sorry, he's the chairman, Joe Tsai, of Alibaba, warned. This is from Bloomberg. I'm quoting here from the Bloomberg story. Warned of a potential bubble forming in data center construction, arguing the pace of the build out may outstrip initial demand for AI services. That's new. Tsai said this at the HSBC Global Investment Summit. This was in Hong Kong. And so now you could argue, and I think you wouldn't be wrong, that, well, I mean, kettle, meet pot. I mean, you both look black there. You could argue that because, Tsai's company is investing $52 billion over the next 3 years on AI build out. So it's not like these guys are not, getting into it. But I think it is also much, much different. Like that's 52 billion over 3 years. You have Microsoft, for example, committing like 80 billion, in the current year. So it's just different. There are multiples of difference here. Tsai is saying like, look, we may be getting ahead of ourselves. And what he called, I think the thing that he said that struck me as interesting. This is how he put it. This is again quoting from the Bloomberg article. I started to see the beginning of some kind of bubble. He raised the concern that there are build projects that don't have uptake agreements attached to them. In other words, like I'm going to build out my data center, and you have committed nothing to using capacity here. I'm going to build capacity before you buy any of that capacity. There's no rental agreement here. So he added, I start to get worried and this is the part I'm going to emphasize this because I think this is the part that really did stand out to me. I start to get worried when people are building data centers on spec. So on spec, what that means, on spec is a term I'm familiar with back in my contracting and freelance days. When you are, let's say, writing something on spec, I'm doing all the work up front. I'm doing it all. And then what I hope is downstream, I can sell that. I'm going to do that work up front on my dime, on spec, on the belief that I've created something of value that I can sell. And that's the point here that Tsai is making. If you are building data centers on spec, you are saying like, hey, if I build it, they're coming. Quote a 1980s movie. There are a number of people coming up funds coming out to raise billions or millions of capital. So in other words, this is the point, Tom, and I'll kick it to you if you have a comment on this. If everybody is building data centers on spec and everybody believes if we build it, they will come, who is the one that is going to build it and no one comes? That's the point that Sai is making. Do you think that is a legitimate concern?
Whew, I mean, what the amount I know about how AI works and what data center requirements there are for AI, could get me in trouble. So I don't want to speculate too much on that. I assume that Mr. Sai really has, been the head of a company like Alibaba. He knows what he's talking about.
Yeah.
I mean, that. Maybe he's referring to something specific that he has encountered in his work, but that is the nature of capitalism, is you take a bit of risk sometimes.
Yep.
I think everybody's kind of uncertain about how much demand there'll be for AI and what the business model will be around AI. I think there's probably a lot of similarities to what we see now with what happened in the internet era back in the late 90s. There was a lot of build initially, a lot of excitement about it. Then there was a bit of a reckoning where there was like, okay, maybe everything's not going to be exactly like this. It's going to be, then there was sort of a, to put it a little bit more bluntly, bit of a crash, a reset of expectations, but then a kind of a build again. So I think we have a tendency as people and investors to just go through these phases of first initial total excitement and call it excitement. We realize we have to reset our expectations, and then we go, the underlying technology and the usefulness of it will kind of just tick along like this, but investors' sentiments about it will go like this. So so that's all I really have to say about it. Go ahead, Tim.
Well, I think that's right. Sanmeet, I'm going to give you an additional bit of information to get your take here, which is this. It wasn't that long ago the Microsoft CEO Satya Nadella said, hey, you know what? Come around 27, 28, we're probably going to be leasing more AI capacity than we do AI build out. So in a way, Nadella may have already been teasing what Sai is saying right now. So it just, in that context, once I give you that additional bit of information, what does that make you think about what Sai is saying here? Because I'm not sure he's making a prediction, but I do think what he's saying is, hey, maybe we're getting a little bit ahead of ourselves.
I mean, I think what he's saying, yeah, I agree. It's not really a prediction. It's more of like injecting some rationality into everything where, AI is a huge technological like breakthrough, and it's going to be something even bigger than what it is now. It's very like, as we were joking just now, there's always like an AI story we can talk about. So the hype is huge. The reality is building. Like in any kind of hype cycle. This was the question I had right away when you sent that article to us. Was in any major hype cycle, not like small ones, a major hype cycle, you kind of tend to have these periods, right, where you're going to overbuild, get excited, and like you build it and they will come. And while some do that and technologies or industries do that and it flames out, this will have a portion that will flame out, but maybe like a portion will not. And so there is a real risk. There is a real risk that there's going to be overbuilding because there's a lot of infrastructure and spend being put into this, and it may not pan out as much, and maybe it will pan out as much, further down the road, but it's not going to be linear either. It's going to be like bumps and starts, and there'll be some improvements in AI, there'll be slowdowns, there'll be some more improvements, step ups. So I think it's just rationality of the fact that, yeah, we could be overbuilding a bit.
There was a
'Cause-
period several months ago where it seemed to me like every few days there was an announcement from one of the major companies announcing how many billions of dollars they're going to invest in their AI efforts. And it seemed like each was trying to outdo the other. It became like an auction.
Yeah, how about
mentality.
OpenAI saying they were going to raise in the trillions of dollars?
Yeah, it was
right?
like an auction. We'd entered like an auction attitude amongst these people, and I thought, like, this is
or an
that
arms
was,
race even.
for me that was a big warning sign that we'd entered a period of like real, irrationality. Like especially when they start trying to outdo each other in terms of how much money they spend. That's a recipe for bad results.
And this kind of leads into your other story, Tim, about DeepSeek and how they came out recently and really crashed the system, crashed the party, I guess you could say. Is hey, we can do this real cheap. Now there were some some questions about
there's
how they
been
got
some
the chips
debunking
and
about that since.
Yeah.
Yeah.
But for the most part, you have to imagine there's so many companies working on AI and models and stuff. Someone's going to crack the code of, hey, how can we do this more efficiently? That's kind of the nature of humanity, right? How can we do everything more efficiently? Was it somewhere I read or heard, or one of you said it? It was like, humans are lazy. They want to find the most efficient way of doing things. And that's what drives us to efficiency and productivity, right? Is we don't want to spend all this time like doing this stuff. So like we don't want to spend all this time like farming and growing our stuff. So we build machines and this and that, right? So
the apex of our evolution is us just lying on a couch and
watch WALL-E, right? Have you seen the movie WALL-E? That's gonna happen, I think. That's my bold prediction. WALL-E will happen. We're just sitting there with iPads on a chair floating around in space while these robots clean up like our garbage. It's like
I love
eerie.
that movie. Yeah.
Listen
kind
to
of
you.
scary,
You're like,
though. It was kind of like an interesting. Yeah. Go ahead, Tim.
I like how you went full Mean Girls there. Like, stop trying to make WALL-E happen. That was very good. That was very good. No, look, I think there's been some very legit debunking of the DeepSeek story. However, there is clearly a movement underway to bring, and this happens in all technology cycles, so we shouldn't give DeepSeek too much credit for this. We should just note that technology adoption life cycles, as you have an extraordinary amount of demand that comes into a market as the hype cycle just spins faster and faster and faster. At the same time, you do have a movement to democratize the technology, as it gets more and more essential, more and more important, more and more necessary. The efforts to democratize the technology by lowering costs and figuring out ways to put it in more places at lower costs, that's always a part of the market development. And so something like DeepSeek was always going to happen. So later on in the show with Jose tonight, we'll talk a little bit more about something technically that they have put out with version 3. But I think the important thing is, and this is the issue that I think is a problem for the market at large. DeepSeek is driving down or essentially putting out models that it claims are faster, more efficient. There's going to be tests on this. I'm not going to make any claims about how good DeepSeek is or isn't. But what I can tell you is that they are challenging incumbents. And they're doing something that I think we cannot underestimate how disruptive this is. They have put it out into the major model market, Hugging Face, and they said, our claim on this, as far as commercial interest, is nothing, zero. So if it's open source, which it is, at least from what we can tell so far, it's not going to cost anything. That is massively disruptive. That's a problem. If you're built, so this is you have two worlds clashing. Big companies writing big checks because AI is here and it's a massive opportunity. And then another coming from China saying, you're right, it's a massive opportunity. And the amount of money we want for this is nothing. Like, so you're going to spend all this money, and what are you going to get in return? Like, that is at least that disconnect, because that feels like this. You know, you have one force that's going big and another that's undercutting it massively. How are you going to fill that space? How does the market form around those two very different competing economic interests? So whether you think DeepSeek is a red herring or not, the way that the economic models are clashing, that's a serious disconnect that is going to have to be resolved in some fashion that I cannot predict at this moment in time.
Yeah, it's crazy. I mean, it's funny how all those two stories kind of converge, where it's like, you know, these models will get efficient, and so maybe then that will even just feed into that narrative of data center overbuild.
Maybe, yeah. I mean, it's a fascinating question, but I'm going to talk a little bit more about that story later, because there was a technical test that I want to get Jose's take on. But I do think that is not, when we've seen this in the past, where you have, you know, chasing a market, like this is an area where maybe the internet era is somewhat instructive, where you have you know, open source models, you have open source Linux come out, and what did that do to the big providers of, you know, Unix mini computers and, you know, large scale servers? It just changed everything. It really was. I mean, somebody who's more technical than me can challenge me on this, but I'll make what I think is a potentially reckless statement. Is as soon as Linux came out, I think that did lead us down a path. It didn't happen immediately, but towards like, oh, okay, well, let's rethink how we're going to use hardware then. And we reimagined those pizza box servers, and then we started doing things like blades. Now you don't even, if I use the term blades, you don't even think about that. This is because I'm an old man and I remember when this was new. But it really was at one point a new thing, where a server could be a board, just a board that fit into a box, and then you could have multiples of them, and now you could have a cluster of servers inside a box, instead of a server being like a pizza box, which is the way it used to be. Now it's like you just put all that on a card. Like, as soon as we started driving down unit costs, we're like, wait a minute, I can orchestrate an entire cluster of servers using Linux. Yeah, let's do more of that. As soon as you start getting those kinds of conversations, it just changes things. And so I don't know how the efficiency argument changes the way we start thinking about AI-driven systems or AI-driven data centers. I don't know what that looks like, but I bet it doesn't look the same in the next 2 years. I think that is a fairly reasonable prediction.
Yeah, for sure. Sure. So let's start taking some questions here. Well, Husker Sooner, it's not really a question, but I thought it would be an interesting comment to say. First of all, if you're a college fan, Husker Sooner, I would love to hear some clarification on that, because the Huskers and the Sooners are big rivals. So
yeah,
did you go to both schools? That would be cool.
Maybe.
So he says, good morning, watching live for the first time in quite a while. Welcome back. I feel the market will get past the tariff tantrum in time. The market has seen worse. So similar to like kind of what Tim and I were talking about with the tariffs. So In relation to that, there was another comment that said, Fulio said, as my wife always says, buckle up, buttercup. Thought that was funny. So you can keep thinking of that when the markets are raging here. So there's a question here. So Neil actually asks for you, Tim. So are you going in all in on gold?
Nope. Nope. Never have, never will. But in these, when uncertainty is highest, I buy in smaller amounts. That's how I do it. That's how I manage weird situations where I just don't have enough clarity. And I do think, but if you have a long enough time horizon, volatility and uncertainty is your friend, not your enemy. And I still believe that. So I think you should continue to be long-term optimistic. Volatility is your friend, not your enemy, when your time horizon is in decades, not months.
Because there will be a time in the future, and it's happened to all of us, where we look at the stock price or the companies that we like, or the S&P, and you're like, whoa, that's really high. I wish I had bought at
seriously.
this and this time. And then you're like, well, next time I will. And the next time comes and maybe you don't. So it's like, there's always that lesson. But Investment Vertigo asks, and this is an interesting one. Good morning, fools. Saw some videos of parks in Florida were very empty. With Canadians staying away from Florida, is this going to damage Disney stock and cruise lines?
That's a tough question. Tom, do you have a thought on that?
Sorry, Sanmeet, can you repeat the question?
Yeah, so he's asking, he saw some videos of parks in Florida being very, very empty. Canadians staying away from America. Will this impact Disney parks and cruises?
Well, I guess if there are lower numbers, it would. I guess that's a straightforward answer. Yeah.
I think is going to hurt Disney is Snow White. It seemed to have not done very well in the box office, and they rely a lot on these movies and tentpole type movies to feed into their whole empire, I guess you could say, or like strong box office showings translate into merchandise sales, sometimes theme park rides, cruise like character show like things. There's all kinds of different things that they can branch off. And Snow White's a classic, one of their oldest, I think, characters. But it didn't do so well in the box office.
On the other hand, Sanmeet, sometimes these things can. A movie that I would never have known that, for example, Snow White is coming out, a movie, unless I had read all the reviews saying, oh, how terrible it is and how much controversy it's causing. So sometimes causing controversy can actually be beneficial to a book or a movie or other things as well. So
that's true.
Who knows? True. World's a complicated place.
Disney tends to be that buttoned up kind of, proper company. So controversy doesn't seem to. They haven't really been that controversial, I don't think, in much. But yeah, sometimes people might see the controversy and be like, oh, this is interesting. I want to see what it's all about, and go see the movie.
Exactly. Yeah. I think music artists kind of thrive on that dynamic as well.
Yeah, for sure. Do you guys see any good questions that you like?
Let's see. There's one here. This is a comment for you, Tom, from Simon in Berlin. I think you recommended Fancy Bear Goes Fishing. I'm on the Bulgarian Virus Factory section. Excellent read. Thanks. I've not heard of this book, Tom. So it sounds like something I need to read.
Berlin, I think you, Berlin, so I don't know that book, Fancy Bear Goes Fishing. I assume you're talking about computer viruses. There are a few good ones, but I didn't know about Fancy Bear Goes Fishing. But I will add that to my reading list. So thank you.
There you go. And Jimmy G is asking, do you think China via DeepSeek is intentionally messing with the U.S. stock market and our capitalism model? I don't know about that, Jimmy G, but I would not immediately say that there is no ulterior motive to DeepSeek. If there is any state involvement, yes, that could be the case. I don't know if it's about messing with the stock market, and I certainly don't know if it's about messing with the capitalism model. But Is there any kind of state action behind it? That could be. That is possible. I would not say there's no chance of that. Now, for me, I'm not making that part of a investment thesis for or against any particular company. What most interests me is the economic dynamics. And I do think like there is a race nationally to be an AI superpower. And I think China would love to be an AI superpower. And I know the US wants to be an AI superpower. So I know that is a thing. So that's another thing. But economically, at the moment, I do think that DeepSeek creates the possibility of being highly disruptive because we have open questions about how do we allocate capital in order to seize the AI opportunity? And are we doing it properly? And DeepSeek raises some questions about maybe we are, maybe we aren't, you know, and it's too early to answer those questions. It is highly disruptive, though. The economics of DeepSeek, because they have, just about literally said, you don't need to give us any money. It's free. It's open source. You take it. I mean, the number of derivative works off of DeepSeek that's already in Hugging Face is just extraordinary. And that's going to continue. That's likely to continue to happen. And so, yeah, that's disruptive. That's for real. Yeah, and oh, you know what? I think this might be Rick who is chiming in and saying the original Snow White saved Disney back in the day. Well, you know what? If anybody would know that, it would be Rick. So,
Is that
yeah,
Rick?
I think so.
Yeah,
Oh,
Rick
hey, Rick.
Mix. So here's another one that is a cool one. David Eric Sellers asks, "What are a few of the best autonomous vehicle investments out there?" It's interesting you asked that question too, because I just got a alert today that Waymo is actually going to be ready for riders in the nation's capital of Washington D.C. in 2026.
Wow.
So the Waymo One app is going to be available in Washington D.C. in 2026. Probably the most frustrating places to drive in the nation, outside of maybe Manhattan.
That makes me think of a story. I once got into a Tesla, and this guy, it was an Uber, so he was Ubering with his Tesla, and I was asking him about it, and he said, "Oh man, the autonomous driving thing is really, really great. I'll demonstrate it for you." But we're driving through like downtown, like DC. As you know, DC is, I mean, it's probably not the worst city in the world, the worst city in America, but I mean, it's busy. I mean, people pulling in, people, a lot of pedestrian traffic.
Yep.
And so he turns this thing on, and literally within about 3 seconds, it turns off. It's like, nope, can't do it. Sorry, you got to take over.
He gave up.
And he tried like 3 times. He really wants to show me how his autonomous view, how well it works. And then eventually he's like, okay, look, you kind of have to be on the freeway for it to really work nicely.
Oh. Oh, that's funny.
Your autonomous vehicle just gave up on you. Said, nope,
like, nope,
not doing it.
At least that's to its credit to admit that it's like, okay, I can't handle the situation.
Hey, the first step to solving a problem is admitting you have one.
Yeah,
there you go.
It has that much awareness. That's kind of scary, right? If you think about it, that autonomous vehicle has that much awareness. So
yeah,
I mean,
seriously.
As far as autonomous vehicle investments, I mean, Waymo is owned by Google, or Alphabet, so that's one publicly traded company that you can take advantage of. Waymo seems to be a little further ahead, if I'm not mistaken, than Tesla. Tesla is also another one that is working on autonomous vehicles. And are there other publicly traded pure play companies that are autonomous vehicles? Maybe Chinese companies, right? BYD maybe, or I don't know if they're working on autonomous.
Yeah, I it's escaping me at the moment, Sanmeet. And I would say, for me, I'd be a little nervous about a sole autonomous driving company, because there are so many inputs that go into doing autonomous driving well, that, and we haven't really seen that fully combined. But I reserve the right to be proven wrong there. I mean, maybe when Waymo goes public, they will have all of that infrastructure all the way in place, and it'll be a no-brainer. I don't know. Makes me a little nervous, though, to be perfectly honest. I think it's one of those where it's a market where there's a huge number of dependencies, not just regulatory dependencies. You also have like here's a way that I would think about the autonomous driving industry. Like sort of second order effects. This is the way I would think about it. So you should not think about it this way if this doesn't make any sense to you. But I would be like, I wonder how that affects insurance. That's like the kind of question I would ask, and then see like who's the disruptor that's going to handle that, because that's the sort of thing where there's a lot of known unknowns once you put more autonomous vehicles out on the road. And so who's the disruptor that's figuring that out and then creating a normalized market around, ensuring autonomous driving? Because it'll be different. It'll have to be priced somewhat differently. The inputs will be different. So for example, the company that we have often talked about here on, in Motley Fool membership, company that does an admirable job about pricing risk that is hard to price. I'm sure you've heard of this company. It's called Kinsale Capital. This feels like a Kinsale Capital type problem, where it's hard necessarily. The inputs are different, and how you price that is going to be just functionally different. So I wonder who and maybe the answer is Kinsale Capital is the Kinsale Capital of, autonomous driving. I don't know the answer to that, but that's the kind of wacky question I ask in these sorts of situations, if that makes sense.
Yeah.
Just to clarify, Waymo is part of Google. Just for
yes.
public knowledge, yeah.
And I think, but Tim, would you agree that like autonomous vehicles is gonna happen?
Sure.
It's just a matter of when. It might be longer than expected. I think it's going to be longer than people expect for it to really be just like the majority of people say, okay, I'm comfortable getting into an autonomously driven car. Clearly, Tom's experience would probably pushed him back a few years.
Yes. I think it depends on what in technology adoption cycles like this, it's where's the need the greatest. And so I could easily see short haul commutes in controlled areas are perfect for autonomous driving. So for example, I could easily see in any campus environment where you have known roads, really well structured, like universities, large scale government campuses, autonomous vehicles that are like, you order one, you pick one up, and across a sprawling campus, I would imagine autonomous buses doing that sort of thing. That would make perfect sense to me. Sure, I could easily see that, but I think it's always it's the rolling up of use cases that is what gets you to a mass market.
Yeah.
Fulia's got a great comment here. They say the robo-taxis won't be viable until they give riders terrible stock tips. That's a good one.
Nice.
Maybe they'll combine robo-taxis with robo-advisors, and you'll just have this one.
Exactly.
One. It's like stock tips with your ride.
Yes. I like that. Matt is saying, unlike Marvel and Star Wars, Snow White was a homegrown asset for Disney. Has the House of Mouse destroyed yet another brand of property? I don't know. I wouldn't underestimate how good those brands are. I mean, they get long in the tooth, and that always happens. But Matt, let me give you an example of something where maybe it's just my take on why I'm not selling Disney. I've owned it for years, and why I'm not selling it. I get a dividend. I reinvest all the time. Genres go out of favor and come back into favor. So, like, for example, you couldn't turn on a program in the 1950s. Like, you couldn't go to a theater or turn on your television set without seeing a Western. They were everywhere. That's all there was. It was nothing but Westerns in the United States. And then they went out of favor for a while. They just disappeared. And it took a long time for them to come back, to reimagine a Western genre. Well, now they are not as popular as they once were, but Westerns we will see them from time to time. They didn't just die away. So yeah, I'm not buying that Disney has killed properties. I don't buy that. I would say, though, like, did Disney maybe overexpose some of their acquired brands? Sure. And like what Mike is saying in our private chat here, like a Star Wars Western, 1,000,000%. Star Wars is a Western in space. And could you see more, like spin-offs that have that kind of feel in that genre? You 1,000,000% could see that. So, like, yeah, I never underestimate the power of a core brand that can be revived. It's happened 1,000,000 times.
I agree. I mean, things do tend to get long in the tooth. Like, I mean, like for a few years ago, all we would ever see are, superhero movies.
Right.
Marvel was just crushing it. And now they every movie they came out with was doing well, successful. People liked it. I mean, I'm a, Marvel fanboy. Now they're coming out with movies I'm not as excited to actually go see, and I've heard they're not as good. And I haven't, usually I'd be lining up to watch all of them, but they went a little long in the tooth with it, and it was successful. It did very, very well for them during that period. Star Wars, I think I'm sure Jim will chime in if he's watching, but they probably kind of killed Star Wars a little bit, or at least put it to the dirt for a little while. But Snow White, I mean, what was Snow White even doing before this, right? How much relevance did it have? I think Disney was trying to revive a brand. They've been doing a lot of live action of their old animated series that were popular, like Little Mermaid and some of these other ones. And so they've been trying to revive some of that, which is great. But I think Disney's biggest problem, I've said it a long time ago, is they just need to get more creative. They need maybe more homegrown originality. And they had acquired a lot of companies, Pixar, Marvel, and Pixar didn't have as many properties. They kind of created through Pixar, or Pixar created. Marvel, they acquired a lot of stuff and then they created, but they just need more creativity and a variety of stuff.
That's going to happen. And I guess this is the thing that I would warn against. If you think that Disney can't do this, I will remind you that probably, of the big things that they have done, there are some that were generated entirely in-house. And if you have, a preteen right now, or a young teen, maybe like a 15-year-old, 16-year-old child, ask them about Frozen. They will remember.
Yeah.
They will remember. And that was developed internally. So I think it's madness to think that Disney has destroyed brands and they're never coming back. No way. I'll take the other side of that bet.
Yeah, I have a
Can I-
13-year-old daughter, and she still remembers Frozen, Moana,
Of course,
all these things.
you know, Ella and what's her name? The other one, the other sister.
Elsa,
you know?
Elsa and Anna.
Elsa
I even
and
remember
Anna.
it. Jeez.
Yeah.
Like an expert, Sanmeet.
I mean, I just remember taking the kids to Disneyland and we had to wait in a god-awful line just to meet Elsa.
Right.
I was like, this is insane.
Yep.
Oh, you were looking forward to it, Sanmeet. You got
So, let's see. Well, Investing Cat says, I work in a cinema would add Disney has plenty of other releases coming out this year that will fill seats, including Avatar 3, which will sell
There
out.
you go. Yeah.
I'm not a huge fan of Avatar, but I think it will probably do well in the box office because there are lots of fans of it. Unless they make it a really bad
knows?
story or something.
Yeah. Like you can always any given franchise can go out of style. It happens, but there's an insatiable need for content. I mean, content is forever in my opinion, but we got to get out of the way because we have actually useful content upcoming.
All right, fools. Well, thanks for joining us on the morning show. We hope we're roughly good. We'll be better next time. We're face down on the glass for our showrunner, Natasha Hall, Tim Beyers, Thomas King, myself. Thank you for joining us, and we'll kick it over to Bro and Dan with some real good content for us all.
Thanks, Sanmeet. Thank you, Tom and Tim. Have a great morning. And Motley
Go
Fool
on,
members,
everyone.
welcome. We're glad to have you. I'm Dan Caplinger here for the weekly retirement show, along with Robert Brokamp. We are talking Social Security today, specifically the pros and cons. Looking at delaying Social Security, we've talked a lot about this subject over the years, and it is something that continues to be a popular topic just because of not only that, I mean, it's a combination of things. There's math, that's always a challenge. There is political uncertainty, that's increasingly a challenge. And there's just like trying to figure stuff out in the future, or even if you're like right at retirement age and this is a pressing thing you're thinking about right now, the decisions that you make are decisions that can have an impact on your financial life for the rest of your lifetime. And so it is natural to want to get information about that. That's what we are here to provide. Not here to provide personal financial advice, not here to provide tax planning, or, we're happy to talk about these things, and we will. And we invite your questions on Slido, #Fool24. Just be advised, we're always going to push you to get your own individualized advice from a team of professionals who is authorized and available to help you, whether it's an accountant, an attorney, a financial advisor, whatever you need. You should not hesitate to get that individualized help. With that, I'll turn it over to Bro, who's going to start us off with this important topic of delaying Social Security.
Thank you, Dan, and hello, everybody. And yes, Social Security is an important topic, right? We've talked on the show before about its importance to retirees. It provides anywhere between 30 to 40% of the income for the average person over age 65. And for a large segment of the population, it is the majority of their income. So focusing on maximizing it will be crucial to your retirement. You can claim it as early as 62. In most situations, you can wait till age 70. The longer you wait, the bigger the benefit. We'll get into the details. So these days, most experts and even academic studies find that most people should wait, if not to age 70, at least till your full retirement age. But that's not what happens. These days, still, the most popular claiming age is 62. Not most people, but the most popular option is to claim it as soon as possible. Only about 10% of people wait till age 70. And I think it's because, as Dan suggested, some of it is people just not understanding how it works, not understanding how the math works. I think it's also very tempting to say, I have the money now, I can claim it now. And it does also depend on your life expectancy. If you do expect to have a below average life expectancy, you probably should not wait. But for most people, they probably should. And I'm going to go into the details here as I share my screen. This is based on an article that I wrote for Game Plan that everyone should have access to, just go to Game Plan, which is part of your premium membership here at the Motley Fool. And the first thing I would like to point out is that if you have not yet reached your full retirement age and you are still working, you probably should wait. Your full retirement age is between the ages of 65 and 67, though these days, the vast majority of people, if you haven't claimed yet, your full retirement age is probably 67 or close to it. And the problem is, if you claim before your full retirement age and you are still working, you will lose a certain amount of benefits depending on how much you earn. And this amount changes every year. In 2025, you lose $1 in benefits for every $2 you earn above $23,400. That's if you're not turning your full retirement age in that year. In the year you turn your full retirement age, you will lose $1 in benefits for every $3 you make above $62,160. Now, I will say by lose, I don't mean you lose it permanently. You eventually gradually get those benefits back at full retirement age. It's kind of a complicated formula, but the bottom line is if you're still working, earning a significant income before your full retirement age, it probably makes sense to not claim. The second reason to delay claiming Social Security, and it's the biggest one, is because you'll get a bigger benefit. Now, your benefit is based on your primary insurance amount, and that's amount you'd receive if you claim at your full retirement age, and it's determined by your 35 highest earning years adjusted for wage inflation up to age 60. No more wage inflation adjustments after age 60. What you see in front of you there is basically the amount that your benefit would be reduced or increased, assuming that your full retirement age is 67. That would apply to anyone born on January 2nd, 1960 or later. And you can see there, I put a number to it. So if someone has a primary insurance amount of $2,500, that's the amount that they would receive if they wait till age 67. They receive $21,000 a year if they claim at 62. $30,000 at 67 and $37,200 at age 70. So you can see those are pretty significant numbers. Number three, you're actually going to get even a bigger benefit due to inflation. That's because often when you see projected benefits, they're stated in today's dollars, and they do not reflect any future primary insurance amount adjustments due to wage inflation or the cost of living adjustments, the COLAs, that beneficiaries receive at age 62, whether you've claimed or not. Every year you'll see in the news the annual COLA, cost of living adjustment, for Social Security. You don't have to be receiving Social Security to get that benefit. Your benefit that you will claim in the future also is adjusted for that COLA. So when you look here, you look on the screen here, you'll see a little screenshot from a Social Security statement. And you can always get your statement by creating a My Social Security account and downloading it from the Social Security Administration website. And it'll show how much your benefit will increase based on the year you claim. And I think that's a good idea to do that because it's based on your actual earnings record. But again, this is stated in today's dollars. The actual nominal amount that you receive may be higher due to wage inflation and the COLAs. Now, I say maybe because the benefit that you see when you look at your statement assumes you're going to keep working until the age you claim. So let's say you look at your benefit that you'll receive at age 70. In this example, it's $1,860 a month. It assumes you're going to keep working till age 70, and that might be increasing your benefit and might be slightly overstating it. So it does depend on your situation. But I think for many people, they do not appreciate the fact that inflation will be on top of the adjustment. For example, if you delay, for every year you delay beyond your full retirement age, the benefit goes up 8%, but it's 8% on top of inflation. So another reason to consider delaying. Now, you'll potentially have lower taxes, potentially. And here's how I arrive at this conclusion. First of all, we have to understand how Social Security is taxed. Not all of your Social Security gets included in your taxable income, just a percentage of it. And it's based on your combined income, also known as your provisional income, depending on which article you're reading. And to get your combined income, you add up your gross income, your tax-free interest, that's from like municipal bonds, and then 50% of Social Security benefits. And then you apply them to these brackets. Now, these brackets are pretty low. I assume that most people watching this are making more than this 0% bracket. It's so low because these were created in 1983, and they have not been adjusted since then. If your combined income is in these brackets, only 50% of your benefit will be included in your taxes. And then above this, 85% of your benefit is included in your taxable income. That does not mean that 85% of your Social Security is taxed. It means 85% of it gets included in your taxable income, which means 15% is always tax-free. And the bigger your benefit, the more tax-free income you'll receive. So let's just go back to this slide. If you claim at 62, only 15% of this will be tax-free. If you wait till age 70, 15% of this bigger number will be tax-free. So that's why I say you could have potentially lower taxes. Now, there are other studies that are more complicated and have found that delaying Social Security will result in lower tax burden over the course of your retirement. But that depends on the other sources of your income while you're delaying. But most of them also conclude that delaying Social Security actually can be a tax-saving measure. All right, potentially reduce required minimum distributions. So once you reach age 73 or 75, if you were born in 1960 or later, you have to start taking money out of traditional retirement accounts. So as I say there, if you retire in your 60s or earlier, but delay claiming Social Security until age 70, you'll need to rely on your savings to pay the bills. So if you are living just off your savings, including taking money out of your traditional retirement accounts while you delay Social Security, you'll reduce how much those accounts will be worth once you reach age 73 or 75, and consequently your RMDs will be smaller because your RMD is based on the value of the account on the previous December 31st. Now, this may not be that compelling for most people, but for those of you who have really, really, really large traditional accounts, and once you get to the age of RMDs, you're going to have to take out way more than you need, this is a more compelling argument. Just two more issues here. So one thing to consider is that you'll have potentially larger survivor benefit for your spouse. So delaying Social Security not only increases your own benefit, it may also result in a larger survivor benefit for your spouse, depending on her or his earnings history. If you and your spouse earned roughly about the same amount over your careers, this is not an important consideration, because when one spouse passes away, the other spouse will either get their own benefit or their spouse's benefit, which is higher. And if you both earned about the same amount, you're just going to probably continue receiving your benefit, or if you receive your deceased spouse's benefit, it won't be that much of a bump up. But as I say in that second bullet point, this is particularly relevant when one spouse earned much more than the other during their careers, and the higher earning spouse is more likely to die before the other. And, the typical situation for this would be, a man and a woman, husband and wife. The husband earned more money while the wife stayed home and did the noble job of raising the kids. On average, a husband is a couple of years older than the wife. And of course, women live longer than men. So it's more likely in that scenario that the wife will live longer than the husband. If the husband claims Social Security early, he will reduce how much his wife will get when he passes away. So it's a very important consideration depending on your the earnings history of you and your spouse. And then finally, more longevity insurance. So we all know that one of the greatest fears of retirees is that they'll run out of money. Social Security mitigates this risk by providing lifelong income. You can't outlive your Social Security income, at least as long as the current iteration of society exists. And the longer you delay, the more so-called longevity insurance you'll receive. Now, as we've talked about in previous shows, Social Security has some significant funding issues. The trust funds are due to be depleted in 2033, and due to some changes over the last several months, it's probably going to be even sooner. And at that point, there's only enough money in the program to pay 79% of benefits. But that means you'll still get something. And as I say there, regardless of the possible future shortfalls, I think the general principle is still likely going to be to remain. The longer you delay, the larger your partially tax-free, inflation-adjusted benefit that will last as long as you do. And my last slide here is, you may have been watching this presentation and you have already claimed Social Security and you're thinking, oh man, maybe I should not have. Well, you might, not everyone, but you might be able to do somewhat of a do-over. So one option is what's known as a withdrawal of benefits. And this is if you've claimed it's been less than 12 months since you filed for benefits. You can basically withdraw your benefits and it's like you never claimed, but you do have to give back all the money you received and any money received on your record. So if your spouse has also been receiving benefits on your record, you have to give all that money back. And you can only do this once. So if you've already withdrawn benefits before, you can't do it again. And then the other thing is to suspend benefits. So if you claimed before your full retirement age, so you've locked in a smaller benefit, but you're currently between your full retirement age and age 70, you can suspend your benefits, and your benefit will get the benefit of increased credits. For every month you wait till you'll claim again, your benefit will get bigger. So it is you've already kind of locked in smaller benefits, but you can at least increase those smaller benefits up until age 70. Just know that any benefits claimed on your record will also be suspended. So your spouse, maybe your kids, if you are in that situation as well. There are a lot of details about these two options, so make sure you learn about all the details if you find these at all compelling. And that is it from me, Dan.
Thanks, bro. I just want to elaborate a little bit on discussions. A lot of people lately have been talking about the decision to delay Social Security benefits in the context of the financial status of the program. I think it's important to understand, we maintain this sort of artificial distinction, this separation in considering Social Security's future, just because the nature of the program in the past has been such that the federal government takes a set of dedicated tax revenue sources, payroll taxes from employee and employer, as well as income taxes on Social Security benefits under certain circumstances. That money is earmarked for Social Security, gets put into the Social Security Trust Fund, and then benefits payable under current Social Security laws are paid out of that trust fund. For years and years and years, that resulted in more money being taken in than being paid out. And at that point, the trust funds were growing in nature. But we knew demographically that things were going to shift, that there were going to be a smaller number of workers and a larger number of retirees, just based on the size of the baby boom generation compared to Generation X and later generations as well. And so we knew that this was happening. Just about all the talk about the financial issues with Social Security, look at Social Security only within that context. But there's an alternative way of looking at things, and that is that if the federal government has made has incurred an obligation, they have made a commitment to the American public to pay Social Security benefits according to current law, then in my view, one aspect that often gets ignored is that if the trust fund no longer has enough money to pay those benefits, it is an option of the federal government to say, yes, we have incurred this obligation. We made provision for it by setting money aside in trust funds. That was a smart move. It worked for 4 decades, and great. But now we have found that it will no longer work. That doesn't make it any less of a government obligation. And so taking the shortfall and funding it from the general fund is an option that is always on the table. Now, I tend to be personally a deficit hawk. And so the idea of adding several $100 billion to the annual federal budget deficit is not my first choice. But lawmakers seem not to have the same issue with that I do. And so I'm a big fan of being internally consistent. And so if we're comfortable with deficit spending in certain areas, maybe we're comfortable with deficit spending by moving this unpaid, this uncovered obligation in the trust funds, moving that to the general fund and recommitting that commitment to Social Security. That's one view. Another view is that if you think that Social Security is too big of a drain on the federal government, then passing laws to change it, to reduce it, to take provisions to control costs, that is obviously part of the democratic process as well. And that's something that I think everybody in doing their Social Security planning needs to figure out. What are the likelihood, what kinds of creative solutions are we going to come up with? But I think it's going to be important, especially as these years, I started covering, when did I become a fool? I started writing for the Motley Fool in 2006. At that point, this doomsday for Social Security was 30 years away. Now, we're below 10 years by many estimates, and very little has been done to come up with a solution. I'm confident that we'll find a solution. I don't know what it looks like, and so it's hard to prepare. But you do the best that you can, and you advocate for the solution that you want, and ideally the process works, and people get what they want and what they need. I'll stop, get off the soapbox there. Let's go to questions. I wanted to grab a question from the Wayback Machine 7 days ago while Bro takes a look and gets some more current questions. I'm just going to answer one here. Neil in Rockville a week ago asked a question here on this show, I think it was. If I have a Roth 457 plan, do I have the same 5-year restriction on taking out money and gains upon separation from my employer, unlike a regular pre-tax 457? So Neil, if I recall correctly, this was in the context of, we were talking about 5-year rules, and I was pointing out that you needed to have, if you did a conversion of money from a traditional retirement account to a Roth account, then there was a 5-year rule that applies there. There's also a 5-year rule on earnings being tax-free that requires that there be a Roth in existence for to cover a 5-year period. As Neil points out, 457 plans are a little bit funky because at least certain types of 457 plans, government 457 plans, will allow you to make penalty-free withdrawals after you separate from service. It doesn't matter what your age is. You don't have to be 59 and a half. You don't have to be 55. You just can do it, and you don't have to pay that 10% penalty. If it's a traditional 457 plan, then you will pay taxes when you take that, unless it's covered by an exemption. But with a Roth 457 plan, that would not generally be the case. I do not think, Neil, that anything that I said changes the rules governing governmental 457 plans. Just be advised, not all 457 plans created equal. Some do have more restrictions than others. And so you're going to want to check with your HR department before you do things like this. The one thing I will warn against, though, is taking distributions straight from a 457 plan is one thing. But if you decide, as many people do, to roll over that 457 plan into a rollover IRA, just be mindful you may lose the ability to get that preferential withdrawal treatment, because once it's in an IRA, it takes on the rules that IRAs have. That includes the IRA rules for early withdrawal penalties before age 59 and a half. And so if you see yourself retiring early, if you see yourself wanting to have access to those funds before reaching age 59 and a half, then it may behoove you to keep money in that preferential 457 plan rather than doing a rollover. There may be pros and cons to that. Maybe that you're stuck with investments in a 457 plan that might not be the investments that you'd choose in a rollover IRA, but you'll then have to do the balancing act and weigh the pros and cons, decide what's best for the particular situation you find yourself in.
Okay, let me get to a couple of questions. It is 10:23. We have plenty of time for questions. We've gotten several good ones, but we will certainly have time for more. So get your questions in about Social Security, retirement planning, really anything related to financial planning, taxes, estate planning. Go ahead and get those questions in. All right, from Cyber Mikey. I recently read that a 529 account can be transitioned to a Roth IRA if the child does not attend an eligible in-state school. Is this common? So the first part I will address. The second part I had not heard. So Cyber Mikey, the part about the requirement being if they don't attend an eligible in-state school. If you have an article about that specific part, I'd love to see it if you could put it in Slido. But generally speaking, yes, nowadays, any unused 529 money can be rolled into a Roth IRA for the beneficiary. But there are a lot of rules around this. So first of all, the 529 has to have been open for 15 years. You cannot roll over any contributions from the last 5 years or any earnings on those contributions. The total amount that you can contribute is, or that you roll over to the Roth IRA, is $35,000, and you can only do it in increments as if they are a Roth IRA contribution and follow those rules. So, for example, the beneficiary has to have earned income for this to even happen, and you can only move as much as allowed to be contributed to a Roth IRA in a single year, and that is $7,000, $8,000 if you're 50 or older. The one thing that's different is Roth IRAs, generally speaking, are subject to income limits. If you earn too much, you can't contribute, but those do not apply to this at all. So as you can see, there are a lot of rules about it, but yes, it is possible. It's that other part that I had not heard, that if it's not an eligible in-state school. So I would love to learn more about that. But otherwise, yes, this is a possibility. And then Kat D says, what is the limit for a single person to contribute to a Roth 401k and a Roth IRA together annually? Thank you for making us smarter, richer, and happier. Thank you, Kat D. So as I just mentioned, the Roth IRA contributions, and they are mostly independent of the 401k. 401k contributions are it's 23,000 this year, 23,500 if you'll be younger than 50 by the end of the year. If you're over 50, you can add another 7,500. If you'll be between the ages of 60 and 63, you can add another 11,250. So it's a little more complicated this year. It's the first year they've had this so-called super catch-up for those between 60 and 63. Those are independent. You can do both of those as long as you're eligible for both accounts. The only way where one might affect the other is, as I suggested, contributions to a Roth IRA are limited based on your modified adjusted gross income. So if your modified adjusted gross income is too high, you may not be able to contribute at all or only part of the annual limit. However, contributions to a traditional 401k lower your modified adjusted gross income. So by contributing to a traditional 401k, you might become more eligible for the Roth IRA if you're sort of on the cusp of those income limits. But otherwise, you can contribute to both. And then I'll just add, to make this even more complicated, some 401ks allow for so-called after-tax contributions, which are above the limits that I said. Most don't, but you could ask if that is eligible for your plan, and then you could contribute even more to your 401k.
All right, Douglas Kerr, about an hour ago, said, Dan, why are you saying Australia is dirt just because it had 1 month out of the last 550 months that was a trade surplus, yet the USA had 449? Douglas, I think that you're probably referring to the show that I did with Motley Fool research analyst Jack Caprell on March 16th at 6 p.m. I've pulled that up. I did not make the comments that you suggested. I didn't refer to Australia being dirt. I am going to say that if I'm going to take the comment as a potential criticism on the methodology that Jack Caprell used in building the maps that he did, and and I'll pass your comment on to him. But I do think that Jack used a methodology that was based on trade data, and I think that I don't have any reason to doubt the veracity of the data, but I'll pass that comment along, and it may well be that at some level of granularity that what you're saying may make sense, but the characterization that anything that either I or Jack said in that discussion about that was derogatory to Australia, I'd love for you to point me to it in the transcript, because I don't see it. Let's move on to Tom on Gross Eel. 19 minutes ago, I'm setting up an irrevocable trust for my grandkids. How do I get a new tax number to open the account? So if you go to the Internal Revenue Service website, you will find guidance on applying for, it's going to be called an employer identification number most of the time. You may see it sometimes referred to as a taxpayer identification number, but the process is very similar. There is a form for, the form SS4 is going to give you the option of, it lets you apply for a unique tax identification number for a trust that will give you the ability to, assuming it's not a grantor trust, that it has a tax existence separate from yours as the person, as the grantor, as the person creating the irrevocable trust, the IRS will give that to you, and then you will get a notification of what that number is, and that number will go on trust tax returns in the future. It'll go on any investment accounts that you may set up in the name of the trust. That'll be something that you'll want to do sooner rather than later, because those tax attributes, if you have set up the trust to be a separate tax entity, then you do not want IRS forms. You don't want the reporting forms that tax reporting forms that a broker or another party may create at the end of the year at tax time. You don't want those with your individual Social Security number on them, or else there's likely to be confusion. It doesn't mean that the rules don't apply, but it does mean that the IRS computers are going to see this income and they're going to say, well, it's Tom's ID number on here. And it's going to, when you report correctly, the number's different because some of that income's actually to an irrevocable trust. It's still going to raise a flag, and you may end up getting a letter. It may be a confusing experience. So highly do recommend go, get that form done, get that identification number. And it's a service, frankly, that if you are setting up an irrevocable trust, most estate planning attorneys, they will have access to that. That's something that, frankly, when, the law firm would do it for you. And so I'm kind of surprised to hear, Tom, that anybody's expecting you to do that on your behalf. Maybe you're doing the trust without that kind of guidance, in which case, yeah, that would make total sense. But yeah, ordinarily that's a service that if you're paying for estate planning assistance, that's a service that I would expect to be included in that, or at least a handhold for you to get to the right place.
Mark, the train operator asks, what is subtracted from the payments? And I assume you mean Social Security payments, and it depends on your situation, right? So if you are on Medicare, Medicare will be taken out of your Social Security. But obviously, if you claim before 65, that will not be the case. And then the other thing could be taxes. And that's an interesting situation. You have a choice on how much of your Social Security is withheld for taxes. One of the biggest transitions, I think, for people who move from working for an employer, taxes are withheld of every paycheck, and then you get the W-2 at the end of the year. Then you go into retirement, and you're at a point where taxes may or may not be withheld from your various sources of income. And so you have to move to the world of paying estimated taxes, or you choose to have a certain amount withheld from your Social Security, from your pension, maybe even from your distributions from your traditional IRA, or even from your dividends or interest received in your brokerage account. And if you have an accountant, ideally they can help you work through that. But yeah, you can fill out a form that determines how much of your Social Security you want withheld. Mark, if that doesn't address the specific question you were trying to get to, let me know and I'll give it another try. And then a question from Paul. Imagine someone will be 70 this August and planning to delay benefits until then. With the change to the claiming process that begins at the end of March, should that someone claim now? This is a really interesting question, and I certainly would hate for someone to choose a smaller benefit for the rest of their life based on the, try not to get too political, uncertainty, shall we say, about what's going on with Social Security claiming process. Many people are going to be fired from the Social Security Administration. Many offices are going to be closed. And then there's this whole requirement of being in person in some situations to claim your benefits. So you have to make the decision yourself. I cannot predict what is going to happen to the Social Security Administration. If personally, I would probably wait, because I am not in a situation where I need Social Security. If I were retiring today, I could put it off for a few months to make sure that I get to maximize my benefit and ride out any uncertainty over what's happening now in the Social Security Administration. But it does depend on your situation. There is no question, though, that if for any reason you need any help from anyone at the Social Security Administration, do it as soon as possible. Because I think what is happening there now is going to make it much more difficult to get anyone on the phone, anyone to respond to an email, or for you to get an appointment at an in-person location, especially if the location closest to you is due to be closed.
And if you have customer service problems with your Social Security, then you know who to talk to about that. Let's see. Dan Park from a week ago asked, Dan and Bro, Medicaid limits assets if you need long-term care to around $2,000 to $3,000. Can you move assets perhaps by trust from one spouse to another so that you don't bankrupt the other? So, Dan, this is an element of financial planning that is so important that there's a separate kind of separate branch of planning around it. Some call it elder law, some call it elder care, elder financial planning. I believe even that there's, Bro's a CFP, a certified financial planning professional, and various other folks have different letters after their name. I believe that there's a specific designation that goes to specialists who understand government programs well enough, like Medicaid, to be able to do planning around it. And there are planning opportunities. I have known clients that have set up Medicaid trusts, that the idea being to allow for the passage of assets to other people while not, while legally making their available assets such that they may at some point in the future qualify for Medicaid benefits, with the anticipation of exactly what you're saying, preventing the bankruptcy of all family members involved, making sure that family wealth is preserved. Directly to your point, Medicaid does have provisions that are intended to try to prevent what they call a spousal impoverishment. I'm just going to share my screen really quick here, just to kind of show you when you go to the Medicaid website, there's, the site acknowledges the fact that there's an expensive nursing care. It's thousands, if not tens of thousands of dollars a month in some areas. And it'll devastate you financially. I mean, it does not take long for that to be the case. And so going to the Medicaid website, this is easy to find. If you just do a search on Medicaid spousal impoverishment, that'll get you to the site. And once you do that, there's a wealth of information there that will talk about what you're taught. It'll get you to the point where you feel a little bit more informed about it. And then you can go talk to one of these professionals about what you need to do it. Just be advised, it's more complicated than just like writing a check to somebody else. Medicaid does have anti-fraud provisions that basically, they'll track over a certain period of time whether you have made significant transfers of assets to other folks, presumably with the goal of shielding those assets from eventual collection and accelerating your Medicaid eligibility. That's something that to be aware of. But that said, I think that there definitely are planning opportunities here that you can do, and so it's worth taking the time to do a little bit of extra work and to try to figure that out. And then I'll take PayPay just had a couple of comments. I'm not sure if they intended to be questions. Points out, my husband's 60, I'm 55. My husband's freaked out about Social Security running out of money, wants to claim early. I tell him that advisors are saying to wait, but he doesn't believe. I'm frustrated. There's lots of fear. I don't know how to talk to him about this. Pepe, I think we're all feeling it. And it's difficult to have conversations about this stuff right now just because there is uncertainty. And there has been uncertainty. And frankly, there will be uncertainty. And you're never going to be 100% sure until things play out what was the best move. I think what I would suggest a couple of things. One is understand that with every money decision, and this is going to get a little bit into my personal views on, on financial planning for people in relationships, because money is a huge stressor. Money is a big contributor to stress in relationships. It can be a big reason why they break up. It can be a big reason why they run into difficulties. And anything that you can do to get on the same page financially, in my view, reduces the chance of creating relationship problems that can balloon and become problematic. I understand your frustration. My view is try to, if it's possible, try to figure out what is at the base of, if somebody's uncertain, if somebody has a view that's different from yours, try to figure out what's at the base of that. Is there a life experience that they had perhaps before you were in a relationship? Is there some life experience that has guided their philosophy of finances in a way that's different from yours? And is there something about your experience that that leads you to take the opposite view, whatever we're talking about? And then from there, I think that you can build on that, and you can kind of come to an understanding. You kind of figure out, okay, yeah, this is why we're doing this. And maybe you think it's irrational, but maybe there is a reason behind it, and just honoring that reason can make a difference. The other thing is, compromise can be important. And so, it may well be that if you run the numbers, financial advisor is in the lovely position of not necessarily having to, deal with the interpersonal dynamics of the relationship. And that's one reason you get the outside personal financial advisor, is they can just tell it to you straight. But good financial advisors will recognize that you may not always take what the book says is the best answer. That might not be the best answer for you, because of these personal aspects of it, because of these different priorities that you and a person you're in a relationship with may have different from like what the book is saying is important. And so do not necessarily think that if you do not achieve the result that you would do if you were by yourself making your own decision, if you don't get that, it's not a loss. Don't see it as a win or a loss. If you can come to a compromise and understand each other and reassure each other that you're making a decision that both of you can live with, that's going to be good for you, then that to me is the goal. And that to me affirms the relationship that you've had.
I'm going to start by sharing my screen because we're getting questions about claiming strategies for Social Security. Understandable, given what we talked about. And I'm going to share my screen. Those who've been watching for a long time know these things. These are the tools that I offer all the time in terms of helping you determine when is the right time for you to claim Social Security. OpenSocialSecurity.com is a free tool. The T. Rowe Price Social Security Optimizer is a free tool. Maximize My Social Security costs, I think, $49. And each one might give you slightly different answers, but ideally what you're looking for is also the explanations. Why are they giving me this recommendation? So I'm going to leave those up for while I answer my next two questions, because they're somewhat related. From Linda 40, my lower earning spouse took Social Security before full retirement age. I, the higher earner, plan Social Security at 70 with the thought he will get my higher Social Security at my passing. What are your thoughts? So this is a very common strategy, particularly when there's a big difference in the earning, but also a big difference in life expectancy. Because normally, as I said in the beginning of the show, the higher earning spouse is the husband, who often is older than the wife. So there's something like a 75% chance that the husband will predecease the wife. Your situation is different. Of course, I don't know your age difference. You may be considerably older than your husband. Probably not, though, from what you've said there. This is a little different situation, but there's no question that in general, for the higher earning spouse to delay claiming will sort of give you the biggest bang for the buck. Once you claim, your husband will be eligible for the spousal benefit, which is half of your benefit, but it's a little complicated by the fact that he claimed before his full retirement age. So that's why I wanted to highlight these tools, because it really does depend on your ages and the differential between your earnings. And then Harold has a question. If payments are based on actuarial tables of life expectancy, on average, shouldn't the total benefits be about equal regardless of when started collecting? And that's generally true, right? The differences in how much you receive by age are based on actuarial tables, and in the eyes of the Social Security Administration, when you claim shouldn't matter, because by delaying, you'll get a bigger benefit, but you'll be receiving fewer benefits because you waited, and it should all even out. The counter argument to that there's really two. Number one, well, maybe three. One is some people think that the actual tables have not been updated recently enough to reflect increases in life expectancy. Number two, those actual tables are based on the average across the United States. And for people watching this show, you tend to have higher levels of education and higher levels of wealth, which are two characteristics that indicate you probably, but not definitely, probably will live longer than the average. So that would indicate that waiting would be a better strategy. And then the third thing would be thinking of Social Security as not an investment, but insurance. And the reason you are investing in Social Security is you want to have insurance against living a long life. So you're not really looking at it in terms of what's going to provide the most benefits. You're looking at it as what's going to mitigate important risks. And one of those risks is living too long. Another risk is inflation risk. But the more you delay your Social Security, the bigger your inflation adjustment you'll get. So things like that. So basically what it comes down to is what you wrote, Harold, is exactly what the Social Security Administration would tell you. But depending on your individual circumstances, whether you expect to have a below or above average life expectancy would influence when the right time would be for you to claim.
All right, bro, I'm gonna lean on you a little bit for this next question because I would imagine it's one that you deal with in your volunteer, very much appreciated volunteer role for the Volunteer Income Tax Assistance Program. That's Borzu from 30 minutes ago. If a person was single and made less than $25,000 because Social Security was all they made in a year, would that person have to file a tax return? Now, where this hinges for me is what the definition of gross income is, because I'm going to share my screen and I'm going to go, what I'm sharing is the IRS website on whether you have to file a return, how much income you need to have in order to file a return. And it will say that if you were under 65 and single, then you need to file if your gross income was $14,600 or more. 65 or older at the end of 2024, again, single 16,550. Different numbers for different filing statuses, but those are generally the numbers. But the question is, what is gross income? Now, we all know because, well, we don't all know. Let's be fair here. We've talked many times about how not all Social Security income is subject to taxation. It is not automatically included in adjusted gross income. Only if you have income above a certain threshold will income from Social Security, a portion of that, be included in your gross income, in your adjusted gross income. What I don't know off the top of my head is whether is that, I can recall the tax return. And the way the tax return does it is that you put your total Social Security benefits, 100% of your Social Security benefits, in a box, but it's not a box on the right side of the page. It's a box kind of in the middle of the page. And then when you carry it over, that's like line A. And then line B was put the taxable amount in there. Put the amount that you do the calculation for the threshold up to 50%, up to a certain threshold, up to 85%, up to, above that number, above that second number. Whatever the calculation is, that's the number that goes in. That's the number that adds up to adjusted gross income. That's the number that is important for tax purposes. But for purposes of filing the return, that's what I don't know off the top of my head. And so, bro, I'm wondering, you probably get folks at the Vita all the time where like most or all of their income is Social Security. Do you feel comfortable like saying one way or the other, like how this gets treated, or is this just an accountant question?
So just so everyone understands what Dan's talking about, I'm part of the VITA or VITA program. It's a volunteer income tax assistance program run by the IRS, where we prepare tax returns for free for lower income citizens. And part of the training covered this. If you are single and the only source of income you have is Social Security, then you will not owe federal taxes unless you have a really big amount, because first of all, you have the standard deduction and it's higher for those who are 65 and older.
Yeah.
So the only reason people like that come into our center or file their taxes is because they want a refund. But there might be other things, right? You might have other sources of income, whatever, your interest, your dividends, your traditional IRA distribution. So that's why they come in and want to make sure. But really, for most people, if your only source of income is Social Security, you're not going to owe taxes. So you generally don't have to file a tax return. But I will say, definitely look at that page on irs.gov to make sure that is absolutely true in your situation, because I definitely don't want the IRS to come after you. And you might just want the record as well, because you want it for one of the things that you have to do when you're an executor is file taxes for the person who is deceased. You may want to just have those records for whoever your executor is if you were to pass away.
Thank you. No, I appreciate that. And then let me just take Mike G's question real quick. I received 2 corrected 1099 INT forms from an account. Does the March one supersede the February one? How should these be handled? Mike, yes. and pointing out, lucky procrastination paid off. Mike, I'll tell you, yeah, these corrected 1099s are terrible. And they are a result of the fact that the IRS puts deadlines on the financial providers getting 1099 information out to folks. And so even if a company kind of knows that what they put out in mid-February might not be right, they still have that mid-February deadline or that the end of January deadline or whatever it is. And so a lot of companies, they'll crank it out, and then, sure as punch, you're going to get one in mid-March that's like, nope, sorry, we were wrong. Here it is. Different types of investments, oftentimes you'll find this. Don't see it very much with interest forms, because interest is pretty simple. So I'd be curious what they goofed up on with that. But yeah, it's definitely something that you follow the latest correction is what happens. And you'll notice on the box, on the 1099 itself, there's a box that is checked off when it's a corrected form. That's how the IRS knows that you'll correct it, to use the corrected version and to ignore the other version. It ties the two. The IRS will look at the information that the employer identification number for the paying entity for the financial institution and do the cross check and say, yeah, we're tossing out the first one. We're taking the March one. That's the one that we're gonna hold you to when you're reporting on your taxes.
T-Stock asking a question that Dan and I helped a USA Today reporter address in a recent article. What if someone doesn't need Social Security until age 70, but claims at 62 and invests for the income at 8 to 10% return for 8 years, better long-term outcome? So you'll get different opinions about this from different people. I recently tried to use a retirement calculator, and found that 9% was the point where if you can earn 9%, then it might make sense to claim early and invest it. The problem is anything that's going to earn 8 to 9 to 10% is the stock market. And so it's not guaranteed that you'll get that. So you're taking a bit of a risk, number one. Number two, if you are, as I said earlier in my presentation, if you are still working at age 62, and then you're before your full retirement age, you may have to give back some of the benefits. So the quick answer is yes, it could work out, but there is no investment that provides a guaranteed 8 to 10%. So if you claim early to invest it and then the market tanks, you would have been better off waiting. And then Zach says, my wife is planning to stop working for a bit. She has money in a company 401k. Any thoughts on the type of account to transfer it to? Does it have to stay in the 401k? It does not have to. And in fact, if there's not a lot of money, they may kick you out. So if you ever get a check from your 401k, you want to very quickly deposit it. Well, in your wife's situation, since she's not working, into an IRA. If she were working, you could deposit in the new 401k. But so I would say in most situations, for most people, rolling it over to an IRA is the better bet, because 401ks do have costs that are often borne at least partially by the employees. Plus, you only have a choice of 20 to 25 mutual funds. They may not be the best. Some may be good, some may be not. You're going to have many more options to rolling it over to an IRA. Ideally, a trustee-to-trustee transfer where the money goes directly from the 401k to the IRA, and you don't have to touch the check. If you do get a check, get it into the IRA as soon as possible, because if you wait too long, it could be considered a distribution, and it will be taxed and penalized.
All right. Harlan asked, good morning, bro and Dan. What are the income limits for deducting traditional IRA contributions from AGI? I just submitted on Slido the Motley Fool article that talks about this. You will find that there are different income limits depending on whether you are or are not covered by a workplace retirement plan at your work. If you're working, if you have a 401k, or a similar plan, different income limits may apply, but you can take a look at that, and that has all the numbers for you. I won't run through the numbers here because we're running out of time, and you can run those numbers for yourself. Cena from, let's see, am I stealing bro's question? No. Cena 21 minutes ago said, morning, fools. I did my taxes last week. I see Intuit is now offering will and estate building services and software. Dan and bro, any experience there? No, I have not seen that. I don't know if Intuit has, if they have legal professionals doing that in-house for folks, or if they're trying to claim some sort of exemption from the unauthorized practice of law for this sort of thing. I don't know. I'm gonna have to take a look at that one, Cena. But I'm always, I don't know. I'm a believer in having separate people do separate things that they're specialists in, rather than necessarily having one person, do everything if they aren't fully qualified for it. And so that, yes, I understand businesses like to, vertically integrate and have multiple revenue opportunities, but I'm not sure that the typical accountant is not going to be able to draft a will or a trust. So that's the question that I need to look at to see if Intuit seems to be doing a good job there, or if any of these folks are going to do as good of a job. In my view, I think having a dedicated professional on your side is worth the cost, but I understand that a lot of people, cost is a more important concern. And so services like this might be attractive. The question is whether they get the job done. And that may be one we just have to wait and see how folks fare under the documents that they help put in place.
Let's see. I'm just going to handle just a few really quick ones. Let It Ride asks, any rec for filing a very simple tax return for free? I put the link in to the IRS free file page into Slido. You'll see it there. And those are partnerships with professional providers that will let you file for free. I have not looked at it in a while, so I don't know how many folks are part of that partnership. But for the VITA program that I do, and there's also one run by AARP, it's generally if you earn less than, I think it's $67,000, you can go into a center and get your tax return filed for free. That's one thing. I would just want to, what other was a comment from Neil in Rockville, though it's not an issue for probably 99.9999% of people. Remember, when transferring out of an employer's 401k, there could be ERISA consequences to consider. ERISA is the Employee Retirement Income Act of 1974. I think the point Neil is making, and it's a good point, is that there is there is a certain level of higher legal protections in a 401k than an IRA, like bankruptcy protections, and if you're sued, it depend on what the claim is and what your state is, because states have different limits for IRAs. But so that is something to consider if you feel like you're in a situation where you may be sued or go bankrupt. And then there was just one other quick one I wanted to get. Where'd it go? Yes, from Mountain Man. I claimed Social Security after my full retirement age and then did a file and suspend. Good for you. Social Security told me that when I turned 70, that the payments would automatically start again. Agree? Yes. So if you file, then suspend after your full retirement age, you could refile again before age 70, or once you hit age 70, you'll just automatically start up again.
Yeah, I checked that out. The IRS website does, in fact, say that very specifically, or not IRS, the Social Security website says that very specifically. That that is definitely something there. I'll just take one real quick. Linda 10 minutes ago asked, where would you put excess required minimum distributions? Put them in a Roth, a regular brokerage account, CD ladder in a bank, others. Linda, it's kind of like asking, where should I put my money? I mean, there's nothing specific about the required minimum distribution money. Once it's there, and it's yours to do with whatever is going to work best for you. If you're still working and eligible to make Roth IRA contributions, then that may be an option. Leaving a brokerage account can work well, especially if you're investing in kind of tax-friendly assets like long-term growth stocks that don't pay dividends. If you're looking to flesh out a cash cushion, then building it into a CD ladder, that can work too. Gifts to heirs. You mentioned inheritances are an important thing. That might be something to think about. But it's all available to you. I don't really treat that money differently than I would treat anything. Unless one area, if you're making charitable contributions and you're over age 73, then taking advantage of qualified charitable distribution rules from IRAs can be a tax benefit for you. But that's kind of where I would leave it. And that brings us to 11 a.m. and let us pass things over to an Ask Us Anything segment with Jose and Jason. But let me just call out our folks, including Natasha Hall behind the scenes, keeping our smiling faces in front of you. For my colleague, Robert Brokamp, I'm Dan Caplinger. Thanks for joining us for the Retirement Show. Have a great day, and do stay tuned. Jason, Jose, take it.
See you, fools. Have a great rest of your day. Hey, Jose.
Hey, Jason. How's it going?
It's wonderful. I'm glad to be on with you, and I like to call this the net contributors hour. Whenever I follow Dan and Bro, the retirement hour. Talk about people that are still putting money in their investment account, still earning a wage. But we'll answer some retirement related questions. At least I will. I know a pretty good bit about that kind of thing too. So financial planning, retirement questions, anything left over, I'll be happy to answer that. Jose, you are a tech expert. You know a lot about technology businesses, semiconductor companies. That whole space is something that you built a lot of knowledge around. So we will answer those questions for you and more. Put your question in, and we'll do our best to answer it if we can. If we can't, we'll let you know. This is not something that we're qualified to answer, and we can leave those questions for smarter fools to get to later. If you're watching on YouTube and you see the comments saying and it's shut down and you're like, well, how do I give you a question? See it right there on the screen. It says slido.com. Go to slido.com, put in the event code. It's Fool24. We're running a dual stream. We've got it on YouTube, but also behind the paywall for Motley Fool members. So we use Slido for questions from everybody. Get those to us. Always remember, too, just because we answer your question doesn't mean we're advising you what we think you should do. We don't know you, your situation. A lot of ethical and legal reasons why we're not going to provide individual or personalized financial advice. But that's sure not going to stop us from giving our opinions and our weighing in with our expertise and thoughts. So please share your questions with us. All right, Jose, do you see any questions? Have you found any questions you're ready to answer?
Yeah, I one about an hour ago, Jason, from Mikey. Is NVIDIA spending heavily to build more production capacity, or are they okay with the backlog of orders and catching up over time as demand may change? So Mikey, I'm going to say yes. Yes to both answers, actually. So, I mean, NVIDIA, while they're not the direct manufacturers of their own AI chips, they just do the design process. They do work really well with everybody that goes in the supply chain, right, Jason? So, for example, to kind of build these AI chips, you need a lot of memory. Jensen has mentioned it, like their B200 or their Blackwell platform has thousands and thousands and thousands of components. And to kind of build with this, NVIDIA kind of works with all those supplies, all those customers. And one way that they could be investing a little bit heavier than usual is because there is a lack of supply right now and so much demand, NVIDIA might go to these customers and say, hey, look, I'll make a bigger purchase order right now, or I'll pay you extra ahead of time, just so you can use that money to increase your capacity or your supply line, because some of these components are taking forever. So a kind of a supply chain player is not just going to build a new supply line unless they're getting kind of that help from that customer. And I'm going to guess NVIDIA is doing that with a lot of their partners, where they're either paying some of these POs maybe ahead of time to help increase maybe the research and development, or increase kind of the supply chains of these other players. Very similar to, even though their AI chips are built by TSMC needs to expand those manufacturing lines. They need to increase their wafer production, but also a special type of technique called advanced packaging. So again, NVIDIA can most likely be kind of paying either ahead of time to help with the expansion of this capacity, as TSMC will say, look, we're not going to expand our lines unless we see an actual PO right now, unless we see some actual money coming in right now that gives us a reason to say we're going to build these lines, and we're not just going to have them empty in a year or two from now. The other question here, Mikey, was is NVIDIA okay with the backlog of orders catching up over time as the demand may change? I think this is pretty tricky because NVIDIA is releasing a new chip on a yearly basis. The demand for one of their platforms might die out or might stay strong for a few quarters, but then the demand picks up for their next generation chip. So it's kind of an art trying to predict the supply and demand curve for a product that keeps getting renewed on a yearly basis. So while you might hear reports that maybe their last architecture, the Hopper, might be slowing down in demand, you're also going to be hearing that the current architecture, the Blackwell, is increasing in demand. And just because NVIDIA is producing a new chip on a yearly basis, they're always going to have a backlog for the next chip, because it takes some time to kind of see that ramp production. You can't just build 1,000 chips at once. Any supply chain, one at a time. So it takes some time before you kind of get to that curve. So I think NVIDIA will, at least for the foreseeable future, always have a backlog for at least their current architecture and the upcoming architecture, as supply is not enough to keep demand at the moment.
I got a question here I want to take, and it's I'm not surprised that we got it. Kim asked for my thoughts on KB Home earnings. So KB Home, ticker KBH. We got a question. We got multiple questions about it. BLSH asked about a half an hour ago my thoughts on home builders and KBH particular. So we can pull some of those questions out of the queue, and I can go ahead and respond right now. So taking a look at KB Home is the I believe they're the largest home builder in the U.S. and there's a few that are kind of in the top two, along with Lennar, KB Home, and one other that do, they're the biggest. But home building broadly is there's a lot of small home builders that do a ton of building. So as much as there are these large players, that think they're looking at their earnings as useful to give some trends. But you have to remember, like KB Home, for example, I think they're in like 50 different markets, which, depending on where those markets are, can be relative. I mean, it can give you some idea about the broader trends of the home building market, but it can also be very geographically specific, right? So, I try not to read too much into one individual company's reports, but I will say broadly, this was probably the weakest of the big builders' earnings results, and probably had the most muted outlook that we've seen so far. Now, part of it is their results. It's their first quarter of fiscal 2025, and it's through the quarter ended February 28th. So this is the deepest into the current environment. Most of the earnings we've already seen are for periods that ended before that. So I think that's part of it. It's not a comp to a lot of the earnings that we saw, several weeks back, which mostly were for quarters that ended at the end of calendar 2024. But just to hit some of the numbers, revenue was down 5%. home deliveries were down 9%. So I think that's interesting that home deliveries were down that much more. Their average selling price was actually up. We're not hearing that from a lot of home builders right now. Their average selling price was just over $500,000. Hence, revenue down less than their units. Operating income was down. Their margins were down. Like operating margin was 9.2%. It was almost 11%. So that's a pretty big delta. Their gross margin was down about 1 percentage point, a little more than 1 percentage point. So your gross margin is down 1 percentage point. Your operating margin is down, call it 1.5 percentage points. I'll add that up and it hit their bottom line. Pretty big, 15% decline in earnings per share. So net income was down 21%. So earnings per share wasn't down as much because they've have a pretty aggressive share repurchase program. So they bought back more shares. They ended the year with less shares than they started with, or the quarter with less shares than they had in the year ago period. Also, their tax rate was higher, about the better part of 1 percentage point higher. So add all those things up, and the environment that we're in is definitely weighing on the bottom line. And for home builders, operating leverage is really important. If you look at their percentage of revenue that goes to cover SG&A, sales, general, and administrative, that was higher. And then you look at their orders and their backlog. Net orders fell 17%. So the ending backlog of homes fell, and the value of that backlog was down 21%. So orders were down 17%, and the backlog value was down 21%. That's important for KB Home because part of their business model is houses that are kind of build to order. So it's their BTO model. Versus you look at a lot of the smaller home builders that are really focused on the entry level market, that they're building a lot of houses on spec, right? So one of the reasons KB is the biggest is because they build across the spectrum of the value chain for houses, from entry level and condos up through custom and a little bit into the higher end too. So because of that fact, they're seeing some of the negative consequences of higher prices and higher interest rates and more economic uncertainty a little more broadly, I think, than other home builders might be seeing. Their backlog was weakened. They saw weakened orders per community. Monthly net orders per community were down 1 full unit. They were 3.6 versus 4.6. Cancellation rate went up 2 percentage points to 16% versus 14%. So you look at all of those things, and there's definitely headwinds in the home building industry. They did in the quarter with 257 active communities. That's communities that are actually open and selling properties. With less 255 versus hang on a minute. Let me read this again. I read it earlier, and now I'm questioning if I read it the right way. So the average community count for the quarter was 257, and it ended with 255, but both of those were up. It was 7% increase versus the year ago period. So it's not uncommon. There are going to be periods where they'll end the quarter with more or less, depending on exact trends with selling through, closing out communities that they've completely sold through, and opening new communities depending on where they are in their build cycle. So, but again, the key here is that it's healthy and it's up a little bit year over year. So what that says is that the market is still, I think you could say, healthy-ish, because the trend is still for growth across the industry. You look at some of the things like LGI Homes was very optimistic, or I should say modestly optimistic. Dreamfinders Homes, they were very positive and optimistic with what they said. Now, the difference there is with those businesses, LGI Homes is in Texas in the Sun Belt. Dreamfinders is almost just in the Southeast. They do a lot of business in Florida and kind of up the East Coast there. And KB Homes is a lot more geographically diverse. So because of that, we're seeing some impacts in multiple markets that are affecting KB Home. Guidance, pretty muted. A couple things worth pointing out. Remember that 500,000 average selling price, Jose? They're calling for the full year average selling price at the midpoint of guidance about 485,000, 487,000. So they're calling for that to continue to decline. They're calling for operating income about 9.4%. So continued erosion of operating margin. They're calling for gross margin between 19.2 and 20%. Again, we were right around 20% for the first quarter, and that was well down from the year-over-year period. So we continue to see deterioration of the results. And SG&A expenses as a percentage of revenues continue to move higher. So again, selling general administrative expenses, selling expenses in particular, they're having to spend more on marketing. They're having to spend more on things like buying down interest rates, special promotional things that they might do that are costing more money, and they're weighing on cost of goods sold. For example, if you throw in something, free appliances, right? That gets baked into cost of goods sold. If you spend more for marketing, that's SG&A, which is an operating expense. So that's how the impact of the current environment and some of the headwinds are affecting the housing industry broadly. They also expect to end the year with about 250 active communities. So again, that's down from where they were at the beginning of the first quarter and at the end of the first quarter. But again, still within a healthy amount as they kind of go through sell-through. And what it says to me, Jose, is you've got the biggest builder saying, look, it's going to cost us more money to sell houses this year. We're going to have to be more competitive, whether it's because of the economy and softening demand, or it's because of rising costs, lumber costs, labor costs, higher interest rates that are affecting prices for buyers. So again, costs are the things that the company pays for. Prices are the things that the customer pays for. They're getting squeezed on both ends of those. So they're having to soak up costs. They're having to increase their costs and soak up some prices to get to deals. And if you think about their community count, again, looking at a decline from where it is now, part of that is just managing their business and also being mindful about not overbuilding in 2025 when there is a lot of uncertainty around labor and lumber. And also, this is something that I haven't seen from a lot of the other smaller home builders. KB Home is talking about land costs being a pressure on their results. So again, it's much bigger than a lot of these other ones that we talk about. These guys sell more homes in a quarter than some of these sell in a full year. So I think the results were fine. They were more or less in line with my expectations. I know that revenue and adjusted earnings, fell short of analyst expectations. The stock's down probably 5% or so today, last I looked. But that's not a big surprise when your results come in a little under expectations and your guidance is pretty muted and you're guiding for basically a deterioration across your financial and operating results. It's not a surprise. This doesn't alter my thesis for home builders over the long term. Again, I'm thinking 5+ years for home builders. I still see a lot of opportunity, but it just reinforces something that I've tried to repeat often whenever I talk about home builders, Jose, is that while I do see that wonderful opportunity, especially in environments like this, when we're starting to see a little bit of deterioration in the cycle, that's what creates opportunities for us. And as much as I think a lot of these home builders are attractive at today's prices, I think there's a very good chance that the cycle does deteriorate more and we get better prices in the coming months, over 2025. But I'm not betting on it. That's why I've made substantial investments, adding to the home builders that I already own, really since like late January, coming through the past couple of weeks. I've added to positions, but I'm prepared to add more if we see the market continue to soften and the prices get more attractive, because there's thankfully we're not guaranteed a recession or a bad economy, right? The economy's okay right now. It's not bad. And if we navigate this period of uncertainty and all of the geopolitical things that are creating a lot of concern and worry, on top of the material impacts for the home builder industry with Canadian lumber and a lot of labor that comes from our Latin American neighbors, those pressures are there. Those things could change overnight or within weeks or days. So once we get more clarity on those things, I think the situation for buyers and for home builders gets better. And I continue to like the industry a lot.
Thank you, Jason. I'll take a question that came in about 15 minutes ago from Everything is Fine. Everything is fine. We've had a few discussions this morning about possibly overbuilding data center capacity. Jose, what's your take and how it may impact NVIDIA and other semiconductors? So for those that are not familiar, earlier this morning, we did have Alibaba's chairman, I'm going to butcher his name. So I'm just going to stay with Alibaba's chairman, mentioned that he thinks there's an AI data center bubble happening right now. And then some of the numbers that are being thrown out in forms of AI investments are pretty insane, like Stargate being $500 billion. And some of these data centers are being built out even before kind of any customers have any contract with any customer. So they're just building data centers, expecting the demand to be there when these data centers are built out. So first, I would like to remind that the Alibaba chairman has is most likely focused in the Chinese market, and something in the Chinese market that is important to remember is the export restrictions, that they can't get the best AI chips. I do believe here in the United States, if we only had the H100 or the H200, we probably would hear the same thoughts about kind of data center capacity at the moment. But because we do get the best of the best chips and they are adapting on a yearly basis, I think that's kind of improving the need for data centers continuing to be built out. The other thing is there are reports that came out earlier today, Jason, that Apple is finally joining the data center race. And these are reports by, I believe it's Loop Capital. Let me just double check one more time. Not Loop. Yep, Loop Capital analyst today mentioned that Apple is in the process of placing orders for about $1 billion of NVIDIA's GB300 system. And this is, if true, again, right now we are just getting these reports from analysts, but if this is true, this is the first time that Apple is actually entering the AI server race. This is a company that has focused on maybe designing their own AI chips, on maybe kind of renting out server solutions from other cloud server providers. But if they do kind of build out these data centers, Apple kind of entering at this moment, it gives me more indications that we're still in the AI race to go. What else are we hearing? I mean, GTC happened last week for NVIDIA, and we're seeing vast demand for AI solutions. NVIDIA's recent earnings that happened just a month ago mentioned that demand is still insane. And we've also had positive commentary from every other kind of semiconductor company. TSM, which reported about 2.5 months ago, mentioned that AI demand continues to be strong, and they expect to double after tripling this year in forms of revenue. We heard Micron last week mention that HBM is still at supply capacity, and they increased their total addressable market. So what other companies are telling me, and the evidence on various companies, is not just NVIDIA, right? It's everybody in the supply chain is telling me that the AI market is still pretty healthy. Cloud providers are telling me that they can't grow. They could have grown faster if they had more capacity. But one chairman in an individual country that kind of is not able to have the best of the best AI chips is telling me that there might be an oversupply build. I don't know how much I would take that. But I do believe noise like this will continue in the AI market. And this is what's going to create a lot of volatility. We might have pocket of weaknesses in certain geographics, in certain areas. And that's always true with any technology. But I think the overall trend, the overall global trend is still very positive for data center companies.
Yeah, I think that's right. I just want to touch on it, the Apple mention real quick, because a lot of people just may not understand how central Apple's chip design business is to its success really over the past decade or so. Once they really essentially completely moved away from Intel at all, because Intel was supplying chips like for their PC, their Macs and their laptops and PCs, and they began to really fully internally design, they could fully integrate across platforms and really lock that ecosystem down, no matter what Apple device you were using, to have your experience and your contacts and things like being able to send messages from your PC or your smartphone. Like integrating all that was a big deal, and a big driver that was their total internalization of chip design. And it's been a big benefit for them in terms of performance, driving down energy consumption, And what we're seeing now with their integration of on-device AI that we're just in the early stages of, Jose, with the neural network and having so much power with GPU, CPU, some shared resources that they're able to leverage in their portable devices, that I think does give them some competitive advantages. So their skill set to be able to leverage that further upstream, it remains to be seen. Are they going to be able to design GPUs that make sense for their use instead of using something like NVIDIA? I don't think we're going to be there for some time to come, but don't sell Apple short when it comes to being a continued driver of demand for the data center for artificial intelligence. I think you're spot on about that. All right, Kim, this is a question I've kind of owed some folks an answer to for a while now. Kim asks, Jason, have you had a chance to look at Millrose, ticker MRP? This is the Lennar spinoff. So Lennar, again, one of the largest home builders. They first announced this, I believe it was late last year. And it's interesting because this decision by Lennar to spin out its property development business was actually one of the catalysts for me to finally invest in Lennar. So Millrose Properties was, before it was spun out, and it was spun out, I believe, in early February, it was the part of Lennar that would actually go develop properties. So you get the land, you've got land, okay, you want to build houses on it. Well, what do you need to build a house? You need roads, you need sewer and water and data infrastructure. You need all of that stuff piped in and paved in and ready. So a lot of home builders, have shifted to a more and more asset light model where you don't want to have all of those things in house, because when the cycle turns, you've got a lot of operating costs that you're still having to manage. You don't want to own land until right before you're ready to build on it. You want to pay some money, pay a premium to the property owner for a land option, and be able to acquire that land when the time comes to start developing on it. So a lot of builders have become more and more asset light. And for Lennar, this was a big step to being no longer doing just about any of those pre-built things in-house. So they spun off Millrose. So my analysis on Millrose at this point, it's still a little bit in my too hard pile, because as much as it's its own company, a standalone publicly traded business, and the platform that they've built is to support the home builders out there that want to have that kind of just-in-time land asset light model for acquiring and developing land. But at this point, it's basically like a land drop-down asset for Lennar. It's going to take some time to develop relationships more broadly across the home building industry and the markets that it operates in. But just for example, okay, so I'm looking, okay, yeah, it was February 7th was when it was spun out. On February 10th, Millrose acquired Roush Coleman's land assets. It was acquiring those land assets at the same time that Lennar was acquiring Roush Coleman, the builder, was acquiring its builder assets. So Lennar acquired a home builder, did not want the land assets. So Millrose acquires the land assets as part of the deal. So I think we're going to still see a lot of like those closely related party deals that are going to happen. At some point, Millrose needs to demonstrate its ability to stand on its own 2 feet. So my intention, I own some Millrose shares that I got with the spinoff from Lennar. It was a tax-free spinoff, and shares were paid basically as a dividend to Lennar shareholders. I'm holding that very, very small position. It's a handful of shares, because my Lennar position was just a starter position. Again, all the things I talked about before with KB Homes, with my concerns about the market for this year. So it's a very, very small position, but I continue to hold it because it's like a place marker for me to continue to pay attention to what's going on with Millrose. I want to give Millrose, a year or so as a standalone company to see how its balance sheet evolves, to see how its relationships and contracts with other builders evolve, and if it can start to deleverage itself away from Lennar and stand on its own as a standalone business. I think it could be an interesting, compelling business, because it's taking on some of the risk that home builders are trying to avoid. And if you can do that with a strong balance sheet, and part of the goal here is to be a dividend paying business. So I want to see what their structure is for paying out the dividend. If they're going to pay a small base dividend and then try to pay special dividends like Costco does and like some of the oil and gas producers do, when profits are really good, you got a lot of extra money you don't need, then you pay that, every year or two back to shareholders. I want to see what their model is going to be for that before I really make any decisions. But I think at this point, probably the smart thing for most people to do is just to give it time to grow up and see if it can walk on its own and then run on its own. At least that's what I'm planning to do. Jose, what you got next?
So interesting question here coming in from where do I have it here? About Tony Loving 26 minutes ago. Is it too early to invest in companies like Joby and Archer? And both of these are companies that work in the electrical vehicle vertical takeoff market.
The EVTOLs, right? I think that's what they.
Yes.
Yeah.
And I think this is such an interesting question, Jason. Is it too early to ever invest in the company? I don't know if there's a yes or no answer, but you have to understand the puts and take with each with a question like this. Obviously, we don't see these types of vehicles in the consumer space right now, right? So we're not seeing these types of vehicles moving right now. So we can see we are early in forms of consumer adoption, and this can be early in forms of regulatory. Now, when you get in early, you tend to probably pay smaller valuations on these companies based on how big the market can go. But those, I think this is when you start to see higher risk on your investment. So the earlier you are, right, Jason, the higher your risk is. I think it's very
exactly. So the percentage of the future potential market that you're paying is smaller, but the percentage of probability that the company delivers positive results is also smaller, right? Right.
Yeah, so I think this is when I would consider something like this a speculative play. And sometimes maybe speculative play seems like a bad word or a bad theme saying that it's a bad stock. I don't consider it a bad thing, but it's just I understand, like we just mentioned, Jason, that the risk is higher. So because the risk is higher, if I was to enter into this market, it would be a very small position because we talked about the probability of that success, more competitors coming in. They might be some of the first movers right now, but if the market continues to grow, you start to see more people entering that space. So the competition, while it might be light right now, can grow dramatically as we get closer to, hey, look, this might be a market that we should all see. There's right now, I was looking at price to sales ratio, Jason, for both these players on a forward 1 year basis. So within the next fiscal year, not this fiscal year. So the next fiscal year, price to sales ratio for Archer is about 30, and for Joby is about 71. So this is pretty far off in the future, and you're already paying for that premium. Now, both of these companies might have like some partnerships, some great news recently. I saw that, which company was it? I think it was Joby. Let me just pull back my notes really quick. I had some notes. Someone is developing a vehicle called Midnight. So that's Archer. So Archer started their production of a Midnight aircraft in Georgia. And they mentioned that they have secured over $1 billion in liquidity and plans to build up to 10 Midnight aircrafts in 2025. So 10 of these smaller vehicles, it's not like it's a massive plane. Usually in these massive planes, 10 is a lot, but here in these super small aircraft, 10 is definitely in early stages. So
this is still proof of concept. I think that's the key, right?
Yeah, and to me, Jason, there's other technology that I feel, for me personally, again, this is not personal advice, I feel like there's other technology that I feel can come into the market a little bit faster, maybe a little bit stronger than things like Archer and Joby, like the robotics market, for example. Maybe not the humanoid robotics, but more robotics in the industrial space, in the workspace. I think if I'm looking for an emerging technology that can grow bigger, I'm trying to look at one that the timeline might be a little bit closer, so the probability of success increases a little bit more. But yeah, I think this is always interesting if it's too early to enter, and it's all about that risk to reward and the probability of success.
Yeah, I want to kind of invert this question a little bit using Charlie Munger's inversion principle, and let's flip it over. And is it, instead of saying is it too early to invest in them, just say at what point does it make sense to invest in businesses like this? I think might be a more useful question to ask and try to answer, because the reality is, as investors, companies go, they have this continuum, right? And at some point, the continuum kind of breaks off depending on the company. So you go from idea to funded idea to startup to initial commercialization to break even to cash flow positivity to profitability to, and along here, you're talking about disrupting existing industries or maybe forming new industries along the way. And at some point you turn into a stable rule maker. You go through your rule breaker years and you become like the rule maker, and you're the stalwart, you're the stable company. And there's still growth along the way there too. And then at some point you just become like this stable, good business that has large economic moats and generates good results. Now, of course, again, there's some break off because, you have idea that nobody funds, right? So that's a failure. You have idea that somebody funds, but you never get to a proof of concept and you fail. You get to like some initial proof of concept, but you never get to commercialization and you fail because you can make it work, but it costs 10 times more than anybody would pay for it. So you fail. You get to that initial commercialization and then you find out, you know what? The addressable market's like 10% the size we thought it was, and you fail. Right. So all along the way, or a bigger competitor comes in and acquires you, and like that could be like, that's a version of success, unless your stock went nuts and they buy you when the stock is down 90%, and you're an investor that bought somewhere along here. That's a fail for you, even though it's all the people down here, they did okay and they made money. So there's lots of failure points along the way before you get to that point of success over the long term, I think is the point. And what I as an investor have to decide is, where along that curve of all those risks does it make sense for me to deploy my capital? Because if you sit down with a financial advisor and they give you a quiz to take to help figure out what is your level of risk tolerance, they're actually measuring your volatility tolerance. Okay. They're not measuring your risk tolerance. I like to follow David Gardner's, I'm not sure if David came up with this himself, or it's the concept has been around longer than David's been alive, but the core concept I attribute to David to giving it to me is, risk is the probability of a permanent loss of capital. Like, what is the chance of you permanently losing money from something, right? Volatility is risk when you don't have the capacity to hold through the downside of that volatility, right? Right. The market goes down, you panic and sell. Or the market goes down and you needed money and you have stocks and now you have to sell, right? So your ability to hold through the volatility part of the downside to get to success is really, really important. But again, can the company get to that permanent level of success? And the reality is that for companies like Joby and Archer right now, we have no idea. Even the people that follow these companies in this industry extremely closely have no idea if these companies can become profitable businesses that generate return for investors. I want to stress that second part. There's been tons and tons of successful businesses that did not make any money for shareholders. Okay. Here's an example of a company. Plug Power has been around for 25 years, and has never generated a single positive quarter of positive operating cash flow in 25 years. The returns for investors are enormous over that period. So companies can exist for a very, very long term and be successful as a going interest, but not be successful for you or me as an investor. I think that is the important thing to remember. And Jose actually has already given the best answer for this. And that is, if you're interested or compelled in an idea, the best way to help manage your individual exposure to that idea on the downside is position sizing. Anything from 0 to whatever you decide is a level of capital that you're worth risking that you could lose the entirety of in a business, in these sorts of businesses, because they're still so early in their existence that we just don't know. We don't know what they will look like when they grow up, and if that's going to be worth more or less for shareholders than the stocks are worth even right now at this phase, because there's been so much heat and light and focus on them from retail investors and some institutional, but mostly us retail investors because of the headlines. And let's face it, I'm 48 years old. I'm finally about to get the flying cars that I was promised as a child, right? They're almost here. That's exciting. Of course I want to invest in that. But for me, I don't see a super high probability at this point. So they're in my too hard pile. But at the same time, I'm the guy that's investing and saying that I think QuantumScape, the battery startup that's still in that pre-commercial stage, I believe that company is going to be financially successful. They also haven't sold a single thing on the commercial side. So, it's all about where your expertise and where you fall as an investor, whether it makes sense or not. And in the case for me, this EVTOL market, I'm not excited about it. I'm not compelled by it. But your mileage may vary, I guess, is the big thing.
Yeah, and Jason, let's see if I can share screen pretty quickly here. Sometimes we start to hear, I feel like I hear questions like this a little bit more often when maybe we get scared of kind of like the big tech players or kind of these big companies. But I just want to show a quick chart of the past 10 years of Apple, Microsoft, and TSM's returns. 10 years ago, these still were massive companies. Apple, over 600% in the past 10 years. That's over a 7xer in 10 years. Microsoft, 820%, over a 9-bagger there. Taiwan, over 600, over 7xer there, right there. So it kind of just shows you that even these big giants can still provide great returns for investor. If you told me my portfolio more than 5x in 10 years, I would be super excited. So sometimes we try to find these massive winners with these kind of long-term plays, but these big tech companies have historically, as long as they keep innovating, as long as they kind of keep within the markets they're in, and keep being leaders in that space, they have a high chance of outperforming the market and making really, really great results for investors.
So we've got a question here. I'm going to do a little bit of research on this. The besties put in here. Why did EQT buy Zio from Crown Castle? Besties, I think you're mixing up two separate transactions. So I've seen some headlines and read a little bit. I haven't really dug into some of the details, but I know Crown Castle sold some of its business to Zio and sold some of its small cell assets to EQT. So I'm going to dig into that. So stand by on that. Jose, have you got another question you can grab?
Let's see what's some questions I can pull up from here. Paul mentioned any small caps on your watch list. So Paul, small caps for me are pretty much kind of in the similar discussion that we were just talking about. Small caps, usually smaller companies, which are early into their market or have maybe a smaller market opportunity compared to their peers. So I tend to make my position as well. I wouldn't make any of these massive position in my overall portfolio. One that I do enjoy right now is in the semiconductor space. Air Test System. They are an equipment player right now, about $300 million in market cap. Air Test System, they provide solutions to do kind of stress testing. Unfortunately, core products for them are used in the automotive industry, and the automotive industry is pretty weak right now. So that's one of the main reasons their orders have kind of taken a huge hit. But I do believe eventually the automotive market will turn around. So Air Test System is kind of my bet against on that, right, on the automotive turning around around and being a small player, it can benefit. Again, small position because it definitely comes with risk. In their most recent earnings, they mentioned that they've actually just filed the lawsuit in China against a competitor in China that might be taking some of their patent solutions to kind of create their own competition. So that's something to kind of be aware of. Some of the bullish takes, though, is they are expanding into other markets. Like I mentioned, they're stress testing mainly for automotive chips, mainly silicon carbide chips. But recently, they've made a few acquisitions to start stress testing AI chips. And as we know, the AI chip market is pretty heavy. So that's kind of a growth opportunity. Again, this for me would be kind of a it is a small play in my overall portfolio, but one that I see some growth opportunities. Another one that maybe I don't own, but I am kind of keeping a closer eye on, Paul, is Serve Robotics. So Serve Robotics, ticker SERV, market cap of about $500 million. They are providing these kind of last mile delivery robots for the food industry. Main reason I'm keeping an eye on them is they do have an order from Uber to have about 2,000 robots by the end of this year. I'm not sure if they will be able to do it, but for me, one of the reasons I'm keeping an eye on this one, Jason, is this is one of the first few companies that really is public and it's pure robotics play. So it helps me kind of, even if I don't own the company, I have it on my watch list so I can see how the robotics market is evolving. Because it is a public company and because they are pretty much more of a pure robotics play, they share a lot of great information in their slides. So as someone who's excited about the robotics space, this kind of provides great information. So Serve Robotics is one that I don't own, but one I am keeping a closer eye on as I see the robotics space is going to be pretty interesting maybe within the next 5 years. I'm not going to say next year. I'm not going to say 10 years. I believe maybe the next 5 years is a great way to start right now.
Okay. All right. Let me grab, I can get Bestie's question now. I've fully read and consumed all the information out there. So Bestie's question, why did EQT buy Zio from CCI? So I can tell you exactly what happened. CCI's Crown Castle. So first of all, this is probably not the EQT you're thinking about. This is not EQT Corporation, the oil and gas company. This is a private investment business of EQT, same name, completely different business. And this really goes back to all of the problems that Crown Castle has had over the past several years. So Crown Castle is a real estate investment trust that's primarily, I think it's entirely in North America, but it's basically a cell towers business. And they've tried to diversify over the years to juice growth. They've built up a fiber business. They've tried to get into small cell towers with 5G, which we've seen really is not doesn't directly translate to what these cell tower businesses like American Tower and Crown Castle are good at. So we saw back in mid-March when they reported results, they actually delayed their earnings by a day. And Tyler Crow, our colleague and a good friend of mine, we followed this company and this industry together for years. He predicted, he says, they've got a deal going with something. There's something they're trying to sell and they're close to the finish line. That's why this is delayed, because they are not going to announce earnings and get questions about other stuff they can't talk about when they can wait a day and talk about it all at the same time. And they did. They announced a big transaction to sell the fiber business and also the small cell business at the same time that they announced results. They also took a substantial write down to goodwill at the same time as that, which was basically it was saying, you know what, we overpaid for all this stuff when we bought it, because when you sell off assets and then you write down the rest of the goodwill when you do the sale, you didn't generate the value based on the price that you paid. So that happened. And the short answer is that Zio it's an infrastructure business, fiber and infrastructure business, I should say, that EQT has a stake in. EQT is one of the funders of Zio. So that's where the tie-in kind of comes in. But then the small cell business, I believe they sold that to EQT. So 2 transactions, 3 businesses, 2 of those businesses that have some overlap with, again, EQT being an investor in Zio. So, and of course, EQT's name sounding like the big oil and gas company that it's not. So I hope that explains it. But the other thing, just to kind of carry on from everything that's going on with Crown Castle, we just announced finally some massive changes on the 17th. So a little over a week ago, they named a new CFO. Yesterday, they announced that their CEO stepping down, that they're going through a transition there. So big changes. Same time they announced the new CFO, they added a new board member. So there's some much needed changes in leadership with Crown Castle right now. Besties also is asking, why is the stock market tanking? Well, Besties, people are selling their stocks. That's why. No? Okay. Yeah. No. So today is a day where yesterday the market felt really good, that it seemed like there was more clarity on concerns about tariffs and geopolitics. And today the market doesn't feel quite as settled as it did a day ago. I think one of the big things is the story has come out. Again, we're not a politics show, and I'm not going to spend hardly any time talking about this, but part of the narrative in the background that's moving the markets, and it's worth knowing it so we don't make bad decisions based on things that are just moving the market but don't really have material impacts for the stocks that we own over the long term, is the news about maybe some a little bit of less than optimal security around discussion of national security things. I don't know if you've heard the story, but apparently an editor for The Atlantic was included in a group chat on Signal with a number of very high-ranking Trump administration officials who were discussing military action against a foreign country. So that it's just more concerns about stability, I think, is the big thing that's kind of upended the market a little bit. We're going to get some more financial data later today. I think the market's stabilized, though. It fell early, but it's kind of stabilized. I think the S&P is actually back to zero, or maybe even up a little bit. So, these days like the day where you see a lot of volatility, this is where bolstering our knowledge about the companies that we own, Jose, and the thesis for why we own them, and learning about the risks and focusing on building our own capacity to own them for the long term is far more important than getting too caught up in the noise of the market from day to day, right?
Yeah, Jason, and this is when I believe volatility is only a risk when, obviously, against, it depends on where you are in your age of retirement. But for the mass majority, I would say maybe volatility is a risk when you don't know the company you're investing in, and you kind of just believe a negative stock price action means that something bad is going on with the stock. And like you mentioned, Jason, that kind of creates maybe emotional decision to sell or buy a stock based on just price action. But for me, the stocks that I own, Jason, I tend to be very familiar with. So when we see kind of this massive stock price, I don't really worry too much. Obviously, I'm not going to lie, it sucks to see the portfolio down, but it's not something that would cost me, that would say, I need to sell this because I don't believe in the business no more just because of the price action. So volatility is just, in my opinion, dangerous when either you're over leveraged or you're not investing, or you don't know where you're investing your money in.
Yeah. Besties, I can't tell if you're joking or you're serious, or you haven't decided if you're joking or serious. Why not gold in these times? These times are different. No, they are. I know that last part. I know you're just joking with us here, but I want to use this comment from Besties to talk about exposure to different asset classes, and also use it to address the most recent question that we've gotten, which is talking about, at its core, turning the downside momentum in the negative periods when stocks are declining, turning them into opportunities, right, versus risk. So we'll talk about both of those. So I personally don't own gold or silver, but I do think for a lot of investors, having a little bit of exposure to something that generally is kind of historically has been uncorrelated with stocks and bonds Sure, if it helps you make better, broader investing decisions, I mean, there's worse things that you can do with a small portion of your portfolio. Part of the conversation that's driving interest in precious metals right now is that gold has gone on this exceptional run for years. I'm not sure if I haven't looked at it in a week or so, but I know gold at some point recently broke $3,000 an ounce. Seems like I can remember not that long ago it was $2,000 an ounce. So that's a 50% increase. And it's been years since it broke 2,000. I realize that. But the point is that asset allocation across different classes of assets isn't just about like the science of optimizing your returns, but Jose, it's a way that we can optimize for ourselves as well. If holding a little bit of gold in your portfolio makes you less likely to sell your stocks in a downturn when you don't need to be selling to raise money to spend in the real world, more power to it. I have some exposure to crypto, partly because I do think eventually we're going to start seeing blockchain and some of the tools that are being built on blockchain actually generate pretty substantial economic value. And that's going to do the heavy lifting from there to get to a stable value for some of the crypto assets, some of the things that are built on Ethereum, some of the tokens that trade on Ethereum that have DeFi tools that are built on it. You could say the same thing about Bitcoin, but in a little different way, maybe bigger, more complex things that you can get some of these programmable money tools that I think are going to generate value. So crypto for some investors can be a way to do that. Bonds, cash, all of those things can be tools to help you manage your stock investments to maximize them as long-term wealth generators and minimize your personal impact around making bad decisions, right? You're letting the tail wag the dog, and the tail is just the stock market going up or down, and that telling you what to do versus your financial goals combined with your understanding of the businesses and the opportunities and risks. Like those are the things that should inform your decisions, not the market going up or down. But with that said, Jose, that brings me to PBR 600 RR's comment. Man, your family gave you an interesting name. This is a great question. When the market goes down, how much of your cash should you spend? Should you still try to keep your target cash allocation? As we've said a bunch of times, we can't tell you individually, anybody individually, what to do because of so many things about your own situation that we don't know. Plus the ethics of just a couple of random strangers on a live stream telling somebody individually that they don't know what to do. But I can tell you what my approach is, and it's evolved and it's changed over time. So the first part of that question, when the market goes down, how much of your cash should you spend? Here's what I've done for the better part of a decade now is the way that I've thought about it is I keep a percentage of my portfolio in cash. That used to be 5%. I'm 48 now. This great bull market that we've gone on has put me in a position where I don't need great market returns to reach my financial goals. So I've increased the amount of cash that I carry to about 10% of my portfolio in cash that I could deploy at any given moment. But if we see a 10% decline, like we kind of tiptoed into recently, and of course the market has rebounded from that low, and this is the S&P 500, I'll take a quarter of that cash, and I will go find stocks that are high on my watch list that have fallen even more than the market. And the sell-off for those stocks has to be detached from something going on with the business. Like if the business is deteriorating and that's the main reason the stock's fallen, no, I'm not interested. They've just fallen more than the market does because they're more volatile than the market. They have a higher beta. I will add to those. And I've done that. Home builders is actually one of the groups of stocks that I've added to. If we see a bigger sell-off than that, I'm gonna deploy even more cash. Like if we see like a 15, a 20% decline, I kind of benchmark those numbers as like, okay, this is meaningful and rare. That it's meaningful and rare enough that it makes sense to deploy a larger and larger position of that cash. I keep that cash specifically to invest when there's opportunity. It's really important to me that I don't make the mistake of holding onto that cash to try to get the perfect buy versus take the opportunities when they're there when we do see market sell-offs. So I have those almost rules like 10%, 15%, 20%, where I deploy a position of that cash. And I tell you, if we see a 20, 25% decline, I will probably have deployed every bit of cash that I have in my portfolio into my best ideas, even on the risk that the market continues to fall more, because it's so rare that we see larger declines than that. And again, because of my age and the fact that I am net contributing, I just pulled up the thing to make my 401k contribution, my solo 401k contribution for the year. Because I'm a net contributor and I'll be putting more money in, I will be able to build that cash position back up over time. So that's how I think about it. Now, the flip side of that, how do I get back to that? For me, 10%. Again, your mileage may vary. How do I get back to that? Over time, deploying more cash, selling stocks that for a business reason, maybe it's one of those Jobies or some other business that I invest in and it doesn't work out and there's something left over and I decide to move on and I sell. Or maybe a stock's just done exceptionally well and it's gotten to a point where I'm paying too much attention to it and it's 10% of my portfolio and that's too much for me. Maybe I'll sell a little bit of that to build up that cash. So that's how I think about it. But again, your mileage may vary. Jose, do you have time? 30-second question to grab here before we hand over to Dan and Jeremy?
No, Jason, but I just want to share maybe some thoughts on that last comment. And you made something in the report where sometimes it might not seem like the smartest investment to all via gold, via cash, but it does kind of create that emotional security. And I think that emotional security is the best thing ever because it prevents you from making mistakes. I personally always hear, hey, it's bad to have cash at hands or cash because in data points and data, it's smarter to have that money invested.
The optimal
somewhere.
Portfolio should be fully invested, but the optimal portfolio requires the optimal person, right? Which none of us are.
Exactly. So that was just the last point I wanted to make, and it seems like, Jason, we can switch over.
Perfect timing. Okay, all right. Let's bring our Jeremy and our Danny to the stage. Hey, gents.
Hey, guys.
All right. Well, we are going to leave you with it. I hope you have a wonderful hour, and we'll see you on the other side.
All right. Thank you. Fellas. All right, Danny.
Hey,
how's it going?
It is going well.
Glad to hear that. Nice to see you as always.
You as well.
Good afternoon or good morning to our viewers, or maybe you're in a part of the world where it's nighttime. But anyway, it's noon on the East Coast here, 9 a.m. on the West Coast. I see our theme title there is Ask Us Almost Anything. So that's always an option. So hit us up with any questions on the Slido, code FOOL24. A topic we discussed ahead of time, Danny, was top CEOs or our favorite CEOs. And I think it was this is an interesting subject. I was on here the other day. I'm not sure if I was with you, but somebody asked about AI disrupting investing and stock picking and that sort of thing. And I think there's obviously there's quantitative elements to investing and analyzing companies, but there's also qualitative ones. And I think one of them that really doesn't get as much attention as it should, and is it is. Well, it's hard to evaluate certainly in a quantitative way, but even in a qualitative way as well is leadership or CEO. But really, so much of a stock success comes down to the people that people are running the company, especially if you're dealing with a startup or a younger company, I think, which doesn't really have any assets beyond its latest product or what they're doing. So yeah, I mean, on that note. Any questions or comments on the audience on favorite CEOs? Please share them or questions. Happy to hear them. I don't know, Danny. Do you have any?
Yeah,
any thoughts?
When you suggested this topic, I was really intrigued because one of the things that the Motley Fool focuses on is the leadership of a company, when they're making some of their recommendations. And so it's something that I've always been intrigued by. I got thinking and looking at the top performing stocks in my portfolio over the past decade. And without exception, every single one of them had or still has a driven CEO, somebody who had vision and who was able to take the company far beyond what I would say mediocre leadership would have been able to achieve. That I think it was Warren Buffett who said that you want to build a company that any idiot can run, because eventually one of them will. And I think that's true, but I also think that the companies that have the most outstanding results over extended periods of time are usually leaders that are visionary.
Yeah, absolutely. And the Motley Fool's a big believer in founder-led, companies as well. I definitely agree with what you said. Maybe I'll go first here. We prepared a couple companies to talk about. One CEO I really like is Satya Nadella at Microsoft. I think over the 10 or 11 years that he's been with the company, I think he's really overhauled the culture and reputation at Microsoft. You could maybe fault Steve Ballmer, the previous CEO, for some mistakes, missing the shift to mobile or losing that battle. But Nadella came in 2014, sort of immediately kind of ended this war with Apple that was maybe not in the interest of either company, and kind of dispelled with this notion of rivalry that had long existed with the company, and made Microsoft's products, the Office suite and that sort of thing, became available on your Mac and Apple products. Azure, their cloud push had been underway by when he took over, but I think he really prioritized that and accelerated it. And as far as visionary, I don't know if we give him enough credit for making the investment or leading that investment in AI and open AI. Microsoft put I think $13 billion in it before anybody had seen or heard of ChatGPT. So I don't know if that product would have come to light, or at least I don't know if it would have come to light in the same time frame without Microsoft and Nadella's influence there. So I think he's been ahead of the curve on a lot of those sort of tech evolutions, and I think Microsoft's reputation has certainly improved with investors during that time. Stocks, like a lot of the tech companies, the stock's done well. I'm curious to see what Microsoft does next, and I think he's changed them from maybe a sort of sleepy company that seemed like they were falling behind the curve to one that is, I think very at the forefront of the next, AI and what comes next in technology. So, he's definitely one to watch for me. I don't own Microsoft, but certainly I think for a lot of us, one of those that got away.
Yeah, I own Microsoft, and I echo some of your thoughts. I think that he doesn't get enough credit for really emphasizing the cloud. I think, going into Microsoft when he agreed to take the role of CEO, he made it clear to the folks under him that he was refocusing Microsoft as a cloud first company. And it's interesting because, if you look back, Microsoft was kind of a sleepy, like you said, had not really excelled at anything for a long time. And just in the about 11 years since he's taken over, Microsoft stock is up nearly 1,000%. And primarily, a lot of that has to do with his focus on the cloud, and they have become the number 2 of the big 3 cloud cloud infrastructure providers behind only Amazon. And Microsoft has been growing faster than Amazon in recent years. Now, it remains to be seen in the AI era whether or not that will continue. But I also think there was a couple of different tranches that Microsoft invested into OpenAI. The first was like $1 billion when they were just talking about the potential for ChatGPT. They hadn't even gotten the most recent version up to speed yet, and the fact that he saw the potential in that, invested in the company, and when they saw the results, invested like another $12 billion in the company, and then quickly began integrating these generative AI features across Microsoft's suite of products and services, I think is a testament to his forward thinking and his ability to see what could be. So hats off to him. I think that was a fabulous decision.
Yeah, and they've, as you mentioned too, yeah, they've definitely been aggressive about rolling out new AI-based products. So yeah, it's well prepared for to take advantage of it as well.
So I don't know if we've gotten any questions or comments in the queue yet. So viewers, if you've got a favorite CEO, go ahead and pop that in the queue, and we can address that as well. One of my favorite CEOs is actually no longer CEO of the company, but that is Reed Hastings, founder and CEO of Netflix. I think that he had a singular vision going back. Even the name of the company, Netflix, was this idea that eventually movies and television shows would be delivered via the internet. And even before they had that idea, before it was technologically possible to do that. So they kind of focused on the DVD by mail thing while they were creating this, ability to stream in real time television and movies. And they focused primarily on the technology and over again to get that technology right. At the same time, they were also developing their recommendations queue, which at the time, that was something that they built in-house, and then they had a contest, and they put it out into the world. And if you can increase our recommendations algorithm success by 10%, we'll pay you $1 million. And that attracted the attention of a lot of developers who were doing that kind of as a side gig. And eventually they did award that $1 million prize. So there are a lot of things to like about where Netflix is today, and many of those things go back to the culture that Reed Hastings established early on in the business. He was always one focusing on innovation, but then they also focused on people ahead of process. One of the things that was mind-blowing when it first came to light was the fact that Netflix didn't have a vacation policy. You could take vacation for as often and as long as you wanted, as long as when you were working, you did an outstanding job. And that was unheard of, really, when that came to light that Netflix was doing that. I think one of the other things that Netflix focused on early on within that culture was the whole idea, and I'm going to drop a couple of links into the queue here in a little bit. But they said that everybody that works at their company, they try to instill in them the culture. They have four core principles First is the dream team. They want to have, the high performers. Everyone working in Netflix is supposed to be part of the dream team. They emphasize people over process. This reads, you get better outcome from employees when they have the information and the freedom to make decisions for themselves. We hire unusually responsible people who thrive on openness and freedom. They also have uncomfortably exciting. To entertain the world, we need to be bold and ambitious. That means embracing the thrill of what's next, even when it's uncomfortable. And finally, they say great and always better. We often say Netflix sucks today compared to what we can be tomorrow. We need the self-awareness to understand what could be better and the discipline and resilience to get there. So, that was kind of another, that focus on culture and making the company the best that it could be. And finally, one of the hallmarks of a really visionary CEO is the ability to see what's coming next. And Reed Hastings was not bashful about cannibalizing the company's existing cash cow, which was the DVD by mail business, when they got to the point where he believed, excuse me, when they got to the point where he believed that streaming was, ready for prime time. And they focused on that. And many people at the time, when they put that focus on streaming and were willing to let that DVD by mail business go by the wayside, a lot of people predicted bad times ahead for Netflix. And now, more than a decade later, you look back and realize just what a compelling decision that was that he made, and how visionary, it was that he was able to see that, streaming video was going to be the next big thing. And he was willing to spend money on that, and burn cash for years in order to get to the company where it is today, which is the leader in streaming video, bar none.
Yeah, I definitely agree on Reed Hastings. Yeah, he's been one of my favorites as well. Yeah, I think one of the lessons there, like you're saying with Netflix, is that a lot of times these real top performing stocks like Netflix, they overcome long odds, or at least what's in the market's eyes, long odds. I mean, I think Netflix, even from the start, they're first with DVDs and streaming. It was a very compelling business model, and I think as far as the visionary thing, I mean, there are a lot of quotes I like from Hastings, but I think I remember at some conference 10 years ago, he said that every for the next 20 years, each year, internet TV will get bigger and linear TV will decline, and I think that prediction has really came true, and that was before really Netflix had this competition from legacy media and streaming. But I think streaming has certainly gone mainstream, and really probably he deserves more credit than that. And another thing I wanted to mention too, just generally, but you reminded me with this with Reed Hastings. A good way to just get to know the CEO or develop some thoughts on them is just to listen to the earnings call. And I think one of the things I liked about Hastings is he just had a very frank and matter of fact way of talking. He was not hesitant to compliment his competitors. For example, he would occasionally call out shows he liked on HBO or a Disney movie or something like that, and just it seemed like maybe the kind of person you'd like to work for as well. So I'd encourage you. I think that's maybe the best way to form some thoughts about leadership is see the way how they present the company on the earnings call and how they handle analyst questions. Do you want to? I see this one. You want to hit this one from Paul since we're on the topic?
Oh, sure. So Paul SF just asked, thoughts on Netflix. Is a 2 to 10 bagger from here still possible? I just looked when I saw that question. Netflix only has a market cap of 424 billion right now. Double that would be 848 billion. So the question would be, do I think Netflix could be, have a market cap of 824 billion right now, and I actually, or 48 billion, and I do certainly think that is possible. In fact, I actually wrote about this several months ago. With the fact that I believe that Netflix could eventually have $1 trillion market cap. Now, to be fair, this is not something that's going to happen over the next couple of years. I think this is probably, somewhere between 2030 and 2035. I don't remember the exact time frame that I put together. But I think Netflix they're the leader in their industry. They are continuing to grow at a fair pace, considering how big that they have become. They are expanding into areas that, just a few years ago, people were making dire predictions about. For example, when Netflix went through its password crackdown, folks said, oh, well, everybody's going to bail on Netflix now. And Netflix came up with a plan and said, instead of just kicking everybody off, why don't we give them the option to, have a less expensive plan tied onto the person that they're, currently sharing with. And that turned out to be a brilliant plan. They also, when they added their ad-supported tier, in the most recent quarter, of all of the new signups, 50% of those were for the company's ad-supported tier, which is now $7.99 a month. I think as they add more viewers to that tier becomes more valuable to advertisers, and they're already saying, and mind you, it's anecdotally, and they haven't put any numbers to this, but they're saying that people on the advertising tier are more valuable to them than people on the basic tier elsewhere. So I certainly think, given those as growth drivers, I don't think they've really cracked the code on gaming yet. But it's certainly, an area that could produce growth in the future. So I certainly think a double from here is possible. How much higher than that, I think, is kind of a wild card.
Yeah, I mean, I think Netflix. I mean, it's been a great stock over its history, but a few years ago is basically left for dead after they kind of had that post-pandemic crash, and they've reported 2 straight quarters of declining subscribers, and it seemed like the market just believed the growth story was over. And I've been very impressed how they've pivoted to advertising, and we've seen some experimenting with live sports and live events, and they've done this in the past where they've responded to a certain pressure by reinventing themselves. I mean, maybe the DVD to streaming switch is the most obvious one, but they pushed back on getting into advertising for a long time, but then I think when the time came, and I remember, I think Reed Hastings around the time was like, look, I mean, this is the demand from advertisers is there, and all the eyeballs that used to be on linear TV are now with us or elsewhere on streaming, so it makes sense for that reason. But yeah, I mean, I think in the stock's been, I think, 5 or 6 bagger since around then. Yeah, I mean, a 10 bagger it might be tough. You might be waiting a while for that, but I agree with you, Danny, that I think doubles is certainly reasonable. See, it looks like Paul had a follow-up question here too. Can you survey Netflix's areas of emerging optionality and its current offerings, including empowered by AI or perhaps live and in-person events? Yeah, I mean, I think live live events is really a huge opportunity for Netflix, and I'm glad they're finally realizing that. I watched maybe some of you know, but I watched a bit of that Mike Tyson Jake Paul Paul fight. But if you watch a live event on Netflix too, you realize, or I mean, you don't have to watch it to realize this, I guess. But no other service has the ability to broadcast or stream something live to. I think they have an audience of 300 million households now, all around the world. And they're growing in every region. So, the company has said that for now they're focused on sort of standout events. They had a Christmas Day package with the NFL, so I think they're trying to do these sort of one-off rather than a full season package. I mean, as far as sports, like you're seeing on Amazon Prime or some of the other streaming services. But yeah, I mean, I think live is a huge opportunity for them, and it creates an event. What I think, right, it would used to be called sort of appointment TV watching, which is maybe a bit binge watching might have killed that in a sense, but I think it's nice to have maybe think of something like the Super Bowl as being that, but a live event that feels like a must see, and everybody's gonna be talking about it the next day. I think beyond live events, gaming they've gotten into a few years ago. I mean, I think gaming is an opportunity for them. They haven't talked about it too much, so I think the focus is still more on TV entertainment. Yeah, I mean, as far as AI, I know they use AI, as far as the recommendation and that sort of thing. I mean, I'm not sure if there's a specific area of AI you're referring to. I mean, as far as content, I don't think they're leaning in that direction. But yeah, I mean, I think I'd look for, they're definitely moving ahead with advertising, still a lot of growth there. And I think, live events is really, those are the two opportunities I'm most focused on with them.
Yeah, I agree. I think that there's been a lot of there's been a lot of attention paid to the fact that Netflix came in and was able to snag a couple of NFL games on Christmas. I think that got a lot of press, but it was also something of a test to see if Netflix could handle hundreds of millions of concurrent streams at the same time, and barring a few little glitches, I think they showed that they can actually do that. So I think that was a pretty impressive test for them, and I think they handled it well, and I think that is probably a just a glimmer of what's to come in the future. I think we can expect a lot more live events from Netflix, particularly if they're, the wrestling that they're adding, live wrestling, is any indicator. We've got a question from Besties about a minute ago. Sold Netflix when they stopped reporting subs data several quarters back. What do you think of that selling thesis? Well, first, let me say to each their own. I know that there were some people who thought that when Netflix announced that they were going to go to an advertising tier, that was going to be a thesis breaker. Some very outspoken fools said, this is the end of Netflix as we know it, and sold their shares. I think after the pandemic, when Netflix's growth hit that plateau and even went down a little bit because everybody was going to go back to everything they were doing before the pandemic and nobody was going to watch Netflix anymore, that turned out to be not as big a concern as it might have initially appeared. I think Netflix has gotten to the point in its evolution where reporting how many subs they have is probably not as important as it was once upon a time. For a very long time, that was the do all and end all for Netflix, was how many subscribers. But we've gotten to the point now where You've got, full paying subscribers in the United States. You've got ad supported subscribers in the United States. You have subscribers in countries that maybe the average revenue that they receive per subscriber is lower than perhaps what they have in the United States. And Netflix says, look, we are a mature company now, and we think the focus should be on our revenue growth, our profits, and our ability to generate cash. So I think their decision to stop reporting subscriber growth, I think, to me, was kind of a non-event, primarily because, as they said, I think they made a strong, a strong argument that it really wasn't necessary anymore. And if you look at most of the successful companies, in the top tiers of investor favorite companies, you're not going to find too many of them who report subscriber growth. So I understand, if that's your decision, that's okay. I'm certainly not selling my Netflix stock for that reason.
Yeah,
Jeremy?
I think you make a good point there as far as the advertising is kind of taking over, or at least some of the growth. So I think that was a lot of the reason for that. So maybe not. Sometimes you do see those announcements, and it seems more like this company is really trying to hide some data.
Right.
But we did get a few questions on Netflix. So I think that Danny might have tapped into a vein with this one. It's fun, but I feel like we used to cover, Netflix used to get a lot of attention, on the Fool and in the market generally, but it's maybe been thought of more in the last couple of years as a more of a boring stock, or I don't know, but certainly it's done well. So maybe I'll hit this one. Or Besties also says that Netflix started that vacation policy that you mentioned of the sort of no prescribed vacation, just take a vacation when you want. And it's now widespread in Silicon Valley. Paul asks, I think this is a good question. What's your most compelling thesis for Netflix? Certainly always good to consider the bear case or the risks in any stock. I think for me, at this point, I'm not concerned about, competition. I think that was certainly a concern in the market, 5 years ago or so, when Disney and the rest of the legacy media was hopping on the streaming bandwagon. But I do think I mentioned they're at about 300 million households worldwide. I'm not sure what the broadband household market is right now, but I think you start to worry about can they double that base, or at some point you're going to hit a ceiling with that growth. The counterpoint to that, though, I think which gives them an ability to grow. Well, two things. I do think they've pricing power, and they have been able to, they're not going to surge their prices every year, but they have been able to pass along price increases. And then I think that the advertising business gives them a lot of flexibility. Danny just says 1.6 billion broadband households worldwide, so they're maybe at about 20% of that. So still room to grow, certainly. But the advertising business, I think they want subscribers on the advertising tier because that gives them a lot more flexibility, because ad rates can certainly go up easily, and the more they can, the better of a job they can do with targeting, the more they're going to make on advertising. So I think, digital advertising is a huge business. Any company in advertising, the Trade Desk, certainly in ad tech and on down is very excited about the potential in connected TV. And I think really, probably Netflix is, you can't get much better than that. Certainly with their reach. So yeah, I think that gives them a lot of upside potential to overcome concerns about, slowing growth, which I do think is a risk for them, certainly.
Yeah, I think one of the things that I have seen that I always bear in mind is something that Netflix always puts in their shareholder letter. And that is, they say we are competing for time, and they give this, kind of really long list. We're competing with linear TV, we're competing with other streaming services, we're competing with video games, we're competing with anything that people do with their free time. That's who our competition is. And so I think, there's always the potential that something could come along, something that we haven't even thought about yet. And maybe it's, related to AI. Maybe somebody invents a better mousetrap, instantaneous streaming, from a neural interface, right into your brain, anything that you can think of. I think it's the things that we haven't thought of yet that, really could pose future potential threats for Netflix. Every time over the past, actually since Netflix was founded, we kept hearing over and over again that something was going to be a Netflix killer. And this was going to be, what came along. And back in the DVD by mail days, it was, first it was Walmart, and then it was Voodoo, and then it was Amazon Prime, and then it years later it was Disney and Paramount and HBO and all these other potential competitors. But as I argued at the time, Netflix has been building this content library for a long time now, when they started with the Netflix originals. And I think this is one of the cases where, they've built up this library now, and that is a huge moat for them, that I think it's going to be very difficult for anybody else to, go beyond that moat, at least not cheaply or anytime soon. So, honestly, I don't think we know yet what the most compelling antithesis is for Netflix. That's a tough one.
Yeah, well, you are right. They've certainly survived a lot of right. There've been a lot of Netflix killers that have come and gone. Yeah, right. I remember the transition to originals too. Right, was they've taken a lot of risks, and they're still doing well. Okay, well, I'll take a little break, maybe just from we might come back to it, but we'll take a break from Netflix for now. I like this question from Besties, who says, do the executives make the business great, or is the business itself great? That greatness depends on time and the environment. Buffett preferred a great business. Yeah, I mean, I think it really depends. I think it depends on the industry and the kind of company. Certainly the age of the company. I mean, and even Buffett, if you look at something like a bank, I mean, maybe operating a bank, comes down to nuts and bolts. Not making smart loans and not losing money and making good investments. It's not a flashy business, but even Buffett he hasn't been shy about calling out bank CEOs. I mean, Berkshire has been selling Bank of America, but I know he's been a fan of Brian. His last name escapes me for the moment, but the Bank of America CEO. So, I think, even Buffett, and I know his ham sandwich quote as well. I mean, I don't think he's beyond considering leadership. In a company like Coca-Cola, another longtime Buffett investment, we've seen them do better since James Quincy came around. But I think, Brian Moynihan, yeah, thank you, Danny. I think, more established company, the leadership is going to have less flexibility, I think, and certainly, something like a bank or a well-established brand. I mean, if you're the CEO of Procter and Gamble, you're probably going to have, I guess you can make acquisitions and maybe do some brand launches, but your brand portfolio isn't going to change that much in the next 5 or 10 years. I don't think so. What you do with those brands is certainly up to you and the strategy and that sort of thing. But I think maybe a younger company, startup, something in tech, which is maybe more of a fast moving industry. I think the CEO counts a lot more, or counts more certainly. And I think those companies too. I mean, any CEO can change the culture, but a younger company, and certainly a founder CEO is going to have more influence on the culture, which is important, and have the ability to shape shape that company and their performance. Another Buffett quote I like is that when a good manager meets a bad industry, it's the manager that tends to lose. So it is, I think it's hard for maybe a example of that. I'm sort of curious to see how it plays out. As Intel has a new CEO, Lip Bhutan. So Intel's struggled. So we'll see how he does. So I think in a bad business, there's maybe only so much a CEO can do, but certainly, yeah. I mean, I think it's one of the top things to consider about a business, and tends to be a component in the top performing stocks.
And if you go back and think about some of the most groundbreaking companies of our time, the ones that really changed how business is done, and you think about Jeff Bezos with Amazon, you think about Steve Jobs at Apple, you think about Reid Hoffman, who was the founder and CEO of LinkedIn. And I think all of these businesses were groundbreaking. I mean, you could even make a pretty strong argument for Meta Platforms. I think all of these businesses did something that hadn't been done before, or if it had been done, it hadn't been, let's say, perfected yet. And so I think there is an argument, a pretty strong argument, that it takes this visionary leader to take a company that maybe it would be great. I mean, a lot of people swore by MySpace once upon a time. And there's nobody on MySpace. MySpace disappeared into the ether. They were first, but they weren't necessarily the best. So I think if you don't have a strong leader, you can have what has the potential to be a great business, and it can fade off into the sunset. So yeah, I think I think leadership for a company, and visionary leadership, is probably one of the single most important things about a business that will either propel it to greatness or not. Just thoughts. So we did have a question from Jennifer a few minutes ago, and I couldn't resist, about 15 minutes ago. Any thoughts on whether and when Netflix may do a stock split? Well, let's start off with the obvious, disclaimer here, that a stock split is largely irrelevant. Not completely irrelevant, because there is investor psychology that comes into play. There's options trading that comes into play. And there are some brokerages that don't offer fractional or trading of fractional shares yet. That said, I think we're getting to the point now. You look, and there are several companies out there that have gone years and years without a stock split. I mean, look at Booking Holdings, for instance. They have a solid 4-digit stock price, and don't seem all that worried about whether or not they do a stock split. I think with many of the tech companies having done stock splits in recent years, I think there's more of a likelihood. I don't think that it will make any difference to Netflix's operational or financial performance, whether or not they do a stock split. But I would say there's the potential that Netflix could split their shares sometime over the next, I don't know, say 2 to 3 years.
Yeah, I think with the share price around $1,000, it's certainly certainly a possibility.
It's getting there.
And they have done them in the past too. So yeah, we'll see. But yeah, I agree with you. It's not I wouldn't buy a stock based on whether or not it's going to split its shares. But well, this is a comment, but I think we can discuss this one as well. Lovely Lily says 15 minutes ago, my favorite past CEO is Jim Sinegal from Costco, speaking from inside and outside. I don't know if that means you worked at the company, but be interested in hearing more thoughts about that if you'd like to share. But yeah, I mean, Costco, and Jim Sinegal ran, I don't think he was the founder, but sort of, built, I think, what we think of as the modern day Costco. But yeah, I think, what we were just talking about a minute ago, as far as, leadership versus the business itself, and that Buffett mentality of sort of leaning on the business. I mean, I think Costco is a good example of a company and a culture that has been built that you can just, and I mean, I think current management is doing a very good job, but you can kind of just rinse, wash, and repeat. And if there's a business out there that I think is, to have that proverbial ham sandwich, run it and still do well, I think Costco is a good candidate for it. It's a very strong brand. Really, it's a simple business model that they've outscaled. I think they're, minimal competition in that warehouse membership-based retail. I know Sinegal, and I said, as I think what he sort of passed along the reins to, I think Craig Jelinek is the CEO now, was very, you got to keep the hot dog deal at 150 and then the rotisserie chicken, and sort of nailed in the idea of these low prices are so key to the business and that customer satisfaction, and the company, it seems like, I don't know if they'll keep it that way forever with those prices, but Costco doesn't have to change much about his business. It's I think customers expect the same experience every time they come, and that's what they get. So I think it's a good, a good example of a kind of business where, giving credit to Sinegal and those who have built a company, but one where I'd be less worried about management, because it seems like so stable.
Right. So we've got a question from Ed from a minute ago. Retailers are getting spooked because of consumer confidence. And I would add to that consumers are getting spooked because of macroeconomic and geopolitical developments. At today's prices, do you consider Walmart, ticker WMT, to be a buy? Since he specified at today's prices, I went to take a look. And over the past, let's say 5 years, Walmart has had a PE that on average has been about 32. Now it's been as high as 53, in late 2021, when we were getting ready to fall into the economic downturn. It's been as low as 20, which was actually, during the pandemic, towards the end of the pandemic. Right now, its PE of about 35 is a little above the historical average. And one thing that I would say is, that it's kind of a double-edged sword with Walmart. if the country slips into a recession, and it's possible, that I think that's kind of what the consumer confidence is about. We don't know what's going to happen as a result of the tariffs and the trade war that's going on. So if the country's economy slips into a recession, then Walmart is one of the places where consumers are going to turn to en masse, because everybody cuts back on spending, and the spending consumers do, they want to do it at the lowest prices possible. And one of the places they do that is at Walmart. On the other hand, I think there is still further that Walmart stock could fall before it levels out, because, excuse me, because as consumers cut back on spending, there's that initial reset that happens. And we see that in places like Walmart and Target and at some of the ultra discount retailers, where first there's a discount in, people stop spending as much money, and then they start shifting their spending patterns to lower price. So I don't necessarily think that, above its 5-year high average multiple, I don't necessarily think that Walmart is a buy, at least not yet. That's my opinion. There are certainly other opinions out there.
Yeah, I think Walmart, I think, what you have to remember about them too is that they do, I think investors see them as a, sort of a safe harbor in a storm kind of thing. If we do see,
Right.
Falling consumer confidence, potentially a recession, but this stock is still going to go down. It probably just wouldn't go down as much as the S&P 500.
I agree.
Yeah. So I think, the valuation seems, maybe fair where it should be. Dividend yield, I think the dividend yield used to be a little higher for them. But yeah, I want to mention too, I think Walmart, Doug McMillon, who's the CEO there, he's done a great job as well. I think he's another one who doesn't really get all the credit he deserves. I think he's been around about as long as Satya Nadella, who I was talking about before, maybe since 2014. And, when he took over, Walmart really didn't have much of an e-commerce business, or nothing like it does today with the marketplace. Right. And, the pickup stations at every store. The business was really struggling, and just, overall the store operations as well. So, we've seen steady growth from them every quarter, and they've certainly are known for their low prices. So I think, if it's something you own, I wouldn't be worried about it in a recession or anything. But I might, as far as valuation, I might want to see maybe a better price on it before jumping in. I'll take this one from Paul SF next. Back to could NVIDIA potentially experience a valuation-driven correction in the next 12 to 18 months? Maybe a similar line of thinking to Ed's question about Walmart. Look, I think anything's possible as far as a pullback, and certainly depending on what we see in the broad market, and I guess this evolving macro sentiment story, and we'll see what else comes out with the data. I think we'll get the unemployment report, or the employment report, next week. But having said that, NVIDIA is already I know they were down about 30% from their peak last week. Maybe they've rebounded a little bit. So they're still off a fair amount from the peak. And the valuation, I think, and I think Danny, you and I have talked about this before. The valuation looks very attractive, at least, when you look at it on a forward basis. I think less than 30. I think the market sees a lot of risks with AI and NVIDIA. There was that huge pullback on the DeepSeek news. So there's certainly potential for a a deeper drawdown with NVIDIA, and there's plenty of uncertainty in the broader AI market. But I think the general news for the companies is favorable. I was pretty impressed with what Jensen Huang had to say last week at the GTC conference. So I think at this point, given NVIDIA's valuation, I mean, unless we really see a crash or a deep slowdown in AI infrastructure spending, or the trajectory of the company's growth has been really just incredible. But if that were to come to a halt, yeah, I mean, I would expect the stock to get hit. But barring those risks, I think it's a pretty good price, pretty good valuation right now. So I'm not too concerned about a valuation-driven correction with NVIDIA over the next, that time period, 1 to 2 years.
Yeah, one of the things that I find interesting about NVIDIA, and we were talking about the valuation. NVIDIA's trailing 12-month PE right now is 41, but its forward PE, which anticipates its growth, is actually 27. So that is a pretty compelling valuation for a company that grew its revenue by more than 70% in the most recent quarter. Now that said, let me just play devil's advocate here. Twice over the past decade, we've seen NVIDIA's valuation dip below 17. It's multiple. A price to earnings, trailing 12-month price to earnings ratio has fallen below 17. So now both of those times were, market driven. So keep in mind, if you have a market driven correction like Jeremy was talking about, we could certainly see a much lower valuation than what we see right now. But, valuation driven correction, I mean, NVIDIA right now is below its average over the past decade has been 60. And now it's trading for 41. That is a significantly lower PE than its average, and it's worth noting that even that average has a spike in it from what happened when NVIDIA really started gaining ground on those AI chips, and its PE spiked to 250. For a short period of time in late 2022 into 2023, and then it came back down. So I think from a valuation standpoint, I absolutely agree with Jeremy. This is intriguing, and I think it's a fair valuation, if not a low valuation at this point. But just remember, it can always go lower.
Yeah, very true. Just to give some context to that forward PE, like 27. I mean, that's I think that's what you find for it's Procter and Gamble, or certainly, or even cheaper than what Costco or maybe Walmart is right now. So the market is, I think, incentivizing that investing in the whatever risk you might see in NVIDIA for the growth you're getting. I think it's a pretty good trade-off right now.
So we have a question in the queue from John Nyland from about 9 minutes ago. I was reading that nothing good happens under the 200 moving average of the S&P 500 or the NASDAQ 100. I'm going to stop before we get to the rest of the question and say that while I think technical indicators like that may perhaps have their uses, I am not making buy or sell decisions based on them. A moving average is just that. It's a moving average. It really doesn't say anything about the specific companies in my portfolio and how well they are performing from a business basis, how well they are performing, operationally, financially. And so I'm more focused on individual companies and what they're doing. Now, the article said to sell at this time. Is that so? I guess it depends on who you are as an investor. For me, the answer is not only no, but absolutely not. I don't look at what's happening with the average because I am a long-term investor. I want to look at my companies, look at the trajectory of their businesses, where I think they will be 3 to 5 years from now. And that's not going to change based on what the 200 moving average is for the S&P or the NASDAQ or anything else for that matter. I'm just curious if Jeremy has a take on this.
Yeah, I think those are good points. I'm curious about the context because I assume we're talking about going below the moving average, which as you said, we tend to avoid technical investing and focus on long-term fundamentals. But of course, if an index or a stock is below the moving average, eventually there's going to be a recovery and it'll be above that moving average. So, I think that's I wouldn't sell something just because it's below a moving average. And as far as knowing where the market's headed short term, I think nobody really knows for sure. We're stocks and the indices are moving every day based on macro news, earnings reports, geopolitical tensions, any kind of really any kind of market noise or a real indicator. So personally, I wouldn't sell for that reason. Though might help you as an investor to be aware of it. Let's see, we're at the top of the hour here, so I think we have David Meier coming on in a minute. Maybe I'll just read a couple of comments we got. Oh, hey there. How you doing, David?
Fine, thanks. How are you, Jeremy?
Good. Nice.
So I'm supposed to be joining with Emily Flippen, but unfortunately, some tree trimmers around her house decided to cut the power line. So she won't be joining us, and I'm sure Danny's taking a break after a long hour. But I thought I would just interject real quickly about this question. I've actually seen a couple of papers about this 200-day moving average. Basically, what it says is when stocks stay above their 200-day moving average, you shouldn't sell. Essentially, what it's saying is the momentum is still in your favor. But when they break below, the reason to sell is because the tendency is for the momentum to stay low, right? Be negative. So what the paper says, or what the papers have said is buy when it just crosses over the 200-day moving average, hold when it's above the 200-day moving average. If it drops below, sell. If it comes back, just repeat that process. And the back testing of the data says that's a good way to do it. And it's actually a little bit long term. I'm not advocating this. I'm just relaying what I've learned. It actually says it's not bad over the long term because stocks don't dip across their 200-day moving averages very often. So it's kind of interesting. I agree with both of you that the most important things is the fundamentals of your company, what it's doing, not necessarily the stock price. The opportunity arises when a business is doing well and the stock price does not reflect that in its valuation, right? And that creates opportunity. But I just thought I would add a little bit based on seeing that before.
Yeah, thanks for sharing that, David. Well, I think looks like Danny's back, so I'll leave you guys to it. Hopefully, I don't know if Emily is coming by, but
I don't think she will be. But so Danny and I will take over. Thanks, Jeremy. Danny, how are you?
Hello, David. How are you, sir?
I'm well. Yes, as I was mentioning, you probably heard, unfortunately, Emily Flippen will not be with us today. She's had a little power outage issue, but that just means we get more of the Hawaiian shirt enthusiast and full contributor, which is an awesome shirt, by the way.
Thank you.
You're very welcome. I think this is the first time you and I have have done this, right?
It is indeed, and I've heard wonderful things about you, so now I get to experience them firsthand.
Well, likewise, and me too. So with that, the way we had this hour set up was, again, ask us anything. So I think we're just going to keep diving into questions.
I think that's a fair assessment. I actually haven't looked into the questions very much to start off with, but I will try to grab something here quickly.
Yeah.
Well, let's see. Here's one. Now, this isn't necessarily directed at me, but certainly one that I feel like maybe I can address a little bit. This is from Everything is Fine from 2 hours ago. We've had a few discussions this morning about potential overbuilding possibly overbuilding data center capacity.
Yeah.
What's your take, and how might it impact NVIDIA, AMD, and semis? This is an interesting situation, and I think there are two schools of thought on this. The first is I have heard from several folks who are much more educated on the data center space than I am, that we can expect at least 50% growth in data center infrastructure each year for the next 3 years. And the reason is because right now we already have more demand in the cloud infrastructure space than we have capacity to support it. So I do think we still have several more years of data center build out. While those numbers may not be correct, I think they're directionally accurate.
I would agree.
And on the other hand, one of the comparisons that I have heard, and just to, the bear side of the argument, is if you go back a decade or more ago when there was this big fiber build out, and all of the companies were racing to build out all this data fiber because it was going to be the next big thing. And a lot of those companies went out of business after they built out all this data fiber capacity.
Yes.
And what eventually ended up happening was we actually did need all that capacity. It was just ahead of its time. So for right now, I don't think we have gotten to that place when it comes to data centers. I think right now they're building capacity for demand that they already have, that already exists. So I don't necessarily think that we are at risk of overbuilding right now. But I think over the next 2 to 3 years, we could get to that point. And much of that depends on what happens with the adoption of AI. Right now, the build out is supportive of that. We don't know what the future holds. So for right now, I think that's kind of an open question. I don't think we're at danger of that now, but we could be in the future. Your thoughts, David?
Yes, so that's a good analogy, and another good analogy is Cisco and its routers, right? Because once we got all this fiber in the ground and the data started moving, we had to send it to the right places, which is one of the reasons why Cisco was at one point the most valuable company in the world, because again, demand was there. And yes, I directionally I agree with you. We need more data centers. One way to think about it is we're not going, our move to digital, whatever digital is, right? Could be just simple cloud infrastructure, cloud computing, AI, training models. We're using and consuming more and more data. And as a result, we need the infrastructure in place to create supply for the demand that is there and that is coming. If it's 50% a year, I don't know. Is it 40? Is it 60? Agree with you. I don't know that. But I also agree. I don't think we're there in terms of an overbuild. In fact, we're probably behind. At at this point. So what does that necessarily mean for, companies like NVIDIA, AMD, or any of the other semiconductor companies? Well, they might go through some, their normal cyclicality, right? There's build up ahead of it to get rid of, to get inventory on hand to meet the demand that's there. Some companies may buy a little bit more or try to buy a little bit more in terms of chips, right? To try to make the process of getting the data centers up and running make it quicker, make it more efficient, make it smoother. But I don't think that's bubble-ish, right? That buying a little more is not necessarily bubble-ish. It's when you massively overbuy. Right. And I don't think that's happening. I think the demand is there and it'll get soaked up pretty quickly.
I just want to acknowledge Bebo's comment in the queue from 3 minutes ago. We want Emily. I absolutely agree with you. We want Emily too.
So Emily update. I just got word that her power is back. She's going to try to join us. So stay tuned. We'll see if she can make it.
And if we can get Emily on here, I will happily see the platform, because I certainly know that they've had enough of me for now. And
Andy, we could never get enough of you. Calm down. There's a question from 5 hours ago from Cyber Mikey, and it's a company that I actually do follow. Given MANH, which is Manhattan Associates, ticker is MANH, fundamentals, given its cloud growth in cloud subscription projected 22% upside from the current stock price. What thoughts do you have? This is actually a company that's, in my opinion, very interesting. They supply software to help logistics firms manage their warehouses. So let's go back to something very similar to what we're seeing in data centers, right? More and more commerce is actually switching to e-commerce, and how it gets fulfilled is more of that is through the warehouse as opposed to the store. So there is growing demand for its products as well, as its software is well known. And as it gets more and more AI tools and capabilities out to its customers, they become better at what they do in terms of managing those logistics. So the company is actually experiencing a little bit of slowdown in its growth, but according to analysts, that should be picking up in the next 2 to 3 years. And again, it makes sense, right? The demand for e-commerce is not going down; it's going up. And so I think whether or not there's a 22% upside to the stock, I don't have an opinion about that. I do think it's a very well-run company. I do like the management team. I do like where they're positioned. I do like their products. I do like how they are incorporating AI into that and improving the customer experience as a result. So this is a company that I think, if for the long term, is definitely one to look at. So I'm curious if this is one that's come across your radar screen.
I was actually I have not really paid that much attention, to be honest.
That's okay.
There are so many things out there. In fact, one of my favorite phrases came from somebody who used to post on the Motley full boards when I first joined. He said, "There are too many T's in China." So I can't cover them all.
No, that's why we have more than one analyst at the Motley Fool.
Indeed. So there's a comment here from Ed from a couple hours ago. Consumer confidence is at its lowest in 12 years. We're walking towards a recession. In regards to the stock market, what should one do and not do? So I wanted to start with the consumer confidence. In March, the level of consumer confidence dropped to 65.2, which was a significant decline from its previous month. And the issue is, we don't really know what's going to happen. Inflation has been extraordinarily sticky. The Fed thought that inflation would be under control by now. And even as the Fed started to cut rates, we thought that inflation would continue to go down, and then it bounced back a little bit. So there's the uncertainty caused by inflation. There is some uncertainty caused by the Trump administration's approach to tariffs and to, excuse me, to tariffs and what some are calling a trade war. Anytime that you have uncertainty in the market, I think that's going to feed into this lack of confidence that's happening among consumers. But I would also say what I would do and not do. For me personally, I would not overreact to broad, sweeping statements like consumer confidence is at its lowest point in 12 years. Because again, I invest in individual companies. I like to focus on what they are doing and how things will progress from there. And I think that as long as I focus on that and focus on the long term, things happen, and there will be opportunities to buy great companies at good prices, even when the market's going down. Hey, and we have Emily.
Hi, fools. I'm sorry about that. I had no power there for a minute, but it's back on now.
Yay. We actually had a comment in the queue from Bebo a few minutes ago. We want Emily.
They were revolting
as if.
because you weren't here. But real quick to Danny's point, I will second that. Yes, it's companies, not necessarily indicators. The other thing to remember is this is just one economic indicator, right? You can't make a decision off of one economic indicator. There's many. The economy is complex. Yes, the consumer plays a big role in our economy. The U.S. GDP is consumer driven. There's no doubt about that. But that does not necessarily, low consumer confidence does not necessarily mean recession. It can mean a lot of things, right? Might just mean slowing growth. But so I agree that it's one to look at, but it has to be in a basket of economic indicators, in my opinion. Over my tenure at the Motley Fool, I've started looking at more and more at macro related variables. I don't spend an inordinate amount of time. I still focus on companies, but my take is you have to, one economic variable cannot encapsulate everything that's happening in the economy. It's just too complex.
What was the question?
Fair enough.
It was about consumer confidence being low. If we're walking into a recession? And then to the questioner's credit, what do we do or what do we not do? So, and Danny's spot on. I don't think we need to do anything right now just based on that.
Sounds like y'all answered it well. I have nothing to add.
Danny, thanks for the extended shift.
Yeah, and it looks like I've been invited to stick around, and if you guys are okay with that, then I'm happy to stick around.
Sweet, more Danny. That must be in the Slido as well, right? More Danny. Am I being pushed out? What's going on here?
I sincerely doubt that.
I'm only teasing. So actually, I have a question lined up specifically for me, and it's a topic in a company that I do get asked about a lot. Besties ask David, what do you make of the most recent report from Sport Radar? The ticker is SARD. And what are your 5-year expectations? So I will say long term, I think this company is well positioned. It's in the sports betting industry. And if you've heard me talk about it before, I apologize, but I'm going to repeat the same thing because I think it encapsulates it very well. This company is the brains behind the bets, because what it does is it gathers data from all the sporting leagues literally around the world. You can bet on anything that is sports related, and Sport Radar takes that data and transforms it into content that can be sold to its its customers, its partners, companies like DraftKings or FanDuel in the United States, betting houses in Europe and across the world. And that's how it makes its money. It actually had a very good report. It ended the year with greater than mid-20s growth in terms of revenue. Margins are expanding. Growth is expected to slow just a little bit, but the margins and the cash flow for 2025 are expected to keep going up. So why would that happen? The reason that would happen is because they actually have made they've re-signed a number of their contracts, and that's causes them to make an outlay in terms of investment. Basically, they have to pay for the licenses for that data. So what the margin expansion and cash flow is telling you is they're actually doing a good job on the money that they've invested, turning that data into revenue and profit and cash flow opportunities. So I'm excited for what the company is doing. It's a leader in the space. I really like the management team. CEO and founder Karsten Kurl has been there since day one. He has recently, in 2024, restructured the company to put AI front and center. And since it's a data-driven business, that makes complete sense. AI helps them make better decisions. Better decisions means better outcomes for not only its customers, but its customers' customers, which are the betters. And so now it's just a matter of execution, which they have a pretty good history of doing well.
And if I can say something on this, I know a lot of investors who are thinking to themselves, I'll never invest in a sports betting company. They're probably just tuned out, despite all the great arguments there. And the reason I say that, Dave, is because I used to, and still do to an extent, follow cannabis companies. And a lot of the same conversations would happen if I start talking about a cannabis company. We're more like, oh, cannabis companies, I wouldn't touch that with a 10-foot pole. I will say, if you haven't given a business like Sports Radar a chance, or Sport Radar, I always want to add that S.
Yes,
Sport
everybody
Radar.
does.
A chance. I would really encourage you to listen to Dave, take a deeper look at it, and open your mind a little bit to that consideration. While it may not be an industry for everyone, and similarly to the cannabis industry, people may have ethical reasons why their own personal values don't align with investing, which is perfectly reasonable.
Totally fine.
If that doesn't apply to you and you're making the judgment that, oh, this is a sports betting company, so it's scammy, it's unprofitable, it's not going to grow, it's going to go through a hype cycle, all of the assumptions that I think come with some of these more taboo industries, I would challenge that. And Dave, you were the person who challenged me on all of those assumptions for myself. And the more I got to understand about Sport Radar, the more interested I became in it. You can view that outlay for intangible assets for the licensing rights as kind of like a CapEx for this company. And my initial concerns were very much, okay, how much money are they really going to be spending upfront versus the value they're achieving? And to your point, Dave, I'm looking at the financials now, and it's amazing how much more profitable this business has gotten. And they were already profitable to begin with, but also just the margin profile, the free cash flow, even taking out these expenditures for CapEx, that is just growing. So this is a kind of a picks and shovels play on the sports betting industry without getting directly into the bettors themselves.
Yes. Danny, is this one that you follow by chance? And it's a small Swiss-based company. So if the answer is no, that's totally reasonable.
I actually hadn't even heard of it until now, and now you have me intrigued to take a look.
Sweet.
That was a pretty compelling argument you gave there, sir.
Does that mean I'm done? I should go out on a high note, right? No, I'm just kidding. We're only getting started here.
There's a comment in here asking about Roku, if y'all are open to that.
Yes.
Now, David, I know you, I think if I'm not mistaken, you are a little bit of a Roku skeptic, understandably so.
We've had some discussions, yes.
Danny, how do you feel about Roku? For some reason, I want to say you like it, but this might be old news in my mind.
You are right. I do like Roku, and I think so far, I think it's been a better company than it's been a stock. But yeah, I'm probably a little bit more bullish than David is, and I'm not sure how bullish you are. So why don't we see?
We'll have like a little, maybe a bull bear and then a mid argument here. And I really put you on the spot here, Dave. I don't think you follow Roku particularly closely, but maybe you can explain why you've been skeptical in the past.
Yeah. So, and let me just say on the outset that it's more just our discussions in the past have been helping me to understand what the business does. broadly speaking, 10,000 foot level. I'm a Roku user. I'm a power user, actually. I have Roku on all my TVs. That's what makes makes sure that I get to watch all the sports that that I consume. But the idea, and I get this idea, the idea that it is the operating system for the TV, that makes complete sense to me. But there's a lot of competition, right? The TV makers basically want to have their own operating system so that they can control the experience. And what Roku has said is, by virtue of them being, they are the leader, they're the leader, right? In terms of market share. Yeah. Okay. I want to make sure I got that right. That they can translate that into more opportunities. Now, go to the financial statements. We're seeing that actually happen. Like that's not the issue. Where my concerns, or what I want to understand better, is how do they do that? So they want to one of the things they want to do is take that operating system leverage that they have, that position, and turn it into advertising dollars. I guess, like, why would if I'm a power user, where would I see those ads, and how would they come to me on a Roku box itself? Because I'm immediately going to Hulu Plus or ESPN Plus or Paramount, wherever my next soccer or hockey match is. That's where I'm going, and I see their ads as opposed to Roku. So again, it's not that I am anti-Roku by any means, but it's just a matter of trying to deepen my understanding. So I'll stop there.
No, I love that. And to your point, Dave, I think there's a lot of truth in what you said, even to this day, about the skepticism around Roku's ability to actually monetize its base. And there's two elements to this. One is, how do you monetize your users? Great, you have all of this engagement. You are the #1 platform in North America in terms of TV operating systems.
Yep.
But how does that generate into free cash flow? And then there's also this kind of separate question that plays into it, which is, why are you the #1 TV operating system? And why is your lunch not being eaten by the Amazons, by the Walmarts, by the other retailers in the world that are all competitive in the space of TV operating systems?
And real quick, I'll interject here to say, to give a little more context. My basis of thinking really comes from Roku on the hardware side. And it may be I just need to flip the way I'm thinking about this, because again, if I look at the analyst estimates for the next 2 to 3 years, they're expecting low to mid-teens growth on the top line, and free cash flow is expanding. So, there's got to be something that I'm missing, and I know you two are going to fill in the blanks.
Yeah, this is my favorite aspect about Roku, because I do think there is, even though it's been so long now that Roku has moved away from being the device that you plug into a TV into actually being the software that is integrated into the TV, there is still, I think, a fair bit of investor confusion. Yeah, exactly. So you have a Roku device. Do you have one that plugs into your TV, or do you have a TV that runs the Roku operating system?
I have both.
Okay, so that's a great example. They initially got started with their hardware boxes, but they also have TVs now that they sell for incredibly cheap prices in places like Amazon, Walmart, Targets of the world, where they have, they have operating systems built into the TV itself. So you may go in and buy a TV, never really understanding that what you're buying is a TV that has the Roku operating system integrated into it. And while this may not be true for every consumer, it's my impression that consumers, for the most part, don't really necessarily care what operating system is on their TV, so long as it, to your point, Dave, gets the functionality done, which is when they click on Hulu, they can watch Hulu without too much interruption happening in their day.
When 245 rolls around on Tuesday and Wednesday, I want to be able to see my Champions League games. That's all I want to be able to do.
Exactly. And the least interruption you can have, no, I love that. The least interruption you can have in your experience, that's all you care about. So you're not going to get an operating system that is, beautiful, but going to interrupt your ability to actually watch the programming that you want to watch. You just want one that gets the job done. And I think Roku has done a great job of understanding that that's the place where consumers are coming from. And as a result, they've been selling their hardware consistently since day one at a loss, saying to themselves, we don't need to be the best hardware. We don't need to be the best operating system. We need to be the most pervasive operating system. And as long as we can have saturation, then we can find ways to monetize after that. So that is consciously part of their strategy, is not saying, well, our platform is just so much better than Amazon or Apple TVs or whoever else is. Even though I do think if you ask management, they'd say that. Of course they would. I don't actually think that's part of their thesis, though. So once they have, and that's the reason why they've been able to maintain their market share. And that market share, by the way, that divide has only grown over time. So even as more competition has come into the TV operating system space, because Roku is so willing to sell their hardware, their TV at a loss versus others not being willing to do that, that has given them dominated market share. And again, accessibility in places like Walmart and et cetera. And they're expanding internationally. All of that is to say they have the market share. Now it comes down to the question mark of, okay, what does monetization look like? And to your point, Dave, they do have ads that they've been integrating, and they've actually made substantial improvements. They had a partnership with the Trade Desk that dramatically increased their profitability over the last couple of quarters. That's the sort of things that they probably should have gotten done 3 years ago that they're just now getting around to. So to your point, there's better ways that they can monetize their ads, and that's part of the reason why free cash flow has just started recently ramping up, is because they finally got their act together. I don't know about anybody else, but just as an example, I used to get Spanish ads on my Roku TV all the time. I don't speak Spanish. And I was like, man, you have this data about me, you should do better. Those have gone away. And I feel like I don't know to attribute the Trade Desk to that, but these types of partnerships have allowed them to more effectively monetize ads. But it's not just the ads, to your point, Dave, on their platform. Yes, the ones that pop up when you hit pause, the Roku ad pops up, or when you pull open the Roku screen and you're picking, you might see paid ads to be like, hey, watch this show, watch this show. It's not just those, although those are very new. They actually have revenue share agreements with all the major streaming services that are on their platform. So they get, and they don't release, these are privates, and I think they're individually negotiated, part of the reason why they're private. So I can't tell you what their agreement with Hulu is. I can't tell you what their agreement with Netflix is or Amazon Prime, but they have revenue share agreements for the ad-based platforms that they're hosting on their side. They're small, but they exist.
So sharing data in order to better to give their partners better targeting data.
Exactly.
Nice.
And then also they also get a cut of any subscriptions that are purchased on a Roku platform. So that's also a form of recurring revenue. And all of that means to say that, of course, as a result of this being the core of their business, the numbers that management really wants to focus on moving forward is the platform revenue and the platform margin profile. Because they're like, hardware, we understand that's a loss leader for us. It's the platform stuff that long-term we're going to make, or we're going to attempt to make revenue from. Now, minor yellow flag. I initially called it a red flag. It's now become a little bit of a yellow flag for me because I've settled with it. As of 2025, fiscal year 2025, so they just reported fourth quarter. This will be moving forward for their first quarter report, which I believe comes out in May. They are no longer going to be reporting two key metrics that I and other investors have been using. That is total household number, I believe, and the streaming hours. So basically engagement metrics, which they're saying these are, sorry, not streaming hours, average revenue per streaming household.
Okay.
And the reason is because as they're expanding internationally, they're basically saying, don't look at stuff like average revenue per household, because that's going to go down as we get more customers and emerging countries, which I would like to think investors can figure out for themselves. There's no harm in reporting these numbers, but management is basically saying 100% you're just focused on platform and platform gross margin. I will say, I think this puts a big onus on Roku management to expand their platform margin profile. Because if you're getting rid of two KPIs that I and other investors have been looking at for years now and saying focus on the platform side, well, guess what I'm going to do? I'm going to focus on the platform side. And if that doesn't start getting a lot better, then I'm going to start getting a lot angrier. Anyway, that's a very long-winded pitch, but basically to say there's a lot of question marks still open with this company because the turnaround in their ad revenue was so recent, and management has had, in my opinion, a couple missteps in the past. I do think the onus is on them now to kind of prove that will maintain, but there has been some recent positive momentum in that direction. And I do think if you believe the thesis here for Roku in terms of the way that they can monetize that engaged audience, then valuation right now is incredibly reasonable.
And I wanted to share, I pulled some numbers up. This comes courtesy of Pixelate. And they say that Roku has a 39% market share in the United States for voice-activated CTV. They have the highest CTV device market share in Canada, in Mexico, and they are one of the top 3 in Latin America and in Asia. So they are actually one of the leaders worldwide.
That's good. And I will say, having followed social media companies, like Facebook, for example, back when it was Facebook. If you looked at how their international viewers, members monetized, it was at significantly less than an American, US based users did. And so I could easily see early on, right? You got to get them on the platform, and it's pretty much going to be, 0 over a big number, which will hurt things. I get that. And then the question is, where does that 0 trend from there once you get them? Like, can you get them to switch over? Which many of the social media companies, they gradually, slowly figured out how to increase the, average revenue per user. So I imagine Roku is going to do the same thing.
And can I talk a little bit about how this management team has handled guidance? Because I just think it is funny. I spent some time trying to pull up my notes here from the most recent quarter. And I remember 2 quarters ago, so not the most recent one, the one before that, shares went down something like 30%. The company had an incredible quarter. On an adjusted EBITDA basis, they beat their own internal expectations on the high end by something like, I wish I had the number here in front of me, but it was 117% higher than what the top end of their guidance had said. So things were crazy. The quarter was incredible. And then management comes out and they guide for a cut to EBITDA in the next quarter, so the most recent quarter, fourth quarter, of like 80%. So they beat their own expectations by triple digits and then cut their expectations for next quarter by 80%. And investors were like, what the heck is going on here, right? Everyone was confused. I was confused. Stock went down 30% despite the incredible quarter. And management was like, yeah, we had a lot of good ads. Ads were great for us in the third quarter. And we think that was because of the election. And we don't expect for that to repeat next quarter. And so we're like, okay, but the election it bleeds into the fourth quarter, like the ad revenue from that. And you're acting like the ads will just fall off entirely in the fourth quarter. So of course I look back on my notes at the time and I was like, the fourth quarter is going to be great. Management just doesn't understand how to manage expectations here. They have never been put in this situation before. They're living in an uncertain environment. Their ads are suddenly a lot more effective. They have new partnerships. They have the election going on. They're confused. And wouldn't you know it, fourth quarter comes around, and while they guided for doing 30 million in adjusted EBITDA, they did 80 million in adjusted EBITDA. And then my favorite thing that they wrote in that fourth quarter letter, when they gave their full year 2025 guidance, they expressly said, we're aiming to provide a more clear and accurate outlook grounded in our latest information rather than conservatism. Basically throwing up their hands and saying, okay, we moved up.
We were sandbagging. That's what they said.
Yes.
What?
So take this management team with a grain of salt. I will say they did own up to it in the earnings call, and they said, we just haven't been put in this situation before. They were confused and they have a better idea moving forward. And they said when 2026 comes around and when 2028 comes around, we're going through the miniature election cycles again. They're going to have a much better picture about what to expect. Hopefully. They've hired people.
Nice.
And hopefully some of the best people.
Guess we'll find out.
So I think we have a really excellent question from the viewer JBL. What would you recommend for beginners to learn about contextualizing valuations? I learn a ton on here. Good. We're glad to help there, but want to spread my wings and become more self-sufficient. Also good. And we would be, I think we would be happy to help there. So contextualizing valuation, that couldn't, I don't think you could state that any better, because that's what valuation is. Valuation is a judgment call about the future. So you need to understand the context today and be able to figure out how to project something in the future. And so one of the ways we do it is what's called a discounted cash flow analysis. If you're a beginner, that's a lot. So I'm going to actually step back and be a little heretical because I remember having lunch with a gentleman named Michael Mobison, who teaches valuation at Columbia and is just a brilliant analyst in his own mind. And he would basically say the only thing that you should be doing is discounted cash flows. I actually think that valuation multiples can be very helpful for the beginner. So what's a valuation multiple? The price of the stock relative to the amount of earnings that it creates, the price of the stock or the enterprise value of a business related to the amount of sales that it's generating. You can make these valuation comparisons across any number of metrics. And what you can do is sort of say, okay, what is the company doing today? What could it be doing tomorrow? And get a snapshot of, does this stock seem expensive? Does it seem risky? Meaning the business has to do a heck of, if a price to earnings ratio is very high, basically the market is saying, we expect this company to do really well over a long period of time. So in your analysis, you have to figure out how that's going to happen and why it's going to happen and why there's not going to be a bunch of competitors who come in and try to stop that. So I'll stop there for a sec and let these two add in their thoughts as we get through this frankly, this really good question.
I talked a lot. You go ahead, Danny, and then I'll follow up.
Well, I think this can be complicated. So when I was early in my investing journey, somebody that was smarter than I was said, keep it simple, focus on the two most widely followed valuation metrics. Follow price to sales and price to earnings, because I don't know how you guys are, but if I get too far into the weeds with something I don't understand, my eyes glaze over and I don't learn anything. So basically just understanding the price to earnings has to do with what the price of the stock is divided by the trailing 12 months worth of profits. And price to sales is essentially the price of the stock divided by the preceding 12 months worth of sales or revenue. And those are the two most commonly used. And the way that I find them useful is by comparing them to what other similar companies are doing or what the market overall is doing. Yep. And that, to me, that's the simplest way to use valuation metrics and to get the most value out of them.
So what that's called relative valuation. You're comparing what you're seeing in an individual company to another company that could be a competitor, or to an index like the S&P 500, for example. And again, it doesn't tell you this is the value of the company. It just tells you this is what investors think about this company relative to another company or another index. And it gives you a little context to work with. And as a beginning investor, this is a great way to basically use it as a springboard to go in and say, okay, now that I have this context, let me go see what the business is doing.
I'm thinking now I should take a pass. And the only reason is because I was about to give a spiel about how much I disliked relative valuation ratios, like price to sales and price to earnings.
And quite frankly, that's okay, because you are an advanced investor. And we also know you have an advanced process. And to that point, that is where we all begin to, that's the direction we all begin to move. So again, relative valuation is a great starting point. Again, a springboard to figuring out what is this business doing? How is it going to keep it going? How is it going to continue to grow? What advantages does it have, and things like that. And then there are a multitude of tools, from the simplest, the relative valuation, all the way to the most complex, discounted cash flow, real options analysis. I've done all these too. My background's in engineering. I can't get enough numbers in front of me. But to, to Danny's point, I love the idea of the KISS principle. Keep it simple, stupid, and start there, get comfortable, and then when you're ready, take the next step. I think that's a great path for all investors, especially beginners.
I think that's beautifully said. And as y'all were talking, that is actually exactly where my mind went, which was, sure, I can sit here and explain all the reasons why I could pick apart why PE ratio isn't the best way to think about Roku today, right?
Right.
Is that actually
Right.
valuable for contextualizing the valuation of a company? And in the context of this question, I think you're exactly right that it kind of works your way up. And the question is about contextualizing, and relative valuation ratios do exactly that. And they can provide an initial sanity check before a deeper analysis happens, which is incredibly valuable. And people have heard me talk about PE ratios and price to sales, or price to free cash flow, EV to free cash flow, those sorts of things as context to the relative valuation of a company. The one thing I'll add is, if you are looking to take that for the next step, my only complaint for the most part with these relative valuation ratios is that they make a lot of implicit assumptions.
Yes.
And a lot of people will make explicit assumptions based off the implicit assumptions that are done from a relative valuation ratio. So if you're looking to take it the next step, ask yourself, what do I actually expect this company to do? Before you even get into any valuation work, what do you expect this business to do? I'll use a business like, let me think about an easy one to understand here. Dutch Bros as an example. That's one that we've talked about before. A good kind of expectation analysis there is not looking at Dutch Bros on a PE ratio, but asking myself, what do I actually think earnings could look like for Dutch Bros 10 years from now? Well, let me go back.
How are they going to get there?
Yes. Let me go look at Starbucks. Let me go look at Wingstop. Let me go look at all of these other semi-related chains and look at how they got there, what their margin profile looks like, compared to the strategy of Dutch Bros management, and ask myself, 10 years from now, do I think Dutch Bros is going to producing 2% net income margins like they're doing right now? Probably not. I think those net income margins could probably be 15 or 20%, right? A little bit more standard for the industry if management executes on their plans. And suddenly the implicit assumptions that you're making by looking at Dutch Bros PE ratio becomes a lot more explicit, right? Okay, well, that PE ratio might be 200 times today, but if earnings grow at this rate, sales grow at this rate, they build out stores at this rate, they have these types of economics, suddenly a decade from now, they've produced 10% compound returns and their price to earning ratio is 25. So that's how you kind of like get there in your brain.
See, does everybody see what Emily did there? She changed her mind mid video, mid streaming. She was like, "No, this is bad," and then she perfectly explained how it works.
Well, then I doubled down a little bit. But this is all to say, the initial responses y'all gave were perfect, and I probably could have just not said anything and moved on. But of course, I have to hear myself talk.
Oh, but we pay good money to hear you talk, Emily.
Absolutely. But I think the example that she gave with Dutch Brothers and the other competitors out there, that is, you can just take that model and repeat it anywhere you like to start off with. I think that's really well said.
And that's just another way of contextualizing.
Perfectly said. What else we got?
There's a good question here from Matt about Disney. So Disney is a foundational stock, and Stock Advisor has been for a number of years. And, Matt's asking about if the most recent results from, I believe it was the Snow White launch, which I unfortunately haven't kept up with, but my interpretation from Matt's question is it was less than stellar. Whether or not that really threatens the long-term thesis for Disney. And my short answer here is no, not any one box office I think threatens Disney. And in fact, movies have been a very weak spot for virtually any business that competes in the industry. All of those kind of IP and stuff that coming out of direct movie theaters have been a declining part of Disney's business. Now, it's one that when they hit, they really hit. Clearly, Snow White did not really hit. Superhero movies tend to hit a little bit easier. The Marvel there of Disney has been there a bit stronger for them, although innovation I think has been lacking. And Danny just put in the chat here that their weekend box office for Snow White was 43 million. And Danny, I take it from that, not good.
I think that Snow White has been a controversial topic for a number of months. I think there was some internet chatter about the choice for the lead actress in the role that I don't think was entirely fair. It wasn't necessarily based on her acting ability, but her background. And I don't think anybody ever expected Snow White to have one of the Marvel openings from way back. But I think a lot of I think a lot of what's going on with Snow White isn't representative of Disney's opportunity as a movie purveyor.
And one other question that we need to ask is how much did they spend to create the movie? Because if some of these movies can be extremely expensive, right? And not getting the return that you're expecting on your investment can hurt a little more. So for context, getting back to that great question that we just had, we need to understand how much money they spent in the process to see just how or to get more of a sense of just how impactful it might be. And then the other thing is we do have to remember this is one movie in a company that creates a lot of content in a lot of different places in a lot of different ways. So there's nothing I don't see. I mean, I don't think I can imagine a situation where one movie would actually, in some sense, ruin the company, completely ruin the company. But, it doesn't mean that investors can't get sour as a result.
Yeah, and I can speak for the stock advisor thought process here behind Disney, which is to say, to be honest, I don't really care about how well Disney does at the box office. This is a declining part of Disney's business, and they haven't had a great track record, I think, and making sure they're not outlaying too much to produce these movies. That's a legacy part of what they've done that has been declining by double digits for a while now. But the focus should be on where is the majority of Disney's operating profit coming from? Where are the profits coming from and how quickly is that growing? And the reason why we'll continue to see Stock Advisor have Disney as a foundational stock, not only because we believe in its long-term thesis here from a valuation perspective, but also because we're seeing a massive rebound in the most profitable parts of Disney's business, which are a couple of things. One is sports and entertainment, right? Clearly a big part of Disney's business now, responsible for something like 15% of their total profits, as well as their domestic park experiences. That is growing quickly. That is rebounding massively in profitability. They do not have infinite pricing power as it comes to the pricing of Disney tickets, but we're talking about a segment of their business that produces more than a third of their total operating profits. That's up substantially from where it was even just a few years ago. So this is a company that has declining aspects of its company. And I think that the media really loves to focus on very particular parts of Disney because, to your point, Danny, sometimes it can be controversial for whatever reason. But I think investors should be focused on the profits for this company and what's driving it. And this has always been cruises, park, sports, and increasingly, actually, their direct-to-consumer business. That includes their infamous Disney Plus, which is now profitable and growing pretty significantly for the company. So these are all value drivers that are beyond, I think, any single box office.
Yeah, and I think it's important to remember as a Disney investor for me is that Disney has probably one of the largest caches of intellectual property of any company in the world, and they can use that cache of intellectual property for things like new movies at the box office, to attract people on streaming, to put new characters in the parks, and one movie does not Disney's fortunes make or break.
Reminds me of the great Buffett quote, "The mouse doesn't have an agent."
I love that.
So there's another question here from Ed and says, Chewy reports tomorrow. What do you think? Good or bad report? I'm going to be honest. I have no idea. I can tell you what I'll be looking for. I will definitely be looking for what is the trend with users. I want to know who's subscribing. I want to know is the percentage of people on auto ship staying flat or growing slightly. That's an important input to their business. I want to know, since this is a very thin margin business, I want to know, are they becoming more efficient? Because management over the last couple of years has been investing lots of money into its warehouse and logistics systems in order to become more efficient, to fulfill those orders, all those auto ship orders. I got my auto ship orders. There's plenty of Chewy boxes for my dogs and on our front porch every month. But those are the things that I will be looking for because from user growth, how is that translating into revenue growth? How is that translating into, how is that combining with the operating efficiency to translate into margin expansion? And then ultimately, what are the profits and cash flows? So I don't know what they're going to say, but that's what I'm going to be looking for. And I know Emily probably has some ideas here too, because we talk about this one.
Me too. I also really like this business. And because I like this business, my immediate inclination when prognosticating about what the future holds is to be incredibly pessimistic and skeptical. I really like to manage my expectations, so I'm not disappointed. So as a result, I will say, I think I'm a little bit concerned for Chewy in this upcoming quarter. Now, just because I'm concerned for Chewy doesn't mean the market is concerned from Chewy. And to be clear, this is a game of expectations. If you're looking at post quarterly report movement, not long-term business value, right? So in terms of what the market expects versus what I expect, there's a disconnect there that is certain to exist. So please do not take my thoughts as speculating as to the movement of what will happen with Chewy. I do not think anybody should ever be trading stocks based around quarterly reports or what they expect to happen or not to happen as a result, to be very clear about that. With that disclaimer made, I can prognosticate now and say, Dave, the same exact things you're talking about are what I'm focused on. And as a result, I am a little bit worried. Their auto ship sales as a percentage of total revenue has continuously increased. And a lot of investors have pointed to that as a KPI, but this cannot go up forever. It's around 80% right now. That's the highest it's ever been.
Yeah.
And I love that aspect of their business. If it goes up again in the next quarter, I'm like, great. But I'm always just waiting for that other shoe to drop for when it reaches, because there is a max capacity at some point. It's not going to be 100%. We just don't know where that max capacity is. So I'm always afraid of the quarter where that goes down and investors start to panic a little bit for absolutely no reason about the value of the company as a result.
Right.
I also worry a little bit about active customers. They've seen that strengthen and they've been expanding, especially into Canada as a result. I worry about management over focusing on active users instead of profitability. I expect to your point, Dave, margins to expand over the upcoming quarter. They have done a great job of that, especially as they push into healthcare. I don't have any inclination that they've reached their max capacity there for margin expansion, right, or that will slow down. This has been a very disciplined management team, but there are factors that they don't necessarily have control over, and active customer growth is one of them. That being said, what can assuage my pessimism has been this backlash against Amazon that we've seen just over the course of this past year. A lot of people, for whatever reason, saying, I'm no longer shopping at Amazon, I'm turning off my Amazon auto ship. Some people have speculated that this could turn into a tailwind for a business like Chewy. I think we'll get our first indicator about whether or not that actually is the case tonight, depending on active user growth as well as profitability.
Yeah, those are good points. One of the other interesting things, if we go back to the very beginning, which was we talked about consumer confidence being low. Interestingly, the data supports the idea that people don't stop spending on their pets. Maybe the incremental spend goes down, but you still have to feed your pets. You still have to take care of your pets. Maybe you don't buy the third toy for them to play with, and you just limit it to one.
No more toys. Who are
Is
you
that a
talking to?
Is that a croissant in the background? What is that?
It is a little croissant, but my entire house is, you can see it. My entire house is covered
Yes.
with cat toys. I'm the worst Chewy customer. I mean, or I guess I should say I'm the best
You're
Chewy
the best.
customer.
So it'll be interesting to see, if some of the effects of consumer confidence are actually beginning to move through this business. Again, context is important. That's we got to understand what's happening in the business before we can make an assessment of, okay, what risks am I willing to take? What rewards are out there for me to get? But I think where Emily said, really focusing on margins, I actually do think that one's a very important piece, because what we've seen from investors over the last, let's call it 12 months, is their sentiment has shifted. Even though growth has stayed pretty low, the business has gotten more efficient. Margins have expanded ever so slightly. And investors said, okay, breathe a sigh of relief. We're happy to see that the business is strong in terms of how it's operating. But if we could, I think if you can get that little bit of growth, right, that along with that little bit of margin expansion, along with that a little bit of extension into more results from the extension that they're making with their brand, taking it from products into services. From a long-term perspective, I'm not really worried about this business as a business, but now we're just looking at, okay, how are you doing? Management says this is what we want to do. So we say, okay, how well did you do against what you said you were going to do? 2 minutes left. Who's gonna bring home the last question?
I think it's Emily.
Yeah, I can take one really. I see a couple here I can take pretty quickly. One from Bebo, who says, Emily, have your convictions changed in cannabis companies since September 2022? Have you weeded or trimmed any? Have I ever ended any positions taken? And this has certainly been a disappointing industry, at least domestically here in the United States from the regulatory perspective. Obviously, I had hoped since September 2022 that we would see more progress on the federal side in regards to regulating, potentially even legalizing, or at least decriminalizing cannabis. We saw a little bit of that potential last year during the Biden's administration, or I should say during Joe Biden's attempt to run for office, where he did have in his initial plans to move cannabis from a Schedule 1 to a Schedule 3 substance, which would remove some of the tax liability associated with companies that are decreasing their profitability. We're talking hundreds of millions of dollars in profits for companies that are being paid out in income tax right now because they're not able to deduct their normal business expenses the way that other businesses are, simply because the schedule of cannabis. And that could happen without full decriminalization, without full legalization. That's just a change in policy that is pretty bipartisan. But whenever Biden dropped out of the election, Harris chose not to pick up that as part of her platform. And then obviously the Trump administration has not made that a priority. People have bigger fish to fry right now other than tax laws around cannabis companies. Shocker, I know. So while I will say I wish there had been more progress there, I will quickly note my long-term belief in a lot of these really strong businesses is still very much there. I always call out Green Thumb Industries as a prime example of an incredibly profitable, strong, well-managed business that hasn't fallen into the same traps as a lot of other cannabis companies. There are good companies that exist out there. They haven't gotten the tailwinds that I think we wish they had gotten by this point. But no, I haven't purposely ended any positions. Probably from a state of laziness more than anything, to be honest with you. That being said, I have had positions closed for me by my brokerage because the companies have gone out of business or share prices have dropped so far that they were effectively penny stocks. And my brokerage said, we're liquidating this, right? Because it's costing us more money to upkeep than it is for you to have in your portfolio.
Wow.
Yeah.
So we have come to the top of the hour. Danny, I want to say thank you so much for doing an extended hour with us. It was awesome to have you.
Yeah, thank you, Danny. I appreciate you jumping in. I realized that my tech issues here were a little bit of a headache, but this 3-person panel was so much fun.
And Emily, thank you to the power company for getting your power back up, even if it was 5-10 minutes late.
To those tree trimmers.
It's great. So it was awesome being on with you. Thank you to all the viewers out there for this hour. And up next, Jason Hall and Lou Whiteman. Take it away, gentlemen.
This 3 + 2, this 5.
This is awesome.
Like 2 or 3 more, and if we were on that other network, it'd be Markets in Turmoil or something. But it's going to give me
four more, and we can play Hollywood Squares.
There you go. Oh,
All
wow.
right.
That's an idea for an hour. All right.
I like that idea.
And I'm out.
See you fools.
Bye.
Hello.
Hi, Jason.
What a glorious, wonderful day we're having.
Is it?
Sure.
All
Sounds
right.
good. Yeah. No, it's good. It's good here. It's good here. We're gonna
All
push
right,
through.
good
We're gonna
deal.
push through some technical challenges on your end, and we are going to have a great hour. It is an Ask Us Anything hour. How do people ask us anything, Lou?
Well, if I was them, I would go to Slido, keyword Fool24, and I would get the questions in now about stocks, and I'm going to keep going with this, Jason, because I really want to get these questions.
I really want to do the relationship advice. hour with
Relationship
you, Lou.
advice.
Yeah,
relationship.
I really want to do that.
Fools, anyone out there who can solve some tech issues for me, just hit me up on the side too. Okay, I just basically need I don't know what I need, but yeah, of course, Jason, what we can't do, whether it's relationships or financial, we cannot give personalized advice. We don't know your situation.
Right.
We are not going to try and give you personalized advice, and don't take anything we say as personalized advice. Do your homework. But we do have opinions.
Own your own answers. And yeah, take our opinions is that. It's just, the opinions of two people that may or may not know a lot about what they're talking about. So
yeah,
that's good. I actually, you know what, as I want to do, Lou, as we're waiting for questions to come in,
sure.
I want to grab a question that came in from Vincent Campos just a few minutes ago. It was during the prior hour. But I want to weigh in because one of the companies that Vincent mentions here is one of my very biggest winners, and that's Intuitive Surgical. So Vincent's question is, what is your view of Monogram Technologies, ticker is MGMR, in the field of robotic surgery compared to Intuitive Surgical? So let me say this first. I am not a deep healthcare expert. We have a number of fools that come on here that are deep healthcare experts, but I've owned Intuitive Surgical for 13 years. And because of that, I have followed that space that it operates in, robotic surgery. And I do know a little bit about some of the other players in healthcare devices specifically. And I think as a starting point, comparing Monogram technologies of today to Intuitive Surgical today is almost impossible because Monogram Technologies is still a pre-commercial company. And Intuitive Surgical is the de facto standard in a lot of the kinds of surgeries that can be done with its robots, its device. So the Da Vinci surgical system. So first of all, two companies in very different phases of the directions of their business. Now, also Monogram, from the little bit of research that I've done about the company, is focused on joint surgery. So there's a device aspect, and then there's the robot that they're developing as well. And Lou, they've gotten some initial clearances, which is a great step forward. But this is still an early stage pre-commercial business. So that's always really important. So there's a tremendous amount of risk for any business at this stage. What's going to be interesting to see for its success, because I do think eventually we're going to get to the point where maybe there's some overlap between a Da Vinci and a Monogram if Monogram is a commercial success. But today, Da Vinci is not something that orthopedic surgeons or orthopedists are using. It's not the kind of surgeries that are performed with the Da Vinci robot. So initially, I think there would be minimal competitive threat to Intuitive Surgical, minimal to zero, right? So Monogram still got a lot of work to do to prove that their device, their surgical robot and the implants can deliver patient outcomes, right? Because that's what's going to move the needle are the patient outcomes good? And are the payers going to want to pay the cost to do it? There needs to be a financial benefit in addition to the patient outcomes. And then here's the biggest thing when it comes to anything in the healthcare system you have to think about the change that you're dealing with. You're talking about moving surgeons from the way they perform surgery today to robotic surgery. And that's challenging. The biotech and healthcare world and surgical device, medical device world is littered with companies that failed because they were trying to change something about the way that physicians operate and run their practices and make money. And that's really, really difficult. So it's going to be an interesting story to follow. And I would love to hear from more highly educated fools that really focus on this space a little bit more. But I think, again, remembering where the company is in the continuum of its life cycle, it's interesting, but it's still super, super early days.
Gotcha.
Lou, what's next?
Well, I don't have much to add on that, but since we can stay on the intuitive theme, how does that sound? All right. Intuitive Machines, ticker LUNR. There's a question from not H-Town Dad said, "What is your view on Lunar LUNR, also known as?"
You're taking us not to outer space.
Well, yeah, but
in the solar system,
staying within the Earth's pull, but only barely. But as what's the thoughts on Intuitive Machines in the new space focus by the administration? To me, the administration part of this is a non-starter. This is a long-term business, and they do have one good thing that came out of their earnings is they do have, I would say, ample cash. They have $300 million plus cash. So the only way politics would really factor in here is if, oh my gosh, this, the runway is limited and we need to see, and then does Washington want to spend here? Intuitive Machines, great ticker, LUNR. What they are focused on and almost focused on exclusively is the moon, getting things onto the moon. And so if you believe in this world where we will start going to the moon regularly again, and then maybe it is a base for which we go to Mars and other places, we are going to need the capacity to get up there, build things, do all sorts of things kind of from here. And that is their business focus. They have done okay so far. Like it's been kind of a mixed track record. Their last attempt landed on its side on the moon, which is suboptimal. However, they say that the equipment, the payload was able to deploy from there. So, better than I can do if I've tried to throw something to the moon. So I don't think it's the disaster that people were afraid of. The bigger risk for me right now is that it is such a focused company. And it is just focused on this one thing. And look, if you want to bring the administration into it, the lead advisor to this administration thinks we can go to Mars without stopping on the moon, and thinks the moon is a waste of time. I don't worry about that, just like I don't think but as an investor, I really do worry about such a niche company focused on just this one thing. And even if they're the best at this one thing, I don't know if I see a sustainable long-term market-beating business there yet. I still personally need to be proven on that. However, kudos to them for what they have accomplished, because the science project part of it, I was talking about it's both a science project and then turning it into a business. They've done pretty well on the science project. They just need to prove the business.
Yeah, minor little detail there for a publicly traded company. Given time, I think the foundation is interesting, though. I think there could be something there. All right.
Yeah. I know it's definitely interesting. It's just what, I don't know. Like, how much business are we going to do on the moon?
Yeah.
Which we'll see.
No, that's fair. That's very fair. What'll be interesting to see is that as time goes by, how much optionality and how much will their business be able to apply to the other things in near Earth orbit in space, right? The stuff in between here and the moon. So we'll see. But they've got some pretty stiff competition. Everybody's throwing money in space, Lou.
Yeah.
Everybody.
Yeah.
All right. I'm gonna. So there's some healthcare questions in here from besties that I'm not touching, Lou, and I'm probably not up your alley either.
No.
So let's just skip those. And where did it go? I think it was the second and most recent question from I Need Input. Here we go. Hey, Lou and Jason, between BLD, which is Builder's First Source, and MCOR, ticker EME, which one looks attractive at current levels for at least a decade? Lou, do you want to weigh in here, or do you want me to go first?
You can go first. I mean, I might take the boring choice. So go ahead, give it a go.
Wait, which one's the boring choice?
I don't know.
They're both the boring. So okay, so
yeah.
So Builders First Source, interesting business. So was Builders? I have to ask. Was Builders? Wait. BLDs. No, BLD is Top Build. I'm sorry, that's Top Build.
Yeah.
So Top Build was a spin out. Who was Top Build spun out of? I can't remember, but it's a distributor, and they distribute insulation, and they have an insulation services business too, where they will actually do the insulation. One of the cool things about distributors is if you run well, and they're a commercial distributor, right? It's not like a Home Depot. It's not a big retail kind of business, is that you can actually keep relatively lean operating costs because you can turn your inventory quickly, right? You know your business, you know your customers, you know the orders, you have an order book, and it makes it a little bit easier to kind of manage that through the cycles, because it is a very cyclical business because of the ups and downs of demand. And one of the things that we've seen too over the decades really is a lot of builders want to outsource stuff like this because it can be hard to find labor to do it, depending on your level of scale. So having a partner that you can have come in to do this kind of work, so their installation. So that's a mouthful.
Easy for you to say.
Not very. Is a good business that they have as well, especially when demand is high, because there's a lot of opportunity and a lot of business there. So, but again, it's a cyclical business, so there's some cyclical risk you have to consider. And we know, Lou, because a lot of their business is like working with home builders, as home builders are stand up a community and there's 20 or 30 or more houses, 100 houses or whatever. There's steady work and it keeps them pretty busy. But when we go through a housing downturn, typically with new build, things get a little more difficult for them, and they have to scale their business down. But the good thing is they have a strong history of generating cash flow just about across the environment. Lou, you know who else has a good history of generating cash flow across the economic environment? MCOR.
MCOR? Yeah.
Yeah. Has never. This has surprised me. I went back and looked a number of months ago, and MCOR has generated positive free cash flow basically every quarter for the past 25 years. Every quarter through the early 2000s recession, through the financial crisis, massive housing crisis, massive banking crisis, so financing for a lot of big infrastructure kind of stuff, all the way up through the pandemic, still managed to generate positive free cash flow every period. For a business that its most valuable asset is people that you have to pay, that's not always an easy thing to be able to do. But the benefit is you don't have a lot of fixed costs like a steel maker or a car manufacturer, right? So they do have some flexibility and scalability in their business as well, coming off of some record years, a lot of growth. I think there's a lot of opportunity ahead of it over the next decade. We talk a lot about reshoring, and people tend to, that kind of gets a lot of attention. But the reality in the US is that if you look at the demographic and the population trends, there's a lot of money being spent in desert Southwest, pockets of the Midwest like Ohio, and then the Southeast, where there's a lot of new infrastructure that's getting built. A lot of businesses are moving there. People are moving there. And MCOR is pretty strong when it comes to that infrastructure. You need electrical, you need mechanical, like HVAC. They're one of the largest. I think it was Miller Electric that they just acquired that gets them. It's a big foray into Florida and more into the Southeast. They have a long history of making these smart bolt-on acquisitions. They paid cash for this deal. You look at the multiple they paid, it looks really reasonable. They have long proven to be pretty good at these bolt-on growing by buying small regional players out and then integrating them into their business. They have a long history of doing that. So now that I've described the two businesses, where to invest, looking at them both, they both actually, from a valuation perspective, in a bubble, they both look attractive. And I think if you buy now and hold for 5+ 10 years, I think investors do well. But I don't know that I'm confident with either one. This is not cheap. This is not thinking like counter-cyclical. Like the best time to buy these is when the cycle turns and demand gets soft and the stocks get pummeled, even though they're still the best at what they do. And you can buy them cheap and, really, really take advantage of the sell-off. To me, 2025 feels like a year, based on all the evidence out there, that until there's more economic clarity, maybe something with interest rates, home builders with the challenges that they're facing with labor and land, labor and materials. I think both are interesting for maybe a nibble. Add a little bit at these prices. That's how I'm thinking about them, and build out that position, over the next couple of years as we get more clarity on the market environment for their businesses, these highly cyclical businesses. Tell me where I'm wrong, Lou.
No, I don't think you are. I mean, I was honestly surprised. I was expecting Top Build to be kind of to get a discount there relative to MCOR, just because of everything that MCOR has been associated with recently.
Yeah.
And you really don't. You get, I mean, I'm factoring in debt, maybe 11 times EBITDA instead of 9, so you don't get much. I think it's the funny thing about MCOR and the whole data center thing is that they both use that to fill their order book, but they also really didn't need to, because as you say, they are finding opportunities everywhere, and you can only grow so fast. So I think kind of at the height of that I was sort of skeptical, but it's kind of come down from that.
Yep.
I frankly, and it's funny, we can get to another one in a second. Bestie's sort of related to this, but I am both. I'm about to tell Besties there's something other than a distributor, but I think for these, I sort of like the distribution businesses better, whether or not it's it just because you get more exposure to more different things. I think both of them are fine long term, but neither one of them excites me to the point where I want to include them in a limited stock portfolio personally.
Yeah, no, that I think that's fair, and that's a good approach to take. I've got a more diversified portfolio where I do cast the wider net.
You just buy everything.
It's a little bit of everything.
It's the Jason Hall S&P 500. Yeah.
There you go. And then, but then what I do is I only add to the winners, or the ones that the opportunities there.
Right. So, so just to prove that I can talk out of both sides of my mouth, Bestie said, on the theme furnace to heat exchangers for efficiency, what are the best businesses in the area? WSO, which is Watsco, for distribution. I do think Watsco is a great way to play it. And I actually don't disagree with that. Again, I think distributors do make a lot of sense, especially well-run ones. And that is a well-run distributor. The one company that actually is kind of just increasingly on my radar screen, and I'm just curious to learn more, but one of these big HVAC companies has been a chronic underperformer, in part because it was the product was spit off and it was doing a lot of different things, and it's basically tried to become a pure play, and I think it's working, but you're still kind of getting a deal on it. Carrier, probably the biggest name everyone knows, CARR in HVAC. This is a really, really intriguing business to me. Like I said, it's just kind of on my radar now, but they came out of the United Technologies conglomerate. They had a bunch of different businesses. They've been now on their own. This is why we talk about, we love these breakups, Jason, because on their own, they had the opportunity to just navigate their own destiny.
Yeah, they get the attention and the capital focus they can't get when they're the smaller subsidiary of a conglomerate.
Right. They didn't have to fight with Pratt and Whitney for capital resources. They didn't have to fight for currency to do an all stock deal to consolidate. Now that they're on their own, they've done a few deals. I'm really curious to watch this company over the next couple of quarters. It's starting to lose that discount as they improve. They're earning that, so maybe it's already too late. I don't know, but I think that's just another company I'd throw out there is really doing some good things, and I don't think the market has fully appreciated it yet.
Yeah, I think that's right. So I'm going to ask you a question here. This goes to this was Sir Lord Graf, Sir Lord Graf, excuse me. So I'm going to be wading into the obscure a little bit with options here. Okay. So I'm going to put the question in, and then I'm going to explain what it is and why it could be potentially an interesting thing. So Sir Lord Graf says sell puts on Palantir. All right, so let me explain what that means. So when you sell puts on a stock, you get money. Somebody pays you. That's the selling part. Somebody is paying you a premium. And you were selling them the right to, at a future date, this is when that option expires, to make you buy a stock, 100 shares. That's how options lots are traded. 100 shares at a predetermined price. So the upside here, as an investor, there's a couple of ways to think about this. So first of all, if you pick a price, let's say, okay, so Palantir trades for about $96 a share right now. So let's say you'd be happy to pay $90 a share. I'm just throwing a number out there. You could sell a $90 put for Palantir for next month or the month after. You could probably do weeklies on Palantir. It's so heavily traded. Or next year, or maybe even December 2027, right? Maybe close to 2 years out. So you could sell a put, so you get paid that little bit of premium, and you get to kind of watch along the way as the stock moves. Now, the value of that option is going to move up and down along the way too. I'm not even going to get into that obscure part. But let's say you get paid, again, I'm just going to use a random number. Let's say you get paid $7 for that $90 put. And let's say it's August. It's this summer. I could pull up options chain and look, but I'm not going to. So, but let's say the stock jumps to $115. You're not going to get the stock put to you, right? Because it's worth $115. Nobody's going to sell it to you for $100. So what do you get? You get the $7, right? You get that $7, which August is, what's that, 4 months from now? So that's, call it 17 or 18% return over a 12-month return. Like if you were to annualize the return, 17 or 18%, that's pretty good, right? That's pretty good. Now, let's say Palantir's stock dropped to $87. The person that holds that put when it expires, because it's going to change hands a whole lot. But anyway, when that put option expires, somebody's going to sell those $87 shares to you for $90. Now, here's the cool thing. You got $7 already. So that means that technically your break even is like 83. Hey, everybody won. You got the price you wanted for the stock, even a little better with the premium. The person that owned that put, they made some money because they forced you to buy a stock for above the market price. That's how options can work. That's the upside, right? That's the good. Maybe you make a little profit. Maybe you get put a stock that's around what you wanted to pay, and you come out even better because of the premium you got. What's the risk? Something massive happens that upends Palantir's business, or just the valuation crashes for some reason, and the stock falls to 50. And you have to pay $90 for a $50 stock. So that is the downside risk of something like that. So my question for you, Lou, is thinking about Palantir, is the idea of using puts as a way to maybe get a better price on a stock like Palantir that I've heard you say it's a pretty great business, but the valuation doesn't make any sense.
Yeah, and never has.
Yeah, right?
Right. Yeah. So it could indefinitely. Well, yeah. Which I'm just saying, it's not a prediction things will go down. Yeah.
Right.
But yeah.
So what do you think?
So, I mean, and again, this is why we don't give individual advice, right? Because
I really reasons why we would not be one of giving anybody specific advice around this kind of question.
Right. But it really does, I think, come down to your risk reward appetite. I mean, Palantir's beta right now is 2.8, which means, 1.0 means they match the market fools. So this is much, much more volatile than the market.
8% more volatile than the market.
Yeah. So what you're getting is you are getting a stock that does tend to do, maybe not down to 50, but well more than a $7 swing or so, where you're going to get to 83. Right. It could happen. It also tends to go up like that too. If it works well for you, in Jason's first example, it is free money, period. But it does involve you paying attention, you understanding the stocks, and on something as volatile, you're probably going to get, I would think, Jason, and again, we're not going to pull up tables, but you're probably going to get better prices for Palantir than you are a slow and steady, boring stock, because that beta, that volatility means more people want insurance and more people want to use these products. And Palantir is just so you kind of, if you want to get those sweet fees on it, you have to take on this sort of a company most of the time where there is this sort of volatility. If you are comfortable with the downside, and definitely if you are comfortable, the best reason to do this is if you say, all right, Lou, I will accept the volatility. I know there's volatility. I know I could end up getting stuck with this thing at 50 or 60, but I really believe that over the next 5 years, Palantir is going to the moon. And even if I'm a sucker today, I think it'll pay off for 2 or 3 years. If you have that sort of a conviction where I just want to own this stock, I do not mind owning this stock, then maybe that changes your calculus too. But I really think it just depends on your tolerance for risk and what you think of the security that you could end up holding. Because there are situations where you can't just dump it at 83 and take your profit real quick.
Right. And that's exactly right. I mean, and here's the thing with options, there are ways you can exit the strategy, you can roll it forward and, kick the can down the curb, but those things always cost money to do, right? So you have to be aware of that. And another thing with using options like puts is, this is, again, it's a $95 stock today. If you have to, if you sell puts, you've either got to have a margin available, credit margin, or you've got to have a cash that's the equivalent of the strike price. So again, let's say $90. You say you sell $90. That's 100 shares. So every contract, you have to have $9,000 of either cash or liquidity available to buy those shares between now and the time that you no longer are the counterparty on that contract, right? So you have to remember there are other implications. Is tying up that cash or having the risk of what's it called? I'm drawing a blank here. The credit when you use
margin call,
margin. Sorry, of having margin, then potentially the risk of a margin call is thinking through all of those implications between now and the time the contract would expire. Just thinking about all of those risks. So, I mean, I will tell you, I've used this sort of strategy with a few stocks where I've sold deep in the money puts. Not expecting the shares to be put to me, but the return that I'm getting on that cash that's sitting on my account, because it's in a retirement account where I trade options, is better than the market's long-term average. Plus the yield that I'm getting on that cash, that is still my cash in my portfolio, even though it's reserved, I can't use that cash for anything. I'm still earning the yield on the cash, plus the premium that I get. So it's really just figuring out your risk reward, the price you're comfortable with, and your ability to take a big loss if something happens and the price that the stock's put to you is way above where the market price for that stock is at the time. So yeah, I think it's interesting. Yeah. What's next?
All right. Well, this one we can have a nice little fight on. Maybe Ed says aviation type companies or home builder companies, which is better to invest in today? I didn't see the today because that may that may weaken your argument because here I'm going to give you, and again we're both going to cherry pick here. And I'm going to say that, it depends on the aviation company. I'm sure Jason will say it depends on the home builder. But I see the long-term demand and the secular just tailwinds for long-term in both. Yeah. What I don't see is today's performance on the home builders. I think if you can get into a well-run, not airline, but aviation company on a component side, you are well positioned to take advantage of those long-term trends, and also you are getting near-term growth. The home builders, you can argue maybe you get some of these a little cheaper, but I don't know how much. And while I do know we need housing long-term, I just don't think right now is the environment where we're going to see these home builders really show growth and margin growth and all those things we're looking for. So I personally would say select aviation companies, but Jason, tell me why I'm wrong.
Well, I want to support you there for a second, because I think the key is it's the companies either select manufacturing, like just they're making components, like you said. It's the ones basically in between the manufacturer and the commercial operator, right? The companies in that middle are really compelling. And I'm not going to say they're anything like recession resistant, but they do have a certain amount of resilience because they're so important to their customers, who especially need them when their demand is weak, right? So incredibly strong companies. So from that perspective,
strong companies with track records who are selling into a multi-year upswing, brought on in part by Boeing's issues. So yeah, you have a lot working for you. Just even though they're cyclical companies, you have a lot working for you for the cycle for the next few years.
Yeah. So I want to show a chart here. Let me send this up. Cousin, if you can grab this, I'll have it up in just a second here. All right, here you go, Natasha. This is a select group of home builders. I included Lennar, KB Home, and NVR, which are three of the largest. KB just reported today. Let's look at today. I'm just curious. How much is Lennar down, and how much did it affect the rest of the home builders? This will be an interesting thing to see. So KB Home reported, I believe, yesterday.
White Charts doesn't think it's going to be interesting. Oh, there it is. Okay.
Okay. Okay. So a little, I mean, it's just a tiny touch of downward pressure. I think the market's still up. Is it up? It was up a little bit today. I'm not sure.
It was up barely. Yeah.
Yeah. So down about 5%. And here's the thing. So KB announced this was their fiscal first quarter through February 28th. So this is the most up-to-date, on the ground results we've seen from any home builder. And they're in like 50 markets. They're the biggest by homes. Lennar's right there with them, one of the biggest. NVR's big and profitable, mostly just on the Atlantic coast, a little more geographically specialized. But the point is that what we got from KB Home was, I would say, the most muted expectations that we've heard from anybody so far, in terms of their forward guidance. They're saying their prices are going to come down. Their gross margin is going to be squeezed. Sales general and administrative, in terms of a percentage of their home revenue, is going to be up. All from the fourth quarter, which was a deterioration from from the first quarter, which was a deterioration from the prior year. So they're basically saying, look, all of our margins are getting squeezed. They're the first home builder I've heard in a while that said, you know what, we're going to get pressured on land costs too. I haven't heard that from a lot of these other smaller home builders. So their guidance was really muted. So this is the stocks over the past year. They're all down over the past year. LGI, for reasons more to do with how much capital they've had to spend and how much debt they have on their balance sheet just to get their land inventory back recovered. But if we look at their percentage off of the highs from the fall, I mean, we're talking 26% down by the stalwart NVR, the best operator in that industry for the past nearly 3 decades. So we're getting to the point where the market is starting to really discount these pretty substantially because of the uncertainty for 2025. Interest rates, the economy, costs and prices for home builders. So there's the cost. There's how much it costs them for land, labor, and lumber, how much they pay for marketing. And then there's prices, which are the pressures on their buyers, right? So they're getting squeezed on both ends. And they're already all saying, look, we're going to have to spend more money to market. We're going to have to buy down interest rates for our buyers. There's a lot of things that they're all dealing with. And the market is discounting those things. But it was also, I think, discounting them to a certain extent, Lou, for maybe a little bit of exuberance post-election, where we saw stocks from November through the end of the year really sprint higher. So there was a little bit of a pop that some of the home builders saw kind of early, but then some of the policy things started coming out, and there was a realization that those things were going to be a lot of headwinds for home builders in the near term. But I'm not convinced that we've seen the bottom yet for home builders. But I bought home builders twice this year in late January, and then again about a week and a half ago. So I do believe that prices are getting compelling, but you have to be able to look 5+ years out, because I do think it's going to get worse for the industry. And that's probably going to bring the stocks down more. But again, looking long term, I think there is massive opportunity for home builders, which means Lou's probably more right than I think we're both right, Lou. But
I mean, both of them have the trends, definitely.
Yeah.
It's just which one has more headwinds right now for me, I think, all
right, let me just hop in real quick because Bestie's just weighed in. So Invitation Homes is not a home builder. Invitation Homes is a real estate investment trust. They rent single family homes. They work with home builders for some build to rent units, but they're not a home builder. I'll throw just for giggles. I'm gonna throw Dreamfinders Homes on the chart, and I'm gonna bring it back up just to make you happy, besties. Hang on here.
Well, Dreamfinders had such a terrible year last year that they have, I think, recovered a little better, but off of a much lower bottom, right? Maybe not.
No. They had a good year. They had a really, really good year.
I'm sorry. Yeah, they had a good. Yeah,
it's LGI.
Yes,
it's LGI that's bouncing back. But Dreamfinder stocks, it's down 44%. So the reason Dreamfinder's stock is down as much as it is like LGI. It has a tremendous amount of debt. They love to tout this NVR, asset light model, land light model, which is true. They exclusively use land options to buy land. So they don't have this big book of debt that's attached to a bunch of land that they sit on for multiple years before they develop. But they're one of the most leveraged home builders, Lou, because they use a lot of corporate level debt. They've used a ton of corporate level debt for acquisitions and to fund growth. So the downside of that, Lou, is they don't have land that they could sell to deleverage their book, their balance sheet. If we did go through a really tough economic period, I don't think it creates a risk, but it is one of the reasons why I have been very consistent that Dreamfinders, even though I own a small position, is my least favorite of these home builders. I think it gets a lot of love across the pool, but I would respectfully say that at the sake of other home builders that I think will prove to be superior long-term investments, particularly if we do go through a tough period where Dreamfinder's pretty high debt leverage really guts its profits and hurts its ability to continue to grow. So hope I didn't make anybody mad by saying that, but hey, we're motley and foolish.
We are. That's why we have the same headphones. Anyway, wait, I didn't say that.
Well played.
Why did I say that? All right. Let's move on very quickly before anyone's watching. Shotgun Santa, can you explain Aptiv's technology in simple terms? What cars use it? How is it different than what others are doing, like autopilot and drive pilot? Yes, Aptiv, ticker APTV. This is the old Delphi business that before that was GMAC, and before that was part of General Motors. But that goes back to when I had hair, Jason. But yes, what they are today, a automotive electronics company. They do a lot more than just kind of whatever their technology goes a lot more than just ADAS, but they do have a package of software and hardware for what ADAS, advanced driver assistance systems. And basically it is, it's just like, I think Drive Pilot is Mercedes, Autopilot is of course Tesla. It is the same idea of driver assist, if not eventually moving towards full self-driving. In terms of technologies, one big difference is that they are a user of LiDAR, laser radar, which Autopilot famously Tesla has avoided. They also are more of a like Autopilot and Drive Pilot are inside of a company. They are vendors to Aptiv would like everybody to use theirs. If you have been mostly in a Stellantis vehicle, if you've been in a Jeep or one of those brands, or in Europe, you might have used their technologies. At the minimum, we're talking about the electronics that allows your car to stay in the lane on the highway or to slow down as the if you have cruise control and you're coming up on someone, it automatically slows down. Things like that, just driver assists. The differentiation here is more in the model that they are a supplier to all versus an internal offering. I do think it can be a winner, but there are a lot of different people doing a lot of different things in this area. And I think we are early enough that we don't really know how we're going to differentiate. I don't know. Any
None.
more thoughts there, Jason? All right. Yeah.
Nothing useful.
All right.
Nothing
Well,
useful.
that doesn't stop you normally.
No,
Go ahead. Go ahead.
Often it doesn't. That's true. That's true. So I just want to reply here. Shout out to Sir Lord Graff for just weighing in. Thank you. Nicely done. The price to sale is nuts, referring to Palantir. Yeah, it is extremely, extremely expensive stock. Interesting strategy. And thanks for giving us the opportunity maybe to help some folks get a little smarter, happier, and eventually richer. If that understanding of the way that options works helps you make better investing decisions out there. No, that's true.
Well, and right, just real quick, because again, this is just more, and I don't just mean this about this company, because look, Sir Lord, I agree with you. And I really love referring to anyone as Sir Lord, so thank you for that name. I like that. It's just gosh. But look, Palantir has the price to sales has looked a lot more silly, and this is one of those stocks that doesn't really trade on fundamentals. So be careful. I mean, and I'm not saying that you're thinking this way, but just don't assume it's a no-brainer because of that, because these sort of stocks tend to stay irrational longer than you could stay liquid, to borrow a phrase from someone smarter than me. So just be aware there are downsides too.
I want to take Paulie D's question here. Paulie D writes, thoughts on my friend's view that AI is very overhyped now, also known hype is vague and unjustified, and any good stocks to hedge in case this view ends up accurate. So I want to, whenever I get the opportunity to share the Gardner hype cycle, I don't want to pass up that opportunity, Lou.
I want to see the hype cycle on this chart, but yes, go ahead.
All right, so let's if we can get a screen share here, I would appreciate it, Natasha. So Gardner's hype cycle, in short, as we're waiting on the screen share, is basically it's a technology. It's the idea of technology or innovation, and the cycle of that technology from its initial launch and visibility, and as it gains visibility, what its cycle is, and the perception of it being a viable thing is the way that I think about it. Sometimes stock jockeys, think of it as like what the stock is going to do. And there's a lot of correlation, Lou, between what stocks tend to do in areas that are very hyped, and what the actual the result of whatever that technology trigger is. So I believe that with AI, we are somewhere in here. I want to say this too. This is a graphic. This is not a scientific representation of what stocks are going to do exactly based on that. In other words, there is no promise that there will be a bubble that we never return to, right? So don't read that into this chart, right?
By its nature, this chart always works better in hindsight. And that's just the nature of what it is. It's not even a criticism, but yeah,
100%. Well, no, that's exactly right. That is exactly right.
Jason was very careful not to put his cursor on any one specific part of that red line.
Because I have absolutely no
idea. Right.
And even people that spend, 14 hours a day, 5 to 7 days a week following the artificial industry or work inside of it in AI or technology that are deeply, involved in this, they don't know either. They don't know either.
Oh, it is unknowable. Yeah.
And that's the key. It's unknowable. And this is not unique. Maybe artificial intelligence solves that problem in the future where these unknowables become knowables, but I might be being a little glib there, but no, the point is that it's historically,
and that's also a great example of the AI hype. So go ahead. We're really nailing it.
Love it.
Yeah.
Love it. So,
I will let you complete a sentence.
So what we also don't know, never, Lou, I never complete a sentence. Let's be honest. It's, I talk for a long time and then somebody has to make me stop. So, but no, the other thing I want to point out is that the degree of the climb and the fall are also not fixed in place either. So that's the thing that's important to remember. And some technologies and disruptions, they play out very quickly. and start delivering economic result relatively quickly. And that's what we don't know yet about artificial intelligence, because we're certainly, again, like Lou said, I'm being very vague. We're somewhere in here, maybe still on the way up, right? And because that's the other thing too. So if you zoom in really close, there's lots of ups and downs in the stock chart that tracks the Gartner hype cycle. It's not just smooth up, smooth down, and then, hey, we're back to making money again. We go through these binary thoughts in our head and the way the market perceives these technology triggers over time. But what we have not seen is eventually where we do go through some more of a heavy period of negative sentiment. There was a little bit of that with DeepSeek, right? And there's still a little bit of that with some of the things that we're hearing from executives that are trying to slow play and kind of downplay the amount of money that the Microsofts and the others are going to spend and what the demand could look like and the monetization of it. So the point is that eventually we're going to go through some tough period. The harder question to answer, Lou, is anything around the idea of how to hedge in case this view ends up as accurate. And what I would say is, as a starting point,
I just put up a real world example of that chart too, which I would love to superimpose the two. It's not perfect, but yeah, go ahead, keep talking.
Right. Yeah. So, but I think Amazon is a good example here, because you think about AWS, a big driver for AWS going forward, and other parts of Amazon's business is going to be AI. Mm-hmm. You could say the same thing with Microsoft, obviously with NVIDIA. Alphabet is, everybody's still trying to figure out, is Alphabet going to ruin search? Mm-hmm. Or is it going to unlock tremendous value for Google and for Google Cloud? That's why it's cheaper than it's been in a decade, right? So, Meta has this amazing ad business and then this furnace that they burn all of the cash to build AI, right? So, so the point is that everybody that owns index funds has massive exposure to this already, to the upside and the downside, and I think the way that you think about hedging is two ways. Number one, position sizing and time is number two. Position sizing, if you have index funds, S&P 500 index funds, and they make up the bulk of your invested wealth, I don't know, probably 20% of that is tied to just the valuation premium for these companies on the expectation that AI is going to drive higher returns for those companies. So for a lot of people, you already have a lot of exposure to that already. Time, for most of us, is going to be the solution for that and the hedge for that, because you own through that trough of disillusionment and you get to the point where there is economic productivity from AI, which is starting to happen. And 5 years is going to be happening a lot more than it is now. And 10 years from now is probably going to be transformative in some ways that we see and other ways that we don't, but is still massively economically transformative for industries and for businesses and some ways in our lives probably. But the point is that time is going to be part of that, but then position sizing as well. If this is the sort of thing that has you substantially concerned, think about maybe increasing exposure to, like, you can buy index funds that don't include these companies. So if you want to reduce your exposure to that, or buying like the Russell 3000, it's the mid cap index. So there are other ways that you can position size your way if you're substantially concerned about the downside here. Right. So there's a lot of ways you can do it.
Yeah, a couple things. And it's funny because I pride myself on always being the cynic, and I'm going to sound like a Pollyanna to take the Pollyanna take on AI right here, and not in individual investing advice, but just kind of how hard this is, because you showed that Gartner hype cycle. And the interesting thing, and the reason I wanted to use Amazon to display it, and I kept it up, is this little part right here. If you can see, like around 2018. For all the world, we could have been sitting here right here as it started the fall saying, yep, here we are. Here is the downward slope. And it turns out that was just a hiccup, and the first upward slope doubled from here, right? So and what that tells me is that, and you can see this is both such a great example of that hype cycle where like the hype and then it goes down and then it Amazon in a way is weird because they keep coming up with new things, so it hasn't flatlined, much to their credit. But it looks so clear in hindsight, but I am sure it looked clear right here when it just didn't, in the 2018 when it just went nowhere for a few years. So, which is just the ultimate point here. It is so hard to time the market, right? As far as hedges, I like what you said. I mean, I don't own any of these companies because we own a bunch of index funds, and I think NVIDIA's NVIDIA is in my top 10 individual positions, even though I don't own it. So that is one way to hedge naturally, is just to for the individual stock portion to look elsewhere. And also, I just to give a shout out, and I'm going to do a lot of plugging right here as we come out, but Motley Fool Money, Richard Bernstein, who is about the smartest person I know. Richard was on this past weekend talking about investment ideas that he thinks are just better than AI right now. And a lot has to do with tariffs and onshoring and just the rise of small to mid cap manufacturing companies. Give it a listen to yourself, see if Richard rings true. But I think that is a great way to hedge. And full disclosure, Richard does have a product that sells into that, so he is probably talking his book. But anyway, definitely, that's I thought it was a great hour. So I plugged Motley Fool Money. I want to plug the prediction show, which we do. They're actually, Jason, it's not just predictions. They are bold predictions. Okay.
Which really, you mean they're thought exercises is what they are.
Yeah. 7 p.m. 7 p.m. tonight. I was on it last week, and Sir Lord, my Lord, we did talk about Palantir and the chances of it going down 50% from here. So you might want to catch a replay on that if you're interested. And on Matt's question, Matt had asked me before about some of these interesting science projects being done in the defense industry. One of the things that I think is really exciting that came out of this Boeing award on a new fighter is that the idea that these are designed to be used alongside UAVs, uncrewed, unmanned aerial vehicles, drones, big drones, not just the little backpack things that AeroVironment sells, but these sophisticated systems that are basically baby F-35s that can add firepower and also really confuse enemy radars. Some of the stuff being done there and with, it's not groundbreaking, there's drones out there, but they are so far ahead on drones than you'd think. Tonight on the Bold Prediction Show, we are going to make a prediction about one said company.
Exciting.
And that's your tease. We're not going any further than that.
That's exciting.
All right. What else do we have?
So I'm going to just hit Matt's really quick about MGP Ingredients, ticker's MGPI. So MGP is basically they're the white label booze manufacturer. They do a ton in whiskey, but they do other stuff too. Big supplier to the spirits industry. And his question is, am I bearish about the business? So the spirits industry is kind of going through a bit of a tough period right now. The pandemic was eye-opening, and the amount of eye-openers that people were consuming, and spirits consumption did go up. The trends have been pretty positive for spirits for really 10 or 15 years, especially a lot of the kind of mid to higher end brands. And that's been really good for MGP, because they actually do a lot of that for a lot of the distillers, a lot of the labels. So, but what we're going through right now is too much supply. Demand is softened, and a lot of the industry is having to kind of pull back a little bit. So that's not great for MGP. But what I can't say is whether its valuation right now creates margin of safety, like we're seeing in the home building industry, where we're getting to the point where valuations are starting to get really compelling, even though we know it's probably going to be a tougher year. So I can't say that about MGP because I haven't looked closely at the business in probably 2 years. But I do know they're probably going to have a little bit of a tough couple of years ahead.
That's
Luke,
fair.
anything to add? No.
Well, no, but yeah, Best just called me out because I did apply the hype cycle to a company and not a trend, which I know is tough. But Amazon, I think for a while was a pretty good illustrator of the e-commerce trend. Like I say, the reason that maybe it hasn't flatlined is because there's a lot of particular text inside Amazon. So fair point.
Yeah, good point.
All right, we have a couple of minutes left, Jason. Where do you want to go?
I guess I'm going to have to do it here. Zach's a fool. I was trying to.
I like this one.
I was trying to ignore it.
Yeah.
It's actually easy to answer, but I'm just trying to not talk about Brookfield here later.
But it's a nice little jab at you too, because you love to point out you've heard that Charlie Munger talked about inverting. So yeah.
Yeah, no, it's fantastic. Zach's a fool wrote, Jason, you were often asked to pick your favorite Brookfield entity. Let's invert. Which Brookfield entity is currently your least favorite? It's not currently my least favorite. It has pretty consistently been my least favorite, and that's Brookfield Business. So it's BBU is Brookfield Business Partners. BBUC is Brookfield Business Corporation. They're the same economic interest in the same business, just one's a corporation and one's a publicly traded partnership. This is the private equity part of Brookfield that's publicly traded. And honestly, I've just never been particularly drawn to private equity style investing on the smaller scale that Brookfield Business operates on. And it's that business is less about owning assets for the long term and generating income from them, like you see from the other subsidiaries where you get the higher dividend yields and the dividend growth. This is more about buying businesses cheaply that you can make better, making them better, and then selling them, spinning them off at a higher multiple. And they've been fine at it, but it's not something that compels me. And I don't know that it's really ever going to generate the kind of returns we see from the other businesses where the tailwinds are better. But I do know that Bruce Flatt in his latest shareholder letter did say that they think that the kind of indexing, passive investorization of, not to be confused with pasteurization, has created some opportunities for Brookfield and some of their peers, and increasingly around the world, where stocks, perfectly good businesses, maybe get left out of an index or not included in an index, and they kind of become orphan stocks. And it's created opportunities for them to buy great businesses at a premium, pay a good premium to the market price, and still kind of be the deep value buy that they like to be able to find. So they may be able to leverage that with Brookfield Business, but I'm more drawn to the dividend growth yield businesses that the other subsidiaries offer.
All right. I want to get one more in real quick. And sorry, I was trying to share. And I'd love to have more time to talk about this one, but this is one more from Bestie. He said, Lou, do you follow Sterling Infrastructure, STRL? Do you have a thesis for these times? What is your 5-year expectation? What about Bluebird? BLBD is there, which is the school bus manufacturer. These are two that it's funny that have both been on my radar screen and I've been hoping to write about or talk about. Natasha, go ahead and share the screen. What I will say about both, I have been intrigued for a while about both of these companies. And for companies like this, one that is a construction company, one makes school buses, it's all about where in the cycle you buy them. And just to put a 1-year chart on them, and if you want to get into cyclical businesses and cyclical industries, and there's a lot more going on, and we're up on top of the hour, so we're not going to deep dive either of these, but these are the sorts of charts that should be piquing your attention. Look at Bluebird in the orange there, from where it was, up 60% real quick, and then all the way back down. Sterling has had its own sort of issues, and they have, I think, some temporary CFOs now, but if you can get well-run companies at the right part of the cycle, and long-term winners in the right part of the cycle, that is where you want in a lot of these cyclical industrial industries. And those are two really good examples of companies that look a lot more interesting right now than they did late summer.
Hey,
all right.
Lou, that was perfect, buddy.
3:00.
Perfect. Right on the nose. Yeah. All right, so we're going to be bringing Rachel Warren and our foolish colleague Neil Rozenbaum are going to be coming to the screen. Right. I believe 3:00 hour. That's
valuation. And you know what a tie-in right there, because with these industrial businesses, it's all about valuation, isn't it?
It really is. It's not always, until it is.
Yeah.
Right? Yeah.
Yeah.
That's deep, right?
Yes.
Yeah.
Yes. It
All
looks like
right.
we're waiting for Neil to come on. I think he's having some tech stuff in the background, so they're getting
Yeah, I
that
saw him-
sorted out.
Saw him pop in and he's popped back out. So we'll see him back out here in just a second.
So it is the valuation hour, right, Rachel?
It is the valuation hour, which
Wow.
generally means we take a lot of valuation related questions and other questions
Yeah.
about any stocks that happen to be piquing viewers' interest. Which there's quite a lot, it seems, this week. There's a funny pattern of there's a bunch of these stragglers at the end of earnings season as well, and so there's been a number of stocks that have been moving the market and that we've been getting some questions about as well. So it's kind of an interesting time to be covering this space.
Yeah, and I'll warn you, no pressure, but when we came on, and there's Neil. When we came on, the markets were green. It looks like we managed to bring them the red, so it's all on you two to get.
Lou, Jason, I would expect nothing less.
There you go.
58 minutes, guys. You can fix this. We believe in you.
And on that note, have a good show. We'll see you later.
Thank you both.
Thank you. Hi, Neil. How are you?
Hello, Rachel. Good. I didn't know the markets were red, so there is that. So less good.
Let's do it. Let's try to get them back up in the next 58 minutes.
Yeah.
Let's see. Yeah, stocks wavering as Wall Street digests Monday's strong rally is the headline that I'm seeing now. It's definitely been a volatile time in the markets recently. But as we were talking about shortly before Neil joined, as I was talking about with Jason and Lou, this is our valuation hour. If you guys have any questions related to the valuation of any specific companies, we go ahead and get those in the Slido. The event code for that is FOOL24, or just any questions in general that you think Neil or myself can answer. We will be happy to do so. Just as a reminder, we are not here to give personalized investment advice, personalized stock advice. We don't know the unique financial situations of each individual viewer. It is very much outside of our purview to give personalized financial advice. But we have a very motley group of full contributors on these shows, and many of us cover a wide range of industries and sectors and stocks, and we all tend to have our own very motley opinions on those companies. And we'd love to share our thoughts on those when you guys ask us. So always want to mention that at the top of the hour. Neil, it's only Tuesday. We're seeing a lot going on in the markets. I don't know if there's anything in particular that has caught your attention or piqued your interest so far as we're starting up the week. I know we also have a number of companies reporting later this week. We've talked about that a bit, and we're starting to get into some of those earnings reports in the next couple days. But yeah, I wondered if there was anything in particular that you're paying attention to as we're starting out this week.
I mean, Monday was quite a good day to start the week when everything is green. Today, not the same, but I still see some big hitters that are still green today. So I guess that's better than what we've seen in the last couple of weeks. Of course, that tariff deadline on April 2nd is still going to be something that the market will be watching, although it's ever changing. So, okay, I mean, it's funny, a week and a half or so ago, everything was about, a recession is imminent, a recession is here, everything's going down. And suddenly, since the last couple of days, stocks have rebounded, markets are more green, and talks of a recession, of a harsh recession, are disappearing. So yeah, so far, so good. I haven't really seen or read anything that blew my mind in the last 2 days or so. Maybe I did, but I can't remember. But if I can't remember, that means it must not have been such a wow article.
Yeah, I've been looking a bit into, as we're in the latter part of the day in terms of the markets being open in the U.S. The headline is U.S. stocks were little changed Tuesday as investors tried to build on the previous session's gains, which were largely sparked by hopes of U.S. tariffs being narrower in scope. The Dow Jones Industrial Average shed about just 0.1%. The S&P 500 slipped just below the flat line, while the NASDAQ gained about 0.2%. Investors have largely been looking past March's consumer confidence data that was actually released today, and I can maybe talk about that briefly, and then we'll get into some questions here. That data reflected a significant drop in U.S. consumers' near-term outlook on income, business, and job conditions. The Conference Board's monthly confidence index fell to 92.9, which was just below the Dow Jones forecast of 93.5, and the measure for future expectations dropped to 65.2, the lowest reading in 12 years and well below the 80 level considered to be a signal for a recession ahead. There was a comment from an analyst at eToro saying sentiment continues to weigh among investors, consumers, and businesses as economic concerns and economic policy uncertainty takes its toll. Obviously, there are a lot of additional factors that investors are watching. We've got the jobs report that comes out next week, which should give some additional clarity on terms of the state of the economy. There's also been the fact that the market has been digesting news regarding potentially fresh tariffs. Obviously, we are awaiting reciprocal tariffs that are expected to go into effect on April 2nd. From the administration, there's been discussions of tariffs as well on pharma-related products as well. And so there's a lot, I think, that investors are, processing right now, and that is being reflected in the markets. But that consumer confidence study that was noted in that piece, so there's numerous of these types of studies, right? A couple of weeks ago, I was talking about the consumer confidence study from the University of Michigan. This particular one came out from the Conference Board. It's their measure for future expectations, which tumbled 9.6 points to 65.2 and was the lowest reading in 12 years. And the board's monthly confidence index of current conditions slipped to 92.9, a 7.2 point decline, and the fourth consecutive monthly contraction. A senior economist at the Conference Board said consumers' optimism about future income, which had held up quite strongly in the last few months, has vanished, suggesting worries about the economy and labor market have started to spread into consumers. Again, this is a survey, so take from that what you will. It is one of numerous consumer surveys that are seen as giving more of a deeper reading into the state of consumer sentiment and what they're thinking. And that is probably having some impact on the market's response today, but there's a lot more beyond that that is sort of roiling the day-to-day machinations of the market. It is worth noting in the report, in addition to somewhat general pessimism among consumers, there was changes in terms of the outlook for the stock market. 37.4% of respondents expected higher equity prices in the next year. And that was a 10 percentage point drop from February. There are also weakening views on the labor market, with those expecting more jobs to be available falling to 16.7% of total respondents. Now, again, views and perceptions of the state of the economy and the state of the job market or the state of the stock market can differ from what the reality actually is. And as I mentioned, we have the jobs report coming out next week that should give some more hard facts and figures with regards to that. So I always like to talk about these reports. These are not the types of analyses that in any way change stock buying behaviors for me. This doesn't inform portfolio decisions. But as we're seeing a time where there is a lot of volatility in the markets and a lot of news that's coming out that consumers and investors are digesting, it can be helpful to see what some of those indicators go back to.
Yeah, no, I agree. I think there is a lot more focus on macro these days because it makes a lot of headlines, and we like to talk about the market whenever we can. But if we listen to most of these legendary investors, they will all tell you that they did not really focus that much on macro, especially not on macro projections, because if we really look at the track record of these macro projections in the last 30, 50 years or so, it's not great. It's not great. I think the Weatherman has a better track record than that. So I always like to look at the businesses, management. I think they know a bit more about their own business, and I invest in a business, not really in a macro. But going back to the previous question you asked me, so I did read something about Alibaba. Their CEO said something about an AI potential AI bubble in the United States, because he talked about the fact that people are investing $500 billion, etc., etc. But what was funny about that is that, I'm a shareholder of Alibaba since end of last year, so quite happy with the outperformance so far. But it's quite funny that he says we might be in an AI bubble, but at the same time, they also did announce, I think a month or two ago, that they're going to invest over $50 billion themselves on AI infrastructure, cloud computing, and all of that. So you're either saying this because you might be behind, or you don't know. So that was something interesting, especially since that's coming out of China. We've had also that DeepSeek moment back in January, also caught a lot of attention. Markets crashed, which was also quite interesting, because after that, when we had Alibaba come out with their own model, which beat DeepSeek, that didn't really get that much attention. And then we had models from Google, Gemini, Perplexity, Grok, they all came out, also extremely good benchmarks, and the market didn't really move. So quite strange. But yeah, that was one, and the other one was that was it. The other one was really not that interesting.
Yeah, and I think it's helpful sometimes to talk about these things because, there is very much, I think, a lot of different perceptions among consumers and investors that may not always correlate to the performance we see of specific stocks or the performance of specific businesses. And there's obviously a big difference between the economy and the stock market, although the economy and its performance do tend to, have an impact, obviously, on the performance of businesses, which correlates sometimes to how stock prices perform. So, but there's often, I think, confusion about how one impacts the other. And so I do think it's important to, look at some of, this news that we're all seeing against the backdrop of the broader market, but understand what might be sentiment versus what might be data that actually, directly impacts the companies that we own and talk about, and being able to differentiate that between that, I think, is very important. And even if we see, actual numbers come out, for example, next week in the jobs report that are less than favorable, and some of the other data that investors are watching for, it doesn't change the landscape for fundamentally great businesses over the long term. Really wonderful businesses do adapt. They go through cycles. And sometimes those cycles can be difficult. What we talk about this a lot. Something that Danny Vena often says on the show is that sort of the price of admission, the ups and downs of the stock market, being in it as long-term investors is an advantage that we have over institutional investors and some of these other larger players. But it also means that often there is a lot of volatility and short-term movements that can be very difficult to stomach from an emotional standpoint as an investor, and contending with those and learning how to navigate around them is probably one of the most difficult but important things as long-term investors that we can do. And it's a learning process. I've said many times, I started my investing journey about 5 years ago. Definitely an interesting time to enter the markets as an investor, and it's certainly continued to be so over the last several years. But it's also been an incredible learning experience. And, I have a lot of passion about this space, not just because it's my job, but also personally. And it has been very much a learning curve for some companies, and truly fine-tuning my strategy and understanding what I want to have in my portfolio and how I want to build my portfolio. But really, as well, having navigated some of this volatility the last several years, and seeing the ups and downs of some really great businesses that I own that have recovered even in that period of time, has also given me a little bit more stamina during this next, round of volatility that we've been in, and helped me have a little bit less, of emotional input into my investing process than I might have several years ago.
Yeah, no, I agree. I mean, I started investing with real money in 2016. Started out with the traditional names. First up, an ETF, VOO, very classical ETF, just to follow the market, and then I think my first 3 stocks were Microsoft, Pfizer, and Coca-Cola, or something like that. Something that today you will not find in my portfolio. But it was one of the, and then Coca-Cola, and then even Kraft Heinz. So you can see the pattern of Warren Buffett in those types of names, because you read all the books, you hear him talk, and then you're like, okay, you know what? He knows something, I don't. So I start off with those names, learn a bit more once I am invested. And that's the early mistakes are basically the price of admission to learn more about investing. I've made lots of mistakes even today, and I'll probably make more mistakes in the future. But as long as the winners are much bigger than the losers, I should be fine. I mean, I had losers that went down 70% or so, especially after what we had from 2020 to 2022. Those were the times where you went from extremely bullish super bubble cycle to a very, very harsh bear market where things got hit 50, 60, 70, sometimes even 80%. I mean, even a Meta saw a drawdown of over 70%, which is quite insane. Since that bottom, the stock is up over 600%, but you learn a lot. I've also learned about the fact that, okay, I have a loser. If the business isn't the business that I bought it at the start, if it, not only because it's down, but because maybe management didn't deliver, the business is now struggling, it's not growing as fast, I'm now much more comfortable to cut those losses. Like, I'm not really seeing that, oh, I'm down 50% or 70% or 30%. Like, I don't want to sell it because I'm down so much, I've already lost money, so I'd rather keep it. No, today I'm like, you know what? It changed. I'd rather take whatever's left of that position and actually put it in a company, in a business that is well managed and that will probably rebound much faster than the one that I own. It's easier said than done, but once you go through all of that, it gets easier. It gets easier for sure.
Yeah, thank you for sharing that, Neil. I want to hit a question that came in about an hour ago, and then if you want to look through the queue and see if there's a question or two that you want to grab. There was a question that came in from Fool Anon Don. That is a very fun, long handle there. What are your thoughts on ELF? Now down about 50% over 3 months, 70% over 1 year. Has this level of correction been fully justified? Is there an opportunity? I do think that it has been a bit of a harsh reaction for this company, but I want to talk through some of the factors that are at play there, and some things to consider if you're looking at this stock while it's trading down right now. Shares are down about 68% over the trailing 12-month period. The stock is still up over the last 5 years, more than 500%. Which is kind of impressive to say the least, but hit very, very hard over the last year. Still trading at a price to earnings of about 38, which I wouldn't necessarily label as cheap. Shares are about $65 each. The company has a market cap of about $3.7 billion at the time of this broadcast. ELF has been dealing with a few, I think, issues that have impacted the stock. And I say the stock because I think the business is still fundamentally in pretty solid shape. But when the company released their results for their fiscal third quarter of their 2025, which was in early February, the market did not react positively to those. And that was partly because there were slower than expected sales in January that led to some lower financial guidance for the upcoming quarter. And I think just overall concerns about deceleration in growth rates for the business. They reported weaker than expected sales trends in January. Management cited a few factors here. Obviously, it's the post-holiday period, so some weaknesses are generally expected in that period of time. They also are heavily reliant on content creation and social media. User-generated content is a huge part of their overall marketing process, in addition to the really well-known popular social media campaigns they run. And given some of the uncertainties regarding TikTok in January, as well as the fact that management also noted creators, and specifically with what was going on in California with the wildfires, may not have felt as inclined to post content regarding beauty when there were other factors at hand to consider. So there were a lot of different things that management cited. It's hard to say very, very likely that obviously post-holiday weaknesses was a very real factor there. But all of that led to e.l.f. Beauty lowering its financial guidance for the upcoming quarter. Following that news, there were some analysts that downgraded the stock. They cited concerns about the company's revised growth forecast and also just overall weaknesses in the cosmetics category. I think there was more of a concern about the company's future prospects, not necessarily just the short-term results, but what they might say over the long term. e.l.f. has invested very heavily in marketing to drive growth. There are some analysts that have suggested that its marketing spending might be outpacing its sales growth and potentially impacting profitability and its growth story over the long run. There's also just the broader space and macro factors in which e.l.f. Beauty is operating. There are some concerns about the slowdown that the cosmetics industry might be experiencing right now amidst a pretty dynamic, economic landscape, and how consumer spending patterns might impact a business like this. Now, I say all that because I still think that this is a really solid company. But it's important to note what are the dynamics that have been going on with the business the last few months. Why has the market been so hard on the stock, particularly recently? And just to give you an idea of what what the company's growth trajectory has been like of late. So in their third quarter of their fiscal 2025, which ended December 31st, net sales increased 31% year over year to $355 million. The company's gross margin increased approximately 40 basis points to 71%. They also reported net income of about $17 million under GAAP. Now, looking at the first 9 months of their fiscal year, net sales increased 40% to $981 million. Net income was about $84 million. Under GAAP, adjusted net income was $152 million, and their gross margin was 71% for that 9-month period. Now, if you compare that to the company's fiscal 2024 in terms of growth rates, net sales in fiscal 2024 increased 77%. They were also profitable, and their fiscal 2024 net income totaled about $128 million in that 12-month period. So 70+% top line growth, really robust growth on the bottom line, working to be very consistently profitable. And so now the company's reporting growth rates in the first 9 months of their most recent fiscal year that are in the 40s, down from the 70-some%. Well, their full year fiscal 2025 growth rate, they had previously forecast 28 to 30% growth, which certainly nothing to scoff at, but that is a bit of a deceleration from the 77% net sales growth that they reported in fiscal 2024, to say the least. When they noted that they had some softer than expected trends in January, they said, look, we're going to take a prudent approach. We're lowering our outlook for the final quarter of our fiscal year. So now, instead of 28 to 30% sales growth in fiscal 2025, we're forecasting that we're going to get 27 to 28% year over year increase in net sales, with 28% being the high end of that spectrum. So those are really solid growth rates for a beauty business, but they are obviously much slower than the 70 plus 80% year over year growth that the business had been reporting. I think that I still think the market has been unnecessarily hard on the stock. Yes, the growth rate has come down. I think there are a lot of factors there. I think there is a dynamic environment in which e.l.f. is operating. There's also just the reality that they are heavily investing in their growth right now. They are really investing in their international expansion. Right now, non-US markets represent about 16% of e.l.f.'s total net sales. They saw 91% year over year sales growth in the first quarter of their fiscal year 2025. So if you take it on individual quarters, some of those growth rates have been pretty exceptional, even though their full year growth rate that they're forecasting will have represented a deceleration from fiscal 2024. But as they are expanding into new markets in Europe, and other parts of the world. They've been expanding into Mexico as well through their partnerships with Sephora. I think that there is a lot of room still for this business to run. I think that there are a lot of opportunities for Elf Beauty to expand in some of these new markets that they're really just starting to tap into. This most recent quarter that they reported, it was their 24th consecutive quarter of net sales growth and market share gains. They gained 220 basis points of market share in the US. Again, in Q3, they grew their sales by 31% from the year ago period. In their second quarter, they delivered 40% year over year net sales growth. This is still, I think, a fundamentally solid business. I think it's important to look at some of these growth rates. It's important to track and see if there looks like there's going to be a slowdown. The biggest thing that I would note is they're still very profitable, but that profitability has decelerated a bit as they've been investing so much in the growth of the business. That's ultimately going to impact profits and margins in the short term, but over the long term, I think that that's going to be really key for them. I've talked about their expansions into markets like the UK, Australia, Germany, here in Italy, where I am, Mexico. These are all very integral to Elf's ability to grow and remain profitable and relevant within the beauty space over the long run. The other thing I'll note that I think is a nice tailwind for this business is their products are, broadly speaking, quite affordable compared to a lot of the average cost of different other products in the color and mass color cosmetics market. I think that there has given them a real competitive edge there. So I think if you're looking at this company and you think that all of these things they're doing with their international expansion, investing in their growth, if you think that that is going to be successful for the business over the long run, maybe this presents an opportunity to look at this business. I've mentioned a lot of the different factors that have changed some of the market sentiment towards the stock in recent months. Profitability has decelerated a bit as they've been investing in their growth. They're obviously also seeing some deceleration in growth on the top line, although it is still very solid for a business that is becoming an increasingly mature beauty business, and for which 70 or 80% year-over-year net sales growth would not be something that the company can continue indefinitely. I still think you have a fundamentally solid beauty business here. I think you have one that's becoming more mature in its respective markets, one that's investing heavily in its growth story right now. And there are some growing pains that sometimes come with that. And I think that that is something that investors will likely have to contend with. But I do think that there is an opportunity personally in this stock over the long run. I like what they're doing with their international expansion. I like the way they've grown their portfolio of beauty brands. There's the flagship Elf brand, and there's also Naturium is a company that they acquired in 2023, which is focused all on natural skincare and other related items. So I still think that this is a great business in the long run. I think that 10 years from now, I might look back and think this is a really great business to buy and hold for the long run. But I do think we might see more negative sentiment towards the stock, at least in the short term, notwithstanding the performance of the business, particularly if consumer spending patterns continue to shift. Beauty has historically been a pretty resilient space, despite fluctuations in times of consumer spending shifts. But often consumers will go and put money down on a lipstick or some smaller value beauty item, even in periods of recessionary headwinds, if in fact the economy were to get to that point. So I think over the long run there's an opportunity here, but there are some valid reasons that the stock has been beaten down. I think it's important to consider those and factor those into your risk analysis as you're looking at whether maybe this is a stock you would consider for your portfolio over the long run.
I mean, when I looked, especially the last quarter when the stock crashed, one, of course, it wasn't the cheapest one before. I mean, going into the earnings report, we've seen that with plenty of other names. What bothered me a little bit is that explanation that they gave because of TikTok. I mean, if a small change in your marketing strategy, such as, okay, creators on TikTok, the trend is now because of the fires in California, for more focus on that, more focus on a TikTok ban. If that is the reason why your business, let's say, is struggling, it was quite worrying for me to hear that, okay, one channel suffers, the whole business suffers, so to speak. I thought they would have a more robust marketing strategy, not just TikTok, but maybe YouTube Shorts, Instagram Reels, traditional channels. Of course, in the past, TikTok worked wonders for them. I mean, look at the growth rates that had become super successful. But when I heard that explanation, it's not an excuse, it's an explanation, I was like, that's a bit strange to me. Because imagine if that happens again. So another time you're going to get hit. It was quite strange. And imagine if TikTok does get banned. Maybe, probably not, but imagine if that happens. What's plan B?
It's interesting because that's been something very specific with e.l.f. compared to some of these other, legacy beauty brands, if you will. They have been heavily reliant on TikTok, and they've been really effective with having these massive viral social media campaigns. They've really catered to, younger millennials, Gen Z shoppers that way, in a way that companies like, Ulta Beauty, for example, have not resonated with shoppers in the same way. And these TikTok campaigns that have, generated millions of user generated videos, which is essentially, free advertising for e.l.f., right? And then billions of views around the world. They've created original music that's topped Spotify and Billboard charts and has enhanced their reach on TikTok. So you're right. This has been a huge tool for e.l.f., but it's also been one they're, I think, very reliant on, which is true of a lot of businesses in today's day and age. I think they have found it to be the most engaging option for the types of ads that they showcase. So I think it was good that management talked about it and didn't try to ignore that factor. But yeah, obviously that would be a major risk for them if TikTok were to, go away again for however short a period of time. That is something where they are very, very reliant. And again, it's not just on these big ad campaigns with really well-known influencers, which they're famous for. It's also user-generated content. People who maybe get, packages in the mail from e.l.f., PR packages, and they'll create videos and, influence their followers to go and buy e.l.f. products. I mean, that's a whole part of that business cycle nowadays. And that is very much part of the lifeblood of e.l.f.'s marketing strategy. So it is definitely, I think, an important risk factor to note when looking at this company. It's also why they've been so successful so far, in a way that some of these other older beauty brands have struggled. But, there's some risk on the other side of that as well.
I agree. Plus, I don't think women specifically are going to stop wearing makeup anytime soon. So buying these types of things, even in an economic downturn, I don't think that will change. But who knows? Maybe.
All of us humans who wear makeup, we probably will not stop buying those. Yeah. Fool Anon, and I hope I'm not saying the handle wrong, but it's it's a lot to read out. Said thanks both, especially Rachel for such a rich e.l.f. discussion. Oh, thank you. As you say, not cheap still, but an interesting business still too, one to ponder. I'm glad that was helpful, the discussion from both Neil and myself. Thank you for your question. All right, Neil, I've talked long enough. What question do you want to hit?
There was, I think Keith asked this question, I think twice, one the last hour. So for a 10-year period, untouchable investment, which stock would you choose and why? Mercado Libre versus Uber. So I'll start because I own both of them. So I'm happy to own both. But if I had to choose one for the next 10 years, I probably would say Mercado Libre, because I wouldn't have to check whether or not Uber plays a big part or in the autonomous vehicle story in the future. Today, the thesis that I have is, one, valuation-wise, I think Uber is very, very well priced. And two, I think it's going to be the distribution, that platform for future autonomous players, whether it's Waymo, Tesla, Mobileye, every other player out there. I think that's going to be the platform, the distribution, where all of these players come and list their vehicles on that. But there could be a scenario 5 years from now, 6 years, 7 years, I don't know, where maybe a Tesla, a Waymo, they have the majority of the market share and they're saying, look, actually, we don't need Uber anymore. We have our own apps. Since we have, let's say, 80-90% of the market, we will just list on our own platform, and that's about it. And that's a risk to consider. And that's why I'm going with Mercado Libre if I have to own one and not touch it for the next 10 years, because I think Mercado Libre, although there are other competitors in Latin America, whether it's the fintech space, whether it's e-commerce, I think Mercado Libre is just so strong in Latin America because they have that whole ecosystem, that, let's say, Amazon-esque business, if you exclude AWS, of course. They've got the e-commerce, they've got the logistics, they've got the fintech. Now advertising is becoming bigger and bigger. So for a 10-year period, no touch, it's probably Mercado Libre because of those points. I will not have to, even today, Mercado Libre is one of those names that since the moment I bought shares, I've never stressed about their performance because the track record is insane. Management is world-class, the business is world-class, and they keep executing so well, even with headwinds, FX headwinds, political headwinds in those regions, etc., etc. Every single quarter is another great quarter by the company. Now, yes, sometimes the stock might react negatively, but that's probably valuation-wise if a stock just runs up too much, even if the quarter is a good one. It can get hit. I'm fine with that. One issue that a lot of retail investors have with Mercado Libre is, of course, that if you have no access to fractional shares, one share will cost you $2,186 at the time of me speaking right now, which is quite expensive if you cannot buy fractional shares. Unfortunately, last time I spoke with their ex-investors relations person, which I think had an interview here 2 weeks ago, Fede Sandler talked with, I believe, maybe Daniel and someone else, but I forgot. He worked for Mercado Libre and New Holdings, and he told me that they're not really focused on the split anytime soon. So I guess the stock has to go much higher for them to consider a split. But yeah, if I had to choose Uber or Meli for 10 years, I choose Mercado Libre. But I hold both of them today because both of them are great businesses. Uber, despite all the autonomous vehicle talk, I still think that it's a show me that their business is getting disrupted instead of, oh, it might get disrupted in the future. But that might get disrupted in the future has pushed me to choose Mercado Libre for the next 10 years. I don't know if you own one of those or both.
Sorry, I had an issue with my mute button. No, I don't own either of these right now. Uber's one I've been wanting to take a position in more recently. Mercado Libre is one I've been watching for a long time, and I'm a long-term shareholder of Amazon, and Mercado Libre is one I would like to take a position in. I've bemoaned to Danny that I just wish that they would do a stock split because I can buy shares, but it just pains me to buy shares at $2,000 each. But it's a fantastic business, and Uber's one that I have found myself more compelled by the last couple years than the prior period, for sure. There was a comment kind of alluding to our prior discussion from Sir Lord Graf, another fantastic moniker. The average price to sales ratio in the cosmetics industry typically ranges between 2.5 and 3.5. ELF has a price to sales ratio of 5.74. Well, thank you for that added context, Sir Lord Graf. And yeah, that is, as I mentioned, even on a price to earnings basis, they are. I don't think I would say that they're cheap from that particular valuation metric. I've said also that, when it comes to looking at businesses, I'm not someone that lets valuations stand in my way when I'm looking at companies that I want to buy and hold in my portfolio for a long time. I certainly think it's very helpful to factor into your analysis of a business. And it is certainly something that I do, but it doesn't stand in the way if there's a business I'm really interested in. But thanks for that additional information. There was a question. Oh, go
it
ahead,
does
Neil.
grow faster than an Ulta, for example. I mean, much faster.
It grows much faster, yeah. Well, and they're an international enterprise, and they also don't own and operate their own brick and mortar stores. That's the other thing. You know, they just distribute through a really credible network of retail partners, which those are a couple other things I've noted in the past have made me much more bullish on this stock in the beauty space specifically, because the beauty space is quite fragmented and there are not that many companies I find compelling in it. Mike had said, Rachel, do you follow Cormedics? Thoughts on their earnings and the market's reaction? So I don't follow this one super closely, but I know a little bit. And so I'm happy to take a little time to go into the business and how their recent earnings report fared. This is a pretty small company for anyone that is not familiar. Cormedics is ticker CRMD. They have a market cap of about 485 million as of right now. Shares were up about 29% today after the company reported, I believe, today or yesterday. I believe it was earlier today that they reported. Although the stock is up about 85% over the last year. But for context, the stock trades at just around less than $8 a share right now. So just to give a little bit of background there. But Cormedics, they are a biopharmaceutical company. They are focused on developing and commercializing a range of therapeutic products, particularly for the prevention and treatment of infectious and inflammatory diseases. Right now, they have one product commercialized that was just approved, I believe, in 2024. And that is a product called DefenCath. It is what is known as an antimicrobial catheter lock solution, and it is designed to reduce catheter-related bloodstream infections in adult hemodialysis patients. And that is what their now commercialized product is. They are working on other therapeutic products. DefenCath was approved in November 2023. Okay, so not in 2024. And that was a notable approval because it was the first FDA-approved antimicrobial catheter lock solution in the U.S., and that is the class of therapies that DefenCath belongs to. And Cormedics is researching how it can leverage this technology to develop a pipeline of antimicrobial medical devices and they have active research programs in surgical sutures, meshes, and other areas where the technology and medicine they've already developed could be used towards future commercialized products. But right now, DefenCath, which is, again, it's considered an antimicrobial catheter lock solution. And it is essentially designed to slash risk of bloodstream infections in patients on hemodialysis. That is a company that has been around about 20 years at this point, but that was, I believe, their first commercialized product. DefenCath is essentially a combination of two medicines. One is called taurolidine, and the other is called heparin. And taurolidine is essentially an antimicrobial medicine. It works against germs. It's designed to keep germs from sticking to the surface of the central venous catheter that's used in the process of hemodialysis. And then heparin, the other main medicine contained within their product, DefenCath, it's a blood thinner or anticoagulant. So just a little bit of background there as well. Right now, their whole focus is on continuing to commercialize DefenCath, as well as developing their pipeline. It looks like, as I was seeing, that shares have fallen sharply following their earnings. The biggest reason for that was the fact that the company announced that they had a significant customer order for DefenCath that had been delayed. They had anticipated beginning shipment to this customer in Q4 2024, but operational resource constraints have pushed the timeline to 2025. That seems to be news that impacted investor sentiment towards the stock, at least today, as we've seen shares get hit. But in terms of their financial results, 2024, they delivered net revenue of about $43.5 million. Q4 net revenue of 31 million. So most of that revenue was accumulated in the final 3 months of the year. They are profitable. They reported net income of 13.5 million in Q4, an adjusted EBITDA of about 15 million. They said that their Q4 was the first profitable commercial quarter in CorMedix's history. So that is a new turnaround there on that metric for the business. And again, the ongoing implementation by outpatient dialysis customers of DefenCath has been the biggest driver of sales so far. They said that they are in the process of staffing their dedicated inpatient sales team, which is a huge part of a partnership that they announced with a company called Syneos Health previously. Obviously, for businesses like this, having a really well-structured sales team is key to be able to adeptly and effectively commercialize your drug and get it to the actual patient. So CorMedix has started to see, this is from their report, increased DefenCath utilization at a number of larger hospitals and anticipates further inpatient growth throughout 2025 as the new field team commences activity. So, this is a business that they are reporting revenue, but it's quite slim at this point, right? The 43.5 million in revenue for the entirety of 2024. This last quarter of their fiscal year was the first profitable commercial quarter in their history. But it's a very, very small figure at this point. They are still building their sales team. And so, uptake of DefenCath is very, very slow at this point. They are working as well on, marketing and promotional support for DefenCath to potential patients in places like VA facilities. They also said that they began identifying investigator sites for their phase 3 study of DefenCath in patients receiving total parenteral nutrition, or TPN. They are, of course, looking to expand the indications for DefenCath in the future. They had about 52 million in cash and investments on hand at the end of 2024. Now they are looking to deliver preliminary net revenue between 50 and 60 million for the first half of 2025. And again, they just reported about 43.5 million for the entire 12 months of 2024. They also think they're going to end Q1 2025 with about 75 million in cash and short-term investments. Operating expenses are quite high at this point. For where the business is at, right? You think about their revenue, their profitability, operating expenses were about 17 million, which was a 9% increase year over year when they closed out the quarter. This is a business that's very, very much in the early stages of growth, right? They are somewhat barely producing revenue at this point because they are in the very early stages of commercializing their product. It's approved, but they're still building their sales team. They're working on looking at further indications for DefenCath in the future. They're initiating a phase 3 study with regards to that. They are newly profitable. Their ability to execute on their the success of their product and be able to really get it into the hands of patients and enact more partnerships with payers, which is going to be something their sales team is going to be integral for. It's going to be really key for DefenCath to succeed as a product and to enable them to grow as a business. And so again, that news that there had been a significant customer order that was delayed, because this is a business that is such in the early stages of growth, that has really barely started to get products into the hands of customers. That's why news of that nature would be something that the market would be so reactive to. So kind of an interesting little business. They are again seeing, early, really positive results from the implementation of their product by outpatient dialysis customers. I think there's a lot that the company has to do to really fully expand its potential, base of patients, and a lot of that is going to be the job of its sales team, is to be working with public and private payers to get that product into the hands of patients and make sure it's covered. So interesting one to follow. Those are some of the updates of what's going on with the company. That customer shipment delay is the biggest reason the stock is moving today. From the standpoint of where this business is doing and being a very small business that's really working on getting its first product to customers. A fairly solid financial quarter, but bear in mind just the context of really how early in their growth they are, and what those figures are looking like. And operating expenses are going to be very, very high for what the level of revenue is that they're making for the foreseeable future.
Very informative answer, I would say. I don't follow these types of companies. I do follow. I mean, we did touch last week a bit more on the bigger companies for sure. There were some questions also about Novo Nordisk, Eli Lilly, about tariffs and all of that. I don't know if you want to touch on that. If not, there is a question I might touch on right now. Any thoughts on Upwork and Fiverr? I'm thinking the best days are behind them now. And I would probably agree here. I mean, both of them since their peaks back in 2021, Fiverr is down, I think, 90%. Upwork is down 76% since then. In the last year, Upwork is up 14%, Fiverr 26%. But yeah, they are not growing as fast anymore as they did previously. You might also say that because of generative AI, you might not need a lot of things that get offered on the Fiverr platform. But for those who don't know, Fiverr, a platform where you can go, used to go and find gigs for $5, whether you need a logo or something like that. They have grown into attracting bigger and bigger clients, something that Upwork did from the start, getting bigger budgets invested, basically coming through the platform. Competitors to say the least. But yeah, of course, their growth exploded in 2022, 2021, and then growth decelerated quite rapidly. In 2022, for example, for Fiverr, revenue only grew 13.3% after it managed to grow 45%, 41%, 77%, and 57% year over year since 2018. And then that decelerated yet again, 7.1% year-over-year growth in 2023, and then in 2024, 8.3% year-over-year growth for revenue. So yeah, this is not a growth stock anymore, far from it, actually. With Upwork, it's a bit of the same, although previously they didn't really grow as fast as Fiverr, but now they are growing 11.5 to 12% year-over-year, so still okay, but the platform is still useful. I just don't think the long-term thesis that some investors had probably in 2020 or something, 2020, 2021, still exists today. Because of generative AI and lots of things that you can do on your own. Of course, there is always going to be a big chunk of people that are not familiar with AI applications, generative AI, and things that you can do on your own, and will always be willing to pay someone to do something. That's always going to exist, in my opinion. Which, yeah, these platforms will benefit from that. But then again, where's the growth? Where's the growth? Fiverr is profitable, very profitable actually. Take rate has been quite good and rising, margins as well. But I was previously a Fiverr shareholder, and this was one of those stocks that I held, even though I was already down 50-60% or so. And then at one point, I said to myself, look, I don't see this rebounding anytime soon. Yes, it is more profitable today than it was before, but I bought it before because I thought this would be growing much quicker. It didn't. I took my losses, and as I've said to you, I think a week or so ago, I said a stock can go down 70% and then it can go down another 70% or so. That's exactly what has happened with a name like Fiverr. So you live and you learn. I agree. I agree with the comment that their best days are behind them. That's a comment from Dave. I agree with them. I think great idea, great platforms, but unfortunately bad timing.
Yeah, I still like Fiverr. I follow that one from afar sometimes. I think that they have done a good job of improving their margins and profitability. But yeah, the market has not been particularly kind to that stock for a very long time. Maybe I will take this question about some questions regarding what's happening with pharmaceuticals and tariffs, and Novo Nordisk is falling further. What are your expectations in the next 2 to 4 years for Eli Lilly, which will go down more? This is from Besties. Well, I'm a bit reticent to predict which stock is going to go down more, because I do think over the long run, these are two really great businesses that will succeed. I don't know how short-term market sentiment is going to impact share prices in the next couple years. I think that if we see more volatility, that it can impact these businesses. I have always said I find myself a bit more interested in a business like Eli Lilly, just because they are a far more diversified business. Novo Nordisk was really a very slow-growing insulin business prior to its success as a GLP-1 major player in the GLP-1 space. Eli Lilly is a company with an incredibly diversified portfolio of blockbuster products. They've recently had approval of key and potentially standard of care disrupting drugs for conditions like ulcerative colitis. They had their early Alzheimer's treatment, Kisunla, that was approved as well. That was a major success for the company. They have a lot of different blockbuster drugs in areas like immunology, oncology. So GLP-1 has injected a lot of growth into their business, but it is certainly not the only area of growth for the business over the long run. Now, of course, Novo Nordisk is working on, the next generation of its GLP-1 drugs. I also talked about earlier today on the pre-morning show with Matthew Frankel about how both of these companies have been expanding their direct-to-consumer options, sort of getting ahead of the curve, if you will, of the cheaper GLP-1 competition. These big pharma companies launching their own direct-to-consumer platforms, where among a wide variety of products that are available, cheaper options of their own GLP-1 medications are available on these platforms. So that's interesting as well. I think these are both solid businesses to buy and hold over the long run. Maybe they are not intriguing to every investor, but for those looking at healthcare, I think they are really solid businesses to look at. Now, in terms of comments regarding the state of tariffs, we obviously have been hearing that tariffs on auto may come before April 2nd, but there's been some hints, at least I think even as recently as today, from President Trump, that some of these other tariffs, such as those that have been hinted about pharmaceutical medicines, may not be implemented until after April 2nd. And there's a bit of a lack of clarity in terms of what those would look like. There was a meeting yesterday, quoted by Politico. President Trump said we'll be announcing pharmaceuticals at some point in the not too distant future because we have to have pharmaceuticals. There was another anonymous official that was quoted saying no final decisions have been yet made on sectoral tariffs being tacked onto the reciprocal tariffs that are being announced next Wednesday. There's also been discussions as recently as yesterday from the administration that certain countries might get exemptions over reciprocal tariffs. There was a quote to reporters that numerous countries might get breaks. So it's very hard to see what the exact implementation of those is going to look like. It is also worth noting that there have been active concerns that tariffs on pharmaceuticals would undermine the provisions of the duty-free agreement that the U.S. has signed onto under the provision of the World Trade Organization. Under the 1994 Agreement on Trade in Pharmaceutical Products, major economic entities, which include a number of countries, including the U.S., agreed to eliminate tariffs on most pharmaceutical products and their ingredients. Now, the U.S. is the world's largest pharmaceutical market. According to statistics from Politico in 2024, the U.S. imported roughly $210 billion worth of medicinal products. Now, for what it's worth, We know that companies like Eli Lilly have announced plans to construct 4 manufacturing sites in the U.S. at the cost of $27 billion. 3 of those sites will focus on manufacturing active pharmaceutical ingredients, which would essentially reshore their small molecule API production. I've seen some other questions about that, so I wanted to note that. The 4th location will extend Eli Lilly's injectables business, which obviously would play majorly into the global demand they continue to see for Mounjaro and Zepbound. Other companies like Pfizer are also in the process of evaluating their overseas manufacturing. CEO of Pfizer, Albert Bourla, said at the TD Cowen Healthcare Conference in early March that if tariffs came into play, he quote, "We will try to mitigate by transferring from manufacturing sites outside to manufacturing sites here in the U.S." Said the situation is obviously volatile and we don't know what will happen. So those are some updates there. I know we are a minute over. I'm sticking around for another hour, and Danny is going to join me for this next one. But I hope that adds a little bit of clarity to the question of how some of these businesses might be impacted, at least in the short term. And with that,
Yep.
Neil, it was great having this hour with you.
Yeah, I think we'll see each other tomorrow, I believe.
Yes, I think we're back for another valuation hour.
Perfect. Have fun, guys.
Thanks so much. Hey, Danny, how's it going?
Rachel, long time no see.
I know it's been, what has it been? 24 hours?
Or thereabouts.
Thereabouts.
Shocking.
And another great Hawaiian shirt to brighten up this lovely Tuesday.
I do love my Hawaiian shirts, as is well known around fooldom.
Well, fools, if it wasn't clear as I bled slightly into the beginning of the new hour discussing the current landscape in the pharmaceutical industry, this is a new hour. We are talking about earnings for the next roughly 58 minutes and some change. Danny and myself will be your co-hosts for this lovely hour on earnings. We still have companies that are reporting earnings at the end of this season. There's a few I think that both myself and Danny are going to be talking about in the next hour. I know McCormick is one of the companies that has reported, so I'll be interested to see what those results were. But fools, if you have any questions about the companies we're going to be chatting about today, or anything earnings related or otherwise, go ahead and get that in the Slido. The event code for that is FOOL24. We will do our best to also work through some of the questions that are already in the queue. Maybe to start off, I will talk a little bit about Oklo. They reported. For anyone that doesn't follow this business, I want to give a little bit of a background on them. This is kind of a fascinating company. So Oklo was founded in 2013 by graduates of the Massachusetts Institute of Technology. Oklo is a nuclear power company. They design and develop what are known as small modular nuclear reactors. Their goal is to provide clean, affordable energy to businesses, communities, data centers. That's a huge area that they see for potential growth in the future. And they want to create small-scale nuclear power plants that run on nuclear waste. Now, the goal of the business is to commercialize and produce significant clean energy through nuclear fission technology at a global scale. They have several project sites. They have their first commercial fission power plant planned out in the US, not yet built. That will be located in Idaho. I know that they have had that facility design concept that has been approved by the US Department of Energy. They hope that that plant will be in operation before the end of this decade that we're currently in, and that the plant would obviously be used to turn nuclear material into fuel. Their current technology includes a next generation nuclear microreactor called the Aurora, which can produce 15 to 50, and I think I read in their earnings report, now up to 75 megawatts of electricity and operate for 10 years or longer before refueling. And just to give an idea of scale, just a 50 megawatt power source, which is huge, could power around 2,500 to 5,000 average homes, depending on energy consumption patterns. Management is planning to sell directly to customers under long-term contracts, providing 24/7 clean energy to data centers, factories, industrial enterprises. They also see applications for government clients like defense facilities, and they want to develop these small reactors that can be deployed in numerous locations, including more remote areas. They only held their IPO not even a year ago. It was in May 2024 through a special purpose acquisition company, or SPAC, that is owned and operated by Sam Altman, co-founder of OpenAI. So that's just a little bit of background on the business that I think is important. If you don't know or follow this company very well, it's worth noting that this is obviously a company that is in the very early stages of what it hopes to be commercializing its advanced nuclear reactor technology. It has to really scale up those operations to the point of being able to achieve revenue. So, as a pre-revenue business and one that would not be expected to be producing profits for quite a while, this is something to be aware of. But again, this idea of developing advanced nuclear power plants that run on nuclear waste and providing clean, reliable, and affordable energy is something that has been really sticky to a lot of people. And already Oklo has some pretty notable partners. They had submitted their first advanced fission custom combined license application to the U.S. Nuclear Regulatory Commission. They had their first site use permit issued by the Department of Energy, and they were granted fuel material from the Idaho National Laboratory. But how do they plan to commercialize this product of selling clean energy using nuclear waste and their small modular nuclear reactors? Well, rather than selling their powerhouse designs, they intend to sell energy to customers using power purchase agreements and to generate stable revenue that way. Power purchase agreements, or PPAs for short, they're long-term contracts between a customer and an energy provider to buy energy at a predetermined price. The PPA model is quite common in the renewable energy space, not so much in the traditional nuclear power space, as many traditional nuclear power players tend to sell or actually license their reactor designs to larger utility companies. But instead, Oklo wants to diverge from this norm. They want to design and build and operate their own smaller scale powerhouses and then follow this PPA model of selling energy directly to customers through power purchase agreements. Oklo just signed one of the largest corporate clean power agreements in history with a company called Switch. Switch provides AI, cloud, and enterprise data centers. And part of that agreement is to deploy I think roughly a dozen gigawatts of memory serves of Aurora powerhouse projects through 2024. They also have a major partnership with global data center and co-location giant Equinix that includes a multi-million-dollar prepayment for a future 20-year power purchase agreement. And they've also received other non-binding letters of intent from other notable future partners. Their Aurora powerhouse is, again, one of the key products that the business is working on. I'm going to go ahead and pull up their results here. So bear with me as I share my screen. This briefly comes up. Okay, that should pull up really quickly there. There we go. I just want to really quickly look through a few of the things here for the business to see how they are doing. Management said in 2024, Oklo took bold steps to lead this transformation, nuclear power being essential to a clean, dependable, and scalable energy future in their view. They said, we went public, we advanced development at our first commercial site at the Idaho National Laboratory. We built a customer pipeline of 14 gigawatts, one of the largest in our field. They say at the same time, nuclear energy has gained unprecedented government support. AI has triggered a Sputnik moment, accelerating the demand for dependable domestic power. They said our partnership with Equinix was the first commercial advanced nuclear energy deal that included an investment in the data center sector. And as they said, we capped the year with a landmark energy agreement, one of the largest of its kind, with data center developer Switch. It's very clear that AI's rapid evolution means it will only become more accessible and scalable if we have the power to support it. So among some of these key updates, they signed, again, one of the largest corporate power agreements in history with Switch. They signed a letter of intent with Equinix for 500 megawatts, accompanied by a $25 million prepayment. They signed a letter of intent with Prometheus Hyperscale to provide 100 megawatts of power in the future, and another letter of intent with Diamondback Energy. They also completed the acquisition of a company called Atomic Alchemy, enabling accelerated radioisotope production. They also designated Siemens Energy as Oklo's preferred supplier of power conversion technology. I noted that they had secured some key U.S. Department of Energy approvals. This includes a memorandum of agreement for siting and an environmental compliance permit for their first Aurora powerhouse at the National Laboratory. And then they began drilling, testing, and site characterization for their first commercial powerhouse, backed by those Department of Energy approvals. They closed, obviously their SPAC, they full year cash used in operations of 38.4 million, which was slightly below their forecasted range of 40 to 50 million. So this is a business that is still burning cash right now. That is something that is very much to be expected. They did appoint a couple new board members. I thought it was kind of interesting to show, because with these types of businesses, there's not a lot to show in terms of the financials with their earnings report. It's all about updates for the business that in the long run, will feed into their financial growth. But they're showing how their modular approach offers customers distinct advantages over traditional large-scale reactors. They say instead of relying on a single large plant, Oklo builds small modular powerhouses incrementally, which allows energy production to scale alongside customer growth. So for example, if you have a data center client that scales from 250 megawatts to 500 to 1,000, their powerhouses can expand in kind. And they say, the benefits of this business model is that it enables a build, own, operate to sell power directly to customers, as I mentioned, with their power purchase agreements. It lowers supply chain fabrication and labor costs. It reduces the timeline to actually have one of these powerhouses operational. And it enables access to project financing for flexible funding. As noted, that agreement with Switch that they entered into to provide 12 gigawatts of advanced nuclear power by 2044, one of the largest corporate power agreements in history. And one other thing I'll note is they have what they say now is the largest order book in the advanced nuclear history of future customer agreements for the power they would provide, spanning clients from data centers to manufacturing, oil and gas, defense, and others. Interesting business, Danny.
I wanted to chime in here because, one of the things about Oklo is that I think it's kind of a groundbreaking idea with these micro nuclear reactors. And as you mentioned a little bit ago, the idea of reducing the costs associated with building these new nuclear power plants. That not only is it make it less expensive, but it decreases the construction times. And then, customers have more flexible power options. So they can actually, contract for the amount of output that they need. And like you said, grow over time. So I think that's one of the more attractive features of Oklo's business.
Yeah, agreed. There's a couple other things on note, and then I'll wrap it up here. It's an interesting business, but I mentioned they acquired a company called Atomic Alchemy, and their vertically integrated production facilities at Atomic Alchemy supply high value radioisotopes amid a global radioisotope shortage. And so the idea is that this could be another business line for them, as Atomic Alchemy is really well situated to supply these for various applications, including fueling thermoelectric generators. They think that this could be a business line that generates revenue for them as soon as next year in 2026. And they see a range of potential applications for this new line of business for them, everything from healthcare to defense to even space clients, artificial intelligence, of course, and nuclear R&D. Something I mentioned as well is how they want to transform nuclear waste into a sustainable domestic energy supply. They are advancing plans to deploy a commercial scale fuel recycling facility, scaling that to establish what would be a long-term fuel fuel supply for a range of domestic clients, and they think that could be tremendous for the business over the long run. And as they say, their vertical integration across nuclear power and fuel recycling, they say that's what we think makes us a differentiated leader, with reactors designed to operate on either fresh, high-assay, low-enriched uranium fuel or recycled nuclear fuel. And that ensures a flexible and stable energy supply. So it's an interesting business. This is a photo of the site work that just kicked off for their first commercial Aurora powerhouse. So that was also kind of cool that they included that. They've also given, the timeline. They're on track to submit their NRC application, for their first Aurora powerhouse in 2025. They give a little bit of insight in their earnings report into the process for that and how their business model, helps them achieve a faster path to licensing. Again, they're still operating at a loss from operations, net loss. They're using cash in operating activities. They are not generating revenue at this point. This is a pre-revenue business, but they did have about $275 million in cash on their balance sheet at the end of their fiscal year. So that is Oklo. Really interesting business. It's one I started to get to know a number of months back, and I've been fascinated by ever since. Not one I would necessarily invest in right now. I don't usually invest in businesses that aren't generating revenue yet, but this one has really intrigued me and excited me. So it's one I'm continuing to study further.
One of the things that I think investors should probably know is not only are they not generating cash yet, but they have not yet deployed a reactor. The first one's coming online at the Idaho National Laboratory in 2027. But I think that the attraction is clear. We've had companies like Amazon and Alphabet and Microsoft have all been looking deeply into nuclear power. Microsoft is bringing the 3 Mile Island nuclear plant back online through a purchase power agreement. Amazon and Alphabet both announced investments in small nuclear reactor technology. So I think the potential is there. But certainly, this is one of those deals where, we're talking about kind of a high risk, high reward kind of opportunity here. And definitely keep that in mind before you go whole hog into Oklo.
Oh yeah, for sure. I think that one of the biggest opportunities for them is with data centers like that. I mean, the idea of them powering local communities is something that's really interesting, but also the sheer level of power that is needed in the age of AI, the ability to fuel and supply power to data centers, I think is something that they're really looking at and focusing on. I think they're partnering with our power to offer a phased power model for data centers, which would combine, immediate energy deployment using, natural gas generators, but then transitioning to power from Oklo's Aurora powerhouses. So at this point, it's all conceptual and in process, and we're going to have to see what that looks like in action. But it is a fascinating kind of a model to look at.
Yeah, it's like you said, it's kind of a fascinating opportunity. We still don't know yet whether it'll be a profitable one, but one that certainly bears watching. So the one that just reported results that I wanted to talk about is McCormick, ticker MKC. Now, McCormick is an interesting business. For those of you who may not be familiar with McCormick, they are one of the leading providers of spices, of flavorings, of food additives, flavor-wise, in the world. And this is one of those kind of boring businesses that exists in the background that maybe investors might not pay attention to. But I'm really intrigued by the way that management is focusing on the opportunity, and we'll get to that in just a minute. So for the first quarter, their net sales of 1.61 billion were essentially flat year over year. Now that requires a little bit of context. While their sales were up 2%, unfortunately, the strong dollar resulted in some unfavorable foreign currency headwinds, and so what they made in increased sales, they kind of lost in foreign exchange. So that was unfortunate. Now they did meet analyst consensus estimates. They had net income of about 162 million. That was down about 2% year over year. And their earnings per share of 60 cents was down 3%. Now, a lot of that is tied to, the foreign currency headwinds. But, there's also one of the things I found intriguing in on the earnings call is that, management has laid out these areas where it has seen the opportunity for growth, and where they are seeing growth potential is where they're investing, the bulk of their opportunities for growth. So I'm going to just change slides here for a moment. So what they said was that they achieved market share gains in core categories across key markets, which helped to propel the growth forward. They had volume growth in both their consumer and their flavor solutions segments, which you and I have talked about before. Now, they did notice that there was some softness in consumer packaged goods, volumes in the Americas and EMEA. And if you look at the underlying economic environment, that kind of explains that a little bit. You've got higher inflation. Consumers are still having to make choices with their grocery money, and sometimes things on the periphery like McCormick spices, flavorings, gravies, etc., condiments, can take a back seat. They did say that they made positive progress in the prioritized investments in the areas that are driving the greatest value. And they specifically mentioned that they made gains in various countries, in the chili, in gravy, in mustard, in hot sauce. And one of the things that I saw in their presentation that I thought was pretty cool was, like, for instance, one of the things that they alluded to was Cholula. If you're like me, you've probably heard of Cholula hot sauce. I've got a bottle of Cholula hot sauce on the shelf in my refrigerator, but they're expanding Cholula. And so now, instead of just hot sauce, they have hot sauce. They have topping and cooking sauce. They have introduced a Chipotle mayo. So they're taking these successful product lines and they're expanding them into other areas, which gives them more coverage on the grocery shelf. It gives them more opportunity to connect with consumers, and the chance that they will pick up more sales once the economic outlook clears up a little bit. I was kind of surprised. They were talking about how gravy, their gravy packets are taking share in certain areas in Europe, and how mustard. Did you know? You live in Europe, Rachel. Did you know that Poland is the mustard capital of the world?
I did not know that. Wow.
I did not know that either. And yet, apparently, in Poland, they consume more mustard per capita than any other country in the world. And McCormick is proud to say that it is taking share of mustard in Poland. So that's kind of a testament to management strategy, which is focusing on those areas where they are gaining market share, where they where they're seeing these opportunities for growth and expanding existing product lines. So I think this is one other place that they mentioned that they are making good progress is in China. And they said that during the Chinese New Year, they were able to make inroads in a variety of spices used by Chinese cooks in these celebratory meals. So again, another interesting piece of trivia, something I certainly didn't know, but makes it a little bit more fascinating to me. And finally, McCormick affirmed its 2025 outlook, which investors were probably happy to hear, considering that growth was flat in the fourth quarter. Now, the company said they still expect net sales growth to be flat to 2% increase. Now, when you look at that in constant currency, which is, aside of the foreign currency headwinds, they're expecting organic growth of between 1 and 3% in 2025. Now, what's even better is that they're expecting their operating income to increase by 3% to 5%. And part of the reason that they're expecting that operating income to climb faster than the net sales is because of the investments that they have made to expand in these other markets, where they talked on the previous slide about investing in those growth opportunities. Now, they did say that their growth margin expansion was going to be partially offset by more of these growth investments. They're going to continue that strategy. And based on the results that they've seen thus far, I think that's a fair strategy. Now, they did say they anticipate about $15 million in reorganization and streamlining charges. So they're trying to, cut out some of those levels of middle management and streamline their organization. They are pointing for the year to adjusted earnings per share of about $3.05 at the midpoint of its guidance. Now, this would represent an increase of about 6% year over year, which is not bad considering they were talking about, net sales growth of about 2% at the midpoint of guidance. And they did say that the year over year decline, because this would be down compared to the prior year, was being driven by foreign currency headwinds resulting from the strong dollar. So that's why they gave the adjusted earnings guidance. So, I think McCormick is one of those companies that I think of as one that I don't give a lot of thought to, but if you go into my refrigerator, you're going to see, McCormick brands in there like Cholula. If you pull out our spice drawer, you're going to see a number of McCormick spice jars in there. I know that we have used McCormick gravy packets. We've used McCormick taco seasoning. And so I think this is one of the companies that kind of exists on the periphery, a boring business that is, maybe has a little bit sluggish growth right now. But considering the economy, I think this might be, a good opportunity for somebody if they're looking to initiate a position or expand an existing position. This might be a good opportunity to do that. When I looked at, what the market's reaction was to their results, it looked like the stock was down a couple of percentage points, and actually it ended up on the plus side. It was up about 0.85%, so not quite 1%. And then it switched to basically flat. So this is one where this is not going to be a tech grower. You're not going to see 30 or 40% gains year over year. But a company that has $1 billion worth or $1.6 billion worth of sales in spices and gravies and condiments and flavor. I found that all pretty interesting.
Yeah, it wasn't wasn't
Poland.
a bad quarter at all. It's a pretty solid business, honestly.
Yeah. And Poland, who knew Poland was, if I was forced to guess, I would have thought somewhere like Germany.
Yeah, I probably would have too, to be honest.
But Poland, that's
great trivia. Impress
I
your
love
friends.
trivia.
Do you know what the mustard capital of the world is?
I do now.
Yeah, as do I after this show. We had a couple questions from Vic that had come in about a couple very, very small biotech businesses that I wanted to add a few comments on. I'll just address one of these to address both of them. So Vic was saying, for whoever asked about biotech, in his opinion, Recursion's run has ended. Thinks it's time for Minds Biomed to run news drop in 2 days, FDA in progress. Rachel, have a look. They partnered with Thermo Fisher Scientific. I did look a little bit into this business. It looks like they did the business is waiting, I know, for a pivotal study that is awaiting, U.S. regulatory approval, essentially, for their flagship product, Colo Alert, which is now marketed in Europe and the UAE. This is Minds Biomed. So Colo Alert, it's approved in the UAE and Europe. They're running a pivotal FDA clinical study for U.S. regulatory approval, which maybe that is what the viewer is referring to, the awaiting results for that. But this is a business that also just completed, I believe it was a 40-for-1 reverse stock split, presumably to avoid being delisted. Shares are down about 90% over the last year, and the stock is still trading at about $4 a share. And that is after doing that reverse stock split. So I can't even begin to express the level of caution I would exert with this business. They have a market cap of about 9.5 million. This is an interesting product, their Colo Alert product, but it is one that from a investment standpoint, I think requires an abundance of caution for some of the reasons I mentioned. I'll get into the business a little bit more closely. Recursion, for anyone that's wondering what that business does, they're a tech bio company. They use AI and machine learning to accelerate drug development. They're focusing on mapping biology and chemistry to find new treatments for diseases like cancer. They are still in the early stages of development. They don't have any approved drugs on the market, so their revenue is largely dependent on collaboration agreements with larger pharmaceutical companies, which introduces a lot of financial uncertainty. And then the other thing as well, I think there's been a lot of apprehension about their pipeline. Their investigational candidates are still in the very, very early stages at this point. But the thing that's been interesting about that business is, they have diverse technologies that generate a large biological and chemical data set, and they tend to leverage those machine learning algorithms to distill trillions of searchable relationships across biology and chemistry. And they aim to industrialize drug discovery by building a platform that expands one of the world's largest biological and chemical data sets. And they operate a very powerful supercomputer called the BioHive. So as I mentioned, they have several candidates in development. Recursion, for example, is developing an oral CDK7 inhibitor, which they have reported promising safety and efficacy data for. They also have advanced 3 new clinical studies across oncology, rare diseases, and recurrent C. diff infections. So that's Recursion Pharmaceuticals. Yeah, Minds is a very small company, much smaller than probably what we would normally talk about here on the show for market cap purposes. As I mentioned, they offer tests like Colo Alert for colorectal cancer. They're developing something called Pank Alert for pancreatic cancer. So they're selling in vitro diagnostic tests for the early detection of cancer, but significantly close to what I would say would be an issue with meeting the requirements to be listed on the NASDAQ now, even following their reverse split. They just completed that in December and then announced in January that they had received notice that they were no longer in danger, essentially, of being delisted, but shares have gone down significantly since that time. So it looks like we're awaiting news about potential FDA approval for their test kit in the US. They do have partnerships with companies like Quest Diagnostics. Thermo Fisher Scientific is another one. But for some of the reasons I mentioned, this is one that, at least for now, I would personally stay quite far away from.
Yeah, that's a reverse stock split and all that. There are lots of reasons not to
But-
like.
But I'm always happy to get, to answer questions about this space. I think there's so many companies that we learn about, and I sometimes get a chance to learn about in real time here on the show, which I really enjoy doing. And some of the businesses I find more intriguing than others. This one, obviously, their product seems really interesting, but the business is very small and seems to be also struggling right now. So that's something I would watch. I saw a couple things in terms of metrics that they have been working to improve. They did, deliver some revenue growth in their most recent fiscal period, and it looks like their financial results come out in for the full year, I think sometime in April. But when you're looking at a stock, and I'm just talking about the stock right now, not the business, that is going through the woes that it is facing right now, that's something to be very, very wary of, I think, as an investor. But if you're looking at this business, pay close attention to any upcoming FDA approvals regarding their colorectal cancer test in the US. That seems to be the biggest tailwind for the business right now. As I mentioned, they do have some other partnerships with bigger companies like Quest, which I think they're going to have their tests potentially rolled out there again if it garners FDA approval. And Thermo Fisher is a longstanding partner of theirs. So certainly some positive developments with the business. The stock itself seems to be flailing since their reverse split, and is going dangerously close again to delisting territory. So tread with caution is what I would say.
Indeed. So just a hat tip to Spiffy. I actually came on several hours ago to fill in for Emily while she was dealing with a power outage, and was on with Dave Meier. And Spiffy said, Danny was great, leave him on. Emily and Dave also awesome also, though. I personally, if it was me, I'd rather listen to Emily and Dave, but thanks, Biffy, for the vote of confidence. We have a question from Dave J about 3 hours ago, actually a comment. Today I sold some longtime disappointments, PagerDuty and Zoom, telecommunications, I'm assuming, and bought Toast and, drum roll please, I think that was for my benefit, Mercado Libre. Yeah, I feel your pain with PagerDuty, and sorry about the dogs in the background, but they obviously found something interesting to bark about. I've held Zoom for a long time, bought it actually before the pandemic when it was a bright startup, had plenty of potential ahead. And when the pandemic hit, it looked like it was going to be a long-term winner. And eventually what ended up happening was it ran out of gas and people stopped using Zoom as much once the pandemic was over. I still own the stock, but it's a big loser for me. I never have owned PagerDuty, but again, I feel your pain. Now, the reason I took this question primarily, however, was because two companies that I have addressed and talked about here at length are Toast and Mercado Libre. So, Mercado Libre, I went back and looked at the results again, and there's one number that really stands out to me when you're talking about the company's growth in the most recent quarter, and that is the fact that they grew their net revenue by 96% year over year in foreign currency neutral terms. And what that means is, Mercado Libre operates in Latin America and only in Latin America. So they don't need to exchange their money for dollars. Yet we here in the United States, since they are listed on our exchange and since they report, submit their reports to the Securities and Exchange Commission to be listed in the US, they have to present their financial results in dollar terms. And strong dollar makes the results look weaker than what they really are. And that's why you see, net revenue was only up 37% year over year in dollars, but 96% in local currencies. So that kind of gives you an idea of the magnitude of their growth in their local currencies. I am also a big fan of, and I am a shareholder in Toast. This is a company that provides software as a service to the restaurant industry. And this is an area that a lot of folks really skirted around. But Toast has consolidated. They offer a number of different solutions for the restaurant industry. They can handle the hostess duties and keep track of who's at the table. They can handle employee scheduling. It handles inventory. It handles food delivery services. And so the reservations. So this is a one-stop shop really for restaurants. They've got an annualized recurring revenue run rate of 34% as the end of last year. And the total locations grew 26% to 134,000. They added a record 28,000 net locations last year. So this is a company that, I have found to be not only fascinating, but also profitable. And one that if this is not one that you've checked out, I think it's worth taking a look at for sure.
Awesome. I was just looking through here. Let's see. Well, maybe this is one we can both give our opinion on. Which sectors gets hit the hardest if consumer confidence keeps going down? I mean,
Tech.
I think that there you go.
Tech.
That was easy. Tech. Yeah, tech is definitely one. I think almost any high growth sector and or sector with high levels of exposure to discretionary spending, however real or perceived that is, will get hit very hard if consumer confidence keeps going down. I talked in the earlier hour when I was on with Neil about the results of a recent consumer confidence survey that came out just today. I think it was. There's a few different ones that have come out over the last couple of weeks, and how we're seeing, declining consumer confidence regarding what the stock market might do in the coming months, the state of the economy, and other, particular areas of interest to consumers. I think that tech has continued to weather a lot of the volatility that we've seen in the last few months. I think that reality is going to be the case if that volatility persists. And I think also other areas and other stocks where consumers perceive weaknesses if the economy were to take a turn. Danny, I think you said you have a screen you want to share. I'm very happy to take a look at that.
This would be, kind of helpful in terms of, showing what the 11 stock market sectors actually are. And so this is the Global Industry Classification Standard. This is from a Motley Fool article about the market sectors. If you're interested in looking at that, just Google Motley Fool and stock market sectors and it will come up. But the sectors that are the major ones that we talk about, energy, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, communication services, and real estate. And looking at that list, and I was talking tongue in cheek earlier, but only just a little, because tech is one of the first areas that you see slide during a market downturn. But really, like Rachel said, generally the market tends to fall in unison. Some sectors will fall more than others. The great news for long-term investors is that if the market falls in unison, that is my cue to start buying stocks that I have been watching that maybe have had higher valuations, because when you've got the entire market falling, higher valuation stocks tend to fall faster and further, not for any company specific reason, but because the market's falling. And so, I have a list of tech stocks that I will be looking at very closely, if the market stayed in correction territory. Now it's rebounded a little bit, so we're back, we're officially out of that 10% correction. But I certainly think that, that the opportunity is there. But I stick by my earlier statement that tech stocks will fall the hardest if consumer confidence goes down.
Yeah, I think that's fair. I think that, because we often see some of these slower growth blue chip type stocks like McCormick show a little bit more resilience sometimes in these periods where there's uncertainty, and sometimes investors tend to, flock to areas where there is more perceived or real safety. I think that those kinds of businesses can definitely be nice, stable businesses to have in one's portfolio. Healthcare tends to be a bit more resilient, both from a business perspective as well as a share price perspective, in periods of economic unrest and waning consumer confidence. So that is also another area where you sometimes, in terms of stock prices, tend to see resilience. And also those are businesses that are, broadly speaking, not very cyclical, and also tend to do well when there are these difficult moments, in the economy, which it's very unclear at this point what is going to happen moving forward and whether or not there are going to be issues regarding recessionary headwinds. But consumer confidence is low right now. Consumers perceive that there are a lot of difficulties, and that often trickles back to people's own lived experiences. And that is something that can negatively impact the movements of the market as well. There was a question from Let It Ride about 56 minutes ago. Rachel, what are your top 2 or 3 pharma or biotech stocks, solely in terms of the most promising products in development? I mean, there's a few there's so many companies I talk about. It's very hard to narrow them down. I mean, a company's portfolio as well as their pipeline is obviously very important in this space. I think one I talk about a lot is Vertex Pharmaceuticals. They're a biopharmaceutical business. That's a really compelling company to me, both from a portfolio perspective as well as their pipeline in terms of what they're working on. They have been known historically for targeting very rare, underserved genetic diseases in terms of the types of products they develop, and in developing functional cures or treatments or therapies that are essentially do not have existing rivals on the market. So, for example, right now in their portfolio, they're working on functional cures for diseases like APOL1 mediated kidney disease, Duchenne muscular dystrophy, myotonic dystrophy type 1. But they are also a company with an incredibly established and profitable business from their cystic fibrosis drug franchise. They are the only company with drugs that are approved that actually treat the underlying genetic factors that cause cystic fibrosis. They most recently garnered approval for their new triple combination therapy, which is projected to significantly outpace in sales growth its already outstanding portfolio of drugs, notably led by a cystic fibrosis therapy called Trikafta, which has been a blockbuster for Vertex. Vertex is expecting their new triple combination therapy to outpace the growth and ability of Trikafta. And there were already numerous elements in clinical studies of that particular therapy that showed improvements beyond Trikafta, which was a major deal when Trikafta was approved a few years ago, because its approval in the US already covered roughly 90% of the cystic fibrosis patient population. But Vertex is in the process of rolling out a couple other really exciting therapies as well that I think are worth noting. One is Journavax. That is their moderate to severe acute pain medication. It is the first in a new class of pain medication approved in 2 decades. It is not an opioid. It specifically inhibits what's called the NEV1 0.8 sodium channel. Essentially, it is a key player in transmitting pain signals in the peripheral nervous system. So unlike opioids, which act on the brain, and therefore that plays into a lot of the addictive qualities that opioids can have, Journavax focuses on the peripheral nervous system where pain signals originate, and it targets the sodium channel that is vital for transmitting pain signals. That is a very, very exciting approval for the business. They are just now in the process of getting that approved in other regions outside of the US and in commercializing that drug. The other big thing for them was the approval of Casgevy, their CRISPR gene therapy that they developed with CRISPR Therapeutics. It's a one-time functional cure for sickle cell disease, as well as transfusion-dependent beta thalassemia, 2 very rare and painful blood disorders. So that's been another really notable thing for the business. But you can look at companies that are much more well-known, like Pfizer, that are in the midst of a real transformation for their business. They had more drugs approved in 2023 than any other company by the FDA. They entered into close to a dozen acquisitions with the, billions in cash and capital that they, brought in from the success of their COVID-19 products. And they have used that to fuel numerous launches, as well as very promising elements in their pipeline. Their oncology pipeline is huge for the business's growth moving forward. That pipeline was effectively doubled by the acquisition of Seagen a few years ago for $43 billion. They already have a number of new products that have been more recently launched from some of their COVID-era acquisitions, like Nurtec, the migraine drug, as well as several oncology drugs. But there are numerous candidates, I think, in their portfolio or pipeline right now that bear watching, and particularly because they're hoping to have 8 blockbuster oncology drugs in their portfolio by the early 2030s, hugely because of that acquisition they made. So Pfizer's another one that I find really fascinating. Eli Lilly we talk about a lot for their GLP-1 success. That has obviously been something that has been a huge boom for the business, but this is a business with a long-standing history in oncology, in very a wide and varied immunology drug portfolio, diabetes care. They have drugs like Trulicity. They have also Munarriz, obviously, which is a dual-acting medication that helps lower, blood sugar levels. Jardiance. They've got their neuroscience drugs like Prozac and Cymbalta. Then other drugs like Taltz, which is a monoclonal antibody for psoriasis and psoriatic arthritis. Verzenio, which is a leading CDK4/6 inhibitor used in the treatment of metastatic breast cancer. Then just approved Omvo for moderate to severe active Crohn's disease. They're also advancing their pipeline with Zepbound for additional applications or indications, for example, for moderate to severe obstructive sleep apnea in adults with obesity, which is another area they've been seeking an indication for. They had the approval of their early onset Alzheimer's drug, Kisunla, which was a huge bit of news for the company and is really just in the early stages of impacting the business. So a lot with these different companies. I think Amgen is a fascinating one to look at. Regeneron Pharmaceuticals, not to be confused with Recursion Pharmaceuticals. Regeneron Pharmaceuticals is a pretty established biotech player. And then if you're going outside of that space, I would say for medical device businesses, Intuitive Surgical is a great one to look at. Not so much for their pipeline, but just for their just incredible business built on their flagship Da Vinci platforms that continue to lead in the world of surgical robotics. Really profitable business. So those are a few companies that I find particularly interesting, in pharma, biotech, medical devices. There obviously are smaller players as well. I tend to focus personally on the larger businesses, but those are some names worth looking at, perhaps.
So we had a question from Matt about 13 minutes ago. Would you call McCormick, MKC, a consumer staple? You are absolutely correct. When you talk, I'm assuming the difference here between the consumer discretionary and the consumer staples sector. And consumer discretionary is more like cars, luxury goods, leisure products. When you're talking about, food stocks, beverage stocks, personal care items, household goods, those all fall under consumer staples. So yes, sorry. Sorry. Yeah, McCormick is definitely a consumer staple. And one thing I wanted to point out, if you're ever curious as to what market segment a company falls into. Now, I use Yahoo Finance, but when I type in the ticker of the company and it brings up, kind of a summary of who the company is and what they do, there's also a spot where it tells you that it's a packaged goods company and that it is a consumer. It says consumer defensive. But in this case, yeah, definitely a consumer staple.
Okay, let's see. We had a question from Ed 47 minutes ago. Axon's not one I follow as closely. I mean, I know that they're the maker of Taser. Duolingo, are these two stocks you keep buying even though they are some of the more overvalued stocks? I don't personally own either of these. Duolingo's one I've been more intrigued by, particularly in the last year. I think that that's a really interesting business in the education tech space, and it's also a business that has been growing at a really impressive rate, and doing so very, very profitably. Even though shares haven't really performed particularly well this year, the stock is up about 50% still over the last year. I think that the thing that has also really impressed me about the business, as I've seen in past comments from management, is that so much of their growth is organic growth. While they obviously do pay for advertising, a lot of the users that come to their platform, they obtain organically. And that's something that saves a lot of costs for the business. And is also, I think, really goes to show the stickiness of the value proposition that they offer. For example, back in 2023, they had said that 80% of their users were acquired organically. Maybe they followed us on social media, they say, or we heard about us from a friend. And we maintain this organic growth by building the best product we can and giving it away for free. They make a lot of their money through ad revenue through their free tier, but they also have a paid subscription option for users who want to opt out of that level. And that is an area of their business that has been growing. They had about 9.5 million paid subscribers at the end of 2024. That was a 43% year over year uptick, even though their monthly active users are about 117 million. That's really a small fraction of their overall user base that they have penetrated so far. And they have a significant, I think, room to run there. And also a profitable business. I mean, they went from 14 million in net income in Q4, 89 million in the 12 months ended at the end of December. That was a huge increase from 1 year ago. So I don't know, this is a business I like. I found it more intriguing in the last year or so. I think their valuation is a bit steep, partly because they are more newly profitable. It's a little bit funky often in those first a couple years of consistent profitability. It's an interesting business. I think it's one that is a standout example in the space that it's operating in, of growing rapidly and not sacrificing profitability for doing that.
Yeah, and I can address Axon just a little bit here. We're down to our last minute or two. Axon is a company that provides not only tasers to law enforcement, but body cameras and the cloud storage to aggregate all of that from their body cameras. Recently the stock has taken a hit primarily because Axon ended its partnership with Flock Safety, which was a company that they had partnered with for their automatic license plate reader technology. And there were some, there was kind of a public back and forth between the two companies' CEOs. I think they will eventually resolve this. It will come to their, it's to their mutual benefit to do that. As far as, valuation goes, right now Axon is trading near its 3-year average PE ratio, which is in the triple digits. I think their average is like 115, 116, and it's currently trading around 120. So yes, this is definitely a high multiple stock. Right now, they're trading for about 98 times forward earnings. So while we cannot give personalized investing advice, if this is one that investors are interested in owning, they should be prepared for the volatility, which will definitely come with owning a stock with this high of a valuation.
Thanks for that, Danny. And with that, we are at time. The hour flew by quickly. I know up next we have Jose and Tim coming in for the next hour here on Full 24. Danny, it's always so fun to do these earnings hours with you.
And with you as well. And viewers, you're in for a treat, man. You're getting a double dose of tech know-how coming from Jose and Tim.
Awesome.
All right.
Thanks, guys.
Come on, guys.
Great. Thanks, Danny. Thanks, Rachel. Much appreciated. Welcome to another hour of Fool 24. Fools, AI plus Semiconductors hour. I'm your host, Tim Beyers. With me, Jose Najarro, as always. Jose, how you feeling, man? Hopefully you're healthy, you're good. You haven't gotten infected with more stuff from your little one?
No, luckily not. But we were just away during the weekend. Hopefully, we didn't catch anything in the plane. So having my fingers crossed.
Okay, very good. We have a packed hour of stories. We have a lot of things we can cover. 4 in particular. So here's the running order I've got. The Alibaba chairman declares maybe an AI building bubble. DeepSeek has a big model functional on a desktop system. I found that kind of interesting. SoftBank to acquire Ampere, which is a company you may or may not know, fools. And then possibly the some changes or the elimination of the AI diffusion rule. We'll see about that. I have some skepticism about that, but there are reports on it. And then there's a couple other things we need to get to. But let's start with the Alibaba chairman here, Joe Tsai. Jose, I talked about this a little bit on the morning show, but I'm just gonna say again, this is quoting from what Tsai said, and this was at an investor conference in Hong Kong. It's the HSBC conference out in Hong Kong, and said, I start to see the beginnings of some kind of bubble. And his issue, I want your take on this, Jose. His issue is that we're seeing a lot of build out of AI themed data centers, but being built on spec, meaning that they're being built before the business is there. You're going to build them up, and there are no uptake agreements there. They could be built and they could be unused for a significant period of time. Do you think he's got an argument?
I think there is an argument there, Tim. I think there are certain data centers, and we're seeing a mass growth in data center players, where you're seeing a lot of neo cloud solutions coming up just because the demand is high. So, if I think in the next 5 years, 5 to 10 years, the amount of neo cloud data center providers that we have right now probably won't all make it in the next 5 to 10 years.
Yeah.
And just like anything, I think just like any emerging technology, you have when something looks pretty good, you see a lot of competition, and within the time frame, that competition starts to dwindle down. And while the market opportunity is still as big, or the total addressable market is still huge, it's only taken by a selective few, and I think that's what's going to happen, Tim. So while I think some of these data centers or these data center players are gonna lose out, I think the capacity need is still somewhat gonna be there.
Yeah. Yeah, I think that's probably right. There is it's a mixed bag. I think he's probably right in that the initial build out, it is getting ahead of itself. And there may be some shakeout here. So I think he raises a good point here. What's interesting about this, Jose, and this is something that Bloomberg goes on to mention, is that so Alibaba, and there you can't say that this is apples to apples in terms of comparison, but Alibaba has about a $52 billion commitment over the next 3 years, 52 billion. So bearing in mind, there is a big cost difference between building out in mainland China, in and around Southeast Asia. There's a real cost difference there. So $52 billion goes a long way. But it's not like their competitors aren't building in same areas of the world. And their competitors, all the big tech names, Amazon, Alphabet, Meta, they are talking about 100 billion, 75 billion, 65 billion, like big numbers in a single year. So orders of magnitude difference. Does that mean that they are making, commitments that are bigger? I think it's not easy to make an apples to apples comparison here, because you could be talking about data centers that are on US shores. You could be talking about data centers in Europe. You could be like the cost profiles could be really different. So we need to bear that in mind. Having said that, Jose, the point is not lost on me. You do have big tech providers that are probably, even though there is no apples to apples, they are probably outspending Alibaba on at least an order of like 3 to 1 on an annualized basis. That's probably right. Even with the cost differences.
Yeah, I'm not. I don't follow Alibaba too much, Tim, to really, but I know that one of the big expenses for all these other data center players are also just because they need a lot of internal GPUs for internal solutions. I don't know. I've seen Alibaba kind of create AI models as well. I forget the actual names of them, so I'm pretty sure they have it.
But I think they call it's either Quen or Quan that they use for their internal AI model, and it has been successful. I think it's fair to say it has been.
Yeah, I agree, Tim. Yeah, I've seen great results on that one, and at least great discussions on it. But also these other three players have just huge market share. I think Oracle is another kind of big cloud provider, Tim, or cloud infrastructure player. Oracle, ticker ORCL, and I think their capital expenditure for this past year was about $17 billion. So if you kind of multiply that one by 3, you're getting closer to maybe that Alibaba expense rate on kind of a 3-year basis of that 53 billion. So I guess it depends. Again, you mentioned it's very hard because to compare them, because it's not apples to apples based on locations. Also, it could be depending on market share, on internal usage. But looking at Oracle, who has their OCI platform, and them doing about 17 billion, so it kind of gives me around that same type of expenses that Alibaba is looking into.
Yeah, so that I'm glad you mentioned Oracle, because that's an example of a company that is, you could argue this. I don't know that we could say this unequivocally, but that is a company that's not spending at the same level at its big tech peers, but they're not hurting for business. In fact, the Oracle platform is being embedded in lots of other. I mean, they're getting business. Oracle is getting business, and they are not investing at the same scale. So I think that's a good point of comparison there. Okay, let's move on and talk about the DeepSeek news. And this was fascinating. I want to show something here, and I think hopefully when you see this, it's going to make some sense. I'm gonna make my screen. Hopefully, let me know when you can. Okay, so this is from Twitter, and this is a DeepSeek model, and it's 30 seconds here, and it's just running. And what it's showing is that it is running. This is on a Mac. This is on like a high powered but desktop Mac, and running the full DeepSeek model at pace here, and about 20 tokens. I think it may be 20 tokens per second, if I have that correctly here. It's pretty impressive what they were able to do here. All right, stop my screen share here. What I'm finding is that I just think this is super interesting that they run at just about 20 tokens per second, and this is on a 512 gigabyte M3 Ultra Mac with the Ultra M3 Ultra. I mean, it's not necessarily consumer hardware, but contrast a $9,500 desktop Mac with the kind of equipment, just the CapEx we were just talking about there, Jose, in terms of a massive data center to run massive models that are, require a huge amount of memory and horsepower. And now we've got, set aside just for a second, whatever you think about DeepSeek and whether or not it's a Chinese op, and that it may not be as cheap as DeepSeek says it is. I grant all of those things are legitimate questions, but the fact that we have an AI researcher going on and showing their work on Twitter, did they fake it? I don't know, but I think they're going to get called out if they did. And this is one of those things where it just raises significant questions for me here, because this is according to DeepSeek. So again, we have to take them at their own, words here. And there are going to be tests of this, and already there are tests happening. This is a 685 billion parameter model. That is very big. That is a very significant model. This is DeepSeek V3. The benchmarks on this is that it has a huge jump in all tests. And according to at least a couple on here, it is now the best non-reasoning model. Okay, let's assume let's not take that as gospel, but let's assume it's possible. Here's my problem with this, Jose, and it's not a bad problem. I have some real admiration for what DeepSeek is doing here. I'm going to leave all of the questions that are about DeepSeek, their motives and their cost profile unanswered, because I do think they're legit questions. But, and this is a big deal, this is an open source model. The amount of money that they are asking customers to pay in order to use their most advanced models is zero. The amount of licensing fees that they are asking others to build on top of or sort of fork off of the DeepSeek model is zero, at least at this moment. That is immensely disruptive. Your thoughts on this, Jose?
I mean, I think when you have some form of bottleneck, innovation ends up winning. And DeepSeek, we've heard that because of restrictions, they can't really scale out the platform like they really want to, because they just can't build that type of infrastructure. So it does seem like they're pushing more to kind of creating models that they can kind of create and kind of use more in local AI. I'm not too sure, though, how Tim, maybe you might be able, how different these are based on some of these other models that you can kind of run locally. Obviously, one of the big things is this is a super huge model of 600 billion plus parameters.
Yeah.
But we do have kind of some Llama models that you're able to run on your laptop or most people don't pay for GPT for OpenAI solutions for those that are kind of in the AI hobbyist or any of these other AI solutions, because you can find a lot of these local models that you can run on an NVIDIA RTX, on an AMD mid-tier or top of the tier GPU. So I would want to see what's the difference here between some of them and how wide is that margin from some of those other large language models.
I think so. To answer that in a way that is probably going to be unsatisfying, but I think you've highlighted the point that I'm trying to make, which is this. I don't know how you are in the business of being a large language model provider and trying to charge real money for it, because you just made an important point. I do think that DeepSeek, I don't know that there's still work to be done. I can't tell you. I know what's being said, that this is a model that is outperforming now. For the moment, it is outperforming. It's outperforming localized llama models. Is that true? I'll wait for the researchers to tell me whether or not that's true. In my mind, though, Jose, that does not matter. That does not matter. What matters is that you have Llama, now you have DeepSeek, and these are fully open sourced, forkable, customizable models that are going to run on everyday equipment. And we're going to scale up the capabilities of these free models as we go. So now we're at 685 billion parameters. That's an extraordinary large and capable model, presumably. Again, there are questions I don't have the answers to, but I'll tell you that looks very impressive to me. And if it's running the way that they are saying it runs, then it's going to be comparable, at least, to Llama. But this feels like a massive problem for OpenAI. It also feels like a massive problem, at least in the short term, for NVIDIA, because NVIDIA does require, again, I'm making an argument here. I would love to be proven wrong. Jensen Huang needs you to believe that you are going to make money. You're going to make real money, big money, investing in AI models and AI hardware, particularly his AI hardware. That's he's making an ROI argument. So my counter to that, if you could call it that, and I'm not sure it's a good counter, Jose, is that where's that money going to come from when the model is free? And if I can run most of this on, or I can have good enough hardware and I can get good enough results and I can pay nothing for it. That is a problem I would like to hear addressed from an NVIDIA perspective.
So, Tim, where I would think here is these types of models are going to just be trained on just kind of some open source data, right? So let's say you are in an Adobe or some sort of this, or some player who has that data. You really can't do it on these solutions because, so I think first, as a user, to be able to run these models locally, you're going to be using a lot of kind of like your GPU. So you got to see what's the trade-off and how efficiency turns off. It's if I'm running these models on the back end, am I going to be able to be running my EDA software or whatever software? Am I going to be able to just be using my computer as normal? Or is the GPU capacity that's being used to run these models, which we're thinking, we saw that one was just thinking back and forth. It took about 58 seconds, I think they mentioned, for the complete thinking process. How much of my GPU, how much of my processing power is going to be there that is going to eliminate my ability to use the rest of my computer? Do I have to wait for that thinking to happen before I go there? And then this types of models like these, they wouldn't have kind of like that proprietary data from, let's say if you're Adobe and you have kind of all these AI images, these open source solutions won't have that. And to have, let's say your customer have to download a different AI model and then application and somehow link it together, I think seems almost impossible to do, where the easiest way is to kind of integrate that large language model into your product or design, with being Adobe, being your Microsoft Copilot. It's integrated already into that software solution. And then that software solution is going to be doing all the back-end computation in some form of data center market. Because not everyone's going to be able to run even $1,000 laptop is still pretty expensive. So I think these large language models right now are really good use cases for comparing maybe against ChatGPT's model. But when you already have kind of an integrated solution into a specific software, being your Cadence, your Adobe, or whoever, I don't think this is a way that you can enter that. I can't see that bridge of creating that AI solution into that software solution. And for that software tool to be able to have AI, it needs to be running on your server, on your data center place, and to be able to handle it correctly.
So okay, let me make sure I'm hearing you correctly. So there's a bifurcation here. There's the front end consumer portal, ChatGPT, DeepSeek, and so forth, open source Llama, and so forth. And then you have the embedded AIs in enterprise software. Okay. Is there anything in your mind that prevents DeepSeek from getting embedded in enterprise software? You think that's just not feasible at the moment?
I think, first it would just be a privacy thing, but I think all these players, what you're going to end up seeing is they're still going to enter the embedded market, and whoever is like Adobe and all these software, I don't think they're going to design their own large language model. They're going to use whichever is the cheapest to kind of create their
100%.
Adobe LLM. All right. They're going to retrain these models, which is a lot cheaper, with their own data. But I think the ability to be able to run that is, even though it might be able to run on the consumer space, just like you can run any type of software in the consumer world, in most laptops, most of the time you end up running them in the cloud. And I think that's what's going to end up happening a lot with these AI solutions, because it's going to be it's going to be very straining on your product. And let's say you have a laptop. If you have a laptop and you don't plug it in and you're running it nonstop because you're just going to be running these AI solutions, how quickly is that laptop going to die? How quickly is that phone going to die? So there's going to be some form of trade-off ratio where there's going to be some things that you can be able to use locally because it's not going to affect your battery power. It's not going to affect the consumer experience with that equipment. But then there's going to be other things that are going to be needed to always be constantly running on the data center space, because it's just, if they were running on locally, it would just make it a bad experience for the consumer.
Yeah, I could see that. I will make a prediction though, and not in the bold prediction show, because I guess in the bold prediction show you do stock movement. I'm not making a prediction in that sense. What I am saying though is that I tend to mostly agree with what you're arguing there. Having said that, modern software development essentially works like this. I pull all of the available open source software libraries that are available to me, and that does the first 70% of my software development. I've pulled all those libraries, things that are common. What you just said, I think, is important. I think the AI industry moves the same way. I will pull my common AI model, AI tooling that is open source, free, embeddable, customizable, and I can train it on my data. I don't know that that's all going to be in the data center. I can see that a fair amount of it could be, but some of it won't be. And the thing I think where we're going to diverge is, I think you're going to have a lot of companies, and particularly a lot of data center providers, they're going to be perfectly happy to quite literally burn up commodity hardware because it's cheap, and they can get it for really cheap. And they could put in a very cheap server with a bunch of blades in it, and it's got a 6-month shelf life, and they won't care because it's really cheap to run it. So I think that is probably something we'll see more of. But yeah, no, I think that's fair. A bifurcated market here. But I think the reason I thought this was interesting is DeepSeek V3 came out. It got downloaded a gazillion times. It's already really popular on Hugging Face, and you already have developers that are looking like to fork it and do things with it. And that's just a sign that there's going to be a lot more open source development coming in this space. I'm not trying to make a statement for or against DeepSeek. I think what I'm saying is that the economics of this space, because they're moving so rapidly to free, it's just changing. That feels like very bad news for OpenAI, by the way. But let's move on to the next story here that I think is interesting, which is back to some hardware, and I think this is one that we are both, I think, relatively interested in here. SoftBank acquiring Ampere. What do you think about that?
I mean, SoftBank has been. SoftBank partnering up with that Stargate project, and having. So I think this complements two things really well. First, it complements the Stargate project, which supposedly is expected to be a massive $500 billion investing in U.S. data centers. There's a lot of discussions discussing if this is $500 billion on kind of capital expenditure or $500 billion within the next 5 years, which are both two different things. It doesn't necessarily mean it's going to be $500 billion in capital expenditure. But if they're building all these data center solutions, could this just be an easier way to get a nice CPU at a cheaper price? If they know they're going to be building, because Ampere, right? It's a hardware player that provides ARM-based CPUs. These ARM-based CPUs are a lot of cloud service providers actually buy them. I think Amazon buys some, Oracle buys some. I think almost all the big cloud service providers buy this from these CPUs from Ampere.
Yep.
Now, if you're building a massive $500 billion supercomputers, that can obviously benefit if you're able to get it at a cheaper price. SoftBank also owns ARM. I wonder if somehow they're going to try to integrate these together to maybe even make a more complete solution. ARM kind of gives you the kind of like that ARM brain behind it, but they also have kind of like I think it's called CSS, complete subsystem solution or something like that, where they give you almost like 80% of how to build the chip. They give you all that IP. So it makes it easier if you're trying to design your own CPU, where you don't have to start from scratch. You can start at the 80% mark, and then you just kind of add your own custom logic solutions to it to kind of make it your own. I wonder if this acquisition is to somehow partner with ARM and make it where now, instead of starting at the 80% market, you can start at the 95% market and be able to charge a premium to that solution, because now you're saving that consumer more time in building some of these CPUs. So I'd like it. I didn't think it was that expensive either. I think it was like $6 billion.
$6.5 billion,
yeah. So, I mean, based on where the semiconductor market is right now, it doesn't seem like it was that crazy expensive. And I can see the synergies with SoftBank and some of the other companies that are under their wing of how maybe it can help them out in the long term of thing, depending on how those synergies work.
I mean, I think it's destined for a spinoff to an independent public company within the next 3 to 5 years. I think that is absolutely coming. I think about it. I don't disagree with anything you said there, but I think the motivation is a little bit different. ARM has been talking about now not moving away from, but in addition to selling designs and IP, also selling their own chipsets. ARM is going to do that now. They're going to make their own high performance chipsets. I think that's super interesting. I think that's Ampere. Ampere is one of those that is a well-known and well understood now set of high performance chipsets based on the ARM architecture. ARM wants its own. They want to be in this business. And so I think this is the precursor to seeing more of this. I think this is going to accelerate the introduction of ARM getting its own chipsets here. And I think SoftBank is very interested in seeing, if there aren't enough, ARM platforms on the market, they will make more ARM platforms for the market, because this is what they want to do. They want SoftBank as you mentioned this, they don't own all of ARM, but they own the vast majority of ARM. And I think it's like 90%. It's not really close. They own the vast majority of ARM. So what they really want is more ARM chipsets in data centers. They want more high performance compute ARM chipsets out in the world. They want them in data centers. They want them in enterprise environments. They want more of this. Ampere is a player in this, so it makes sense for them to own it. It makes sense for ARM to build more like either a companion chipset or something else that fits in and around Ampere. They want to make this something that is much more common, and ARM has an advantage here, one that is more interesting. They have a really good power signature. Just in general, the ARM platform has a really good power signature, which is very good for these high performance environments and high performance data centers. So I think that's part of the thinking here. We'll see, how well this goes. And again, more backing into this market. That's the sort of thing that encourages developers to say, okay, I see what you're doing here, and you need more software libraries. If you want to get ARM more embedded in data centers and in large scale AI and enterprise compute, more libraries that make ARM more functional is what you need. So the software build out of ARM, I think, is well on its way. We've got it now. We just need it in more places, and we need more functional libraries for ARM. I think that is absolutely coming. So SoftBank has a real incentive to build out the ARM ecosystem as much as it possibly can. So not too surprised to see this acquisition. Any other thoughts on this before we move on?
Yeah. So Tim, one of the biggest, it kind of reminds me a little bit of when I hear of ARM building its own chips and kind of competing with customers, it always leaves like a little bit of a bad taste in my mouth. It kind of reminds me a little bit of kind of like Intel focusing in the foundry business and kind of having external customers. And it's like, hey, how can you have companies like AMD or NVIDIA or some of these other players if you're already kind of building? Do you think with this kind of Ampere acquisition, where instead of ARM building its own AI, its own CPUs, ARM-based CPUs, and selling it as the ARM subsidiary or the ARM business entity, will it most likely maybe send some of its engineers to Ampere, and then Ampere be that part of the business where now you can safely say, hey, look, ARM is not competing against our customers. It's more just Ampere, who is already in this space, selling these CPUs, but we're just kind of helping them out with some transition of talent that really knows how to use kind of our ARM products.
So instead of building it internally and having their own chipsets, their ARM chipsets become the Ampere chipsets, and so it becomes the independent maker of, ARM has a big interest, but ARM is distinct from Ampere, and Ampere makes two. I mean, it could happen, and as the majority owner now of both, could SoftBank orchestrate a merger of equals or something like that, where Ampere folds in under as a business unit? Or is there just a more orchestrated relationship here where they do stay independent, but there is deep sharing of resources so that, I don't know. It would seem to me that if you were going to do a structure like that, Jose, you would have ARM essentially acquire Ampere, and it would have minority interest, like it would have a big investment on its balance sheet, and it wouldn't be the primary owner, but you'd see on the balance sheet like minority interest, and it would be getting, that minority interest contribution from Ampere. Maybe. We'll see. There's definitely there's a good argument for there to be deep cooperation between those two. ARM wants to see more chipsets in data centers, and Ampere is actually functionally building silicon to put in more data centers. So there is clearly an incentive for this to happen. I'm not too surprised by it though, and I think on balance, I more than most have absolutely given it to SoftBank in years past because I think they've been irresponsible. I don't think this is irresponsible. I think it's smart. I think it's probably the smartest thing they've done in a few years.
I believe I'm trying to do some research here, Tim. I think they also recently acquired another kind of AI accelerator company, GraphCore. Let me just Google GraphCore and SoftBank.
Well, while you're doing that, I'm going to talk to the other. Let me just quickly answer a question or two, and then we'll come to this. So this is a request that we have from Vion, maybe at the end of the hour. But yeah, you finished looking up here, and then you chime in. But this from Vion: Jose, your bullish thesis on Micron at current value versus the contrarian view of my contrarian view. Not for me today. We'll watch on the sidelines. So essentially, what Vion wants is for you to make the positive case for Micron, and what Vion is speaking to is, I'm not bearish on Micron, but the reason I said I wasn't interested yet is because it is still very much in a high commodity business, and right now I think the cycle is violent for Micron. But there's no doubt, and I made this point, there's no doubt in my mind that what it's doing right now is essential. And you and I talked in past shows about what Micron is doing with high bandwidth memory is absolutely vital, especially for AI. I'm not sure they're the only ones that are doing it. So what I want to know is, what's the durable advantage that Micron has, particularly from a technology perspective? I'm not against it. And I feel right now I'd be buying at the top of the cycle, and that would make me nervous. So that was kind of my argument there. But what do you got on the acquisition? And then if you want to answer the Vion's question, please go for it.
Yeah, so GraphCore joined SoftBank in July of 2024. So for about $600 million was the acquisition. And it was kind of it was a British AI chip maker, which focused on creating some form of AI, a form of AI GPUs, but within certain, not a direct competitor, wasn't just, but it was an AI chip maker. So it does seem like and 600 million, again, based on current terms right now, not the worst. Yeah.
Small potatoes for sure.
So now here, Tim, with the Micron thing is so right now, luckily, I want to say for Micron, we have still not seen, I agree that the memory market is a very cyclical space, heavily cyclical, heavily commoditized, especially on legacy products. Right now, on the bright side, we still haven't really seen a turnaround story in consumer tech. We still haven't really seen orders in the PC market, in the phone industry. So in the automotive market has been extremely weak for various years. So in those industries, I would say it's not impossible, but it's almost impossible to be in the top of those cycles if they're still kind of haven't turned around yet. We haven't seen kind of that PC refresh cycle or anything like that. Right now, there's this huge advancement in high bandwidth memory. For high bandwidth memory to continue, Micron needs to continue to innovate, because HBM itself is not a moat, in my opinion, or it's not something that prevents competition from stopping. Eventually, the previous generation of HBM is going to be commoditized. So HBM2 right now, I believe, is very commoditized. HBM3 is still not there, but it's getting closer to there. HBM3E, the one that's the most advanced, it's really much a two-player game right now. So for Micron, I think you need to have the appetite of the risk that Micron needs to continue to innovate into the next generation of HBM, the next generation being HBM4, next generation being HBM4E. because it reduces that competition. And when you reduce that competition, you are able to maybe fight a little bit better on margins. You don't have to worry too much about the pricing nonsense that happens in a competitive, in a commodity market. So first, you have to believe Micron is able to innovate in these next generations of HBM. If they don't, then it goes back to being pretty much a commodity company.
Yeah.
Luckily, Micron has given us those incentives, or has given us kind of colorful insight that they are moving really good. HBM3E 12 high stack is progressing really well, which is going to go in NVIDIA's Blackwell Ultra. They already mentioned that they're doing really well in the HBM4. So we're getting that color there. The other great thing is this is a market that is very, so you have to balance that supply and demand. The great thing with HBM is you have that trade-off ratio for, and HBM is just DRAM that goes through a special type of advanced packaging to make it HBM. Unfortunately, it's very hard to do this. That is a very trade-off ratio. It's almost a 4-to-1 ratio. So for every, let's say, just quick, for every 1 gig of HBM, you need to use 4 gigs of DRAM. Best way to kind of explain it on a top level overview. So if you're trying to create HBM, you're pretty much destroying that supply of DRAM. So you yourself are destroying the amount of supply that you have in this market of emerging technology, which can help that balancing off. And right now they're already pre-supply constrained in that DRAM space. And again, you still haven't seen the push from the PC market. You still haven't seen the push from the phone market. So you're already kind of supply constrained in DRAM because the trade-off ratio of HBM, what happens when those other markets start to pick up? Now you're going to have a very tight supply constraint industry. And as long as you don't go and overbuild many more capacity, so that's the other tricky thing. If you don't go and build over capacity, then you're going to have a really great cycle this time, in my opinion. But again, it's a lot of ifs and a lot of perfect execution. And that is almost not impossible, but it's definitely going to be pretty hard. But overall, I am bullish in Micron because it does seem like that trade-off ratio is going to help out at least that supply demand curve that we normally see in the memory space.
Fair enough. I mean, let's just share my screen really quickly here. I just want to show this in the background. So if you see down there, what I want to point out here, Jose, is you have, so this, for the 6-month period, roughly 7.2 billion in net cash provided by operating activities. This is Micron. But then right here, you're close to 7.3 billion in CapEx. So my argument would be, I don't think anything you said is, that all makes sense to me, that they are investing, that HBM is a significant opportunity, that it will be a higher margin opportunity because they are sacrificing some lower margin product to get to a higher margin product. All that makes sense to me. The thing that is hard for me to get my head around is, when does that CapEx investment period start to moderate such that Micron can harvest free cash flows? I don't know when that is. I have no idea, Jose. I just can't figure that part out.
Yeah, and especially, Tim, I agree with that point, especially if you need to continue to innovate with the next HBM solution. They probably are not going to build that same type of infrastructure, or they might just swap out equipments, which might make it a little bit cheaper. But if you're going to continue to innovate, you're definitely going to need to continue to spend on those capital expenditures.
Yeah, for sure. But it's great. That's a great point. So hopefully that helps Vion. All right, let's keep moving. I want to quickly address the AI diffusion rule. This is let's make this like 3 minutes because it's fairly simple. The AI diffusion rule says this primarily. It's a holdover from the Biden administration. It says, like, look, we don't want to ship AI equipment. We don't want to ship AI chips to countries that we are competing with in the AI market. We would like to be the AI superpower, and we do not want to give advanced AI equipment, particularly US made super advanced AI equipment, to adversaries or adversarial countries. We just don't want to do that. And so this is why, for example, we have the DeepSeek story where they did not use the most advanced NVIDIA chips. They use older generation NVIDIA chips and then built something that was more efficient. They're working with older equipment, limitations. And so the AI diffusion rule says, let's keep those limitations in place. Now there's an argument for, hey, maybe we should remove some of these restrictions. Maybe we should allow countries like Poland, for example, get their hands on more of the most advanced AI equipment, because maybe that would be very good for them. That would be good for industry in their country. That would be good for their national defense and so forth. It is very early in the stages of seeing whether or not these rules would be removed. But I think, Jose, the reason to pay attention to this is it would create, theoretically, at a time when we're talking about tariffs, we would suddenly be opening up global trade on some of our most valuable and important exports that we could possibly ship to any other country in the world. And that could be good for some of these companies that we've been following, NVIDIA in particular. What do you handicap the odds at the diffusion rule being either substantially modified or eliminated?
Eliminated, I don't think so. I think the AI diffusion rule as a whole on the top level overview is, like you mentioned, Tim, two major points. First, increase AI investments in the United States, which I think no matter which administration
this administration wants to do that. Yeah, for sure.
And the second big thing is reduce the ability for any adversary countries to get AI solutions, right? So I think on a top level approach, it's going to stay there. I think there could be some tweaks. In a quick AI diffusion, there are 3 tiers. There's tier 1, which are pretty much United States and like super or super close allies.
Our closest allies,
Yeah. Then there's tier 2 countries, which are maybe not the closest allies. And these countries, Tim, they can only have 7%. Each individual tier 2 country can only have 7% of capacity compared to the total capacity of what these data center players have. So let's say Microsoft has 100, let's just say 100 flops of power in United States. If you go to a country like, let's say maybe Malaysia, which I believe is in tier 2, they can only have 7 teraflops.
Yeah, 7% of that 100,
yeah.
Right.
Right. So, and then in these tier 2 countries, I think no matter how many countries there are, the total within this list is only about 20%. So, I think maybe those numbers might shift a little, where maybe you might see a higher increase there. But I still think the overall goal is going to be, if you want to invest international, you're still going to need to increase your capacity here in the United States. But I think the limit is going to change a little bit different. Maybe it might not be 7%, maybe it might be 10% per individual tier 2 country, and maybe it might not be 20%, maybe it might be 30%. I think those are where we're going to see some switches, if it was my best guess, Tim. But the overall top level of this AI diffusion law, I think past administration and this administration enjoy what it's expected to do.
Yeah, it's going to be a lot of lobbying. Going to be a lot of lobbying, fools. We'll see how this plays out, but it is something to watch because it will have an impact on what the global business for some of these companies can look like. NVIDIA in particular. Okay, couple of quickies, quick stories, then we'll take some questions here. Did you have a take on the OpenAI leadership changes, Jose? I mean, there were some of them, not a ton, but they were announced today. You know, the new chief research officer, that's Mark Chen, stepped apparently into an expanded role. So I guess he was already in this role to some degree. Brad Lightcap coming in as chief operating officer. So he'll run, day-to-day operations. And then we got a chief people officer in Julia Villagra. So all of these, I think, are existing members of the OpenAI team, I thought it was interesting that they made this announcement today, and I didn't see if there were any other announcements. What you sent to me was like hey, we're gonna have a thing at like 11 a.m. Eastern. I couldn't tell if it was anything other than this. Was there anything else?
Yeah, so I didn't follow that leadership update. That's new news to me, Tim. What I did see is OpenAI today announced more capabilities of their AI image generation.
Oh, the image generator. Okay,
Yeah,
got it.
so
Got it.
it became better, and this is because I right now for consumers, Tim, is becoming a pretty cool time for AI as Google and OpenAI are going back at it. I think Google a few days ago announced kind of this pretty cool AI image generation. Now OpenAI kind of we can also do this, so they're releasing it. Google today just announced, or DeepMind just announced a new form of AI thinking model. My best guess is within the next few days or within the next week, OpenAI is going to release a new AI model as these two giants are really going back and
Yeah,
forth.
they're going at it, isn't it?
Yeah, so this competition is great for consumers, and we're going to see who has the biggest trump card right now and who has the best AI model at the moment.
I mean, I will say I have been. This is something we had an internal meeting earlier, and our friend Seth Jason was making the point, and I took him up on it because I had not. I hadn't done any work, and Seth is constantly working with the newest models, and he said to all of us, he said, "I am impressed how much Google has done to improve their models." So I tried, at his urging, I tried today the Gemini deep research model. Pretty good. Pretty good. I have to say, I was impressed. So not surprisingly, Seth was right about that one. All right, keep moving. I agree with you that the competition is very good. I have to say something about this thing. No political statements here. I have a take on what happened. I am not going to share that because this is not a political show. But the signal, usage of signal for planning a bombing in Yemen, for national security planning, and then accidentally opening up that signal chat to a journalist who published some amount of description without revealing, state secrets. What happened, I think is there's a lot of chatter about that, but I think it highlights something super important. Cybersecurity as a market. This is one of the problems with investing in cybersecurity is the number one security issue. If this doesn't, there are many ways we could make this point because there's been so many of these issues in the past. But here it is again, Jose. Once again, what is the security issue? It's
People.
human beings. It's people. People are the problem when it comes to security. That is a fact. Whatever you think about this issue, and please keep it to yourself because this is not a political show, but this illustrates yet again that people are always the problem in cybersecurity. So I do think there's going to continue to be good cybersecurity stocks, but don't buy the argument that a piece of software or a good firewall can ever prevent bad judgment from overwhelming a secure system. Bad judgment will do it every single time. Having said that, still believe in CrowdStrike. So for what it's worth, but yeah, I just thought I'd mention that because it's a staggering illustration of how people can, no matter what else we innovate, people are always going to be the problem when it comes to security. Okay.
And that's like, Tim, right? When you have like scam callers or these phishing things, they're not trying to compromise the computer. They're trying to compromise the user. That's why when you kind of get these personal callers calling your phone, because they're trying to compromise you, which is way easier than to compromise a system. Yeah, the people, that's definitely a cybersecurity market there for that.
I know there was a company that I was very interested before it got taken private. It was acquired. Jose's company called KnowBe4, which did training, and I thought that is a part of the market. Like if we ever have another public company in cybersecurity that does really interesting and has good tools for things like penetration training, phishing training, spoofing training, all of this stuff that I think is super important for just training up a population to make you've got to make your personnel habits secure, and then your software layer, like your software layer is only going to be as good as the personal habits of the people who are attached to that software layer. That's just how it works. All right, we're going to hit some questions quickly. 5 minutes to go. Sir Lord Graf, been a couple of years since we chatted. Good to see you again, sir. Copilot is run on what AI? That is Azure. I assume you're talking about the Office apps. The Microsoft Copilot is embedded into all of those apps, and I think it's getting better. But as a category, copilots are becoming more and more useful and interesting, and they're becoming more widespread. So I would say watch out for those. Copilots are pretty interesting. I was talking with my old friend Tim White, former Fool Tim White, not that long ago, Jose, and he showed me what he's doing with Claude Code. Again, pretty good. Like, looks really good. That is a co-piloting app for like helping you write code. And it was Tim basically showing me how he was programming conceptually, knowing what to build, knowing what to say, but the actual code spit out and tested by Claude. Very interesting. So that's like a co-pilot instance that I think we're going to see more of that. Go ahead. Would you want to add?
I was just going to say, I think most Microsoft Copilots right now are run in some form of distilled version of OpenAI's large language model, which are run on Azure. But I don't know if he meant the actually AI model, but the AI model is some form of.
So you think they're running in GPT?
Yeah, so they're running some form of OpenAI model, and there are reports that Microsoft now is kind of looking into maybe not changing it, but have the options where the consumer will eventually be, hey, I want to run this Copilot, but I want to run the Copilot that runs on the back end of DeepSeek model, that runs on the back end of Llama model, or that runs on the back end of the default OpenAI model.
Got it. Okay. Well, that's okay. That's good to know. Foolish investor, what do I do with my gains in NVIDIA? Certain there will be more severe AI NVIDIA winter when data centers pull back. Just hang in through the very long term. We can't give you personalized advice here, but I think a lot of this depends on how big is your position. What else would you buy if you were selling some NVIDIA? I don't have an issue with you diversifying. Again, you got to do what fits you. But I think it's hard to time things like this, foolish investor. So 2 questions from me that I would ask you to ask yourself. How big is your position? If you sell some NVIDIA, what else would you invest the proceeds in? I think those can help you think about this a little bit more, because NVIDIA ain't going to be the only one. If there is a severe AI winner, they're not going to be the only one that gets hurt here. So it's not like NVIDIA is the one that's going to get, punched in, painful areas. And then I want to answer it because we've got 2 minutes left, and then maybe there's one more we can add, but super quick one on this. So Matt is asking, can you share with us the Rule Breakers team about Chegg? A surprise you didn't issue a sell recommendation today. Reason I didn't recommend a sell recommendation is because Chegg has, this is to Jose's point from earlier, if you're going to have embeddable AIs around useful data, then I don't. Matt, Chegg's data has value. It has value. Chegg's answers are verified and they have value. So it's been absolutely blitzed, but I don't think, like, it's not like there's still some cash there. You know, they are on the verge and they tend to be fairly close. If they can manage their expenses, they can still squeeze out cash flow and they can still do things like pay down debt at a discount. It's a business that's not doing well, but it's not a business that's about to die. And I'll tell you, what they've done, I don't know if you've seen this, Jose, but they've sued Google because Google essentially has modeled now what they do with Gemini as an answer engine. And if Chegg can prove that the answers that Gemini is providing are in some way sourced from Chegg data, which is, I think, part of the allegation here. I don't know this for sure, but I think that's part of the allegation. Then they might have a case, in which case, is it unreasonable to think that Google or somebody else wouldn't just buy all of that Chegg data? I think the answer is there's a decent chance of that. So I don't feel like selling it right now, Matt. I think that would just be given up too easily, even though I agree it's been compromised. Maybe we're at the top of the hour. Are you able to do 30 seconds on, do you see a challenge from the Manus to current single LLM based models? I don't know what this is, but from Foolist, do you have a thought on that quickly, Jose?
The only thing I know about this is it's kind of like an AI agent that's really coming up. I haven't really done research. It's another Chinese startup.
Okay.
So a Fullest, no real thought about this at the moment.
Yeah, maybe ask next week. We may have more to say about this next week. But that's it. Top of the hour. Let's get out of the way so we can make room for the next crew here. Thank you, as always, for being a part of Fool 24 and paying attention to our far too techie and deep tech rants here. Jose, good to see you again, sir. All right.
Yep, I had fun, Tim.
Very good. All right, we got Will, we got Danny. Let's kick it off and let you guys get to it. Fool on, everyone. We'll see you soon.
Fool on, guys.
Fool on. Hello and welcome to another hour of Fool 24. I'm Will Healy, joined by my co-host Danny Vena today. How are you, Danny?
I am doing just ducky.
All right, sounds good. Well,
I got nothing to complain about. Life is good.
Yes, good for me as well, especially since we're doing consumer and tech for the next hour. I think this is a topic where both of us can speak extensively. So I think you're going to start off with Shopify. So look forward to hearing about that. If you're just joining us, as usual, you can ask questions. That question platform again is Slido, which can be found at slido.com with the code being Fool24. And so, unless you have any further anything else to say, I'm going to hand it off to you to talk about Shopify.
Well, there was a story that emerged late last week that I thought was pretty fascinating, primarily because I've seen this playbook before and I recognized it as soon as I saw it. And so the announcement came from Shopify, and the company said that it was partnering with a company called Braze, which is a retail engagement service. Braze, essentially what it does is it helps e-commerce providers by providing immediate feedback on the customers that are on its platforms. It helps you personalize offerings to those customers. So, if somebody gets on your e-commerce site, they put something in the basket and then they leave as an example, you can contact them and say, hey, you left this in your basket. They can also offer personalized, offerings, coupons, specialized offers of other items on the site. And so when the announcement came out that Shopify and Braze had entered into a strategic partnership. And Braze offers like real-time engagement. So, they can offer merchants more conversions, higher retention, higher lifetime value. I saw this as almost a no-brainer for Shopify. But one of the things that I note is that, Braze, essentially what they do is they collect consumer data. So if they are integrated into your platform, they know who the consumers are, they know what, say, for instance, e-commerce shops they go to most often, they know what items they buy most often, they know what items they look at. And so it provides them user information that Shopify merchants can then use to engage better with their customers. I don't know if you have heard about this before, but let's take, for instance, Roku. You've heard of Roku before. Roku is a company that offers the most widely used streaming platform in North America. It's the most popular streaming service in Canada, in the US, in Mexico. It's one of the top platforms in Latin America and in Asia. And one of the things that Roku does is you give them voluntarily your email when you sign up, and then they collect data about you. They look at what programs that you watch, whether or not those be subscription services like Netflix or Disney or Paramount Plus, or if it's just their ad-supported channels. And they know which, for instance, advertisements that might be interesting to you. So they're gathering your data so that they can make more appropriate commercials for you, more appropriate advertising in front of you. You may have heard about that before with the Trade Desk. The Trade Desk has something called UID 2.0, user ID. And what the Trade Desk does is the Trade Desk partners with all the top ad agencies. It partners with a lot of services like Roku, and it exchanges data so that they can, again, make sure that the customers that are seeing these advertisements are the ones that are most likely to act on them. And so I thought it was really interesting that, Shopify has partnered with another company in this strategic partnership that is going to allow them to better leverage the data that they have by adding more data into it. And then their merchants then get another benefit from listing their platform on Shopify, in that now they get even more granular user data from the customers that use these platforms, and it's across all of the merchants that use them. So that's a lot of data, and I think it makes Shopify a bit more interesting.
Yeah, it's for a while now. Shopify has derived the majority of its revenue from merchant solutions. That's the part separate from the platform. So it's really, not only does it have a platform that's very customizable, very easy to use, even if you're not a programmer, very fast, but it's really built this extensive ecosystem. And this is just one more layer to that ecosystem. Frankly, I'm not sure how I would measure that as an investor. I don't know how much difference that's going to incrementally make to Shopify stock, but I do think it's definitely a positive. And I think this ecosystem they're building has given them a competitive advantage. I think that competitive advantage is slightly larger now thanks to this. So I'm very excited to see what's going to happen with this as a Shopify shareholder myself.
Yeah, it's certainly, I have always been intrigued by the fact that, Shopify has been able to attract and retain so many of these merchants, and some of them, have been around for a long time. And again, it's all about the data. To me, they make the vast majority of their money from the services they provide, but those services become all the more valuable if part of those services includes data that the merchants can use to be more successful. So that's why I thought this was pretty interesting.
And are you a Shopify? You're a Shopify shareholder too, correct?
Oh, I am a Shopify shareholder. In fact, Shopify, I haven't checked lately, but Shopify, I would say, is probably in my top 10 positions and might even be as high as one of my top 5. But I will take a look and I'll let you know here in a minute.
Yeah, as a week ago is actually my largest position, not by much, but actually as a month ago, I should say, because after it had that recent downdraft, that was no longer the case. But it has come back over the last few trading sessions somewhat. So yeah, I think that kind of went through a sort of a natural correction, or I guess it was technically a bear market since it was more than 20%, but it's had a natural pullback. It's going up again. Yeah, it is a highly valued stock still. Looking at the earnings multiples, it's trading at 70 times earnings, price to sales ratio of 16. Those are certainly not cheap. I've seen more expensive in stocks. I've seen Shopify be more expensive, but I think it's something. I don't know that it's high enough to discourage a lot of buying. I'd still recommend it here if I wasn't, or I'd still be buying here if I wasn't fully invested myself.
Yeah, I did just look, and it is my 5th largest position, primarily because I bought it years ago and have held it through, all the ups and downs. And my Shopify position is a 20 bagger.
Yeah. Oh wow. I'm more of a 3 to 4 bagger, but so I bought a little later, But I'm very very happy with my returns in Shopify. So I expect those will rise in the future.
And mind you, that's not because I'm particularly smart or anything. Primarily, it's because I bought Shopify. I held on to it. I never sold any of it for a long time, and that's kind of what happens with long-term investing in successful companies.
Yeah, as they say, time in the market beats timing the market. I bought mine. I bought my shares in 2022 during the bear market. I went in my lots. I got fairly close to the bottom. So yeah, I've been happy with my performance over that time. As for my stock today, I wanted to talk about Qualcomm. Qualcomm I see as a consumer tech stock that does not get a lot of respect. For those of you who don't know Qualcomm, they make the smartphone chipsets that power your iPhones or Samsung Galaxies or other smartphones. And they've long held a technical lead in this industry. They've holding it since before there were smartphones, really. And they've managed to hold it through a series of patents. They keep innovating. They're not the only smartphone chipset maker by any means, but they've been the top one. I think MediaTek, which is a Taiwan-based company, is also pretty prominent in this industry. A couple of things I've heard it lately. Bear with me. I'm trying to get my slide to pop up, and it doesn't. Oh, there it is. Okay. So, just looking at the business, it had been growing very rapidly during the 5G upgrade cycle earlier. And you can see the spike, the stock spiking, stock price spiking, particularly in 2021 and 2022. Amid that, that's kind of run its course. Revenue turned negative for a time, but now they're trying to push an AI-driven upgrade cycle, and thanks to that and investments in other segments. That's kind of come back. We're back to at least double-digit growth in terms of revenue and income. As you can see, most of the revenue still comes from handsets. They are increasingly pivoting into IoT and automotive. Especially you see that automotive growth year over year at 61%. So I think that's going to be huge in the future. They also license their technology that hasn't grown quite so fast lately, but it's still, approximately 10% of the revenue, maybe a little bit under. You look at the revenue by region. They don't publish this every quarter, but they published it late last year at the end of their fiscal year. China's still been the single biggest revenue source for Qualcomm. I think that's caused a lot of concern because one, the tenuous relations between the U.S. and China, and also the government said they couldn't sell the Huawei. I think that's weighed on the stock. In the U.S., where it's about a quarter of its revenue, Apple has been trying for years and years to fire Qualcomm, and it has henceforth not been successful. But now it looks like they might have finally gotten to a point where they can take the iPhone off of Qualcomm chips. So they're expecting by 2027 Apple will no longer be a Qualcomm client. So they pivoted into building a relationship, better relationships on the Android side, and all these other segments like IoT and automotive. They're going into PC chips as well. So, and then looking at the regional revenue, 20% is South Korea, 9% is the other regions of the world. But this has been a fairly solid company. As you can see, it may be a little frustrating with all the ups and downs, but it still is slightly beating the market. Despite that, its PE ratio is 17, which I think is extremely cheap for a semiconductor growth stock such as this. Now, I think some of the Huawei problems are weighing on it. I think some people are concerned about losing Apple as a client. Qualcomm claims it can make up that revenue and then some by pivoting it into these other things over the next few years. So we'll see. But I think just in spite of those problems, I think Qualcomm is a little bit undervalued at these levels. That I think at the very least it deserves to trade at a higher valuation. And I think if it could solve some of these issues and move past Apple moving on, I think this could be a strong stock over time. I own some shares. It hasn't grown quite as fast as I would like it to, but I'm still haven't given up yet.
Yeah, Qualcomm is one of those companies I could never wrap my mind around the future opportunity. There was a lot of irons in the fire, and just one I could never convince myself that it was that big of an opportunity. Solid business, steady if not that impressive growth, and it's probably, as you say, it's slightly ahead of the S&P 500 returns over the past, 5 or 6 years. I don't know. I want something with better returns than that. I'm just kind of selfish that way.
Yeah, I'd like to see better returns. I was expecting to, and it hasn't quite panned out. But I remain ever faithful. So we'll see if I'm right or wrong over time.
And it looks like we might have lost Will for a minute there. I think perhaps we'll just find a question to answer here while we wait for Will to come back. So Besties asked several hours ago whether or not ODFL, Old Dominion Freight Lines, is a good value or a value trap here? What are your expectations for the next 5 years? I am an Old Dominion Freight Lines shareholder, and over the past 6 months, we've kind of got two different things going on with ODFL. The first is obviously the macroeconomic backdrop. And we have seen recently, for instance, that FedEx has trimmed its guidance for the coming year. And we've seen, similar prognostications from some of the other, trucking companies or delivery companies. So I think that's part of it. But also over the past 6 months, ODFL has not kept pace with one of its rivals, XPO Logistics, ticker XPO. So I think there's a little work that needs to be done on the company level. I think ODFL has a really good track record over the past several years, but has frankly fumbled the ball a little bit over the past year or so. Now, I will say about ODFL what I've said about other companies. 1 or 2 bad quarters doesn't necessarily a trend make. And given the fact that they have a long history of doing what they do, I would say over the next 5 years, I expect Old Dominion Freight Lines to be a good performer, if not a solid or excellent performer. That is, of course, if they can execute, which they haven't been doing as well over the past 6 months, primarily because their less than truckload segment has not been doing that well. And hopefully we will see that pick up. Again, I don't have any information that's not, publicly available. And I think a lot of what we're seeing right now has to do with the macroeconomic headwinds. But also, I want to see them maybe gain a little ground against their rival XPO Logistics. And look, Will's back.
Yeah, sorry for the technical difficulties. The present and leave studio are buttons are right by each other, and I accidentally hit the leave studio trying to take down the previous slide. So apologies for the mistake.
You may be surprised to know that I did exactly the same thing the first time.
Yeah, I had that done to me a couple of weeks ago by somebody, so I think it's a common problem. So Pro Shop Guy had an interesting question. I guess it's directed to you, Danny. Can you convince Will that NVIDIA is actually undervalued on PE metrics after your bold prediction last night?
So what I want to do is I want to start with, let's pull up an NVIDIA chart because I want to show you, various metrics and what the Y chart looks like for NVIDIA. I'm just going to share my screen here for a moment. Let me go ahead and make a larger chart there because it's a lot easier to see. So what we're looking at here is over the past 10 years, NVIDIA has had an average price to earnings ratio of 60 on average. Now, right now, that price to earnings ratio is 41. And just on a side note, if you go down here to the very bottom, that little bit that you see in blue, that's the forward PE ratio of less than 27. So what we're seeing is a stock that is has a multiple that's much lower than its historical average over the past 10 years. But, investors generally what they want to know is, well, what have you done for me lately? So let's go from 10 years down to 5 years and see. And sure enough, over the past 5 years, NVIDIA's average price to earnings ratio has been 81. So right now its PE ratio is about half its 5-year average. If we go to 3 years, again, getting closer to now, oh, look, its average over the past 3 years has been 81. So it's about half its historical average. Now I'm gonna click on the 1 year just so that we can get a little perspective here. Even over the past year, its average PE ratio has been 58, and it's now 41. So just starting looking at that, we can see that NVIDIA, from a historical standpoint, is much cheaper than what it has been. Now, I'm also going to kind of look at the company's price to sales ratio and what it looks like, trailing 12-month price to sales ratio. Now, right now, that number is about 23. I'm going to throw some annotation in here just so that we can see, what it has been historically. And if you look at it on average, it's been about 17 on average price to sales over the past 10 years. Right now, it's about 23. If you click down to 5 years, again, the average is about 25, still down about 23 right now. You go to 3 years, price to sales ratio on average has been about 26, still 23. And you go to about 1 year, and we're looking at about 32 on average. So generally, what those charts tell us is, looking back over the past 1, 3, 5, and 10-year periods, NVIDIA stock is cheaper than it has been on average for a very long time. Now, what I want to do is take one other chart here. I'm going to go back to the company's PE ratios and look at what the cheapest is it has been. And over the past, I'm going to go to 10 years, and we can see that NVIDIA's, the cheapest the stock has been at all over the past 10 years was during the pre-pandemic period, when it was down to about 17. So we're not quite down to its lowest ever. And it actually hit that back in 2015 as well. So there's been 2 times where you could get NVIDIA stock cheaper than what you can get it right now. And you can see that this area right around 2022, we're actually right about just a little bit lower than what we were then. So for an investor, that if an investor is interested in investing in NVIDIA stock, there is a lot of data there that shows that from a historical value, NVIDIA is as cheap as it's been in a long time. It's cheaper than its average over the past 1, 3, 5, and 10-year periods. And for a stock that's never really been cheap, it's pretty darn cheap now. So I would say, Will, what are your thoughts on those charts and on NVIDIA's valuation in general?
Oh, I'm feeling a little bit better about NVIDIA now, to be quite honest. And I was never negative about NVIDIA in the long term. I just thought, the market tends to punish stocks with decelerating sales growth in a way that's not fair to NVIDIA, because there's no way you can maintain triple-digit sales growth over a long period of time. So it is decelerating. It's still pretty robust, though. There was one stat I was a little put off by. I was put off by the price to sales ratio. I think that's coming down now to where I'm not quite so pessimistic. But we look at the price to book value ratio. That's at 37. I have a bit better. I'm not quite so pessimistic about that, despite the fact that it's still high. I would be very surprised if NVIDIA stock fell below 100. I don't know that it has too much more downsides left, if it has any at all. But yeah, I feel a little bit better about it. I've always noticed that it was cheap from the PE standpoint, or at least not always cheap, but cheap in recent months. Yeah, I was still a bit leery about some of these other valuation metrics, but I'm starting to feel better about those now. I will say that. Danny, I think you're muted.
I think you're right. I think that one of the things that we have seen, and we've seen it repeatedly in this market, I've talked about it once or twice before, is the fact that, if you have a company that has high growth and a resulting high multiple, and then you see either decelerating growth, or the company misses what Wall Street's thinks its growth ought to be, you see these stocks get punished. And even though NVIDIA beat on the top line, on the bottom line, on their next quarter's outlook, everything that Wall Street was expecting, the stock's still down. So I think that what we're seeing is some contraction in the multiple, and I think that's normal and it's expected. And as NVIDIA shareholder, I'm not really concerned about it. I will say that I have been looking very seriously about potentially adding a trading position for NVIDIA. NVIDIA is my second largest holding, and third largest holding today. By a whisker. Mercado Libre is actually my second largest holding now, and NVIDIA is my third. And that's because of the investor sentiment that has been weighing on NVIDIA over the past few months. I think there are still some questions that are lingering because of DeepSeek. Investors are skittish now because they're afraid, well, what happens if somebody comes up with the way to make these AI models without having to use any of NVIDIA's high-end chips? I think that's the lingering question. Now, CEO Jensen Huang has come out and said, no, I think this is actually shows the value and shows that there are going to be, developments in AI coming, left and right. And this is going to increase the adoption of AI. And when you increase the adoption of AI, obviously you're going to need more of NVIDIA's chips. The same argument that was made about, the steam engine killing coal back at the turn of the century. And what actually happened was we saw an uptick in the adoption of steam engines because, and more use of coal. So I think that, NVIDIA certainly fits in that category. And it's the dark clouds that I can see through, using a quote from David Gardner. So I'm not concerned about that. And I certainly think NVIDIA has a bright future.
Yeah, and I would agree with that sentiment, especially in the medium and the long term. So you just brought up Mercado Libre. So I saw a question from Keith about 3 hours ago, touching on Mercado Libre. Based on very long-term expected terminal growth rates and high assumed terminal discount rates, what are your thoughts on Mercado Libre, symbol MELI, Uber, symbol UBER, and C Limited, symbol SE? Yeah, well, first of all, I would put Uber in a different category than Mercado Libre and C Limited because Mercado and C are, roughly the same types of businesses. There's a few differences. Yeah, Mercado Libre is not in gaming, for example, but whereas Uber is primarily a rideshare and a delivery company, so it's kind of in a different category. When it comes to terminal discount rates, I suppose you'd have to ask whose discount rate, because discount rates in the U.S. are going to be a bit different from the ones in, say, Latin America or Southeast Asia. Terminal growth rates is a good question. Of those, I probably like Mercado Libre best for terminal growth rate. The impulse to be conservative wants me to say that it's going to be 10 to 15% long term, but I'm kind of feeling like maybe it can beat that. I don't know, but at least for the next few years. Now, maybe beyond 5 years, it might come down beyond that. C Limited, its gaming sector has been a little bit more volatile. I've said recently I like C Limited a little bit better than Mercado Libre. Looking at the valuations, I'm starting to change my mind. Looking at the forward PE ratio, for example, Mercado Libre trades at a forward PE ratio of 47, whereas C is at about 35. And C has very strong e-commerce now that they've pivoted back to Southeast Asia, and they've always been strong in fintech. the gaming sector has been a little bit iffy. I think it's finally coming back though, but we'll see. Predicting several years out is a little bit harder. But I'm more bullish on the fintech and the e-commerce sectors longer term. Than I think gaming I'm bullish, but I think there might be a little bit more volatility there. Whereas Mercado Libre main segments, e-commerce, fintech, and logistics, I don't really see anything happening to those. So I'd probably, even though Mercado Libre is a little bit more expensive, I probably would now pick that over over C Limited. Although I own both. I actually own Uber as well. Like I said, Uber is a different type of business. I don't know if their terminal growth rate is going to be super high unless they succeed with autonomous. If they succeed with autonomous, maybe you're just, I think you're going to see that terminal growth rate go much higher. But I think it really depends on that, and I think it's too early to make a call on that one. So I'm going to reserve my judgment on Uber until I see more data.
I looked at that question and I don't do financial models in that way. I'm more of a story investor. That said, I think it's probably too early to know when or how far out from now it will be before Mercado Libre hits a terminal discount rate. Because if you look at their growth, the company is still expanding in many ways. Yeah. For example, their revenue growth in the most recent quarter on a foreign exchange neutral basis, and I'll explain that in a minute, was 96%. 96% revenue growth in local currencies. Now, the reason that I focus on the local currencies is because Mercado Libre doesn't do any business in the United States. Therefore, it has no reason to do currency translations from the 18 countries that it does business in Latin America to dollars, not in reality. Now, it does do that on paper because it trades on the U.S. stock market and because it's required to do so by the Securities and Exchange Commission. So anytime you have a strong dollar, which we have now and have had for some time, it's going to adversely affect what the company's results are when you are looking at it only in U.S. dollars. And sure enough, if you look at Mercado Libre's revenue growth, it was only up 37%. And you think, okay, well, that's fair, but it's not really a barn burner. But 96% in local currencies kind of puts a different slant on it. So trying to come up with a terminal discount rate right now, I think is kind of a fool's errand, small f. So I think for me, excuse me, with Mercado Libre, I think, for me, I just going to hang on to my shares and hang on for the ride, because I think we still have, at least a decade or more of accelerating on and off accelerating growth. And Mercado Libre is a company that is going to probably help fund my retirement and make sure that I don't eat cat food.
I think it might get you there. I'm looking at inflation rates across Mercado Libre's major markets. It's in the single digits still in both Brazil and Mexico. However, Argentina had a 67% inflation rate over the last year, and until recently it had been as high as 300%. So I think that could be skewing the numbers somewhat. But even if you take that out and measure it in U.S. dollars, 37% is still a very, very high growth rate.
Well, and one of the things to keep in mind about Mercado Libre is that they're a take rate business. So, for instance, if I was to buy something on Mercado Libre's platform, they get a percentage of each sale. If I use their Mercado Pago payment processing to pay for that, they get a piece of that payment. And they do that across their business. And that's how the company has insulated itself from these hyperinflation rates that you talk about. And in fact, if you go back and look over the past 2 decades, I've owned the stock since 2009. And some of the hyperinflation rates in Argentina during that time were actually much higher than what they are now. Argentina's hyperinflation rate is actually down over the course of the past 10 or 15 years. And if you look at Mercado Libre's performance through that period, it illustrates that hyperinflation in a period does not stop the company from executing at a high level.
I think it actually helps the company execute. Quite frankly, they see Mercado Libre seems to have a talent of taking an issue in Latin America and turning it into an advantage. It's done that with hyperinflation. It's done that with logistics. It did that with Mercado Pago when a lot of its customers didn't have any capability to buy online. So they've actually thrived by solving the region's problems, in my view.
Indeed.
So, moving on to the next question. Do you see anything you like? There's some I can take if you don't see anything immediately.
I see one from Kent. It was actually from this morning. But, when Kent asked, so what are the best retailers in your opinion? I think you're going to get a diverse opinion depending on who you ask. From my opinion, I think Amazon is one of the best retailers. They recently overtook Walmart as the largest retailer in terms of sales. I think that it's a very sticky platform. Amazon has encourages customers, particularly its Amazon Prime members. They have a vested interest in getting their money's worth. If you pay the annual fee to Amazon to be a Prime member, you're going to want to get your money's worth in terms of all of that free shipping that comes along with that. So that makes Amazon very sticky in terms of being the first place that their Prime members will go to look for a product that they may be searching for. I think another thing that is very another thing that's very sticky about Amazon is their subscribe and save offering. So if you have a product that you get every month without fail, and you want to just have it delivered without having to worry about going to the store and get it and having it sent, you can have any number of issues sent to you via Amazon Subscribe and Save. That's how we get our dog food. For a while there, I was having difficulty finding the large bags of large breed dog food for my daughter's dog. And we could find it on Amazon. And we could get it for the same price or statistically the same price every month. Now, I keep an eye on that because every once in a while, Amazon will raise a price or lower a price. But generally speaking, you're getting the same price every month or, within a narrow range for those products. Now, I did have an issue, and I'll make sure to, for full disclosure, we had an issue, I think it was probably a year and a half or so ago, where all of a sudden one of the products that we were getting regularly shot up in price. It was like, 15 or 20% higher than it had been historically. And I canceled that subscribe and save order. And I went back and I found a product from a competing merchant that was at the price near what I had been paying. And I resubscribed to it and haven't had an issue since then. So it's not necessarily a set it and forget it. You certainly want to keep an eye on it. But it does make Amazon's retail more sticky. And I think that's probably one of the reasons why that, and the, just general ease of e-commerce, that Amazon has been gradually and slowly but surely taking over some of Walmart's business. They've been growing more quickly. And I think this is something that one of the reasons why I think that Amazon is probably what I consider one of the world's best retailers.
Yeah, I would probably go with Amazon or Costco. I think something that Amazon that a lot of people overlook. I can't prove this because the financials are too murky. But I really think that the online sales segment of Amazon loses money, and they treat it as a loss leader, in my opinion, so they can sell more subscription services, more advertising, third party seller services, things like that. Also, the vast majority of Amazon's income comes from Amazon Web Services. So I think for that reason they're actually running a slight loss in the business. Now someday we might see the financials. Maybe I'm proven right and maybe I'm proven wrong, but I think that kind of gives them a competitive advantage that a Costco or a Walmart would not be able to enjoy. It's separate from that. I like Costco. I think they're more one of the more solid retailers. They don't grow quite as fast as Amazon. They don't have they don't have a cloud service that they can depend on if they want to cut their prices further. But I think Amazon or Costco rather has come up with a model that appeals to a wide swath in America, and it's one of the few that succeeds internationally. You might remember when Walmart and Home Depot and some other retailers tried to go international, and they could not succeed outside of Canada and Mexico. And a few like Target and Lowe's didn't even succeed in Canada. So Costco seemed to just breeze through that problem, as has Amazon, and I say maybe Walmart now that it's taking a more online approach with its international sales. But I think that's another one to look at. I do think the valuation on that is a little bit rich. We're in a very unusual situation where Costco is trading at a higher PE ratio than Amazon, which is something that I don't know if that's ever happened, to be quite honest with you, or if it has, it was a very, very long time ago. So those are probably the top two I would go with.
So I saw a question in the queue from Ed from about 17 minutes ago, and I kind of want to address it because I think the situation that Ed is referring to requires a little bit of context. So Ed says, if NVIDIA sales increase, but their margins contract, does the investor pay the price? And I think we have to take a step back and look at what has happened historically, because NVIDIA's margins are certainly lower than what they were in the recent past. But I think that that tends to ignore what happened before that. And so what I want to do is I want to bring up a chart for the past 10 years that shows what NVIDIA's margins look like. So if you bear with me for just a minute while I get this screen up. So here's the chart creator. And if you look at NVIDIA's margins, what we're talking about is the fact that in the first quarter of NVIDIA's fiscal 2025, the company achieved an all-time high gross margin of 78%, which is this part right here. And since then, it's ticked down twice. And, a lot of investors are saying, oh, well, NVIDIA's margins are dropping like a rock. Yeah, but let's look at what NVIDIA's margins have done, say, since this peak here that they had in early 2022. That was one of their highest rates in a long time. Excuse me. And yet what we're seeing now is this idea that NVIDIA's margins are slipping and the company is, and it's not that bad. It really isn't. It slipped 2 consecutive quarters from an all-time high that it shot up to. And one of the things that we're seeing is as NVIDIA has released its Blackwell processor, one of the things that happened is that we saw, because of the way that processor was released and because of the way that the way that processor was purchased, we saw a little bit of a decline in the margins. But honestly, I mean, if you look at that chart, that tells you everything that you need to know about NVIDIA's margins, which honestly are still near an all-time high. So no, I don't think the investor pays the price for NVIDIA's margins contracting because, yeah, they've contracted a little bit, but they're still near an all-time high.
They're still near an all-time high, but unfortunately, sometimes the market likes to punish companies because they're going the wrong direction. Objectively speaking, these are phenomenal numbers. Don't get me wrong, but sometimes the market will, at least in the short term, punish companies just because they're coming down. But this is, if there's any pain, I think this will be in the short term, in my opinion. Looking at other questions. Let's see, BLSH, I guess Blush, maybe. I apologies if I'm mispronouncing it. Asked Jim G one day ago. Find the relative valuation of Forian, symbol FORA, versus Reddit, symbol RDDT. Still applicable as a benchmark. Any thoughts on Forian's Q? Well, I looked up Forian. Unfortunately, it's a $66 million company. I'm not permitted to comment on companies that they're under 200 million. So unfortunately, we cannot answer that question unless somehow maybe the symbol was mistyped or something. So if that's the case, inform us. But as it stands, I cannot comment on that. As for Reddit, Reddit's only been trading for about a year, and it's been a fairly volatile growth stock in that time. During that time, I'm not really sure that you could really put a benchmark on it yet. It hasn't, companies you would put a benchmark on, tend to be more mature. This one has been all over the place in its trading history. It has come down in recent weeks, though. And looking at the valuation, let me pull that up. We're looking at a forward PE ratio of just 40. So, given that it was pushing 100 at the end of last year on the forward PE ratio. So the valuation has come down significantly since then. That's almost back down to where it was when it first started trading in March of last year. So it's looking a little bit more appealing. Same with the price to sales ratio. That's at about 15. That's a little bit higher than what it was in March of last year again, but it was 25 or a little bit north of 25 earlier this year. So I think the valuation picture on Reddit is improving dramatically. But again, I don't know that I put a benchmark on it per se. There's been a little bit too much volatility to really define it as high or low. I'm kind of speculating here by guessing that, but it looks cheap compared to where it was, certainly.
So we had a follow-up comment from Lovely Lily, who said, I agree with you, Danny. Amazon is my retail store. In the past few days, I've ordered 3 items. They certainly do encourage, repeat visits, particularly if you're an Amazon Prime member. And that's why, if I'm looking for something, Amazon is usually the first place that I will go. Now, in fairness to Walmart, if I'm looking for some consumer staples, I know that I'm going to get a better price on, say, paper towels and toilet paper. So, I might go to Walmart or, even order from Walmart for those items because I know they're going to be if not dramatically cheaper, at least enough cheaper that it is worth my time to take the few extra clicks to get those items from Walmart. And I do some shopping there. I also do some shopping at Target, depending on what I want. I know there are certain places, for instance, Target has the sandwich slice pickles that I want for my sandwiches, along with some other things. So, we do certain items at Target, certain items at Walmart. But to lovely Lily's point, the vast majority of our recurring shopping happens at Amazon.
Yeah, I'm pretty much the same. It's really Amazon or Costco for me. I'll like today's point. I'll go to a Walmart or a Target for onesie twosie type items, depending on what I need. But typically, I'm in one of those, or I'm in a regular grocery store. So, about 9 hours, Chuck Hulse had an interesting question I wanted to touch on because this stock hasn't been covered in a while. Chuck Hulse asked, a TV featured a 3D printed house in Texas. Wow. What is the status of 3D printing? I own some a DDD stock, and it's way back. It's way off its high from 2021, and that's true. DDD stock is 3D Systems Corp. It was a hot stock back in 2021 when a lot of investors were talking about 3D printing during the 2021 bull market. It kind of fell out of favor. I think at one point it was up to, I think it got north of $56 a share. Today, it's approximately $2.75 a share. That takes its market cap down to the $375 million range. So it's at this point, it's barely big enough that I can talk about it. The growth has just been stagnant or to slightly negative. They've been suffering fairly heavy losses. Just looking at its last quarter, revenue was down 9% yearly to $113 million. There was a $144 million asset impairment in fairness, so that was most of the $179 million loss for that quarter, but it was still a loss even if you take that out. It so happens they're going to report their earnings tomorrow after the bell, and the street is looking for $115 million in revenue, which is about where it was in the year ago quarter. And then they're looking for a loss of 11 cents per share, which is about what it was again in the same quarter 12 months ago. Some interesting things that might give it some speculative potential. It is partnering with Daimler to make 3D auto parts. They estimate that's a $2.2 billion market. Like I said, their quarterly revenue was just $113 million. So there's a potential they could significantly increase the revenue from a deal like that. They also sold their GeoMagic software portfolio and raised about $123 million from that. So they're not in bad shape in a cash position. $190 million in cash. Their long-term debt is $212 million versus $218 million in equity or book value rather. I think that's higher than I'd like to see it, but it's not a death blow by any means. I mean, it's possible that the stock could, find new sources of revenue and come back. But I see it as a speculative stock at best. I wouldn't put a lot of money into this stock if I'm going to buy it. I'm probably not going to buy it myself, but if I were, it would be a very tiny position. But anything's possible, so I can't really write it off completely.
So we have a question from Matt from a couple of hours ago that I thought maybe I would address. If Disney hasn't done long-term damage to its acquired assets, then why did they record a content impairment charge of $2.5 billion during fiscal 2023? So I went back and looked. Now, I haven't dug deep into this. So my numbers could be off. But what I'm seeing is that Disney took a $1.5 billion impairment charge in the June quarter of 2023. And when the company explained that, they said this was primarily due to the removal of certain content from Disney Plus and Hulu and a strategic review of its content strategy. Now, you remember back in fiscal 2023, basically Disney was creating content willy-nilly and basically throwing anything at the wall to see if it would stick. And I think they decided shortly after that that they would get more tax benefit from taking some of these shows off of the streaming service and taking the tax write-off than they would by using them to attract new customers. Now, keep in mind, Disney has very granular data on if a customer signs up and when they sign up and what they watch immediately when they get there. And so I think Disney found, for instance, I think Willow was one of the shows, and the one and only Ivan was one of the movies. And they took these, basically short-lived streaming service shows, and they took them off of the platform. Now, that's not to say that, there was, I would not say that that would be long-term damage to their acquired assets. I think that was a strategic decision that impacted a small number of streaming shows and streaming movies that were created just for Disney Plus and Hulu. And they were able to get much more to their bottom line by taking that action rather than leaving them on the site. And with that, we have reached the top of the hour. And I think you're going to be excited. I think we're going to be joined by Lou Whiteman and Rick Munarriz. And is this an hour of bold predictions coming up?
It's going to be real bold. By the way, though, guys,
that was a bold prediction, Danny. Well done.
Real quick, shout out to, I don't know if it was Adam or Bart, whoever it was, but we appeared right as Danny was saying our names. That's production, baby. That was well done.
Cool on, guys. I'm looking forward to it.
Thanks, gentlemen.
Thanks.
Rick, how you doing this evening?
I'm doing all right. I'm feeling like a prognosticator. Prognosticator? Yeah, that sounds weird saying a prognosticator, but yeah, I guess that's what we are today. So
yeah. Fools, it is 7 p.m. on the East Coast. We're starting to get dark. Things are getting crazy, and we are getting bold with our predictions. As always, but especially this hour, what we're scrolling at the bottom, this is for educational purposes only. We are sort of by design. We're saying stuff that we're giving our opinions, but we are sticking our necks out trying to make bold predictions. This is not personalized as financial advice. Please don't take it as such. With that, Rick's going to give some predictions. I'm going to give some predictions. We're going to critique them, and you are going to vote on them. So, fools, please get over to Slido. Fool24 is the keyword, and vote. Tell us we're right. Tell us we're wrong. Use some, creative language to tell us we're wrong. I'm always looking to learn new words, So, I don't know, Rick, with that, should we jump right in?
Yeah, let's do it. So, my first prediction, and again, this is a 3-year time horizon. So obviously I'm giving myself a lot of time for this to happen. But what my prediction is that Freshpet, ticker symbol FRPT, will be acquired in the next 3 years. So Freshpet, I think the name sort of says it all, but maybe you've seen some of the Freshpet ads. This is a seller of fresh, refrigerated, frozen, refrigerated pet food. So for dogs and cats, if you want to give your dog or cat premium food instead of just kibble, you can go many different ways. And one way is to get fresh food for your pet. And while Freshpet is not the only company doing Freshpet. Early on, several years ago, they did the very smart, brilliant tactical move. This is vision in play, where they said they approached supermarkets. It actually started with convenience stores and the Walmarts and the Target stores. Said, hey, do you mind if we put in a refrigerator? Just like your regular slotting fees you pay to get items in there. We'll put in a refrigerator branded with Freshpet, and then we'll just sell our food through there. And the retailer said, yeah, sure, it's a great deal for them. They get everything that they get in association with someone stocking their shelves, and more importantly for them, it's a win-win, because the retailer, whether it's a drugstore, even a convenience store or a supermarket, which is the more obvious place, not just pet supermarket that has many options, they can get their food there and get done. And so if you go shopping, hey, I'm going to pick up food for my pet. Right here is where it is. And the same thing is, especially with pet food, it's the kind of thing where once your pet is on a specific food, once you switch from, let's say, like, the regular cheap kibble, like the Alpo, not Alpo cans, but just like, the kibbles and bits and all the other dry dog food and dry cat food. Once you upgrade, it's hard to switch out. So once you switch to Fresh Pet and you see all these natural, foods that even the Fresh Pet employees actually eat. There are videos, go to the Fresh Pet, Google Fresh Pet employees eat their own dog food or something to that effect, and you will see it in action. It's shocking, but also encouraging that it's that safe for humans too. And so the company's done a lot of things right. And again, in this case, over the years, they've had about more than a decade of at least 20% revenue growth, but they've been hit hard this year. And the stock, I think, has been hit harder than the fundamentals. This is a stock that's down 42% so far this year. And yes, the reports, Nielsen, third party data retail tracking sales said, fresh pets are starting to slow. And sure enough, when they reported their fourth quarter results, they did say that revenue rose 22%. It had been 27%. It brought down 20. It was actually closer to 30% for the first 9 months of the year. Brought it down to 27% for the full 2024. And guidance, but the guidance isn't so bad. Guidance says 21 to 24% this year, and their guidance for 2027 is 1.8 billion, which translates into an annualized growth rate of 23% through 26 and 27. That part is good, and they also raised their margin guidance for 2027. So 3 years from now, 2.5 years from now, by the end of 2027, they expect to be not only growing at the same pace they're growing now, but it's actually generating more profit than they were initially expecting in the earlier guidance. The problem is, obviously, when you give a 3-year timeline, message of markets about the near-term guidelines, and they're seeing that right now you have Fresh Pet sort of in trouble with sales growth and a lot of other factors, impacting everything from margins and everything else that could weigh on them if sales start to slow. Now, I think that the Fresh Pet is one of the more attractive buyout candidates of these disruptive stocks that I follow, and I think that this is the kind of company that could be a win for a buyout. It could happen one of two ways. Either one company just sees, hey, you know what? This company has problems, but it's growing at the same 20% clip, which is faster than most food companies, much pet food companies. And it'd be attractive for them to buy for a company that is in the pet food market. And it'd also be attractive to just anyone that's, want to expand their product line, because obviously with pets, Fresh Pet, just a couple of years ago, coming out of the pandemic, they had this whole thing where, hey, we're doing so well, and we're afraid that we can't keep up with demand after all the pet adoptions happened post-pandemic. They pared back on their marketing spending just so that they can satisfy their existing customers. That's not the problem anymore, but they overbuilt. They built capacity to have enough capacity to really deal with the high demand, and now demand is clearly not growing as quickly as it was before. Obviously, 20+% growth is still great in my book, but this is the kind of thing where I think it's an attractive company trading at a great price, not necessarily cheap. It's still expensive. It's less expensive, but I think it's very attractive right now. If a company wanted to come in and buy a leader that's pretty much cornered the market in retail, there's no other supermarket or Target or Walmart or your drugstore, or convenience store, or even gas station is going to say, all right, let's just put in another fresh pet food fridge. And you obviously can't stock fresh pet food right next to human food, even though Fresh Pet's established. So I think I've rambled a lot, Lou, but my prediction is basically that I think someone will buy Fresh Pet out either now when it's low or when it just recovers and starts turning around and everyone says, oh, it's back on track, and hop in then. So right now, I just think that Fresh Pet is vulnerable for a buyout in the near term, but I do think that it's going to be it's going to hold up well for the next for the next 3 years. I think someone's going to come in and buy it either on the next step down or possibly on the way up.
So the poll is live now. Head over to Slido full 24 and get in on it. And I love the way Mike, I'm guessing this was you, that it's worded here. I agree that dogs and cats do not need fresh food. I love that wording because look, we're a bunch of old men. We can talk about how did animals ever survive in the 80s when they didn't get all this stuff. But I have learned it is foolish, lowercase f, to bet against what people will spend on their pets. And I say that very much as part of the problem. The thing is, though, we tend to be fatty about it, right? And what we do today might be when Fresh Pet could be a thing and then not. Next 3 years, take out this could go one of two ways. This could be, I mean, you kind of gave yourself basically upside and downside here. It could get a lot worse to the point where someone just says there's value in the assets, or it could get a lot better and people say, all right, they did it. Are you thinking that investors from here, are you going to be disappointed if it happens? Are you thinking that this suggests upside or just maybe the end of the run for them?
Again, I would be disappointed as a fresh pet investor for it to happen, because again, it's just like my Roku prediction earlier back in our second show, the second bull prediction show. I said Roku would get bought out in a couple of years. I don't want to see it. I don't want a 20-30% jump in something that'll have to wait a couple months to realize, rather than what I think I can, this company I think can continue to beat the market over the long haul. So no, I don't. If it's a bump, I'll take it and I'll find somewhere else to put my money. I don't want it to happen. I'm not wishing for this to happen. I just think it just makes sense. Sometimes a stock is at that point where it's sort of out of favor, but it's still attractive as a brand and attractive as a growth vehicle for someone else to buy it and take it, whether it's private equity or any of the other potential companies that are presently in this market and want, to gain some skin in this game. I think it's, I think it can happen, but I don't want it to happen. I'm just saying, I'm just predicting it'll happen.
And let's be honest, it's hard to be a standalone niche brand in a market that is dominated by big players. So kind of the safe harbor. Even Ben and Jerry's had to join Unilever at some point, which is kind of, I feel like there's kind of a thing here. So yeah, no, I think I'd probably vote that yes. And you're probably right, because this feels more like an interesting brand, an interesting product to me than it does a standalone thriving public company for the long term, even if it is a good product and even if it does have staying power. Yeah. All right. Have you voted?
Oh wait, I just had the first poll. Wait.
Yeah.
Second poll?
Yeah, get it in there.
Oh, I just did the. Oh, so wait, it's just the. I disagree. We love our pet food. We'll support fresh food. But,
yeah, that's it. So you have, right?
Okay.
All right.
Yeah.
Fools, we're counting down less than a minute. Get it in, and then we can give you the results. But yeah, no, I mean, so I got to be honest. Full disclosure, I feel like a terrible pet owner because we give our dog the Iams mini chunks. I don't know. I don't think I really want this stuff in my house, though, Rick. Can I say that? Because I may eat it.
Yeah.
All right. It looks like we are split right down the middle. Or no. I disagree. I disagree. Pulls it out at the end.
Yeah, I'm getting different responses. But instead of agree, it says I agree. The dogs and cats do not need fresh food, and I disagree. We love our pets and will support fresh food, but not necessarily whether it will be acquired.
Yeah. I think Pro Shop Guy is just being cute with it. I think it is.
But do you have to agree? If you agree it's going to be acquired, then it's saying that they do not need fresh food. So I don't know. It's a negative connotation to getting bought. But yeah. So
these are the existential questions.
Yes. Yes.
But yes. So I do think though 38% said that a deal will not happen. 31% said yes, and then the remainder said I need more information. So there we go. Yeah. All right. Are we moving on?
Yeah, let's move on. Yes.
All right.
What do you have? What do you think? What's your leadoff hitter here, Lou?
Let's talk airplanes for a second, because I've gotten a lot of questions in the last week after the Pentagon announced Boeing as the manufacturer of the next generation air dominance fighter, our basically next fighter jet. And I feel like that's been sort of beaten to death, and we're not going to go there because that's now happened. But one interesting and probably more speculative angle of this that I want to address is a lot of the announcement was talking about whether or not this airplane will be our last generation of crewed aircraft, because we are making that great progress with AI, with drones, with so much technology. And I do think they all talked about, what they're going to be doing, like this new plane will do in tandem, in unison with very, very high-tech drones, kind of not those little things you see today, but mini versions of the aircraft that can fire, that can disrupt. Think about how much safer it makes it for our pilots if for every one airplane with a crew in it, there's like 10 flying alongside of it to confuse the radar. So this is a thing. And there is a way to invest in that. A company called Kratos Defense and Security, KTOS. I think that they're going to be acquired in the next 18 months. And I think this announcement is part and parcel why. Okay, so who is Kratos? They are a tech-focused defense contractor that is increasingly focused on these unmanned aerial vehicles, or UAVs. They're not just these little backpack drones that we've seen used in Ukraine. These are the mini F-35s. Their Valkyrie has been flying for a few years. It's an impressive aircraft in and of itself. It is smart enough to react to what an F-35 is doing and plot its course based on what the other airplanes in the sky are doing. It's a really cool thing. Firepower, confused radars, all this stuff. So Kratos has had this under development for a long time. I think we're near an inflection point with this Pentagon announcement. I think that over the next couple of years, Boeing's got 5 years to put together this airplane. Probably not Boeing, but maybe this is how Lockheed Martin goes back into it. Maybe another contractor. Kratos has kind of hit that awkward middle ground where they're too small to be a prime contractor, but they're too big to be a startup. I think that they would fit nicely into someone's portfolio. Now, I'll say I don't know if this will be a big premium. The stock's up 85% of it in the past year, but basically we are only where we were back in 2021 when the Valkyrie first started testing and everyone was getting excited. The Pentagon is planning orders. This is not vaporware. This is a real company, and I think it would fit really, really well into a larger, more diversified defense contractor's portfolio. And I think it's finally we're nearing the end game for Kratos.
And this isn't based on, you're not factoring anything, like it's not like the political environment where it's maybe the defense contractors may want to, hey, it's time to, to start getting together to take advantage of the current situation or cost cuts that may happen. It's just a general, independent of what's happening politically. You think that it's still attractive bio candidate of how different it is and how cool it is.
Yeah, I think regardless of who's in the White House, the rules are after the Cold War, we consolidated probably way too much, and primes can't buy primes, period. But there's a lot of leeway for primes to buy smaller companies, especially with promising tech, because the Pentagon wants them in balance sheet. So, you always have, just like any other deals, you have M&A, depends on who's in power. But I think this can get done in this administration. I think if there was someone else in, they could probably get done too. This is par for the course. You see very, very few mid-tier defense contractors because you're either a nimble startup or you really, really need the capital resources. It's hard to be kind of stuck in the middle there.
Yeah, so the poll is open now. I don't know if you voted yet, Lou. I did.
Yeah, I'll get it in there. These are, and I can't emphasize enough, you should Google, not now, at 8 o'clock when we're done, you should Google the Kratos Valkyrie, because they look like real aircraft running around, and they can do some really amazing things. Like I say, feeding off of what the airplanes around it can do and kind of adjusting to that. It's a neat company. This is a long time coming. They've been at this for 20 years, and they actually have production going on in Oklahoma right now. So again, it's not vaporware. It's actually something that's coming.
Yeah, it sounds cool. About a minute ago, the poll looked just like the Mercedes-Benz hood ornament, but symbol. But right now, it's pretty split. It's pretty even between agree and disagree. I'm disagreeing with you here, Lou. I think 18 months. I think you went too close. And I know 3 years. I was giving myself a lot of time to be right or wrong. It's a very tight window that you gave it.
I did. I almost intentionally. And I agree with you. It's the timetable. I do believe. I've seen this story too many times with this size company. I do believe this is their fate. But I will concede to you that the timing of it is very much the question.
Yeah, and the crowd is shifting in your favor now. It's 44%. Agreeing, 33% not, and 22% just need more information. But a neat company. So
we don't get enough deals like this anymore. In part because of what happened after the Cold War, and that is the so-called peace dividend. We were spending less on defense, and we needed fewer companies, and now we're down to only one or two in most of these things, which kind of scares the Pentagon the other way. But like I say, these sorts of deals that are almost just funded R&D off of the private balance sheet, this is the kind of M&A the government really likes.
Yeah. So I guess, are we good to close the poll? I think you said it all. I voted, you voted.
Yep.
40-40, so that's even again. Oh, no.
No, wait. I am wrong.
Oh. Edge out with a photo finish. So
there you go. There you go. All right. I like that. I got to disagree.
Yeah, it's good. It's good to not always agree.
Mm-hmm.
Like Dueling Fools, a feature I introduced like 25, almost 30 years ago. And back then, it's good to not always agree with your fellow fools. And
When he was in kindergarten, fools.
yes, when I was in kindergarten, of
Yes.
course. Yes.
Yeah.
That's how gray beards happen. Yes, from kindergarten. But yes, thank you for the kindness, Lou. But yeah, so I again, I think it's a great story. The only reason I didn't was just the timeline. It just seemed like a little too tight, and a lot of things have to happen. I know when even if it was announced in the next 18 months, that's all I think would need to happen, because obviously it may close a long time. The larger,
That's
the
a fair
larger
point too.
But again,
Yeah.
I was just going by the announcement of an acquisition. That would be
Right.
enough to solidify that in your corner. But I still felt that was maybe a little too much. Too long.
You can't play radio with 3 years though, Rick. Yeah, just can't. All right. Get bolder now. Let's go. What do you got next?
All right. So this one's gonna seem it's technically I think it's the easiest of my predictions to make, but I figured I'd make it anyway. I made what some called a really lame Disney prediction the first time. I did this just saying that Disney would close over 100 a year. A year from where it was 2 weeks ago when I made the first predictions. This is that Disney will have the highest grossing movie of 2025, and I'm saying this only because right now, clearly sentiment is a little, kind of like concerned when it comes to Disney theatrically. This is a company that had a lot of bombs in 2023. Then in 2024, they just slumped. They got out of their slump. They wound up with the 3 highest grossing movies worldwide. In Inside Out 2, Moana, and Deadpool and Wolverine. Deadpool and Wolverine was second, Moana was third. So clearly dominated the box office, but off to a pretty disappointing start so far this year. Obviously, the big weekend story was Snow White. Snow White came out, and it was already a pretty controversial. It was more of a battleground release. There were some people unhappy with some of the ways that they took the subject matter, the casting decisions, and all these things. But at the end of the day, I think everyone sort of said, okay, it's not going to do really well like some of the other live action reboots. So they basically took the Snow White story from 1937 and decided 88 years later, put it with live actors, added a couple new songs. And the movie, it grossed just $43 million in U.S. ticket sales, $87 million worldwide, and that's opening weekend. And to frame this appropriately, that's not good. It's not good for a company a film that costs $250 million, and that's before the marketing costs that get tacked onto that to distribute the film worldwide. So Disney will probably take a charge on this film. I know the last hour ended with a question sort of on charges. Disney taking a charge. This is the kind of thing where it probably will have to do it in this case. But at the end of the day, and also back last month, Captain America: Brave New World, the latest installment in Captain America, is generating. It's 4 weeks in, but 4 weeks in, the last time when Captain America came out with a movie, which is back in 2016, Civil War, it wound up grossing $400 million. This one hasn't broken $200 million domestically, so it's going to be fall short. And rarely do sequels fall short unless a franchise is sort of struggling or a studio's just not making the right film. So you have those kind of negative things happening in Disney theatrically right now. But I'm looking ahead. And first of all, right now, even the way it is, even as bad as Snow White was, that's still in this country the second highest grossing opening weekend of 2025. That disappointing 43 million. Captain America was number one. But you get to the point where there are a lot of big movies being put out by other studios. You have another Mission Impossible movie. You have another Jurassic World movie. So you have a lot of big movies that are going to be put out by big studios. There's the second part of Wicked. Anybody that saw the first part of Wicked, and a lot of people did back in November and December of last year. Now the second part comes out this November. So there's a lot of competitive product out there. But Disney has a much stronger slate for the rest of their films coming out. They have 2 Marvel films, a Fantastic Four and Thunderbots. They have Lilo and Stitch, which is a live action reboot, just like what happened with Snow White. But this one, I think, is going to do a lot better. Disney has had pretty good luck lately with just taking their old classics and sort of dolling them up in some way. The Little Mermaid in 2023, as bad as that year was, that was one of their big wins. And recently, Mufasa, The Lion King, which had a terrible opening, wound up with more than almost 720 million worldwide. So I think the company's doing well with some of these properties. There's also a Freakier Friday, which is another Freaky Friday movie. And not that I think that any of these, there's another Pixar movie. There's a lot of things Disney's putting out this year. But the reason I think this is almost like a layup, it'd be a dunk, but I'm too short to dunk, so I'd probably miss that. But I'm going to call it a layup just because in this case, the movie that's coming out in December is Avatar, Fire and Ash. And just to put this in perspective, Avatar films, the first 2 Avatar movies, James Cameron Avatar films, and this is Avatar, the Na'vi, the sort of CGI rendered stuff, not the Avatar Airbender stuff, which is different. This is the popular movies. 2 of the 3 highest grossing movies of all time worldwide are the first 2 Avatar movies. So this is a 3rd installment. It's a given. It's going to probably top $2 billion. The last movie that did this was the second Avatar film that came out a couple years ago. So I think I can pretty confidently say that Disney will have the top box office film of this year. And that's my prediction, though I'd like to think that maybe they might do a little better. They might get the first 2. And again, I don't know if it's going to be Lilo and Stitch. I don't know if it's going to be a Thunderbots. Probably not Thunderbots. Fantastic Four may work. I know the original film didn't necessarily blow anyone away, but again, things happen over time. But I really think Lilo and Stitch is going to really impress a lot of people. The trailer looks great, and there's no controversy with the movie. Everyone seems to be happy that it's happening, and there's a lot of emphasis on what's happening with the Lilo and Stitch as a character popularizing in the theme parks again. I think Disney will do well in the theatrical box office despite its slow start through the first 3 months of the year.
So I might be showing my age here, but in fools, I'd be curious in the Q&A, let me know. But if there's anybody else listening to Rick run down those movies and thinking, man, this is why I never go to the movies anymore. I was like, I don't know. Come on. We can do better than this. Was there anything you named that wasn't a sequel or a continuation or a remake or something? But,
Well, again, so this is the thing, Lou. Hear me out here, okay? I understand where you're coming from, but these sequels are what is considered the sure thing. Obviously, you're going to.
I know, but are they?
The first Avatar movie became a blockbuster. The first one of all these movies that had sequels was a blockbuster as an original property. There is a new Pixar movie coming out, Elio. So there are things happening that could actually be that one thing that just breaks through. Thunderbots is also a new Marvel sort of cinematic universe kind of property that's happening. So, but again, the easiest bets are the stuff that a lot of people are going to watch Mission Impossible. Jurassic World always draws a big crowd. It is what it is. So I get it. I love to see original content. I don't just want to see a story I've seen grow tired. You see franchises sometimes push too far. Maybe Captain America pushed it too far with this 4th or 5th film, whatever this was in the series. But yeah, I do think that I agree. But I get excited about all these movies. Sorry, Lou.
Yeah, no, it's fine. It's fine. I won't even talk about the fact I can't believe that was only half a Wicked. Because the first one was 3.5 hours, right? So, but anyway, but that's again, but this is bold predictions, not old men complaining about things. Rick, I will tell you,
define gravity of our islands to stay awake for 3.5 hours.
Yes, there you go. That is the action adventure. Rick, I'll tell you, you made a compelling case, and you made it with Avatar, I think, and I think that might be the winner, but I'm voting no here for one simple reason. I may not like the guy, but I'm not voting. I'm not betting against that last Mission Impossible. There's just that franchise in the way, especially. I mean, you didn't really say, but did you mean U.S. or international box office?
No, international.
International, just worldwide.
Actually, no. Let's go domestic because there's like a Chinese movie that came out that's already topped $1 billion.
Gotcha. Okay.
So and to be more specific. Last year, just 2 movies topped $1 billion, and that was Inside Out 2 and
fantastic movie. That sequel I liked. All right, anyway, so but the international POK. If we're only talking U.S. box, maybe, but still, Tom Cruise lifts his hand and people hand him money.
Yeah, and he looks younger every year. I don't know how that happens. So
I mean, it's just like with us.
And he does his own stunts like we do here on the Bold Prediction Show.
Yeah. I don't even sit here and sit on my own. Yeah. All right. We are 50. I made a compelling case. Nobody bets against Tom Cruise. We are 55%. I disagree. I do not see the creative. We got to find out. Some of these last second votes might be coming in from Chicago. Do we think that's going on here?
This is like when you're on eBay and you think you're about to get the product, and sniping, what they call on eBay, when somebody just would go in and just take the last second and break your heart, and you don't get that collectible you wanted. But right now it's even.
It's even, and kudos to Rick because no one needed more information, so you did a good job making the case. Yeah, and look, I get it with the sequels and stuff, but I don't know. Try a little harder, Hollywood. All right. Because look, I mean, that's the same reason that nobody probably wanted to do Harry Potter back in the day, because it was different. And I don't know. I mean, this is why Netflix gets all the cool stuff, because they're willing to throw money against the wall and see if it is. experiment a little, will you?
J.K. Rowling just kept writing the books. They had to keep making the movies, and one of them they split into two, like they did with Wicked. So yeah,
Yeah.
Hollywood.
All right, should we move on? Fools, please do. Like a full 24 on the Slido. Let us know what's going on here. We can't have ties. So we just need one more person to log on and vote just to make sure we don't get a tie again. So, and
I'm not wearing a tie, so
no. I sold all mine last year, so it's good. It's good. All right, my next prediction is probably my kind of most blah, but it wouldn't have felt that way a couple of days ago. We've had 2 okay days the last few days, but despite all the drama, despite all of the multi-boxes going up on non-full 24 financial news streaming, looking at you, CNBC, despite all the talk of crisis and corrections and declines and chaos, I think the S&P 500 is going to finish the year green, and solidly so. I went with 7% just because that's the long-term average, but I am going to call it right now, timestamp, the S&P, for all the drama we're experiencing, it's only March, Rick, and we are going to have an up year. And I'm going to explain to you why. Yes, it's been gloomy. Even with the recent rallies, S&P is still slightly off. So even like the last few days, we haven't necessarily caught up. But Rick, I'm convinced the sky isn't falling. In fact, I said like a week ago, and I still stand by it, I think I would argue at this point, the data is way, way, way better than what the stocks have been doing, that the stock market has overshot the data. Now, of course, it could be, Lou, you just hold on, because the data is going to increasingly get worse and prove the stock market is right. But I actually believe that the economy is still okay. What I think is going on here isn't a reflection of a real slowdown in the economy. It's that confidence thing. It's just the chaos of everything, good or bad, coming out of Washington. There's just a lot going on right now. And in times of just change, we all tend to do less. So this can be a temporary thing. I think good management, and I think by and large, the S&P 500 is full of good managers. I think good management you tell them the rules of the game, they can play hard and they can win the game. All right. Right now, they're waiting to hear the rules, and that's why it's slowed down. But I do think that this prediction is basically that the dust will eventually settle, that the last few weeks, tariff on, tariff off, whatever else, this is kind of the getting comfortable or getting in period, and we are going to settle, and things will get more business as usual out of Washington. CEOs will know the rules, consumers will know the rules, and we can once again focus on how actual businesses are doing. And again, I think we're actually still okay here. So where does it all end up? It ends up maybe not another 25% year because there is all this chaos, but I think we are solidly green in December, and we're pretty happy that we were in stocks this year. That shouldn't feel bold, but it does.
It feels bold to me, Lou, because again, so the S&P 500 is down almost 2% even after rallying the last couple of days. So you're basically saying the next 9 months we're going to get a 9% gain, which I think most investors would love. Basically averaging out to a 12% gain over the course of a year based on the next 9 months. But to me, again, I get it. I get what you're saying. The economy is holding up better than we think. We see some negative consumer confidence levels. We see a lot of disarray and disharmony in general. We see the tariff war. It was April 2nd the day, or is that the can gonna get kicked again? All these things that are happening, and once those things are cleared, I can see where they could be a big sigh of relief, and everyone say, okay, we can go back. Inflation, egg prices are dropping again, so hooray, and everything's gonna be cozier. And then the Fed could say, all right, yeah, we'll go. Inflation's under check. We can start lowering rates, and everything that we were waiting to happen last year starts happening, by the second half of this year. I can see that happening. But I'm gonna agree with you. I'm gonna agree with you, even though just in the poll's sake, for the poll's sake, just because I think I have to be an optimist. But I think 9% in the next 9 months is definitely better than you'd be getting just about most fixed income investments at this point. So I did go with yes. I think it can happen, and I think you're right. But I don't think the skies are as clear as you think they are, just because the economic numbers are holding up and the employment numbers are in check, and everything is there's still some grumbling out there, and I don't know
definitely
what will fully end. But yeah, I think it's a great call. I think 7%. That's you're like an odds booker, like a bookie. You have that spread right there. 7% is kind of like that great line, like.
Right. And that is the long-term average, right? Yeah. No, I intentionally didn't go 20.
Yeah.
I would point out to you that at 9% would, from here is still less than half what we did the last couple of years. So it's not undoable. Yeah. Fools, real quick. There was a quick technical error with the with the poll as far as what it said. I think it was Viking. So if you can edit your response down at the bottom if need be, but get your votes in. The thing is, and I love that you said that, optimist, because this is why, and I mean, 1 year or even 9 months now at this point isn't really long-term investing. But the reason that we are long-term investors is that we are, I think I can speak for here, we are bullish on ingenuity, on businesses kind of making improvements and making things work. And this, again, I mean, there are times when, 2008, stocks went down because of the economy. It happens sometimes, right? That's definitely what happened. I just don't see an economy out there. We are more stressed than we were a few years ago, without doubt. We are not maybe trending in the right direction, but things have not fallen in the real economy the way they have fallen in the stock market. And I do believe, and maybe it's a desperate plea for the dust to settle, but I do believe that if and when that dust does settle, I do think that just great companies can go about navigating through maybe a tiny bit weaker economy, but still fine, and they can figure out how to get gains from here. I think that is the smart bet to do, is to bet on optimism instead of bet on continued doom and gloom.
Yeah.
We'll see.
We're not alone in optimism right now. It's 75% in favor of the S&P 500 going up at least 7%. And again, so we started the show with 2 buyout predictions of companies that were bought out in 18 and 36 months. But that was also optimistic. It wasn't like, oh, buy these companies, please, someone take these companies for sale. We think they're both going to get bought out at healthy premiums because they are disruptive and have something to offer. The companies that would buy them out. It's not an SOS. It's more, I don't know what the right acronym, but it's not SOS at least. So yeah.
It's Jeff Mulvaney in the comments made a good point too that I meant to get to, is that even if the dust doesn't settle the way I hope it does, there's still a case to be made that over time we will adjust to this and get less freaked out by it. Every time. And so maybe there's less of a reaction, we become a bit numb to it. I think there's a case for that. Jeff, I'll tell you, my biggest fear there is that I don't necessarily think they're bluffs this time. I do think it is sort of the quote unquote new world order. So I think they may be stickier than we think, which I'm talking against myself. But again, I think even in a high tariff environment over time, whether or not I would tell you it's a good thing or a bad thing, but there's other YouTube streams for that. We don't have to get into the political thing of it, but I do think that throw a situation at a good CEO and he or she will figure out what to do with it. They just need to know that these are the ground rules we're playing by.
Yeah, and you don't have to talk politics again. Even in whether it's the right or the left or even the center, taking things. Stock market finds a way to appreciate. Companies are still doing pro-business things, and they're thinking about how can we get better at our operations. That's their focus driven. They want to increase shareholder returns, regardless of what the political and economic climate may be. And this optimism is contagious.
We are down to a minute, but don't close this mic because I'm going to insist. Whoever's out there, I need more information. No, you don't. You're an investor. You're an investor. We're not going to grade you on this. I'm the only one who can grade on this. So come on, let's do it. We don't need you. You're an investor. You're thinking about this stuff. So I need more information here. Yes or no? Up or down? And Rick, if it's you, I apologize. No,
I agree with you. I'm in the 75%.
Yeah.
But you sound like a PBS pledge drive. Like please keep us on the air, and we'll donate this, Jerry Lewis book or something. I don't know what they're giving away these days.
Better yet, keep your vote as I need more information and just send me $20. I like that better.
Yeah.
But you can click on the poll tab, edit responses right there. It's starting to work against me now because I think the audience is going to turn on me now, but come on, we can do this. We can do this, fools.
The last vote you attracted went against you, but you're still obviously clearly in the lead with this. And again, it will be nice to see the market end. Again, it will be just 7%, but based on where we were just like 2 weeks ago, when it thought this would be another repeat of maybe 2022 or some other dreadful year in the past. Isn't scary checking your stock quotes the last couple of days. Not that will stick, but yeah, I think things will find a way. Stocks will find a way to keep climbing. Definitely in the long haul. 9 months is sort of a short-term bet for us fools, but if I have to vote, I'm with you on this.
And here's the homework as we close this up for you, 67% especially, but for everybody. Let's remember this as we invest and as we have more days that things might not go our way, that if it's deeply red, let's remember this conversation, this mindset, because honestly, we should be looking well past 9 months ahead, but let's keep that in mind and not focus on the day-to-day down, as hard as that is. All right, let's close this up, Mike. I failed to I failed to get it, but we did get a solid 67%. And Rick, I'm usually wrong. So if the voter who said I need more information, I could be wrong. Maybe you do. So come on, get in there. Let us know, because then we can do quality improvement. But yeah.
And and now we return to Antique Roadshow or whatever PBS would be airing at this point. So.
Send me money. All right. This is why they never ask me back, Rick.
But you're back, and I'm back. So we find we're like the market. You can't shoot us down. We find a way to persevere and grow through the thick. So I have one more. I guess we each have one more bold prediction. So this one I know is going to be controversial because Lou, we talked about this back on Valentine's Day that I called Celsius sort of like a heartbreaker, and I know that you were not kind to Celsius. This is so my prediction is that Celsius will beat the market in the next 365 days. I want to say in the next year, but I wanted to be more explicit, like from March 25th, 2025, all the way to March 25th, 2026, a year from now. So I wanted to spell it out that it'll beat the market. So let's get a little. First, let's start with a little background on Celsius. Celsius Holdings is a company that they make Celsius, the popular energy drink, or at least maybe not so popular these days. But this is a company with these little cans. They promise thermogenics, which is a combination of a lot of things, and it's all there on the. It's not a secret ingredient or anything that will increase your metabolism. It increases your metabolism by safely increasing your body temperature just by 1% or 0.5% or 2%, and that helps you burn fat and burn calories quicker. So the theory is if you drink it and then you go out for a walk or you walk the dog or you're actually going to a gym. It's gonna provide more results than just if you were just gonna do the exercise on its own. And so initially it became very popular in vitamin stores like the GNCs of the world and gyms. A lot of fitness centers would sell Celsius. They still do. But then it just became popular. And before you know it, you'd see it at Target, you see it at supermarkets, you see it at drugstores, you see it at gas stations. Odds are, if you walk into most places that have canned beverages and they have energy drinks, they're gonna have Monster. They're probably gonna have Red Bull, and if they have a third one, it's gonna be a Celsius can. It's an entirely different market than the energy drink market, specifically by a Monster and Red Bull. And but the product works. And for 3 years in a row, till 2023, it provided triple-digit growth, so more than 100% growth for 3 years in a row. You don't see that very often for a company that's been around for decades and on a strong base of sales. But that's what happened during this whole, when retailers are just stocking up on the stuff. PepsiCo came in 2 years ago, 2.5 years ago at this point, and became a minority stakeholder and agreed to be their national distributor and opened up some international opportunities. Everything was going great until PepsiCo started paring back on their orders. And initially they were saying, Celsius was saying, no, we're just trying to right size this. They had overextended their hand. But again, it was really, you had to be cautious as an investor thinking, is it really that, or just people not buying it at the end level? And that's why they're sort of paring back on the inventory that Pepsi is distributing. They collect the revenue when it's actually passed on to the distributor, not when it's sold at the end